So hi guys, welcome to financial management marathon revision classes, which are absolutely useful for May attempt and even November examinations as well. See, unless the financial management syllabus changes, this marathon can be used for any attempt. Why? Because we have covered it comprehensively for 12 hours. By the way, the faculty dealing with is our Sreshta faculty, Samba Shiva sir. So this marathon covers not very in depth like a regular course, but I can tell you, believe me, you will get a very good clarity. Already Samba sir's GST class and income tax class was already uploaded. GST class has got more than 25, it's nearing 25,000 views hardly within 10-15 days of uploading. Okay, so now this is financial management. Sir is a gem faculty in financial management, teaching from past 8 to 9 years. So what are the topics that he is covering? So he is covering investment decisions, time value of money, leverages, capital structure, cost of capital, and investment decisions, working capital, and of course even one or two more chapters were there which I missed probably. So almost 11 and after 12 hours. Even the timestamps were given below the description of this video. That below the description of the video, timestamps were also given. You click on the timestamp, you go to the respective chapter. And by the way, who are we? We are Sreshta for CA and CMA Institute, okay, which is completely a digital based platform, a complete digital platform, exclusive digital platform for CA Into, that exclusively, where all 8 subjects were taught exclusively in English. And you know what? We already uploaded, we are the only institute from South India who have uploaded 8 subjects marathons on only our YouTube channel, CA Harsha. Getting it? We have uploaded all the 8 subjects marathon. Group 1, all the 4 subjects we have uploaded. Group 2, all the 4 subjects we have uploaded. Minimum in each subjects we covered at least 70 marks portion in each subject. Minimum weightage chapters that we covered as part of marathon in each subject is 70. Like accounts we covered 80 marks, GST income tax we covered close to 80 marks weightage. Like all the chapters we covered. So where can we find all these particular videos? Go to CA Harsha YouTube channel where you're watching this, open playlist. In that CA Inter Marathon playlist you will be finding. Inside that you'll find all the marathons. Even if at all any amendment was added, that is also added here, newly added amendments. Getting it? But of course these marathons are, by the way, recorded in the month of April 2022. All the subjects were recorded in April 2022 except my subject auditing of CA Inter, which is recorded 1 year ago. Even that is useful for May and November attempt as well. Getting it? So remaining 7 subjects were newly recorded exclusively from May 2022 examination onwards. So imagine, they are all already amended marathons, amended classes. So kindly have a nice time. By the way, the faculty uses material. In all our marathons we used material. Some materials we used, some notes, some reference books we have used, where you can download all that PDF content. Open this rest of a CA and CMA application. Similar to this, a logo will appear. Getting it? A similar logo will appear on the Play Store. Rest of a CA and CMA. The moment you type rest of a CA CMA, we are the only institute with that name. Getting it? So open that, login. Inside that main menu, materials will be there. In that main material, solutions and running notes is all that were available. So whatever Samba Shiva sir uses running notes or main material, that is also there in this application. So why late? Start watching. Believe me, you get a kind of clarity like never before. See, these marathons are only for those who already finished a regular coaching. Getting it? Who are just waiting for revision and then going and writing for the examination. For them only these marathons will help a lot. If at all you want to prepare from scratch from the marathon, don't do that risk. That's not an improper learning. Okay, sir, that's not a proper learning. It's completely an inappropriate way of learning. That's not right. Don't risk your attempt by just believing only on marathon lectures. Always a formal learning is formal learning, but for whom these marathons give best output? You already gone through coaching somewhere, any institute, whatever the matter. Now you might be having some doubts in various concepts. Through these marathons, by covering various concepts in these marathons, I'm telling you, many of your doubts will be rectified. That's for sure. Okay, and share your feedback after listening to this marathon below in the comments section. Thank you. Have a nice time. Share it to your friends as well. It'll be very useful for them. All the best. Thank you. And sir will continue, by the way, sir will continue with the entire financial management marathon. Economics already uploaded, paper 6 auditing already uploaded, paper 5 advanced accounting is uploaded, EASSM is already available in the playlist. And group 1 accounts, group 2, group 1 law, company law, other law, both together we uploaded till date for 65 to 70 marks weightage. Almost 18 hours we uploaded for law paper. Costing we uploaded for some 14 to 15, 16 hours. Taxation we uploaded close to 20 to 24 hours. So we are the only one who uploaded 150 hours close to. So why late? Enjoy.
A very good morning, students. Welcome to the FM marathon classes for May 2022 exams, right? So in this marathon classes, we are going to discuss about all the theory and formulae, all the important points, right? We need to keep in mind while doing the problems. Okay, ma'am. So FM, as you all know, that it's part of the paper number 8, financial management and economics for finance, right? So in which part A you will be having financial management for 60 marks. And then part B you will be having economics for finance for 40 marks. Okay, sir. And in the financial management, total 60 marks portion, out of which the problematic portion is around 45 to 50 marks, and the theory portion is for 10 to 15 marks. So if the problematic portion is given for 45 marks, theory you will get for 15 marks. If the problems is given for 50 marks, theory you will get for 10 marks. Right, sir? So now let's see the list of the chapters for problematic portion. So you'll be having first chapter as time value of money. Time value of money chapter is not actually an exclusive chapter in financial management portion, right, sir? You don't find this chapter called time value of money in ICI study materials. This time value of money, these all the provisions were discussed in the chapter investment decisions as a topic. But in our academy, we are discussing the time value of money as an exclusive chapter, because time value of money provisions are very, very important for doing the problems in other chapters. Without having the knowledge of time value of money principles, you cannot do the problems in other chapters. So that's why we are discussing the time value of money as an exclusive chapter. Okay, now, it's because when you're strong in fundamentals, then doing the remaining chapters problems are very easy. Clear? Next, so time value of money, there won't be any question directly from this chapter, because as this is not a chapter as per ICI study material, but this is very, very important for doing the problems of other chapters. Okay, now next, then after that, the most important chapter, investment decisions. It's actually a very lengthy chapter, sir. Investment decisions, very lengthy chapter, and that's why I've converted these investment decisions chapter into the three parts. Number 1, investment decisions. Number 2, advanced concepts in investment decisions. And number 3, risk analysis in investment decisions. So totally you will be having 3 parts, same chapter. Only because of the lengthiness of the chapter, I've converted them into the 3 parts. First part, investment decisions, you're going to learn all the basics of investment decisions. And here in this part, you're going to discuss about the advanced concepts like replacement decisions, NPV, IRR, conflicts, these advanced concepts. And the third one, this is final level topic, risk analysis in capital budgeting decision. It's actually a final level topic, but recently, since last 3-4 attempts, this chapter becomes the part of CA intermediate. So we are discussing. Are you following, sir? Right. So technically speaking, all these 3 chapters are single chapter. Investment decisions, advanced concepts in investment decisions, and risk analysis in capital budgeting decisions. Capital budgeting decisions and investment decisions are okkate. The other name of investment decisions is a capital budgeting decisions. Are you following, sir? Right. So investment decisions, as I said, it's a very important chapter. You'll definitely get 1 question from this chapter for 8 marks. In every examination attempt, you'll definitely have a question from this chapter for 8 marks. Next, after that, cost of capital, then capital structure, leverages, advanced concepts in investment decisions, working capital management, yet another very, very important chapter, where you will get one question compulsory for 8 marks. Then ratios analysis, yet another very important chapter. One question compulsory for 8 marks. And then risk analysis in capital budgeting decisions, dividend decisions analysis, dividend decisions analysis. Okay, mom, every one of you. So these are the 10 chapters we are having in the CA intermediate level for the problematic portion. Clear. Now, among these, the most important chapters I've already listed out: investment decisions, and then ratio analysis, and then working capital management. In every exam attempt, definitely you will get one question each from these 3 chapters. So 24 marks question paper is already leaked. Yes or no? And then these 2 new topics were introduced recently, means 2 years back, risk analysis in capital budgeting decisions and dividend decisions analysis. In every chapter, you will get at least one problem. So 5 marks, 5 marks, 10 marks. So totally 34 marks, the question paper leaks. Now coming to the theory portion, mainly scope and objectives of financial management and types of financing. These 2 are the very important theory chapters. Among the theory weightage of 10 to 15 marks, from these 2 chapters, you will get a minimum of 10 marks. You will get a minimum of 10 marks. So 34 plus 10, 44 marks. 44 marks, the question paper is already leaked. Yes or no? So like this, you plan accordingly and prepare for financial management. Every one of you. Right, sir? Okay, now without wasting of the time, we will move into the very first chapter, that is the time value of money. Okay, sir. So time value of money, chapter number 1. I'm going to start this topic with the question: what happens to the value of money with the passage of the time, whether it increases or decreases? So with the passage of the time, as the time passing on, what happens to the value of the money, whether the money value increases or decreases? The value of money increases or decreases? The answer is the value of money increases and as well as decreases. So from which point of view you are discussing? Are you discussing from monetary value point of view or real value of point of view? If you are discussing from monetary value point of view, the monetary value of the money increases as the time passing on. Right, sir? Best example I've given here, interest. And from the real value money point of view, in real terms, while you're talking in a real terms, the value of money decreases because of the inflation. Of course, at CA intermediate level, we are going to discuss about only one angle. This is from monetary value point of view. Real terms point of view, we are going to discuss at a CA final level, not at a CA intermediate level. Right, ma? So financial management at CA inter level is only for 60 marks, but at CA final level, it will be called as SFM, strategic and financial management, and where you will be having for 100 marks. Right, sir? Next. Right. So while the time is passing on, the value of the money increases. Why? So I've given an example here. Suppose that on 12th of February 2021, I've taken a loan from you. 1 lakh. And I promise you to repay exactly after 1 year. So you've given me 1 lakh to me. Now, after 1 year, I came to you for repayment. Now, if I repay you 1 lakh only, will you accept? No, you won't accept, because you expect more than 1 lakh from me. You will expect definitely more than 1 lakh from me. But why? See, how much you given to me? 1 lakh. So how much I need to repay you? 1 lakh only. But sir, you're not repaying me immediately, right? You are repaying me after 1 year. So what, ma? After 1 year, what happens? Sir, as the time passes on, the value of money increases. No. How it is increases? Sir, okay, sir. I'll give you examples. Sir, had I been given this 1 lakh, right, to a company, means had I been invested this 1 lakh into the company shares, and after the 1 year, I would have received dividend, no? Yes or no? Had I been invested this 1 lakh into gold, I would have received some gain out of it. Had I been invested this 1 lakh into any fixed deposit or savings deposits into a bank, after 1 year, I would have received interest now. Right, sir? Opportunity cost. Opportunity cost. Right? So now, because that I am giving the money to you, I'm losing this opportunity cost. So compensate me. Clear? See, if I give the amount to you today and you're repaying me tomorrow, the gap is just 1 day. So for that 1 day, I don't expect anything from you. If I give you the money today, after 1 week, you are repaying to me. For that 1 week, I don't expect anything from you. It's enough to pay the same amount of 1 lakh. But after 1 year, you are repaying to me. 1 year. Within this 1 year, a lot was happened. Clear? Right? So even if I deposit this 1 lakh into a bank where the banker offering me some 8% rate of interest, so I would have received 8,000 as interest. 8,000 as interest. So if you're repaying me 1 lakh only to me, that 8,000 is my opportunity cost. It will be a loss to me. Yes or no? Right? So the value of money increased by this 1 year. Next, inflation is one more reason. Like, sir, actually, I thought of purchasing gold at the time when you asked money to me. Money, right? At that time, for every 10 grams of gold, it is 50,000 rupees. So means if I purchase the gold at that time, I would have purchased some 20 grams. But now after 1 year, 10 grams of gold now becomes 65,000 rupees. That means with the same amount of the 1 lakh, now I am able to purchase hardly 15 grams. Earlier, before 1 year, I was able to purchase 20 grams. But now I'm able to purchase only 15 grams. 15 grams, the value, the prices of the gold increased. So this 5 grams of gold difference is a loss to me. Inflation, because of the inflation, rise in prices, right? Next, risk. Risk. Sir, if I given you money to you today, and if you are repaying me tomorrow, the risk is very less. If I given you the money today, and if you're repaying me to me after 1 week, the risk is very less. But you promise me to pay after 1 year, 365 days. The risk is very high, sir. Because within this 365 days, I can't do anything. Like whatever the promise I made, I might ignore that promise. I might fly to US and settle there itself. I might die, who knows? There is a risk of death also. 365 days, I will be alive. What is the guarantee? What is the guarantee? Nowadays, there is no guarantee even for 5 minutes. When I was traveled by train, there was one person who stand besides the entry, right? Entry door, exit door. And all of a sudden, he slipped his grip and he fell down from the running train and he died on the spot. So before 5 minutes, to whom I had a chit chat, after 5 minutes, he was not there. He was died. So there is no guarantee to the life. 365 days. How will I have a confidence on you? How will I believe you that you will be survived for this 365 days? If within this 365 days, if you die, whom will I ask the money? So risk is there. So whenever you are taking the risk, you will expect some returns. Next, satisfaction of the wants, sacrification of the wants. Sir, if I had not given the money to you, I would have purchased the gold, right? Now, because of you, 1 year, I'm sacrificing my want of purchasing a gold. Now, because of all these, you will expect something additional amount from me for opportunity cost, inflation, risk element, sacrification of the wants, right, sir? You will expect some additional amount from me, and that additional amount is what we call interest here. Okay, now, and there are 2 methods available for the calculation of the interest. Number 1, simple interest, and number 2, compounding interest. First, look at the simple interest example. So as on today, that means in Y0, I've deposited an amount of 1,000 rupees and the banker is offering me rate of interest at the rate of 10%. Rate of interest at the rate of 10%. So that means after 1 year, I'll get an interest of rupees 100. Right, sir? Now, at the end of the first year, the amount becomes 1100 rupees. Now, second year also, I'll get the interest at the rate of 10%, but not on 1100. When it comes to simple interest, the interest is always on principal portion. Thank you. The interest is always on principal portion. You don't get interest on interest when it comes to simple interest method. So what is your principal? 1,000 rupees into rate of interest 10%. So even for the second year, you will get 100 rupees. So at the end of the second year, the amount becomes 1,200 rupees. Now third year interest, again same. You will get interest only on principal portion, 1,000 into 10%, 100 rupees. Totally 1,300 rupees you're going to receive at the end of the third year. So third year, you are withdrawing the money. So how much you are going to withdraw? 1,300 rupees. So 1,000 rupees is your principal portion, and whatever the additional 300 you are getting, that is called interest. Okay, now how to calculate this interest and amount with the help of the formula? Look at here, simplest formula, simple interest formula, PNR. This the formula you might have learned in your childhood days in your 5th class or 6th class. Simple interest is equal to PNR. P stands for principal, N stands for number of years, and R stands for rate of interest. R stands for rate of interest. Okay, now. So now apply the formula into our example. Simple interest is equal to PNR. Principal 1,000 rupees. You deposited 1,000 rupees at the beginning of the year 0. And you maintain this deposit for 3 years. Number of years, 3 years. And the bank offered 10% rate of interest. So you'll get my simple interest is equal to 300 rupees. Got it now? How much simple interest you got? 300 rupees. Now, while calculating the formula, amount is equal to, that means the amount which you are going to get at the end of the third year. The amount which you are going to get at the end of the third year. How much you are getting? 1,300 rupees, which includes your principal portion and as well as your interest portion. P plus I. Now, principal portion P plus I, that means simple interest. Just now we have learned a formula PNR. So I place low, write down the PNR. So P into P plus PNR. Take the P as common. Now the formula become amount is equal to P into 1 plus NR. Amount is equal to P into 1 plus NR. That's the formula for the amount. Now apply the example. Principal 1,000 rupees into 1 plus NR. N stands for number of years. R stands for rate of interest. 3 into rate of interest and the 10%. When you convert into decimals, 0.1. Clear. Now 1,000 into 1.3, then you'll get an amount of 1,300 rupees. So this is how we need to calculate the simple interest. Clear now. But from examination point of view, you don't have this concept of simple interest. From examination point of view, interest means compounding interest only. Compounding interest only. So only for your general knowledge purposes, I've explained you about the concept of simple interest. Only for your general knowledge purposes. Every one of you cleared now. Next, coming to compounding interest. Right, sir? So from here onwards, whenever I'm talking about interest, it means compounding interest. It means what, Amma? Compounding interest. Clear? Now look at here. Same example I'm continuing. In Y0, I have a deposit of 1,000 rupees. Y1 interest at the end of the first year, I'm going to get interest at the rate of 10%, 100 rupees, amount 1,100. Now, second year, interest at the rate of 10%, 110 rupees. Look at here, I got an interest of 110 rupees. How would I got this? At the end of the first year, my amount is 1,100 into 10%, 110 rupees. Or you can also calculate it this way. On principal portion, 1,000 into 10%, plus on interest portion also, you will get interest. 100 into 10%. So you will get 110 rupees. Are you following, sir? So compounding means interest on interest. Compounding means interest on interest. See here, in the simple interest concept, at the end of the second year, you got only 100 rupees interest. So in the simple interest, you will get interest only in principal, only on principal. But whereas in compounding interest concept, you will get the interest on principal and as well as interest also. Okay, now look at the year 3. At the end of the year 3, you have an amount of, sorry, at the end of the year 2, you have an amount of 1,210 rupees. And for year 3 interest, it will come how much, Amma? 1,210 into 10 percentage, 121 rupees. Clear, sir? Or we can calculate in this way also. First, just a second, sir. So under compounding interest, we will get the interest on principal portion. So 1,000 into 10 percentage, 100 rupees plus on first year interest. Sorry. Yeah. Into 10 percentage, 10 rupees on second year interest. Second year, how much interest you got, Amma? 110 rupees into 10 percentage, 11 rupees. So all put together for the year 3, you will get, Amma, 121 rupees. Got it? Every one of you. 121 rupees. Clear, sir? So like that also you can find out. So totally at the end of the year 3, you got an amount of 1,331. So in which the principal portion is 1,000 and interest portion is 331 rupees. So you can see here, when it comes to the simple interest method, you got only an interest of 300. But whereas when it comes to the compounding interest method, you got an interest of 331 rupees. Clear? So under compounding interest method, you will get more interest than simple interest. Clear? So complete, ma? Right. Now, let us find out the formula for the calculation of the interest and as well as amount under compounding interest model. Now look at the first amount, sir. The formula is P into 1 plus R whole power N. Right, sir? So amount P stands for principal portion. 1,000 rupees we made a deposit into 1 plus R whole power N. This is a compounding interest, more compounding, no? So we need to make a compounding here. Whole power 1 plus R, 1 plus R. So 1 plus 0.1, rate of interest 0.1, 10%. When you convert into the decimals, it becomes 0.1 whole power N. Right, sir? So whole power 3. N stands for number of years. 3 years, no? 3 years compounding you have to take into account. So 1,000 rupees is the principal portion into 1.1 whole power 3. So 1,000 rupees into 1.331, you will get the amount 1,331. Got it now? Right. So at the end of the third year, you are going to get an amount of 1,331 rupees. Next, compounding interest formula. See, if you want to get an interest portion, so deduct your amount portion from the principal, you will get the interest. Are you following, sir? Every one of you. Right. So here, amount minus principal will give you compounding interest. You have invested 1,000 rupees. At the end of the year, you got a 1,331 rupees. So 331 you are additionally getting, and this additional amount is interest. So this is your amount at the end of the third year, from which you are deducting principal portion. So A minus P. Amount formula, we know it already. P into 1 plus R whole power N. Right? In the place of the amount, write the formula minus P. Minus P, same as it is continue, minus P. Now take the P as common. So now the formula will be P into 1 plus R whole power N minus 1. Right, sir? So this is the formula for the compounding interest. Now apply the values. So principal portion 1,000 into 1 plus R whole power N, 1.1 whole power 3 minus 1. So 1,000 is the principal portion into 1.331 is the compounding factor minus 1. So 1,000 into 0.331. So compounding interest 331 rupees. Clear now? So this is how we need to calculate the compounding interest. Clear, sir? Every one of you? Now look at here. You have the basic introduction and everything regarding the time value of money, right? And here you have some golden principles, like the basic concept in finance is time value of money, which means that 1 rupee today is not equal to 1 rupee tomorrow, other things being equal. Right, sir? The time value of money means worth of a rupee received today is different from the worth of a rupee to be received in future. Right, sir? See, if I give you 1 lakh today, or after 2 years, I'll give you 20 lakhs. Which one will you choose? 10 lakhs as on today or 20 lakhs after 2 years? Which one will you choose? If I were you, I will opt for 10 lakhs as on today. At the end of the year, you can wait for 2 more years and you will get the double amount, 20 lakhs. Right. In order to get the double amount of 20 lakhs, I need to wait for 2 more years. I need to wait for 2 more years. But within these 2 years, anything can happen. Risk is there. See, 10 lakhs as on today is certain, guaranteed. But 20 lakhs after 2 years is uncertain, not guaranteed. Risk element is there. Are you following or not? Every one of you, right, sir? And 10 lakhs, today's 10 lakhs value is always greater than after 2 years, 20 lakhs. The worth of 1 rupee today is not equal to worth of 1 rupee tomorrow. Today's 1 rupee value, tomorrow's 1 rupee value is completely different. Are you following or not? Every one of you. Clear? That's the time value of money golden principle. Clear? Next. So methods are models in this chapter, right? Among these total 9 models, we have already completed 2. Simple interest completed already. Compounding interest completed already. Then future value of a single amount, present value of a single amount. Future value of annuity, present value of annuity. Present value of perpetuity, present value of growing perpetuity, and finally effective rate of interest. Okay, now we will discuss all these models in detail. Don't worry. Clear? Now look at this simple interest that I've already explained you with the help of example. Simple interest formula. Simple interest is equal to PNR, and amount formula P into 1 plus NR. Clear? Then after that, model number 2, concept of compounding interest. Amount formula P into 1 plus R whole power n, and compounding interest is equal to P into 1 plus R whole power n minus 1. Okay. Next. Now coming to the model number 3, calculation of future value of a single amount. Calculation of future value of a single amount. Now what is this concept all about? Right. So look at here, sir. Future value of a single amount. Calculating the future value of a present deposit or a present investment. So in this model, we are going to discuss about all about future value. If I deposit 1 lakh today, what will be its value after 10 years? If I invest 10 lakhs in a business today, what will be its value after 5 years? If I deposit some 20 lakhs in a fixed deposit as on today, what will be its value after some 20 years? Right. So we are determining the future value of present deposit. We are determining the future value of present investment. So if I invest as on today, this much amount, if I invest, what will be its value after 10 years? Are you following or not? Every one of you, right? The golden principle. So worth of 1 rupee today is always greater than the worth of 1 rupee tomorrow. We know it already now. So look at this example, sir. So year 0 and Y0, we are making a deposit of some 1 rupee, and the banker offering us 10% rate of interest. 10% rate of interest. So that means after 1 year, what will be its value, ma? 1 rupee is my principal portion. 1 rupee is my principal portion, and the bank are offering me interest at the rate of 10%. So for 1 year, I'll get an interest of 10 pies. So at the end of the 1 year, I'm going to get 1 rupee 10 pies. So if I invest 1 rupee today, after 1 year, I'm going to get 1 rupee 10 pies. So this 1 rupee 10 pies is called future value. Yes or no? Sir, in that scenario, what would be the future value if I invest 100 today? So 100 into 1.1, 110 rupees. So if you invest 100 today, after 1 year, you will get 110 rupees. If I invest 1000 today, 1000 into 1.1. So 1000 into 1.1, 1100 rupees. If I invest 1 lakh today, 1 lakh into 1.1, 1,10,000. So if I invest 1 lakh today, after 1 year, I'll get 1,10,000 as future value. Are you following or not? So what I'm doing, sir? I am doing the present values. These are all my present values. I'm multiplying the present values with future value factor. And that's the formula for the future value. Are you following, sir? So future value of a single amount is equal to present value as on today, whatever the investment you are making, as on today, whatever the deposit you are making, that is what you call a present value, into you're multiplying all this with future value factor. So present value into future value factor is your future value formula, future value single amount formula. Okay, now, and how to determine this future value factor? Nothing but 1 plus r whole power n. 1 plus r whole power n. Are you following, sir? Every one of you, right? That will be your future value factor. You can also write this formula in this manner. Present value, nothing but your principal portion P into future value factor, nothing but 1 plus r whole power n. So present value of a single amount, you can write either present value into future value factors, r percentage n number of years, or you can also write like P into 1 plus r whole power n. Both the formulas are correct. Both the formulas are correct. Okay, now, sir, how to determine this future value factors? How to determine the future value factors? You have two options, ma. One, you can calculate with the help of the calculator, and two, with the help of the factors table. Factor tables means I'll take you there to the factors tables. And here you come. Factor tables, ma. Here table A1 representing the future value of single amount factors. Future value factors. Table A1 representing future value factors. Okay, now suppose that if I given you a combination 10%, 5 years, what is the future value factor? 10%, 5 years. So 10%, 5 years. So yes, this is a factor. For the combination of 10%, 5 years, the future value factor is equal to 1.611. 1.611. Every one of you following now? Right, sir. Next, I'll give you one more combination like 8%, 8 years. 8%, 8 years. What is the future value factors? 8% and 8 years. So the future value factor is 1.851. 1.851. So this is one way of determining the future value factors by using the tables. And there is absolutely no problem that you can bring this table to your examination hall. Absolutely allowed. All these factors tables are allowed into your examination hall. Right? Absolutely no problem. Right? Immediately after entering into your room, just give this factors tables to your invigilator. And whenever there is a need, you can take that factors table from the invigilator. Are you following now? Sir, if in case invigilator objects, then no problem, sir. For every examination center, a practicing chartered accountant will be there in every examination center as an observer. If invigilator objects that factors tables into the room, you can simply go to the chartered accountant observer and you can complain to that observer. Are you following, sir? Every one of you, right? Or else you have one more option, determining these factors by the help of the table. With the help of the table, calculator. How to determine future value factors with the help of calculator? Very simple, sir. Very simple, sir. Suppose that if I ask you for future value factors for the combination 10%, 4 years. 10%, 4 years. Right, sir. Now, every one of you get ready with the calculator. Take the calculators. So ready, ma, with the calculators? And since we are asking for determining the present future value factors for 10%, so enter 1.1 in your calculator. Type 1.1 in your calculator and then press into, then is equal to. Now on your screen, calculator screen, you will be having the factor 1.21. This is your Y2 factor, year 2 factor. Again press is equal to, you will find 1.331 on your screen. This is year 3 factor. Year 3 factor. Let us find out for 10% 5 years. Because here we have the answer, 10% 5 years. Then again press is equal to, then you will have year 4 factor 1.4641. 1.4641. Now then press, every one of you press GT button. GT, grand total, GT button on your calculator. You will have 4.0051 as the factor. Right, sir? This is what? This is the total of year 2, year 3 and year 4 factors. Now you have to add separately year 1 factor and year 5 factor. Year 1 factor and year 5 factor. What is year 1 factor? For the first year, you have a factor of 1.10. For the first year, you have a factor of 1.10. And for year 5, the factor will be 1. For year 5, the factor will be 1. So, for year 1, the factor is 1.1. And for year 5, the factor is 1. You will get it out here. So, why for year 5, the factor is 1? Sir, for year 5, you don't get any interest, sir, because you're making, right? See, because on year 5, just a second, sir. Right. Sorry, ma, I am calculating actually future value annuity factors. Right. Future value annuity factors, but we are in the concept of future value factors only. Future value of annuity factors, this is a process. Sorry, I have just gone into the thought that I'm calculating future value annuity factors, right? So we actually asked for only future value factors, no? So simply future value factors, very simple, ma. Start with the 1.1 in your calculator, every one of you. Start with 1.1, that is your first year factor. Press into, then is equal to. So you will get year 2 factor as 1.21. Then is equal to year 3 factor 1.331. Then press is equal to year 4 factor 1.4641. And then is equal to year 5 factor 1.6105. So you can convert into 611. So year 5 factor, how much am I? 1.611. Get it, everyone? 1.61. That's it. That's it. So 1.1 into is equal to, whenever you press the is equal to button for the first time, that is your second year factor. You always start with the second year factor. Then press is equal to third year, is equal to fourth year, is equal to fifth year. That's it. So 10%, 5 years, the future value factor is 1.611. Get it, everyone? So that is how you can find out with the help of the calculator. Right, sir? Next. And after that, you have the problems for the calculation of future value of deposit, right? With the whatever the theory knowledge I'm giving you, with the help of the theory knowledge, try to solve all the problems. If you get any doubt while solving the problems, you can ask me. Absolutely no problem. Okay. And next, look at this problem number 3. There is an important point. Yeah. Problem number 3. Rupees 4,000 is invested at 10% per annum interest. What is the amount after 3 years if compounding is done annually or semi-annually? So 4,000 we are investing as and today. So this is your present value at 10% rate of interest. R is equal to 10% rate of interest. And what is the amount after 3 years? So n number of years is equal to 3 years. 3 years. Okay, now here you asked to find out the amount after 3 years, the future value of this deposit, the future value of this deposit after 3 years, if the compounding is done annually or semi-annually. Okay, now look at the answer, sir. Calculation of the future value of the deposit after 3 years. If the compounding is done annually, that means yearly once you are getting interest. Yearly once you are getting interest. So given information, deposit as on today 4,000 rupees, the present value of deposit. Then the rate of interest R is equal to 10% per annum. Number of years N is equal to 3 years. N is equal to 3 years. Then future value of deposit is equal to present value into future value factors R percentage and number of years. Okay, present value of deposit 4,000 into future value factor for 10% 3 years. So calculation number, you will get the factor 1.331 into 4,000. So future value of deposit 5,324. So that means in Y0 you are investing 4,000 rupees, and Y3 at the end of the third year you are going to get 5,324. The difference is your interest. Around 1,324 you are getting interest over this 3 years. Okay, now next, sir, what will be the answer if the compounding is done semi-annually? Yearly twice you are getting interest. Yearly twice you are getting interest. 2 times in a year. Now you have to make some changes, like deposit as on today 4,000 rupees. Rate of interest. See, the rate of interest given is 10%. The rate of interest is given 10% per annum. So for 12 months, it is 10%. But I want the rate of interest for every 6 months, because here the compounding is happening for every 6 months. So that means 10 divided by 2, it will be 5% for every 6 months. So the rate of interest now you have to take 5%. Number of time periods N. Sir, yearly 2 times I'm getting interest. Yearly 2 times I'm getting interest. So 3 years, and for every year I'm getting 2 times as interest. 3 into 2, 6 is the number of time periods. So after making these changes, you have to find out the future value of deposit. So future value of deposit is equal to present value into future value factors. So present value as on today we are depositing 4,000 rupees into future value factors for the combination of 5%, 6 time periods. Now 5%, how to find out? With the help of the calculator. Simple ma. 5% kada, you should start with 1.05. You should start with 1.05 into is equal to second year factor is equal to third year is equal to fourth year is equal to fifth year is equal to sixth year. You will get 1.3400956. So that is why I've taken 1.34. So 4,000 into 1.34, 5,360 you will get at the end of the third year. See, sir, here in Y0 we are making an investment of 4,000. At the end of the Y3 we are getting 5,360, and the difference amount is interest, which is 1,360. Here, sir, you can see when compounding is happening annually, your interest amount is 1,324. But when compounding is happening semi-annually, your interest is 1,360. Additional amount you're getting 1,360 when compounding is happening semi-annually, 1,324 when compounding is happening annually. You are getting an additional interest of 36 rupees. That is why as many times as possible, if the compounding is happening, then that much of benefit you will get. Higher the number of times compounding, higher will be interest. Clear? Next. Problem number 4. Now look at the problem number 6. It's completely a different problem, whereby here you'll have Union Bank issues reinvestment certificates for a period of 4 years. If 6,000 is invested in these certificate, their maturity value becomes 7,800. What is the rate of interest if it is compounded every year? So here we provided with number of years information, present value information, and future value information. So even future value information is also given. So what is missing here? Rate of interest, and that rate of interest we are asking to find out. So if we invest 6,000 as on today, after 4 years we are going to get 7,800. Now the question is, at what rate of interest we are getting that amount? So look at here, sir. Problem number 6. 4, 5. I guess that problem number 6 I've given on homework basis at that time. Let me check. No problem. I'll do it right now. Problem number 6. So problem number 6. Now look at whatever the information given to us. So we have the information of present value 4,000, number of years 3 years, and future value how much, sir? 7,800. And present value is also 6,000 rupees. Okay, sir. Every one of you. Now we know the formula. Future value is equal to present value into future value factors, R percentage, and number of years. We know the future value 7,800, and we know the present value 6,000 into future value factors, R percentage we don't know, number of years 3 years. Now future value factors is equal to 7,800 divided by 6,000. Now the future value factors becomes 1.3 now. 7,800 divided by 6,000, 1.3. Now we need to trace this future value factor. We need to trace this future value factor in future value factors table against to 3 years. So come to the future value factors table. Yeah, this is future value factors table. Future value factors table. Against to 3 years, at what rate of interest the factor of 3% is lying. So 3 years now, you have to go horizontally. 1.3 is the factor we are looking for. 1.3, 1.3, 1.3, 1.3. Yes, it is falling in between 9% and 10%. It is falling in between 9% and 10%. Okay, sir. Right? And you can write 10% as your answer. Absolutely no problem. Because we need a factor of 1.3. At 9%, it is 1.29 for you only. It's not 1.3. It is 1.29 for you only. So you can write the answer as 10%. At 10% rate of interest, right? The future value factors lying at 10% rate of interest against to 10 years. So the answer you can write here, the rate of interest offered by the bank is equal to 10%. Okay, now. So look at the answer. Rate of interest is given 7% approximately. Just give me a second. Sorry, Matt, the period is 4 years, no? Number of years, 4 years. I've taken it as 3 years. I'm sorry. Number of years, 4 years. N is equal to 4. So we need to look at the 4th year, ma. Sorry. 3rd year, choosana. So come to the 4th year. Yeah. Go horizontally 4th year. This is a 4th year now. 1.3 is the factor we are looking for. Yes. 1.331 at 7%. The answer is 7%. So rate of interest is 7%. So the bank offering us 7% rate of interest. Clear. So at 7% rate of interest, our present value of investment of 6,000 increase it to 7,800 after 4 years. Clear. That's the answer. So with this concept, we have completed the 3rd model, that is future value of single amount. Okay, now I am winding up the session here. In the next session, I'll start with the remaining models of time value of money. Clear, sir? So till then, have a good day and good night. Stay home and stay safe. A very good morning, students. So welcome to the FM Marathon classes. In the last class, we have started discussion regarding our first chapter, that is time value of money. And we have completed discussion regarding models, simple interest, compounding interest, and then model number 3, calculation of the future value of the single amount. Right, sir? Now time for the model number 4, calculation of present value of a single amount. This model is quite opposite to the last model we have discussed. The last model we have discussed about the future value of a present investment, the future value of a present deposit, right, sir? So for the present value, we have find out the future value. Now, quite opposite. Quite opposite. So we are going to find out the present value of a future investment or a future profits, right, sir? So look at the notes here, running notes. So look at this first example that you having a plan of buying a new mobile phone after 2 years, which costs you 50,000 rupees. So in order to have this 50,000 rupees in your account after 2 years, how much should I invest as on today? Right. So you have a need of 50,000 rupees, but not immediately after 2 years. After 2 years. So in order to have that 50,000 rupees in your bank account after 2 years, so what will be the present investment should I make? Clear. Now, one more example. X Limited issued 10 lakhs worth of debentures as on today, and the redemption period is 10 years. So X Limited knows that at the end of the 10th year, it's going to have a liability of 10 lakhs rupees. These are redeemable debentures. So at the time of redemption period, these debentures should be redeemed. What do you mean by the redemption? Repaying the amount to the debenture holders. So X Limited knows very well that at the end of the 10th year, it will be having 10 lakhs liability. Okay, sir, let it be. It is anyhow after 10 years. No, we will see at the end of the 10th year how we are going to pay. No, that's not a concept of a businessman, successful businessman. Successful businessman always anticipates the future liabilities and he will ready from today, right, to meet that liabilities. So here, in order to have this 10 lakhs rupees at the end of the 10th year, now the company will make investment from now onwards. So how much should I invest as on today in order to have 10 lakhs rupees at the end of the 10th year? So we know the future value, we know the number of years, we will know that rate of interest. So what is missing here? Present value is missing here. So how much should I make investment as on today? How much should I deposit as on today? How much amount should I save as on today in order to have a particular amount at the future? Clear? That is what? Finding out the present value. Clear, sir? So look at here. Example. Sir, at the end of the first year, we are in need of 1 rupee. So we went to the banker. We went to the banker and we asked the banker, okay, banker, in order to have 1 rupee in my account at the end of the first year, how much should I invest right now? What is the rate of interest offered by the bank? 10 rupee, 10 percentage, 10 percentage. So if I want to have rupees 1 rupee at the end of the first year, how much should I deposit as on today? Right? The banker said, okay, sir, you want 1 rupee after 1 year. Yes, sir. And my bank is offering you 10% rate of interest. So as on today in Y0 present terms, as on today, it's enough to deposit some 91 pice, 0.909. If you round it up, 91 pice, 91 pice. So deposit 91 pice as on today. We will give you 10% rate of interest for this 1 year. Now at the end of the first year, your account will be having 1 rupee as balance. So in order to have 100 rupees in my bank after 1 year, then you have to deposit some 90 rupees, 90 paisa as on today. In order to have 1000 rupees at the end of the first year, then 909 rupees. You need to have 909 rupees as on today. You need to deposit 909 rupees as on today. Then at the end of the first year, you can withdraw 1000 rupees. That deposit value will increase us to 1000 at the end of the first year. Clear? Now, what are you doing here? These are all your present value factor. This is your present value factor. You're multiplying this present value factor with your future value. So that means I can write the formula present value of single amount is equal to future value factors, future value into present value factor for the combination R percentage M number of years. So you're multiplying the future value. This is your future value. You're multiplying with present value factors in order to get the present value of the single amount. Yes or no? So that's why present value is equal to future value into present value factors. Clear, sir? Every one of you. Next. So this is a formula I've already mentioned here. And after that, sir, how to determine this present value factors? We know that future value factors is equal to 1 plus r whole power n. Right. Now the present value factors become, there exists inverse relationship between present value factors and future value factors. Are you following, sir? Now the formula becomes 1 divided by 1 plus r whole power n. 1 divided by 1 plus r whole power n. That is your present value factors. Clear, right? So nothing but you can also write present value factors is equal to 1 divided by future value factors, because this is the formula of the future value of factors. So 1 divided by future value factors. Similarly, you can also write future value factors is equal to 1 divided by present value factors. They are reciprocal to each other. Reciprocal to each other. So present value factors and future value factors are reciprocal to each other. Therefore, whenever you are multiplying the present value factors with future value factors, you will get answer 1. When you are multiplying two reciprocal factors, the answer will always be 1. The answer will always be 1. Are you following or not, every one of you? Right. Now, how to determine this present value factors? You have two options. One, you can use the table. We have the table now at the end of the chapter. At the end of the chapter, I've given you the tables. Table number A1 is a future value factors. This we have seen in the last class. And for the present value factors, you need to look to see the table number A3. Table number A3, this is present value factors. Present value factors, table number A3. This is one option you have. The other option you have is you can find out this present value factors with the help of the calculator, and which is quite easy. Quite easy, sir. Suppose that you would like to find out the present value factors for the combination 10%, 5 years. Now, every one of you get ready with the calculators. Every one of you get ready with the calculators. Now, on your calculator, enter 1 divided by 1.1. 1 divided by 1.1. See, when you're finding out the future value factors, you have to multiply. When you're finding out the present value factors, you have to divide. Division. You have to go for the division. Right, sir? You have to go for the division. 1 divided by 1.1. Press the is equal to button. You will have on your screen 0.909. That will be your first year factor. Then press again is equal to 0.826, second year factor, is equal to third year factor, is equal to fourth year factor, is equal to fifth year factor. On your screen, you will be having now 0.6209. This should be rounded up to 0.621. This can be rounded up to 0.621. So present value factors for the combination of 10%, 5 years, you can see 10%, 5 years. Yeah, here you can see the factor 0.629. Got it, everyone? Simple, sir. So 1 divided by 1.1, and we need the present value factor for 5 years. So press the is equal to button for 5 times. Press the is equal to button for 5 times. Then you will get the fifth year factor. Every one of you. Right, sir. And you can do one more example, like some 7%, 8 years. Present value factors for 7%, 8 years. 7%, get ready. 1 divided by 1.07. 1 divided by 1.07. And we need the present value factor for 8th year. Press the is equal to button for 8 times. So 1, 2, 3, 4, 5, 6, 7, 8. Now on your screen, you can find the factor 0.582. Let us cross check 7% and 8th year. You can see 0.582. Got it? So in this manner, you can find out the present value factor very easily. Every one of you. Clear now? So look at here. So present value is equal to future value into present value factors for the given percentage, R percentage, and number of years. Right, sir? And we know the formula future value is equal to present value into future value factors. Clear, right? Then future value is equal to present value into, in the place of future value factors, I can also write 1 plus R whole power n. Now take the present value here, this side, present value is equal to, so take out this side, or else you can also do like this. We write like future value is equal to present value into 1 plus R whole power n. So into 1 plus R whole power n, take this side. So It will be future value divided by 1 plus r whole power n is equal to present value. Now we can also write present value is equal to future value into 1 plus r whole power n. Yes or no? No, that means present value is equal to future value into 1 divided by 1 plus r whole power n, nothing but your present value factors. So this is how this formula was derived. Every one of you. Clear? Next. After that, you have some few theory topics like discounting. Discounting is nothing but the process of elimination of the interest from the future value in order to arrive at the present value. Suppose that you are getting 1,331 rupees, right? You are depositing 1,000 rupees in Y0. After 3 years, you are getting 1,331 where the banker offering you 10% rate of interest. Okay, now. So this is your future value, 1,331. This is your present value, 1,000 rupees. So that means in order to arrive at the present value, what are we doing, sir? The difference is what you call interest, 331 rupees. So present value, if you want to purchase, get the present value, then the formula should be future value minus interest. So 1,331 minus 331, that will give you the present value of 1,000 rupees. Yes or no? So the process of eliminating the interest from future value in order to arrive at the present value is what we call the discounting. Okay, now. And whatever the rate of interest we are using in the discounting process, that rate of interest is called as a discounting rate. So the R rate of interest we are using now, this is what you should call a discounting rate. You have to call it as a discounting rate. Then after that, discounting factor, what is the factor you are using here? That is 1 divided by 1 plus r whole power n. That is what we call a discounting factor. Clear now? So this is the topic of the present value of single amount. Clear, everyone? Okay. And after that, you have some problems. You can do all the problems with the theory knowledge set. Here's the formula for the present value of single amount, right? So future value divided by 1 plus I whole power n. You can also write 1 plus r whole power n. I, rate of interest. You can represent it with I, or you can also represent it with R. So future value divided by 1 plus r whole power n. Clear, sir? Then next, calculation of the amount of the annuity or future value of annuity immediate. So future value of annuity, sir. So look at here, the next model. Future value of annuity. Before going to understand the concept of the future value of annuity, first one should understand the calculation concept of annuity. First, let us try to understand the concept of the annuity. Then we will go for the future value of annuity concept. Okay, now look at here. Annuity means an installment. An installment, right, sir? See, majority of the students is of the opinion that annuity means whatever the amount we are paying every year per annum. That is what we call annuity. Answer is wrong. Wrong answer, sir. Annuity means an installment. That installment can be occurred on annual basis or semi-annual basis, quarterly basis, or monthly basis. So recently I purchased an AC. I purchased an EMIs, monthly installments. Every month I'm going to pay 5,000 rupees as installment. Every month I'm going to pay 5,000 rupees as installment, like that for some 8 months. Right, ma? So from May month till the 8th month, May to December month. May to December month, every month I'm going to pay 5,000 rupees as my EMI for AC. That is an annuity. That is an annuity, right? And I'm having LIC policy, Jeevan Anand policy, 10 lakhs worth policy. Example only I'm taking. Every 6 months, I'm paying 30,000 rupees as premium. Every 6 months. Every one of you. So that is also an annuity. I'm paying since last 10 years. That is also an annuity. And I'm having SIP, SIP, making investments into the mutual funds. Every month from my salary, some 10,000 rupees will be deducted. That is also an annuity. Are you following, sir? Right? So in order to call a particular series of payments or receipts as an annuity, there are some conditions to be satisfied. Like there must be a series of payments or receipts should be occurred at the regular intervals in equal amounts. Then it will be called as an annuity. Clear, ma? Examples: loan repayments in EMIs, LIC premiums, health insurance premiums, and systematic investment plans, SIPs. These are all the best examples for annuities. Clear? Next. Then after that, you have the concept of future value of annuity. Future value of annuity, right? So means, sir, every year I'm depositing an amount of 1 rupee. So year 1, 1 rupee, year 2, 1 rupee, year 3, 1 rupee, year 4, 1 rupee. So like this, 4 years I made investments, or 4 years I made deposits into a bank. Now at the end of the 4th year, what will be my annuities value? Sir, every year you are depositing 1 rupee. Yes. Like that for 4 years. Yes. So means at the end of the 4th year, you are going to have 4 rupees. Only 4 rupees. That's my investment here, 4 rupees. What about interest? So for all these 4 years, I will also get interest now. For all these 4 years, I will also get interest. Clear, right? Now, finding out the future value of these installment is what we call future value of annuity. First of all, you made an annuity here. Every year you are depositing equal amount. Every year you are depositing 1 rupee. So there is a series of payments occurring at the regular intervals. Every year, the gap between the two installments, the gap between the two investments, the gap between the two deposits is 1 year. 1 year. And this is what we call payment interval. Payment interval is nothing but the gap between the two deposits or two investments. Clear? Payment interval 1 year. And like that for you made it for 4 years. This is what we call term of annuity. Number of years kadamma ikkada manam term of annuity antam. Term of annuity 4 years. Term of annuity 4 years. And whatever the equal investment you are making every year, this is what we call periodical payments, PP, periodical payments. The amount of investment you are making every year, the amount of investment you are making every year in equal amounts is what we call periodical payments. Clear now? And here you can see every installment is at the end of the year. Y1 means at the end of the first year. Y2 means end of the second year. Y3 means end of the third year. Y4 means end of the fourth year. Clear now? This is what we call ordinary annuities here. The last installment will be fetch no interest. Last installment will not fetch any interest. No interest, nothing. Because the last installment was happened in Y4. Y4 means what? End of the year 4. That is the last year, end of the year 4. So at the end of the year 4, you made an investment of 1 rupee. On the same day, you are withdrawing the total amount. So that's why the last installment always will not fetch any interest to you. So the last installment future value remains to be same 1 rupee. And whatever the investment you made at the end of the third year, there is a time gap of 1 year. For this 1 year, it will get interest. Assuming 10% is the rate of interest offered by the banker. So 1 rupee for 1 year interest now. So this 1 rupee investment at the end of the fourth year, the value will be 1 rupee 10 paise. And year 2 also you made an investment of 1 rupee, right? Year 2 also you made an investment of 1 rupee. And this year 2 will get interest for 2 years. You will get interest for 2 years. Okay now. So this 1 rupee present value plus 2 years interest. So at the end of the fourth year, its value will be 1.21, 1 rupee 21 paise. And the investment you made at the end of the first year, it will get interest for 3 years. 1, 2, 3. So 1 rupee your present value of investment, add 3 years interest. So at the end of the fourth year, its value will be 1.331. So your future value of annuity 4.641. So means if you are depositing 1 rupee every year, like that for 4 years you are depositing, like that for 4 years you are depositing. At the end of the fourth year, its value will be 4 rupees 64 paise. So means you made an investment of 4 rupees, right? Over the 4 years. End of the fourth year, you are getting 4 rupees 64 paise. The 64 paise will be interest for you. Every one of you following now, right, sir? Next, sir, if I deposit 1,000 every year, so 1,000 into this 4.641. So you will get 4,641 at the end of the fourth year. Sir, if I deposit 1 lakh every year, so 1 lakh is a periodical payment into 4.641. So end of the fourth year, you will get 4,64,100. So you made an investment of 4 lakhs. End of the fourth year, you are getting 4,64,100. So the difference of 64,100 is your interest. So what are you doing, sir? Here, this periodical payments, you are multiplying with the future value of annuity factor, and that will be your answer for future value of annuity. So look at the formula, sir. Future value of annuity is equal to periodical payments into future value of annuity factor. Clear now? Next, here comes a doubt, sir. What is future value of annuity factors? How to determine? Again, you will be having two options, ma. Number one, you can calculate with the help of your tables. Coming to the tables once. In tables, go for the table number A2. Table number A2. This is your future value annuity factors. Future value annuity factors. Table number A2. Okay, now this is one option you have. The other option you will be having with the help of calculators. With the help of calculators also you can find out. Look at ma. So I've given an example here. First example, 10% rate of interest and 4 years is a number of years, a term of annuity. Let us find out the future value of annuity factor. 10% kada. Let us start with the calculator. Every one of you take the calculators, and we are finding out what? Future value annuity factors. Future value. Right, sir? Every one of you. Means multiplication you have to do. So 1.1, start with 1.1, 10% rate of interest. No, 1.1 into is equal to, on your screen you will find second year factor as 1.21. Again is equal to third year factor 1.31. 1.31. Then press GT button, grand total on your screen, GT button. Then you will find 2.541 as a grand total. And what we have done so far is we have added year 2 factor and year 3 factor. We have added year 2 factor and year 3 factor. Okay, now then we need to separately add first year factor, that is 1.1, and we need to add separately fourth year factor 1. Fourth year factor, the last year, as we already know that the last year will not fetch you any interest. The last year will not fetch you any interest. So only 1 rupee. 1 you have to be add. Then you will get how much? 4.641. This is your future value annuity factor for the combination 10% 4 years. 4.641. Get it up? Now let us cross check with the table. 10%. 10% is the rate of interest, and fourth year, no? Cross check 10% 4 year. You will have the factor 4.641. Get it, everyone? 4.641. The same answer we have calculated here. 4.641. Okay. Right now, let's go for the one more example. 12% 8 years combination. 12% 8 year combination. 12% now, you have to start with the 1.12. On your calculator, start with 1.12. Into is equal to, on your screen you will find 1.244. 1.244. That is your second year factor. Then press is equal to up to 7th year factor. We need factors for 8th year now. So find out up to 7th year factor. Every one of you press the is equal to button up to 7th year factor. So already I pressed the is equal to button once. That is second year, third, 4, 5, 6, 7. 7th year factor. I have pressed the is equal to button up to 7th year factor. Then press the GT button. Every one of you press the GT button. Now on your screen you will find 10.1797 as your factor. 10.1797. That is your year 2 to year 7 factors. The grand total of year 2 to year 7. Now add separately year 1 and year 8. First year and last year we always have to add separately. First year 1.12 and last year 1. Because we all know that last year will not fetch you any interest. So add 1.12, add 1. You will get 12.2997, or you can also write directly 12.3. You can also write directly 12.3. Clear now? Now let us cross check in the table. 12%, no? Yeah. Here is 12% and 8 years, no? Yes. You can see 12.3. Get it? That is how you need to find out the future value of annuity factors with the help of the table. Clear? So that's the concept of the future value of annuity. Okay, now And whatever we have discussed now, it is an ordinary annuity, sir. Ordinary annuity. And we also have the concept of annuity due. But examination point of view, the annuity due concept is not that important, sir. I'm giving you only your general knowledge purposes. Look at here, the differences between the ordinary annuity and annuity due. Ordinary annuity, as I said already, the installments always at the end of the year. Each installment is assumed to be made at the end of the year. But when it comes to annuity due, the installments are at the beginning of the year. Each installment is assumed to be at the beginning of the each year. Are you following, sir? Every one of you. So first year installment at the beginning of first year. So Y0. Second year installment at the beginning of second year. See, at the beginning of second year, Anna, at the end of the first year, Anna, Wakate, same, one and the same. At the beginning of the second year or at the end of the first year will be one and the same. That's why I made the second installment at the end of the first year. Third installment at the beginning of the third year. I can also call it as at the end of the second year. Fourth installment at the beginning of fourth year. Nothing but at the end of the third year. Like this, I can take ma. Okay, now next. So when it comes to ordinary annuity, the last installment will not fetch any interest. But when it comes to annuity due, every installment, including the last installment, will fetch the interest. Clear? Next, how to determine future value of annuity due factors? I've given you one formula here. Ordinary annuity factors for n plus 1th year minus 1. Suppose that if you happen to find the future value of annuity due factor, future value of annuity due factors for the combination 10%, 5 years. Now in that scenario, what you have to do is future value of ordinary annuity for n plus 1th year. What is term of annuity? 5 years plus 1. So means first you find the future value of ordinary annuity factors, for 6th year. Now from that total deduct 1, you will get the future value of annuity due factors. Okay, now next. So after that, next model we will be having present value of annuity. Yeah. Next model, model number 6, present value of annuity. So that means here, suppose that we got a business proposal. There was a business, right? And the person is ready to sell that business. And we ask for the purchase consideration. How much you are expecting? That person said to us, I'm expecting some 4 lakhs for this business. But I asked him, how? Why are you expecting that much amount? He said me like, sir, if you purchase this business, I'll give you assurance that every year you will get a profit of 1 lakh. Like that for next 4 years, I'll give you assurance. So 4 lakhs minimum profit you are going to get over the 4 years. So that's why I'm expecting 4 lakhs. Okay, what you said is right. But 4 lakhs, am I getting as on today? No, I'm getting over the 4 years. No, right? Over the 4 years. Year 1, 1 lakh, year 2, 1 lakh, year 3, 1 lakh, year 4, 1 lakh. So like that 4 years, I'll get 4 lakhs. And you're asking me immediate payment of 4 lakhs for the purchasing of this business, right? So whatever the profit I'm getting 1 lakh every year over the 4 years, that representing the future value. We already know the golden principle of time value of money. That is, the worth of 1 rupee today is always greater than the worth of 1 rupee tomorrow, right? Whatever the 4 lakhs I'm going to receive over the 4 years, right? That 4 lakhs value is always lesser than the present value 4 lakh, the present day 4 lakh, right? So in order to acquire this business, what is the maximum amount I can pay for? 4 lakh is absolutely no. We are not going to pay 4 lakhs because we are not getting 4 lakhs immediately, right? We are going to get the 4 lakhs, but in a future, right? So how much should I invest as on today in order to get this business, in order to acquire this business? So every year 1 lakh you are getting. Now what will be the present values of these periodical receipts? Are you following, sir? Every one of you, right? So how much should I invest as on today in order to get every year 1 lakh profit? Or I went to the banker and I've given my instructions. Okay, banker, every year I need to withdraw an amount of 1 rupee like that for next 4 years. Now, how much should I deposit in lump sum as on today? Clear. So first you need to determine the present value of the future deposits, future receipts, present value of future receipts. So at the end of the year 1, you are going to receive 1 rupee, assuming the banker offering the rate of interest 10%. So the present value will be 0.909. At the end of the second year, you are going to get 1 rupee. The present value will be 0.826. How are you getting this? 1 divided by 1.1. Pressure is equal to button 0.909 is equal to button 0.826. Again is equal to 0.751. Again is equal to 0.683. So you are going to get 1 rupee at the end of the fourth year. Now, this 1 rupees present value is just 68 paise only. And whatever the 1 rupee you're getting at the end of the third year, its present value is 75 paise only. Whatever the future value 1 rupee you're getting at the end of the second year, its present value is just 83 paise only. So like this totally tapma, you'll get 3.169, or you can also round it up to 3.17. So you need to deposit as on today 3 rupees 17 paise. You need to deposit as on today 3 rupees 17 paise. If you deposit 3 rupees 17 paise as on today, every year you can withdraw 1 rupee like that for 4 years. Like that for 4 years. Yes, sir. Sir, in order to withdraw 1 lakh every day, every year, so as on today, you have to deposit 3,16,900 or 3,17,000. So deposit as on today 3,17,000. Like from next year onwards, every year you can withdraw 1 lakh rupee. Every year you can withdraw 1 lakh rupee, like that for 4 years. Are you following or not, every one of you? Okay, next. So this is what finding out the present value of annuity. Now, what is the formula, sir? Present value of annuity is equal to periodical payments into present value annuity factors. Present value annuity factors. So how to determine this present value annuity factors? Very simple. Again, you will be having two options. Number one, you can use a table number A4. Table number A4 is a present value annuity factor table. Look at this present value annuity factor table. And you can also calculate this present value annuity factors with the help of the calculators. So get ready, every one of you, get ready with the calculators. So present value annuity factors, let us find out for the combination of 10%, 5 years, 10%, 5 years, right, sir? So now get ready with the calculators. So 1 divided by 1.1, 1 divided by 1.1, and you need the present value annuity factor for 5 years. Press the is equal to button for 5 times. Press the is equal to button for 5 times. 1, 2, 3, 4, 5. And then press GT button. You will be having a factor 3.791. 3.791. Now go for the table. 10%, 5 years. 10%, 5 years. 3.791. 3.791. Get it? So in this manner, you can find out the present value annuity factor. Right. Let us take one more example. Some present value annuity factor for the combination of 8%, 15 years. 8%, 15 years. So get rid of the calculator. 8% mean 1.0, 1 divided by 1.08. 1 divided by 1.08. And we need the annuity factor for 15 years. Press the is equal to button for 15 times. Press the is equal to button for 15 times. And after that, press the GT button. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. And then press GT button. You will be having the factor 8.559. Okay. Now check out in the table. 8%, 15 years. 8.56. You can round it off. 8.559. You can also round it off to 8.56. Get the same factor now. 8.56. Okay, now like this, you can find out the present value of annuity factors. Clear? Next. After that, the next model will be present value of annuity perpetuity. Here it is. Model number 7. Present value of perpetuity. Annuity forever is called as perpetuity. Annuity forever is called as perpetuity. Look at here, sir. Yeah. Present value of perpetuity. Right. Concept of perpetuity first. Let us try to understand the concept of perpetuity. Annuity forever is what we call perpetuity. Clear, sir? See, annuity with a time limit. Suppose that a time limit of 10 years. It's not a perpetuity, sir. It's simply annuity. Future value of annuity or present value of annuity. That's it. But annuity with infinite time period. Annuity with infinite time period is called as perpetuity. There is no end point. Perpetuity means forever, infinite, no end point. Clear? Now, look at this example, sir. I went to the banker and I asked the banker, okay, dear banker, I would like to withdraw an amount of 1 lakh per annum. An amount of 1 lakh per annum, like that for infinite period. Now tell me, what is the amount? What is a lump sum amount should I deposit as on today in your bank in order to get this infinite withdrawals? So I would like to have infinite withdrawals of 1 lakh per annum. Now, love, tell me, how much is a lump sum amount should I invest as on today? How much is a lump sum amount as on today I need to invest? Assume that the banker offering 10% rate of interest. The banker offering 10% rate of interest. So 1 lakh you would like to withdraw every year for an interest of 10%. So if you calculate, you'll get more 10 lakhs. You'll get 10 lakhs. Right? So as on today, you need to deposit 10 lakhs rupees. As on today, you need to deposit 10 lakhs rupees. Like that, right? If you made that lump sum investment as on today, now every year you will get 1 lakh withdrawal. See, here you are not going to touch your principal amount. You are not going to withdraw your principal amount. You are not going to withdraw your principal portion. You are going to withdraw only your interest portion. So like that, for infinite period, you can withdraw that amount of 1 lakh. How did you get this formula, sir? Simple. See, in order to find out the interest, no. 10 lakhs is a deposit we are making. 10% is a rate of interest. So I'm getting interest of 1 lakh. I'm getting the interest of 1 lakh. Clear? Now, in order to find out this principal portion, simple, sir, into 10%, come this side. Take this side. Okay, na is equal to itwaipu తీసుకొచ్చిందమ్మా. Into is equal to itwaipu వచ్చేసి ఏమవుతుంది? Divided by. So rate of interest divided by rate of interest. The amount of interest which you are going to get, annual cash inflows. So annual cash inflows divided by rate of interest will give you the present value of perpetuity. By using the same formula, you can also find out the rate of interest. Rate of interest it వచ్చేస్తుందమ్మా, present value of perpetuity it వచ్చేస్తుంది. So rate of interest is equal to annual cash inflows divided by present value of perpetuity. Okay, this is the concept of present value of perpetuity. Next, after that, present value of growing perpetuity. Look at here, sir. Model number 8, present value of growing perpetuity. So perpetuity law, you are going to receive the amount in equal. Like this example, in this example we have seen, if we deposit 10 lakhs rupees as on today, from year 1, I'm going to withdraw an interest of 1 lakh in year 1. In year 2, 1 lakh interest I'm going to withdraw. In year 3, 1 lakh interest I'm going to withdraw. And like this for, I'm going to withdraw this interest of 1 lakh every year for infinite period. For infinite period. You can see every year I'm going to get annual cash inflows, equal amount of annual cash inflows. Equal amount of annual cash inflows. But if I want a growth in this annual cash inflows, Like in year 1, I would like to withdraw 1 lakh. Year 2, 1 lakh 10,000. Year 3, 1 lakh 15,000. Year 4, 1 lakh 25,000. So I would like to see the growth in my perpetuity, in my annual cash inflows. Now, in order to get this growing cash inflows every year, like that for infinite period, how much amount should I invest as on today? How much should I invest as on today? That is what we call a present value of growing perpetuity. Present value of growing perpetuity. So if you have equal amount every year, that is your normal perpetuity. But in your cash inflows, if you find any growth, that is your growing perpetuity. That is your what, that is your growing perpetuity. Every one of you following now. Present value of growing perpetuity. Sir, how to find out the present value of growing perpetuity? Look at the formula, sir. Present value of growing perpetuity is equal to cash flows at the end of the first year. Take the first year cash inflow. Cash flows at the end of the first year divided by R minus G. R, you know very well, rate of interest, and G is the growth rate. Adjust the growth rate for your rate of interest. Okay, now. So cash flows at the end of the first year divided by R minus G is a formula for the finding out of the present value of growing perpetuity. Every one of you. Okay, now. Next. The last model in this chapter, effective rate of interest. Effective rate of interest, we need to find out effective rate of interest only when there is the compounding is happening more than once in a year. Then only there is a need to find out the effective rate of interest. See, when compounding is done more than once in a year, there is a need to calculate the effective rate of interest. Means whenever the compounding happening on quarterly basis, whenever the compounding happening on semi-annual basis for every 6 months, then there is a need to find out the effective rate of interest. Look at this example, sir. Look at this example. Sir, I have deposited 1 lakh, right? And the banker offering me 10% rate of interest. And the banker said compounding is happening annually. Every year, at the end of the every year, we'll pay you interest, right? So interest, how much I'm going to get? 1 lakh is my deposit, 10% rate of interest. 10,000 is my interest amount. Now let us say if the banker offering us compounding on quarterly basis, if the compounding is done on quarterly basis, now we need to make some changes. 1 lakh is my present value of deposit. Rate of interest, this 10% is per annum. 10% is per annum. Now what will be the rate of interest for every quarter? So 10 divided by 4. 2.5% per every quarter. And number of time periods, 4. Yearly 4 times you are going to get the interest now. Yearly 4 times. So future value is equal to present value into future value factor, R% and number of years. So present value 1 lakh into future value factors, rate of interest 2.5%, number of time periods 4. 5 minutes. Then you'll get the future value factor 1.1038. 2.5% now. So get ready with the calculators. And we are finding out future value factor now 1.025. 2.5% now. So 1.025 into is equal to second year factor is equal to third year factor is equal to fourth year factor. You will have now 1.1038 is your future value factor. So multiplication, you will get future value is equal to 1,10,380. So principal you deposited 1 lakh, but end of the first year you are getting 1,10,380. So what is your interest, 10,380. Sorry, 10,380. So you are getting 10,380 interest for the investment of 1 lakh. As a percentage, 10.38%. I think he said the banker offering us only 10% rate of interest, but effectively you are getting 10.38%. Effectively you are getting 10.38% because of the compounding of quarterly basis. As I already told you, as many times as compounding is happening, the more interest you will get. More times the compounding is happening, the more interest you will get. Are you following now? Right? If compounding happening on yearly basis, means yearly one time you are getting interest. So 1 lakh into 10%, only 10,000 your interest. But when compounding happening on quarterly basis, so 4 times in a year, you are getting interest 4 times in a year. So that's why the rate of interest becomes 10.38%, effective rate of interest. Normal rate of interest offered by the bank at 10% only, but effectively you are getting 10.38%. Okay, now the formula for finding out the effective rate of interest is equal to 1 plus R divided by M whole power M minus 1. R is rate of interest. M is equal to number of times the compounding happening, number of time periods. So 1 plus rate of interest 10%, so 0.1 divided by M, number of time periods, 4 times the compounding happening, divided by 4 whole power 4 minus 1. So 1.025, 0.1 divided by 4, 1.025 whole power 4 minus 1. So 1.025 whole power 4. So 1.025 whole power 4 kadamma into 1, 2, 3. Yeah, you'll get more. 1.025 whole power 4, the value 1.1038 minus 1. You'll get more 10.38 as effective rate of interest, 10.38 percentage. 1.1038 minus 1 as per the formula. Then you will get 0.1038. When you're converting it into percentage, it will be 10.38 percentage. It will be 10.38% effective rate of interest. This is how you need to find out. Clear now? So with this, we have completed our first chapter marathon, that is time value of money. As I already told you that this is not an exclusive chapter in ICA material. So you don't get a question from this chapter, but whatever the formulae I have learned, we have learned, right? Whatever the formulae concepts we have learned so far, all these formulae and concepts will be helpful, useful while doing the problems for the coming chapters. Without having the knowledge of time value of money, you cannot do the remaining chapters problems. So every one of you, as many times as possible, do all these problems, learn all these formulae. Okay. So that's it for today, sir. In the next class, I'll come up with the second chapter, investment decisions. Okay. Till then, have a good day and good night. Stay home and stay safe, sir. A very good morning, students. In the last class, we have completed regarding the time value of money chapter marathon classes. Right, Ma? Now, time for the second chapter, the most important chapter, investment decisions. Okay, sir. So examination point of view, investment decisions chapter, very, very important. In every examination attempt, we will get one problem compulsory for 8 marks. And apart from the problem, sometimes we also get a theory question from this chapter from 3 to 5 marks. So one problem compulsory for 8 marks and one theory question we can expect in between 3 to 5 marks. So the weightage of this chapter, I can say 10 marks minimum. Are you following, sir? So look at here, chapter number 2, investment decisions. So I've already discussed the weightage of the chapter here. One problem for 8 marks and one theory question in between 3 to 4 marks. Okay, now what are we going to learn from this investment decisions chapter? So financial management is mainly about decision makings. 3 important decisions we are going to make in the financial management, and they are financing decisions. It is a decision regarding the procurement of the funds. Number 2, investment decisions. It is a decision about the investment of the funds. And number 3, dividend decisions. Declaration of the profits as dividends. Right, sir? Now, investment decisions deals about what, Amma? Investment decisions deals about the investment of the funds. So in this chapter, we are going to make the decisions regarding the investment of the funds. Clear? So we are going to invest the funds in fixed assets and as well as in current assets. So investment of the funds into fixed assets will be dealt by this chapter, investment decisions, and investment of the funds into current assets will be dealt by the chapter, working capital management. So in investment decisions chapter, we are going to discuss about the investment of the funds in fixed assets. Should I purchase the plant and machinery or not? Should I construct the building or not? Should I purchase the land or not? So all the investment decisions in relation to the fixed assets will be discussed in this particular chapter. And all the investment decisions with respect to current assets will be learned in the chapter working capital management. Okay, now. So whenever you are going to make an investment decision, your objective should be returns should be higher, right? So whenever you are investing the funds, what would be your objective? Your objective should be the returns from that investment should be higher. Yes or no? So whenever you are making investments into shares of a company or into the mutual funds or into the gold or into the some bank deposits, what would be your objective? Your objective would be the returns from this investment should be higher. Similarly, whenever you are making investment decisions into fixed assets, from that particular investment into the fixed assets, our returns should be higher. Clear, sir? Next, importance of investment decisions. Sir, investment decisions, these are having the substantial portion of our investment. Suppose that our total investment is 100 lakhs, out of which minimum 80 lakhs investments into fixed assets and the remaining 20 lakhs into current assets. So out of the total investment, 80% of the portion in fixed assets. Investment decisions deals with, and it involves substantial portion of your investment. Huge amounts are involved in these decisions, and these decisions are irreversible in nature. Means once a decision is made, you cannot take it back, right, sir? Once you purchase a plant and machinery worth 10 crores, after using it for 1 month, you cannot say to that seller like, we don't like your plant and machinery. Actually, we don't thought of this kind of plant and machinery. We are in thought of a different kind of plant and machinery. So take your plant and machinery back and give us 10 crores. No, they don't take back. So investment decisions mainly irreversible in nature. Once you made a decision, whether it is a profit with the decision, whether it's a loss with the decision, you have to accept. From that particular decision, if you get a profit, enjoy the profits. If you get the losses, face the losses. That's it. You cannot take back these decisions. You cannot reverse your decision. Okay, now. And these decisions will have the impact in the long run. See, if you are earning profits from this decision, you will earn this profit for a longer period, say 10 years. Similarly, if you're getting losses from this decision, the losses will be last long for 10 years also. So whether it's a profit or it is a loss, it will be for long run. See, if it is a profit, very happy. In the long run, we are going to enjoy the profits. But if it is a loss, you cannot bear the losses. You cannot bear the losses. Sometimes you need to shut down your business. Clear? These decisions are complex in nature. Yes, very complex. Because of the above features, these are involving the huge amount of your capital portion, irreversible in nature, and this will have impact in your long run. Are you following, sir? Next. And after that, you have an example here to understand this concept of investment decisions. Look at here, ma. Cost of the car, 5 lakhs rupees. Number of days that the car can be given on lease, 250 days per annum. Lease charges 600 per day. Annual maintenance 75,000 per annum. Life of the car 6 years and salvage value 2 lakhs. So at the end of the 6th year, if you sell the car, you will get 2 lakhs rupees, ma. So from the above information, decide whether it is beneficial to enter into the business of the leasing of the car. So whether buying of this car and running them on lease basis is advisable or not. This is what the decision we need to make here. Look at here, ma. From a layman's approach, from a layman's angle, what he will think about this decision, sir? How his approach will be? His approach will be like, what will be my cash inflows and what will be my cash outflows? How much I am investing and how much I am getting. Clear? So he's getting, right, cash outflows. First, look at the cash outflows. How much he is investing. First, in order to purchase the car, he need to spend 5 lakhs rupees. You need to spend 5 lakhs rupees. And then annual maintenance cost, 75,000 per annum is the annual maintenance cost, like that for 6 years, 4,50,000. So the total investment he is making on that car, 9,50,000 over the 6 years. Now what is the cash inflows he's getting? So he's running that car on lease basis, right? In a year, he's running that car on lease basis for 250 days. And for which every day is getting lease rental 600 rupees. So 600 rupees per day into 250 days in a year, like that for 6 years. So 9 lakhs is the lease rents he's getting. And at the end of the 6th year, he's selling the car for 2 lakhs. So totally 11 lakhs cash inflows is getting. Totally 11 lakhs cash inflows is getting. So for the investment of 9,50,000, he's getting an inflow of 11 lakhs. So the profit will be 1,50,000. So what the layman said, so I'm investing 9,50,000. In return, I'm getting 11 lakhs. So I'm getting a profit of 1,50,000. So the decision should be, since there is a profit of 1,50,000, it is advisable entered into the business of running the car on lease basis. But this layman's approach is 100% wrong. There are so many important factors, important considerations missed out in this layman's approach. What are they? Look at here. Drawbacks are loopholes in the layman's approach. Number one, he ignores opportunity cost. See, he's purchasing the car for rupees, how much amount? He's purchasing the car for 5 lakhs. 5 lakhs. Suppose that if the same 5 lakhs invested into a bank fixed deposits, where the bank are giving you some 8% rate of interest per annum. So that means you will get an interest amount of 5 lakhs into 8%, 40,000 per annum. Like that for 6 years. So 2,40,000 rupees interest he would have get. Yes or no? If he invested the same 5 lakhs into a bank fixed deposit, where the bank are offering 8% rate of interest per annum. So per annum, he would have received interest of 8%. That means 40,000 rupees. Right, sir? Like that for 6 years. 6 years into 40,000, 2,40,000 interest he would have received. But by investing the same 5 lakhs into car, he is missing this 2,40,000 interest. Opportunity cost, and this opportunity cost was not considered in the decision making. The first drawback. Second drawback, time value of money. Sir, simply he's added all the cash inflows and cash outflows of the different years directly, which he should not. Look at here. Every year is getting a lease rentals of 1,50,000. How much? Every day 600 rupees into in a year 250 days the car is running on lease basis. So every year is getting lease rentals of 1,50,000. Year 1, 1,50,000. Year 2, 1,50,000. So on up to year 6, 1,50,000. But all these years lease rentals are having the same value? No. Year 1, 1,50,000 is completely different from year 6, 1,50,000. Time value of money. We have learned a golden principle. The worth of 1 rupee today is always greater than the worth of 1 rupee tomorrow. Yes or no? Year 1 లో వచ్చే 1,50,000, year 6 లో వచ్చే 1,50,000 రెండింటికి సేమ్ వాల్యూనే ఉంటుందా? ఉండొచ్చు. So you should not add different years cash inflows directly, different years cash outflows directly. You should not add, you should not subtract, you should not divide, division, multiplication, different years cash inflows you should not add directly because they have different values. But the layman has not considered this time value of money principle. He simply add all the years cash inflows at a stretch. That's not correct. Next, number 3, depreciation. Car is a depreciable asset, and where he is considered the depreciation impact in the decision making, he ignored the depreciation impact. Next, tax impact. You are doing a business, leasing the car on a higher basis, running the car on higher basis. You are doing a business, you are earning profits every year. Where is the tax element? Are you considering the tax element on your profits? No. So these are all the important drawbacks or loopholes in the layman's approach. By covering all these drawbacks, loopholes, by overcoming all these drawbacks and loopholes, right? Scientifically, there are some techniques developed, and that techniques are called as a project evaluation techniques or capital budgeting techniques. Capital budgeting techniques are project evaluation techniques. Right, ma? In these project evaluation techniques, all these loopholes have been covered, overcome. All this takes into consideration. Clear, ma? So there are 2 different types of techniques, ma. Traditional techniques, also known as non-discounting techniques. And the second one, discounting techniques are time-adjusted techniques. Okay, ma. First, look at the traditional techniques, also known as non-discounting techniques. We have 2, ma. Average rate of return and payback period. ARR method and PBP method. Clear, sir? And in the coming to the non-discounting techniques, you have NPV, net present value method, then IRR, internal rate of return method, then profitability index method, then terminal value method, and finally discounted payback period method. 5 methods in discounting techniques, 2 methods in non-discounting techniques. Okay, now first let us discuss about the traditional techniques, also known as the average rate of return, also known as average rate of return, ARR. This can also be called as accounting rate of return. Average rate of return now, accounting rate of return now, both are one and the same. So why we are calling average rate of return as accounting rate of return? Because while calculating this average rate of return, mainly we will take into account the accounting profits. While calculating this accounting rate of return, mainly we take into account the accounting profits. So based on the accounting profits, we will calculate this rate of return. That is why this is called as a accounting rate of return. Okay, now this is the only method. This is the only method we are going to consider accounting profits. Remaining in all the methods, we are going to consider FM profits, financial management profits. Both are completely different. What is the difference? I'll tell you later. Okay, now, sir, what is the average rate of return? It is the maximum rate of return. It is the maximum rate of return we can expect from a project. So whenever you're making investments into a project, you must be having some target in your mind. Okay, from this particular project, I should earn this much rate of return. So whenever you're making investments, you must be having a target in your mind. Okay, from this particular investment, I should earn this much rate of return. And whatever the target you have in your mind, that will be your average rate of return. Yes or no? Say I'm investing some 10 crores rupees in a project from which I'm expecting 15% rate of return. And that 15% rate of return is what we call average rate of return. And you must have a target, sir. Why? Because, sir, for making investments into this particular project, I'm involving a cost of 12%. I've taken a loan from a bank for which I'm paying interest of 12%. So from this particular project, I should earn a minimum rate of return of 12%. Yes or no? Then only the project is viable to me. Then only the project is acceptable to me. Are you following or not? Right? So look at this example. X Limited, funds available 10 lakhs rupees. Right, sir? Now, there are three different projects available. ARR from project 1, 12%, project 2, 15%, and project 3, 18%. Clear? So generally, whenever you're making investments, I've already told you, the objective should be your returns from this project should be higher. So this is the project which gives me the highest rate of return. So I will choose project 3. Are you following, sir? I'll choose project 3. And the decision making here is purely based upon you always have to compare your average rate of return with the cost of capital. Whether this project, whether this return is able to cover my cost or not. If my return is able to cover the cost, yes, this project is acceptable to me. If my return is unable to cover the cost, this project is not acceptable to me. So that's why the decision making should be always compare your average rate of return with cost of capital. If average rate of return is greater than cost of capital, accept the project. Are you following or not? Look at here, project number 3, where your ARR is 18%, which is greater than the cost of capital 15%. Hence, project 3 is acceptable. Clear now? Sir, how to calculate this average rate of return? So look at the formula, sir. Accounting rate of return, average rate of return is equal to, you can see the formula here. Profit after depreciation. Totally, there are 3 versions for finding out the ARR. Version 1, annual basis. Version 2, total investment basis. And version 3, average investment basis. First, look at the version 1, annual basis. Means you are going to find out the ARR per annum, not project as a whole, per annum. First, find out the ARR per annum. Then, find out the ARR for the project as a whole. Like, sir, year 1, year 2, and year 3. You find out the ARR like this, some 10%, 12%, and 14%. Per annum ARR you find out. This is finding out the ARR on annual basis. Now, if you want to know the ARR for the project as a whole, the total of these 3 years ARR of the project as a whole is equal to this, just total up 10%, 12%, and 14%. And there are 3 years now divided by 3. So 10 plus 12, 22 plus 14, 36. 36 divided by 3. So ARR of the project as a whole, you can say 12%. 12%. Okay now. So the formula will be annual basis ARR, profit after depreciation divided by investment in the beginning of the year. Right? Next, total investment basis. In this version, we are going to find out the ARR for the project as a whole. ARR for the project as a whole. Formula will be average annual profit divided by the investment into beginning into 100. Next, average investment basis. Average annual profit after tax divided by average investment into 100. Right, sir? Average profit after tax divided by average investment into 100. So generally, if the question is silent about the different versions, simply the information is provided to you and asked to find out the ARR. In that scenario, you have to adopt this method, average investment method. Unless otherwise specifically provided, calculate the ARR basing upon average investment basis. If specifically provided, calculate accordingly. Apply the formula accordingly. Yes or no, ma? Every one of you. Okay. So, sir, how to find out the average profit after tax? The total profit after tax divided by life of the project. Okay, now. Next, average investment. There are 2 formulas available. Number 1, opening investment plus closing investment divided by 2. Number 2, half of the initial investment plus initial cost minus salvage value plus salvage value and plus working capital. Use this formula, then find out the average investment. Okay, now. Next, and while making the decisions with respect to the projects, there are 2 different types of the projects available, ma. Right? Number 1, mutually exclusive. Number 2, mutually independent. Ma, mutually exclusive means here among the given projects, you are asked to select only one project. Only one project. Right, sir? So there are 3 projects available. Project 1, 2, 3. And ARR, you can see 15%, 18%, 20%. Cost of capital, 12%. You can see that in all the projects, P1, P2, P3, ARR is greater than cost of capital. All the projects are acceptable. But the thing is, the nature of the projects, mutually exclusive. Nature of the projects, mutually exclusive. That means you need to select only one project. Now, which project will you choose? I'll choose project 3 because I'm getting highest return, 20%. Yes or no? So when it comes to the mutually exclusive projects, where you have to select only one project, right, sir? Selection of a project means we are rejecting all other projects. That's the nature of mutually exclusive projects. So I'm selecting P3. That means I'm rejecting P2 and P1. So when it comes to the mutually exclusive projects, you have to select the projects with the highest ARR. Now, when it comes to the mutually independent projects, right, sir, selection of one project doesn't mean that we are rejecting other projects. We can also select other projects as well, depending upon the funds available with you. Depending upon the funds available with you. Clear? So look at the nature. Selection of the project, selection of one project doesn't mean we are rejecting the other projects. Projects are independent to each other. Yes or no? So in these cases, we need to select all the projects whose ARR is greater than cost of capital. In this example, all the 3 projects here are greater than cost of capital. So we can select P1, P2, P3, all the 3 projects simultaneously, depending upon the funds available with us. Depending upon the funds available with us. Every one of you following now. Right. So look at here, decision making. In the case of the single projects, means only one project is giving to you. And with respect to that one project, you need to make a decision. If ARR is greater than cost of capital, accept the project. Means your average rate of return covering all your costs, whatever you are incurring from that for that particular project. So yes, Since I'm getting a huge amount of returns, accept the project. If ARR is less than cost of capital, reject the project. Sir, I'm incurring a cost of 15%, but this project is giving me only 10% rate of return. So my returns are not able to meet my costs. So simply reject the project. And if ARR is equal to cost of capital, you may accept the project. You may reject the project. It's up to you. Okay, now next, coming to multiple projects means more than one projects in consideration. More than one project in consideration. And if the project's nature is mutually exclusive, we need to select only one project. So accept the project with highest ARR. In case the project's nature is mutually independent, each and every project is independent of the other projects, then you can select all the projects whose ARR is greater than cost of capital. Okay, ma. So this is about the average rate of return. Next. With this theoretical knowledge, you can do the problem, Sama. Next one. Next concept, we'll have the concept of cash flows after tax, CFAT. CFAT. We call it as CFAT. Cash flows after tax, CFAT. CFAT. Okay. So these are FM profits, ma. These are FM profits, also known as cash profits. FM profits, also known as cash profits. Okay. So what is the difference between the accounting profits and FM profits? Look at here. Accounting profits calculated on mercantile basis. Calculated on mercantile basis, and which takes into account all the payables and all the receivables. Paid includes payables and receipts includes receivables. Even if it is a particular expenditure under payable status, it will consider it as payment and it will charge to the profit and loss account. Thereby your profits will be reduced. Even a particular income is on receivable status, it will be considered as income and made a credit entry into your profit and loss account. Your profits will be increased. Right, sir? But whereas when it comes to the FM profits, these are calculated on cash basis. Means only actual cash payments, and actual cash receipts are considered. Payables, receivables ignored. Okay, now next, coming to the accounting profits, even it considers the non-cash expenses like depreciation. Non-cash expenditure. When it comes to the accounting profits, you might have seen in the profit and loss account to depreciation. They will charge it as an expenditure. Depreciation is a non-cash expenditure, ma. You're not incurring anything out of your pocket. Yes or no? By booking a non-cash expenditure as an expenditure, your profits would have reduced. But whereas when it comes to the FM profits, depreciation will be simply ignored. Next, accounting profits will not reflect the true financial position of the company. Yes, when you're booking payables as an expenditure, when you're considering receivables as income, which are not yet received, don't know whether we are going to receive in future or not, uncertainty is there. And when you're booking non-cash expenses as an expenditure to your profit and loss account, how the accounting profits will reflect the true financial position of the company? It won't reflect. Yes or no? Suppose that you have a gross profit of, yeah, look at here example I've already given. By sales 100 lakhs, all the sales are credit sales, ma. All the sales are credit sales, right? 100 lakhs. And you incurred an expenditure of, let us say, 80 lakhs, and you have a profit of 20 lakhs net profit. Now, if I open my cash box, should I find the 20 lakhs in my profit box? No, because these are all not yet received. These are all credit sales. Yes or no? You have not yet received from the debtors. Whenever there is a debtor, there is a bad debt. Yes or no? But immediately after making credit sales, you have recorded it as income and you're showing you have a profit of 20 lakhs. But in your cash box, nothing is there. In your bank account, nothing is there. Where is the 20 lakhs profits? Right, sir? Every one of you. Next, look at here. Another example. You have a gross profit of 40 lakhs and you booked an expenditure of 35 lakhs and you also booked a depreciation of 10 lakhs. So total expenditure comes out to be 45 lakhs and you have a gross profit of only 40 lakhs. So you're booking a net loss of 5 lakhs. Now you tell me, sir, whether your company really running in losses. By looking at your accounting profits, your accounting statements, it is showing a 5 lakhs net loss, but which is not your role, correct loss. Your company is in profits, 40 lakhs profit you have, out of which 35 lakhs is a expenditure. So you have a net profit of 5 lakhs. This 10 lakhs is a non-cash expenditure. Yes or no? So in reality, you have a profit of 5 lakhs, but as per the accounting financial statements, it is showing a loss of 5 lakhs. Clear? So that's why accounting profits will not reflect the true financial position of the company, but whereas FM profits reflects the true financial position of the company. So that is why while making the investment decisions, one has to consider FM profits only, known as CFAT, cash flows after tax. Okay, sir. Next. Sir, how to calculate this cash flows after tax? We have a standard format, right? It starts with the PBDT, profits before depreciation and taxes. PBDT, profits before depreciation and taxes, from which deduct the depreciation. Then you will get PBT, deduct the tax element, you will get PAT, add back depreciation, you will get CFAT, cash flows after tax. Now, after looking into this, you will get a dot here. So just now you said while calculating the FM profits, you are asking us to ignore the depreciation. But why you considered here? Why you considered here? Right? Less depreciation, add back depreciation. Suppose the depreciation amount is 100 rupees. Here I'm deducting 100 rupees. Here I'm adding 100 rupees. What is the impact? Plus 100 minus 100 will be striked off. The impact will be 0. So that means I've ignored depreciation while calculating CFAD. Are you following or not? So for the purpose of ignoring the depreciation in the calculation of CFAD, why there is a need to subtract it once and adding back again? So we are doing this because of the tax benefit. Because of the tax benefit. Depreciation, though it is a non-cash expenditure, on that depreciation, we can claim tax benefit. Depreciation is a tax deductible expenditure. Tax deductible expenditure on which we can claim tax benefits. Are you following, sir? Every one of you. Suppose that my profit after tax, 1000 rupees. Depreciation, 200 rupees. So profits before tax, 800. Tax element, let us say at the rate of 30%. So 240 rupees. So profit after tax, which comes out to be 560 rupees. 560 rupees. Okay, sir. And add back depreciation 200. My cash flows after tax 760. Suppose that if I have not considered this depreciation at all, my PBDT would have been, it is 1000 only, no? And minus depreciation, I have not considered, I've just ignored. So my PBT, 1000, and what will be my tax? My tax at the rate of 30% would have been 300 rupees. 300 rupees. But by considering depreciation here, my tax liability is just 240 only. And I got a benefit of 60 rupees tax benefit. Depreciation is a tax deductible expenditure. That is why while calculating CFAD, you just subtract the depreciation first, and after calculation of the tax element and everything, add back the depreciation again. That's it. Are you following, sir? Every one of you. Next, there is one more alternative to calculate the CFAD. This is the other alternative, PBDT, from which deduct the tax directly. Then you'll get PAT. Add back the tax shield on depreciation. Whatever the tax benefit you are getting on depreciation, add back directly. Then you'll get CFAD. Like, continue your example. PBDT 1000 rupees minus tax at the rate of 30%, which comes out to be 300 rupees. Profit out of after tax 700 rupees. And tax benefit on depreciation. What is your depreciation? 200 rupees into what is the tax rate? 30%, 60 rupees. So cash flows after tax 760. Ochindama 760. Every one of you. So oksar add chesi, oksar less chesi, yenne oddu sir naku. Right. I just don't want to see the depreciation in CFAD calculation. Okay, do one thing. You can simply take the tax benefit on depreciation directly. It's a benefit to you. So add back to your profits. So profits after tax 700. Add the tax benefit on depreciation 60 rupees. Then your CFAD 760. So while you're calculating CFAD in alternative 1 or alternative to, in both the cases, you will get the same profits, 760, 760. Are you following or not? Clear. So that's how you have to calculate the CFADMR. Next. So in the traditional techniques, the second one is payback period method. Payback period method. Just give me a second, sir. Second, a traditional method, and second, a non-discounting technique. Right? Payback period method. A payback period method explains about in how many years we will get back our investment, initial investment. What is the time required to getting back or for recovering our investment? And that time is what we call payback period method. Payback, whatever the amount of paid, what is the time required to getting back it? What is the time required? What is the period required to getting back it? Getting back it. That is what we call payback period method. Right, sir? So payback period explains about it is the time required for recovering our investment. For recovering our investment is called as a payback period method. Okay, ma. Suppose that, right, initial investment, look at this, ma. We made an investment of 10 lakhs rupees in a project. And from that particular project, we have the cash inflows like this. So year 1, 2 lakhs, year 2, 2 lakhs, year 3, 2 lakhs, like that up to 8 years. So 8 years, we have a uniform cash inflow of 2 lakhs every year. Right, sir? Now, can I call this 2 lakhs as profits from year 1 to year 8? I have a profit of 2 lakhs every year. No, sir. You cannot call it as profits, right? Unless and until your investment is completely recovered. Right, sir? That is not your profit, sir. Look at here. You made an investment in Y0, 10 lakhs rupees, and the 10 lakhs you are recovering over the 5 years. The first 5 years, whatever the CFAD you are earning, this you should not treat it as profits. This you have to treat it as a recovery of your investment. Recovery of your investment. And after your investment was completely recovered, from thereafter, whatever the profits you are getting, they are your real profits. They are your real profits. So from year 6 onwards, in this case, from year 6 onwards, whatever the cash inflows I am getting, these inflows I have to treat it as profits. The first 5 years is just recovery of my investments. Is just a recovery of investment. Now in this example, I can say payback period is equal to 5 years. So whatever the investment I have made in Y0, that is 10 lakhs rupees, it took me 5 years to get back my 10 lakhs rupees. So the payback period is equal to 5 rupees. 5 years, sorry, Emma, 5 years. So when you have uniform cash flows throughout the life of the project, the formula for the calculation of payback period is as follows. Initial investment divided by annual cash inflows. Your initial investment is 10 lakhs divided by annual cash inflows 2 lakhs per annum. So payback period is equal to 5 years. Got it, ma? The first 5 years, you are able to recover your investment. Now, when it comes to the decision making, sir, whether it is advisable to accept this project, if you ask me, I'll say no. Out of the total life of the project, 8 years, you are working hard 5 years only for getting back your investment. 5 years you are working hard. అంటే 5 years కష్టపడితే కానీ మన ఇన్వెస్ట్మెంట్ మన చేతికి రావట్లేదు అండ్ తర్వాత సరే పోనీ ఇంకో 5 years అన్న మనకు వచ్చే ప్రాఫిట్స్ ని మనం ఎంజాయ్ చేద్దామా అంటే లైఫ్ ఏమో 8 years ఉంది. దట్ మీన్స్ మాక్సిమం 3 years ఓన్లీ యూ కెన్ ఎంజాయ్ ద ప్రాఫిట్స్. Out of the total life of 8 years, 5 years you are working hard for getting back your investment, and only 3 years you are going to enjoy the profits. Only 3 years you are going to enjoy the profits. So logically speaking, it's not correct. Not advisable to accept the project. See, we need to recover our investment as quick as possible. Then only we can enjoy the latter part of the life of the project as profits. Okay, now next. Situation 2. uneven cash inflows throughout the project. So equal cash inflows unte, straight away you can apply the formula. By applying the formula, you can find out the payback period method. But when the cash inflows are uneven, like look at this example, you made an initial investment of 10 lakhs. So the cash flows after tax will be like this. Year 1, 3 lakhs, year 2, 3 lakh 50,000, year 3, 3 lakh 50,000. And you can see there are uneven cash inflows, right? Equal to levama, a year lo kuda, uneven cash inflows. In that scenario, first you have to find out this cumulative CFAD, cumulative cash flows after tax, like year 1, 3 lakhs, year 2, 6 lakhs 50,000. How did you get this? Year 1 CFAD 3 lakhs plus year 2 CFAD 3.5 lakhs, 6 lakh 50,000. Year 3 cumulative cash flows after tax 10 lakhs. Ela ochindi. Year 1 3 lakhs plus year 2 3 lakh 50,000 plus year 3 3 lakh 50,000. Totally 10 lakhs. So like that, you have to find out the cumulative cash flows after tax. Every year cash inflows you have to accumulate. Now look at here. What is your investment amount? 10 lakhs. And your 10 lakhs investment is exactly recovering at the end of the third year. So you can say the payback period is equal to 3 years. Okay, next look at one more example. Your initial investment is 10 lakhs and cash inflows are, look at here. Year 1 4 lakhs, year 2 4 lakh 50,000, year 3 3 lakhs. So means uneven cash inflows you are observing. Uneven cash inflows. So whenever I've said already, whenever there is an uneven cash inflows, find out the cumulative cash flows after tax first. So 4 lakhs for year 1, 8 lakh 50,000 for year 2, 11 lakh 50,000 for year 3. Okay. So here you have to find out the cumulative cash inflows first, and then look at in which year or in between which years your investment is falling. What is your investment? 10 lakhs. And your 10 lakhs investment, you are able to recover in between year 2 to year 3. In between year 2 to year 3. Yes or no? Up to year 2, you are able to recover 8 lakh 50,000. The remaining 1 lakh 50,000 you are recovering in year 3. You are recovering in year 3. Okay, ma. Now in this scenario, how to find out the payback period method? Look at here. Payback period method is equal to formula year up to which the cumulative cash flows after tax is less than initial investment plus unrecovered investment divided by CFAD for the next year. Year up to which your cumulative cash flows after tax is less than initial investment. Up to second year, your cumulative cash flows are less than initial investment. So second year plus unrecovered investment. What is your total investment? 10 lakhs. Up to the second year, you are able to recover 8.5 lakhs. So unrecovered investment 1.5 lakhs. Unrecovered investment 1.5 lakhs. And this 1.5 lakhs unrecovered investment, you are going to cover from the third year cash inflows. What is your third year cash inflows? 3 lakhs. So divided by 3 lakhs. Okay, now. So then payback period should be 2.5 years. 2.5 years, or you're going to call it 2 years, 6 months. 2 years, 6 months. Okay, ma. So this is how you need to find out the payback period under different situations. Clear, everyone? Now, what is the decision-making process under payback period method? Look at here, ma. Decision-making process under payback period method. Yes. So when it comes to the single projects, if your project payback period is less than standard payback period, accept the project. What is the standard payback period? Ma standard payback period anna industry payback period anna okate sir. Industry payback period. See, your company is belonging to a particular industry. Like you are doing a software business. You are into software business. So means your company is belonging to software industry. Like TCS, INVST, Wipro, Mahindra Technologies, Tech Mahindra, right? These are all belonging to same industry called as software industry. Clear? Look at this example. When Infosys is finding out the payback period method, and it is find out that the payback period is equal to 4 years. Now, this payback period should be compared with the industry payback period. And if this project accepted by the other companies in the same industry, what would have been their payback period? Right? If TCS accepted this project, what would have been its project payback period? If Mahindra Satyam Tech Mahindra accepted this project, what would have been its payback period? If Wipro accepted this project, what would have been its payback period? That is what we call industry payback period. You always have to compare your company's payback period with the industry payback period. And when it comes to payback period, lower the payback period, higher will be the benefit. Means lower the payback period and within less time, you are able to recover your investment. Out of 10 years, assume that within 3 years, you are able to recover your investment. That means in the remaining 7 years, you are going to enjoy the profits. Yes or no? కదమ్మా మనకి పేబ్యాక్ పీరియడ్ ఎంత తక్కువ ఉంటే అంత అడ్వాంటేజ్ మనకి. ఎంత ఫాస్ట్ గా మన ఇన్వెస్ట్మెంట్ మనం రికవరీ చేసుకోగలిగితే రిమైనింగ్ లైఫ్ మొత్తం కూడా మనం ప్రాఫిట్స్ ఎంజాయ్ చేయొచ్చు. సో యూ ఆల్వేస్ strive for recovering back your investment as quick as possible. Then the rest of the life of the project, you can enjoy the profits. Yes or no? So that's why if our company's payback period lower than standard payback period, accept the project. If your company's payback period is greater than standard payback period, like your company able to recover the investment in 5 years, whereas the other companies in the same industry able to recover the investment in 3 years only. So when other companies are able to recover the investment in 3 years, why can't our company? Why our company taking 5 years? There is something wrong. So let us reject this project. Okay, ma'am. And if your payback period is equal to standard payback period, you may accept the project, you may reject the project. That's about the individual project. When it comes to the multiple projects, more than one project is there. That's in, if it is a mutually exclusive project, then accept the project with the least payback period method. And if it is a mutually independent project, accept all those projects whose payback period is less than standard payback period. Clear, ma? Next, coming to the payback period method, we have some assumptions to understand. Ma, FM antene assumptions. FM is all about assumptions because FM discuss about the future. And future is uncertain. You need to take some assumptions. Basing upon the assumptions only, you will make the decisions. Look at the assumptions here. All the cash flows given in the project problem are assumed to be certain. So what are the cash inflows I am assuming in this particular project? They are certain cash flows. You have to take that particular assumption. Otherwise, you cannot do the problem. Right, sir? Next. All the cash inflows are assumed to be accrued evenly throughout the year. Means, look at here, ma. In year 1, I'm getting 365 lakhs. Now, my question is, in which particular day are you getting this 365 lakhs cash inflows? At the beginning of the year or end of the year or in the mid of the year? No. I'm getting this project's cash inflows evenly throughout the year. Means every day my cash inflow is 1 lakh. Like that for 365 days, 365 lakhs is my cash inflows. Evenly throughout the year. Every day I have a equal cash inflows. That's the second assumption. Are you following or not? So after completing the answer of the payback period method, you have to write must and should. You have to write this assumptions compulsorily. These assumptions also carries marks, ma. Suppose that you got a payback period problem for 5 marks. You have done the answer correctly, but you forgot to write the assumptions. You will get hardly 3 to 4 marks for the answer. At least 1 mark will be deducted for not writing assumptions. So keep this fact in mind. So with this, we have completed the traditional techniques, non-discounting techniques. Okay, now let's move on to the discounting techniques. Discounting techniques. Right. Discounting techniques, also known as time adjusted techniques. Okay, ma'am. So far, we have completed non-discounting techniques, also known as traditional techniques. Sir, here in non-discounting techniques, traditional techniques, that is ARR and payback period method, There are so many important considerations which are missed out, like mainly time value of money principles. Time value of money principles. If you look at the average rate of return and payback period method, different years cash inflows are directly added. Right, sir? While calculating payback period, year 1, year 2, year 3, year 4, year 5, all the cash inflows are directly added, and basing upon which we find out the payback period, and basing upon which we made a decision, but which is not correct. We know that different years cash inflows should not be added, subtracted, multiplied, divided directly. In order to make the addition or subtraction, first you have to bring them into the same time periods. Only the same time period cash inflows can be added, subtracted directly, can be compared directly. Yes or no, right? If you want to add the two different years cash inflows, first try to bring them into the same time period. Then you can add directly, absolutely no problem. So year 1 cash inflow, year 2 cash inflow, you cannot add directly, sir. Either year 1 cash inflow, you need to take it to the future, or year 2 cash inflow, you need to bring it to present. Then only you can make the comparison, or you can make addition or subtraction. But whereas when it comes to the traditional techniques, that was not happened. We have simply added different years cash inflows directly, basing upon which we made a decision which is absolutely a wrong decision. Majority of the circumstances, the financial managers use only the NPV method for making financial decisions. NPV method is the most widely used method for making investment decisions. It is the most widely used method for making investment decisions because it covers all the important considerations like time value of money principles, opportunity cost element, depreciation element, tax impact, everything it takes into account. So that is why it is a best project evaluation techniques. So how to find out the NPV? Very simple, sir. It is the present value of cash inflows minus present value of cash outflows. So you are bringing the cash inflows and cash outflows into the present value terms. And then you are making subtraction based on which you are finding out NPV. Present value of cash inflows minus present value of cash outflows. Here your inflows and outflows will be in a different time periods. That's why we are bringing them into the present value terms in Y0 terms. After bringing them into the present value terms, then you can make a subtraction. Then you can find out the NPVs. Right? So present value, NPV is equal to present value of cash inflows. Means also we can write it as present value of operating cash inflows plus present value of terminal cash inflows minus present value of cash outflows. Okay, right? Next, there is a standard procedure for the finding out of the NPV, sir. In step number 1, we will find out the present value of cash outflows. Step number 2, we will find out the present value of operating cash inflows. Right? Whatever the cash inflows you are getting through your day-to-day business activity. By your day-to-day business activity, that cash inflows are what we call present value of operating cash inflows. Step number 3, we are going to find out the present value of terminal cash inflows. And step number 4, NPV calculation. Right? You can see here, present value of cash inflows, you got 1,30,000 example, and present value of cash outflows 1 lakh. So NPV 30,000. What do you mean by this 30,000? 30,000 means it is your profit. It is your profit, right, sir? We are earning after recovering of your investment. 1 lakh investment is recovered, and opportunity cost also. So after considering your investment and opportunity cost, right, sir, after recovering both, whatever the amount is there, that till is your real profits, NPV. Clear, sir? Net present value, it is the net of present values. Net of present value of cash inflows and present value of cash outflows. That is why this is called net present value. Net present value, NPV. And this 30,000 is the amount of the profits which you will earn as on today. Present value terms I'm talking about. Okay, now, so look at here. In Y0, you made an investment of 1 lakh rupee, and end of the year one, you're getting 20,000 rupees cash inflows at the end of the first year. But for the calculation of NPV, we don't take this 20,000 as cash inflows. We will take the cash inflows as, right? You need to bring them into the present value, right? So it is year one profits. No. So assume that the opportunity cost, the cost of capital given is 10%. So you need to take the present value factors at 10%. So 1 divided by 1.1. For calculating present values, you need to division. So the present value factors for the first year 0.909. 0.909. Okay, ma. So means 20,000 into 0.909, you will get a 18,180. While calculating the NPV, we will take only 18,180 as cash inflows, not 20,000. Even though you are getting in year one, right, 20,000 profits, cash flows after tax 20,000. But for the calculation of NPV, we are taking only 18,180 as year one cash inflows. Because 20,000 you are going to get at the end of the first year, but I want present value as on today's value. So what will be the present value of 20,000 which you are going to receive at the end of first year? First year end lo receive cheskune 20,000 yokka present value enta 18,180 rupees. Like that for every year. Suppose that in year 2 you are getting again 20,000 rupees in Y2. At the end of the second year also you have a cash flows after tax of 20,000. So second year factor తీసుకున్నమ్మా 1 divided by 1.1 is equal to press చేయండి first year factor, again press is equal to second year factor. So 20,000 into 0.826. You have to take into account 20,000 into 0.826, only 16,520 for the calculation of NPV. 16,520 for year 2. Are you following, sir, every one of you? Right now. So though you are getting every year 20,000, but these are representing future values. I want present values because I'm making the decision as on today. So I want the present value of cash inflows. I want the present value of cash outflows. So I have to convert all my future cash inflows into present values. At what rate of interest I have to convert them? At cost of capital rate. So convert all your future cash inflows into present values by taking cost of capital as a base. At cost of capital rate, all your cash inflows should be converted into present values. Then take the total of that present values. That will be your present value of operating cash inflow. Arthamautundamma. Next. At the end of the life of the project, you will get terminal cash inflows. Right? After the completion of the project, whatever the assets you purchased, that assets you would be sold out. You will get the terminal cash inflows. Suppose that the project life is 5 years. End of the 5th year, you will sell all the assets. You will get terminal cash inflows. But you are going to get at the end of the 5th year, no? But I want present value, no? So then the terminal cash inflows should be multiplied with the 5th year present value factor. 5th year present value factor. Then that will be converted into the present values. Are you following or not, every one of you? So like that, every cash inflow you have to convert into the present value. And cash outflows, majority of the circumstances you made the investment in at the beginning of the project only, they always represent present value. So you have the present value of cash inflows, you have the present value of cash outflows. Subtract cheyandamma, you will get NPV. Okay, now every one of you. Present value of cash inflows minus present value of cash outflows. Clear? Next, decision making. So when it comes to the NPV, the decision making will be like this. In the case of the single projects, if NPV is positive, accept the project. If NPV is negative, reject the project. If NPV is equal to 0, you may accept or you may reject. But if NPV is positive means like that, suppose that you have NPV of some 10,000 rupees. This 10,000 means after recovering your investment and after recovering your opportunity cost, still you have a profit of 10,000 rupees. So accept the project. Suppose that you got an NPV of negative 5,000. NPV of negative 5,000. And that means your project is unable to recover your initial investment and as well as your opportunity cost, unable to recover your initial investment and opportunity cost. So it's not advisable. It's not advisable to accept the project. Okay, ma. And when it comes to multiple projects, when more than one project is there, and if the project's nature is mutually exclusive, means you have to select only one project, then select the project with the highest NPV. Accept the project with highest NPV. Ledu said the project's nature is mutually independent. Each and every project is independent of the other project. Then you can accept all the projects whose NPV is positive. Select all those projects whose NPV is positive. Okay, now next, assumptions. Just like we had the assumptions in payback period method, we have assumptions in NPV as well. What are the assumptions? First one, all the cash flows given in the problem are assumed to be certain. What are the cash flows giving? Like you can see here, problem number 8. Different projects information is provided to user. Project A, initial investment 2 lakhs. Project B, 1,90,000. Project C, 2,50,000. And project D, 2,10,000. And after that, project cash inflows are given from year 1 to year 5. These are the cash inflows. All these are certain cash flows. All these are already received cash flows. No, these are future cash inflows. These are all future cash inflows. Future cash inflows. Yes, sir. So if I invest cash investment of 2 lakhs in project A, from year 1 to year 5, I'll get 50,000 per annum as cash inflow. This is my future cash inflow, right? Which involves some uncertainty. But for doing the problems of NPV, we need to take these assumptions. What are the cash inflows we are assuming for a project? They are certain cash flows. Next. All the cash flows given in the problem are assumed to be occurred at the end of the year. This assumption is quite opposite to payback period assumption. Sir, no. In the payback period, we have learned that the cash inflows are occurred evenly throughout the year. Every day I have an equal cash inflow. Suppose that in year 1, I have a cash inflow of 365 lakhs. Payback period saying that from day 1 to day 365, every day I have an equal cash inflow of 1 lakh. Like that for 365 days, 365 lakhs, my cash inflow. But whereas NPV said that from day 1 to day 364, my cash inflows are 0. Whatever the cash inflows I'm getting only at the end of the year. So day 1 to day 364 work, your cash inflows are 0 and you are getting all the 365 lakhs on day 365th only, the last day. And why we are taking assumption? But just because of the present value factors. What are the present value factors we are seeing in the tables? That factors representing end of the year. See, first year, you have a factor of 0.909 at 10% 1 year. But this factor is representing end of the year. So has your cash inflow should also represent end of the year. So when your cash inflows and factor is end of the year, you can very easily multiply them. Are you following or not? Next. Third assumption, all the cash flows given in the problem are assumed to be reinvested at the cost of capital rate. Whatever the cash inflows we are getting in the project, all the cash inflows are not putting idle. We are reinvesting them at a cost of capital rate. Clear, ma? These 3 assumptions are very, very important assumptions. So after completion of the NPV problem, you have to write the decision depending upon your NPV. And after the decision making, you have to write the assumptions compulsorily. Compulsorily. If you don't write the assumptions, you will lose the marks compulsorily. Clear now? Okay, now? Every one of you. And whenever there is a working capital involving in the NPV calculations, working capital involving in NPV calculations, the working capital will be having impact in 2 steps, ma. First, you have to treat it as your cash outflow. In the step number 1, you have to treat it as your cash outflow. And in step number 3, while calculating terminal cash inflows, you have to consider it as your recovery of working capital as your cash inflow. Recovery of working capital, cash inflow. Are you following, sir? Every one of you. You can see here, In problem number 10, we have a working capital of 5 lakhs. First, it should be treated as your cash outflow. At the beginning of the project, working capital is a cash outflow. At the end of the project, same working capital is cash inflow. Same working capital is your cash inflow. 5 lakhs rupees. Are you following, sir? See, end of the project, whatever the investment, working capital we have invested at the beginning, that will be recovered. That is why we have to consider it as terminal cash inflow again. Initially cash outflow, end of the project cash inflow. Clear? That's the nature of the working capital. Look at the problem number 10. We'll do one problem. Problem number 10. Mama. The United Petroleum Limited has a retail outlet of petrol, diesel, and petroleum project. Presently, it has 2 pumps exclusively for the petrol, right? One for non-lead petrol and one for diesel. Free air filling is carried out for vehicles buying the fuel from the outlet. The pumps have a useful life of 10 years with no salvage value at the end of the year. The UPL sells petrol and diesel at 23 rupees and 10 rupees per liter respectively. Existing annual sales petrol 5 lakhs liter and diesel 2 lakhs liters. And it is earning 4% as commission on sales. Okay. Due to manifold increase in traffic, the existing pumps are not able to meet the demand during peak hours. The UPL is contemplating to installation of the additional pumps for diesel and petrol at a cost of rupees 10 lakhs together and with additional working capital of 5 lakhs. So that is why in step number 1, we have taken the cash outflows, right? So initial investment 10 lakhs, cost of the new pumps and additional working capital 5 lakhs. So the present value of cash outflows 15 lakhs. Step number 1 completed. Next, the additional sales of petrol and diesel expected to be 2 lakhs and 1 lakhs liters per annum respectively. As a result of the installation of the new pump, the operating cost would increase by 24,000 annually by way of salary of pump operator. Other yearly additional costs or insurance at 1% of the cost of the pump, maintenance cost 12,000 per annum, and power cost 13,000 per annum. Okay, these are some additional costs. United Limited Petroleum pays 35% tax on its income. Depreciation will be on straight line basis. And the management of UPL seeks your advice on the financial viability of the expansion proposal. Prepare a report for consideration, assuming 12% is the required rate of return. Simple, sir. Step number 1, we have already done outflows. And step number 2, calculation of the present value of operating cash inflows. Okay, now, so depreciation per annum. While calculating operating cash inflows, first you have to find out the depreciation per annum, because in CFAT calculation, depreciation will be there. You have to consider depreciation. So, and as I said, the problem said SLM method have to be adopted. Cost minus salvage value divided by life will give you the depreciation. Cost of the new petrol pump 10 lakhs rupees and salvage value it is given in the problem 0. And life of the project 10 years. Life of the petrol pump is 10 years. So depreciation per annum you will get 1 lakh. Depreciation per annum you will get 1 lakh. Okay, sir. Next, what is the interest you are getting, sir? Additional sales 2 lakhs liters of petrol at 23 rupees per liter and 1 lakh liters of diesel at 10 rupees per liter. This will be your sales revenue on which you are getting commission of 4%. So commission is your earning here, not the sales amount, sir. Commission is your profits earning here. So 2,24,000 you are earning commission, right? Out of which you incurring some expenditure like salary of the pump operator, insurance charges, maintenance costs, power costs. After deducting all this, whatever you're getting is called as PBDT, profit before depreciation and taxes. Out of which deduct the depreciation, which we calculated in the step number 1. 1 lakh depreciation we calculated, then 65,000 PBD, from which deduct the tax at the rate of 35%, you will get PAT, add back depreciation, you will get CFAT. From year 1 to year 10, you are getting a CFAT of 1,42,250. Since you are getting equal cash outflows after tax, cash flows after tax from year 1 to year 10, you can simply apply annuity factor. Equal cash inflows throughout the life of the project. Annuity factor apply at 12% 10 years. So then you will get the present value of operating cash inflows 8,03,713 rupees. Now coming to the terminal cash inflows, what is the salvage value of the new pump? 0. Gross sale proceeds 0. What is the return on value of the new pump? 0. Because cost 10 lakhs and over a period of 10 years, you claimed a depreciation of 10 lakhs, your return on value will be 0. Capital gains 0. 0 worth of assets sold for 0. So capital gains 0. Capital gains tax 0 and net sale proceeds 0. Okay, now see in the case of SLM method, you can directly go with GSP is equal to NSP. Gross sale proceeds is equal to net sale proceeds, which is equal to 0. In the case of SLM method, written down value method, you have to follow the step-to-step procedure. Okay, now then add back NSP of the asset 0, add back the recovery of working capital 5 lakhs, terminal cash inflows 5 lakhs, and this 5 lakhs you are going to get at the end of the 10th year. Okay, now so but we want present value because we are making decision in present. Multiply with the 10th year present value factor. It is a single amount now, so you have to take the factor, present value factor, not annuity factor. If it is a series of amounts, annuity factor. Single amount, present value factor. So 10th year present value factor 0.322. Then you will get a present value of terminal cash inflows 1,61,000. Now you can find out the NPV, sir. Present value of cash inflows minus present value of cash outflows. Operating cash inflows plus terminal cash inflows minus cash outflows. You got a negative NPV of 5,35,287. So look at the decision. Since the NPV is negative, it's not advisable for the UPL to install the new pumps. Okay, now. And after the completion of decision making, you have to write the assumptions. Clear? So that's how you need to do the NPV problems. Right? So far we have completed traditional techniques, ARR and PBP. In discounting techniques, NPV completed. The next session, I'll start with the remaining discounting techniques. Okay, now. Till then, have a good day and good night. Stay home and stay happy, sir. A very good morning, students. Welcome to the FM Marathon classes. In the last class, we started discussion regarding chapter number 2, investment decisions. And in that, we have completed introduction to investment decisions. And then we started discussion regarding the traditional techniques, also known as non-discounting techniques. They are average rate of return and payback period method. Both are completed. And after that, we started discussion regarding the discounting techniques, in which we have totally 5 discounting techniques: net present value method, profitability index method, internal rate of return method, IRR, and then you have terminal value method, and finally discounted payback period method. Among these 5 methods, in the last class, we have completed about the NPV, net present value method. Right, sir? Now time for the next discounting technique, that is profitability index. Profitability index method, also known as desirability factor. Also known as desirability factor. Sir, what is this profitability index method and how to calculate this? First of all, we have the different names for this method. Profitability index method, and also known as desirability factor, also known as benefit cost ratio, and also known as present value index. In the main exam, right, you may be asked to find out the profitability index, or you may be asked about the desirability of factor. You may be asked about the benefit cost ratio or present value index. All of them are one and the same mark. Clear? Now, a question arises when there is a need arises for the calculation of profitability index. Sir, in the last class, we have already learned that NPV is the best project evaluation technique. It is the most widely used techniques by the finance managers across the world. And when we already had a best technique, what is the need of learning the other discounting techniques? What is the use of other discounting techniques? You'll get a doubt, right, sir? See, each and every project evaluation technique has its own advantages and disadvantages, merits and demerits, have their own features, right, sir? Now, when it comes to the profitability index method, this method generally we will adopt when we are running out of the funds, when we are in scarcity of the funds. Assume that there are 3 projects in consideration. All the 3 projects have the positive NPVs. And we know that if a project having a positive NPV, it is acceptable. So all the 3 projects are acceptable. But unfortunately, we don't have the sufficient investment to make investment into all the 3 projects. We don't have the sufficient funds. We don't have sufficient funds. Now, in that scenario, First of all, we should find out the profitability index of each and every project, and the decision making should be based on the profitability index. The project which is having the highest profitability index should be chosen first. Next to highest should be chosen second. So like that, the decision making goes on. Clear? So when there is a need arises for the calculation of profitability index, when there is a scarcity of the funds. Profitability index should be calculated when there is a scarcity of the funds for investment. Look at this example. Funds available. We have only 10 lakhs with us and 3 projects in consideration, right? So total 3 projects. Project A having the investment requirement 5 lakhs, project B 4 lakhs, and project C 3 lakhs. Total investment required for investing in all the 3 projects 12 lakhs. And you have a positive NPV in all the 3 projects, right, sir? So all the 3 projects are acceptable, but for investment into all the 3 projects, you need the funds of 12 lakhs, whereas you have only 10 lakhs. So there is a scarcity of the funds, 2 lakhs. So that means among these 3 projects, you are able to invest only in 2 projects, not all the 3 projects. Then a question arises, which 2 projects should I choose? Whether it is project A and B, or B and C, or A and C. Now, for that purposes, we should find out the profitability index. What is the formula, sir? Very simple formula, sir. We know the formula for the calculation of NPV. What is the formula, sir? Present value of cash inflows minus present value of cash outflows. This is a formula for the NPV. Now, for the profitability index, very simple, sir. Present value of cash inflows divided by present value of cash outflows. That is a formula for the profitability index. So if you subtract, you will get NPV. If you divide, you will get profitability index. As simple as that. When present value of cash inflows subtracted from the present value of cash outflows, what are you getting? You are getting NPV. When present value of cash outflows, cash inflows divided with present value of cash outflows, you are getting what? You are getting profitability index. Are you following or not, every one of you? Right, sir. Now find out the profitability index for all the 3 proposals, right? So present value of cash inflows for project A 8 lakhs divided by present value of cash outflows 5 lakhs. So profitability index 1.6. Then for project B 1.7 and project C 1.73. For project C 1.73. Are you following or not, every one of you? Now in this scenario, observe, sir, what this 1.6, 1.7 and 1.73 indicates. It indicates about for every rupee of investment, we are getting 1 rupee 60 paise cash inflows. For every 1 rupee of investment, we are getting 1 rupee 60 paise cash inflows. So if you invest 1 rupee, you will get 1 rupee 60 paise cash inflows. So that means for every rupee of the investment, you are getting an NPV of 60 paise. So profitability index explains about NPV for every rupee invested. See, generally we are having enough funds for the investment. Suppose that for all the 3 projects, the funds require 12 lakhs. We have 20 lakhs with us. Now in that scenario, you simply go and invest in all the 3 projects because all the 3 projects are having positive NPVs. There is no need to calculate profitability index. No need to calculate profitability index. No need to go analysis of every rupee invested. What is NPV I'm getting? There is no need. Are you following, sir? When you have the sufficient funds with you, there is no need of looking into the what is the NPV I'm getting for every rupee invested. But when there are scarcity of the funds, you have to be reinvest each and every rupee very carefully. Yes or no? See, when we have sufficient funds with us for doing any expenditure, for meeting any expenditure, we don't think twice. We don't think twice. We'll simply expenditure like that. Are you following, sir? Every one of you. When you have sufficient funds with you, no, yes, I have the funds. But when you are in scarcity of the funds, for every expenditure, you have to think twice and thrice because you're not having enough money with you. Before COVID, the people are, used to spend the money like anything, like water, right? They throw the money like anything for purchase of anything. But after COVID, the situation got changed. Now the people are thinking twice. Should it be required to us or not? Should I purchase it or not? Right? Do I need to incur this much of money for this? Is there any requirement? Is there any need? So they are thinking twice, thrice after COVID, because COVID hits like us anything. There are many people financially weakened like anything. Right, sir? So profitability index importance comes to the picture only when the company facing scarcity of the funds problem. Whenever you are in scarcity of the funds, you have to invest each and every rupee very carefully. Clear now, every one of you. Next. So the decision making rule here, you can see when it comes to the single projects, if profitability index is greater than 1, accept the project. What do you mean by greater than 1? So if profitability index is greater than 1 means your present value of cash inflows are greater than present value of cash outflows. When your numerator is greater than denominator, then only you have a resulting value, the positive resulting value, right? So your cash inflows are greater than cash outflows means you have a positive NPV, accept the project. But whereas if your profitability index is less than 1 means your present value of cash inflows lesser than present value of cash outflows, which results into a negative NPV. Negative NPV, reject the project. If your present value of cash inflows greater than present value of cash outflows, which results into a positive NPV, accept the project. When present value of cash inflows is equal to 0, sorry, profitability index is equal to 0, means your present value of cash inflows are exactly equal to present value of cash outflows. Right, sir? So you may accept the project, you may reject the project. It's up to you, sir. Because your cash inflows are exactly equal to cash outflows. Clear? Next, when it comes to the multiple projects, if the nature is mutually exclusive, accept the project with the highest profitability index. In the given example, in this example, suppose that if these projects are mutually exclusive, means only one project should be selected. Which project will you select, sir? I will go with project C. I will go with the project C as it is having the highest profitability index. Okay, now next, in the case of mutually independent projects, accept all those projects where the profitability index is greater than 1. Select all those projects whose profitability index is greater than 1. Clear? This is how you need to make the decision making under the profitability index. Clear? Next. So that's all about the profitability index. Now here comes yet another very important topic from this chapter, internal rate of return, IRR, internal rate of return. Here it is. So internal rate of return, it is an advanced version of ARR. Advanced version of ARR, average rate of return. So the differences between the ARR and IRR is ARR calculated based on the accounting profits. If you remember the formula for the calculation of ARR, average profit after tax divided by the average investment into 100. Yes or no? So average rate of return, also known as accounting rate of return. Why we are calling it as accounting rate of return? Because it is calculated based upon the accounting profits. Whereas IRR based calculated based on the cash profits, FM profits, CFAT, cash flows after tax. That's the first major difference between ARR and IRR. Next, while calculating the ARR, we ignore the time value of money principles. We ignore the time value of money principles, and also we consider depreciation. But whereas when it comes to the IRR, we will consider the time value of money principles. We need to bring all the cash inflows and our cash outflows into the present values. Then only we can make the calculations. Different years cash flows, we should not be directly added, subtracted, division, multiplied. We cannot compare even. So first we need to bring them, all of them into the present values. Then only we can calculate, compare, and we can do anything. So while calculating IRR, we will consider the time value of money principles and we ignore the depreciation. Even though we calculating the CFAD, like you might have remembered that format: PBDT minus depreciation, PBT minus tax, PAT, add back depreciation. So even though we are deducting initially depreciation, but latter part of time we are adding back, so the impact will be zero. And why we are doing like this? Once we are deducting and after that we are adding back, the reason is being we are claiming the tax benefit on depreciation. That's it. So that means we are, technically speaking, we are ignoring depreciation. We're just considering only the tax benefit on depreciation. That's it. Yes or no? Every one of you. Next. It ignores the opportunity cost. While calculating ARR, we ignores the opportunity cost element. But while calculating IRR, we also considers the opportunity cost element. So these are the differences between ARR and IRR. Whatever the drawbacks are there in ARR, all the drawbacks are overcome in IRR. So by overcoming all the drawbacks in ARR, a new technique has been developed, and that new technique is called IRR. The concept is same. The theme is same. ARR and IRR theme is same, but only thing is that under ARR there are so many drawbacks. Under ARR all the drawbacks were eliminated, overcome. Clear, sir? IRR is the maximum rate of return one can expect from the given project. It is a maximum rate of return we can expect from a given project. IRR is equal to 15%. It is the maximum cost you can bear. See, IRR we can understand in two different ways, from return point of view and as well as from cost point of view. See, whenever you are considering a particular project, let us say there is a project X where the investment required 10 lakhs. Now, when you're considering this project, should I accept this or should I reject this? When you're considering this project, first you should find out the IRR from this project. How much IRR I'm going to get from this particular project. Are you following, sir? Why we need to calculate the IRR? Because suppose that for these 10 lakhs, you have many options. Like you can raise the funds by issuing the equity shares, by issuing the preference shares, by issuing the debentures, by bank loan, by loan from relatives and friends. You have multiple options for the procurement of the funds. Are you following, sir? Suppose that when you're going for the equity capital option, the cost of equity is 20%. When you're going for the preference share capital option, the cost of preference share 16%. When you're going for the debentures option, the cost of debentures is 14%. You have the different cost elements. First of all, you need to find out the IRR from the project so as to know that whether my IRR is covering all these costs or not. Without knowing IRR, suppose that you opted for equity share capital option. By issuing the equity shares, you raised the funds of 10 lakhs. You procured the funds of 10 lakhs. Are you following, sir? Now, with the 10 lakhs, you made investment into this particular project. And after that, you got to know that you are getting only 12% rate of return from this project. Right, sir? But what is the cost you have incurred for this project? You have incurred a cost of 20%, but end of the day, you are getting a return of 12% only. So means this project is not viable, not suitable to you. You shouldn't have made investment into this project. Yes or no? Right? But you already made investment. This is an investment decision which involves the huge amount of investment of your business, which is having a long-term impact. These decisions are irreversible. You cannot take back your decision, man. So you have to face that losses for a longer period. At one point of time, you're always in a danger of shutting down your business. So that's why without knowing the return element from a project, you should not accept the project. First, find out the return which you are going to get from that particular project. When you know that I'm going to get only 12% rate of return from this particular project, you shouldn't have opted for these options. None of these options should be exercised for the procurement of the funds. You might look for another option which having a cost of less than or equal to 12%. Suppose that one of your friend came out and your friend is ready to give you a loan and he's charging just a rate of interest of 10%. Yes, this option is viable to you because you're incurring a cost of 10%, whereas the project is giving you 12% rate of return. Yes, now this project is viable to you. Are you following or not? So that is why everyone first should find out the IRR. Then only you have to make a decision whether this project is viable to us or not. After finding out of the IRR, you need to compare that IRR with the cost of capital. If your IRR and the project return is greater than cost of capital, yes, accept the project. If your IRR is less than cost of capital, reject. If your IRR is equal to cost of capital, you may accept the project or you may reject the project. Every one of you following now? Right, sir. Next. So that is why it is the maximum rate of return one can expect from a given project, and it's the maximum cost you can bear. Suppose when you know that your IRR from the project is equal to 12%, and when you're looking for the procurement of the funds, you have multiple options available. Which option will you choose? Generally, the option which is having the cost less than or equal to 12%. So you can set to your suppliers of the funds. You can set to your lenders, dear lenders, I can bear a maximum cost of 12% only because my project is giving me only 12% rate of return. So that's why IRR can be discussed in both ways. Number one, it is a maximum rate of return one can expect. Number two, it is a maximum cost you can bear for the project. Clear? So that is why at IRR, NPV is equal to 0. NPV is equal to 0. Are you following, sir? Right? At IRR rate of return, your NPV is equal to 0. It is a rate of return which equates your present value of cash inflows is equal to present value of cash outflows. Which equals present value of cash inflows is equal to present value of cash outflows. Every one of you following now? Next. For the calculation of IRR, you have different scenarios. And first of all, before going to that, you can see the other names of IRR. In the main exam, you may be asked to find out yield on investment. What do you mean by yield on investment? Nothing but IRR. You may be asked to find out the marginal efficiency of capital. Nothing but IRR. You may be asked about the rate of return over cost. What is rate of return over cost? Nothing but IRR. Time adjusted rate of internal return, IRR. Productivity of the capital, marginal rate of return. All these are the other names of IRR. Okay, now different scenarios for the calculation of IRR. First one, for an investment with a single cash flow. Means, look at here. You made an initial investment of 20,000 and after 2 years, you are going to withdraw an amount of 25,992. So in Y0, you made an investment of 20,000 rupees. At the end of year 2, you are going to get an amount of 25,992. Now, you know the present value, you know the future value, you know the number of years as well, 2 years. What is missing, Amma? Rate of interest. Rate of interest missing. Right, sir? These kind of models we have done in the first chapter itself, time value of money. Right, sir? Now, either here you can apply future value of single amount formula, or you can apply present value of single amount formula, whereby you can find out the R, rate of interest. Clear? That's first scenario. Second scenario, single cash outflow with multiple equal cash inflows. Means here in Y0, you made an investment of 10 lakhs. And your cash inflows are like this. Year 1, 2,50,000. Year 2, 2,50,000. Year 3, 2,50,000. So on up to year 6. Every year you have a equal cash inflows. So you know the present value, 10 lakhs rupees. You know the periodical payments. This is present value of annuity because there is a series of payments which are occurring at the regular intervals in equal amounts. So you know the present value of annuity, you know the periodical payments, you know the term of annuity as well. How much amount? 6 years. What is missing, sir? Rate of interest. So apply the present value of annuity formula and find out the rate of interest. This model also we have done in the first chapter. Okay. Scenario 4. Before scenario 3, first I have discussed here scenario 4 because scenario 4 is the present value of perpetuity. Single cash outflow with multiple uniform cash inflows for infinite period. Means you made an investment of 1 lakh in year 0. Sorry, 10 lakhs in year 0. You made a deposit of or investment of, right, 10 lakhs in year 0. And from year 1 till year infinity, you are getting a cash inflow of 1 lakh every year. Right, sir? Present value of perpetuity. You know the present value of perpetuity? You know the annual cash inflows. We know the formula that present value of perpetuity is equal to annual cash inflows divided by rate of interest. Yes or no? Present value of perpetuity is equal to annual cash inflows divided by rate of interest. Just a second, sir. Annual cash inflows divided by rate of interest. Now, rate of interest is తీసుకొచ్చేయండి. Rate of interest is equal to annual cash inflows divided by present value of perpetuity. Yes or no? So that's the formula we have used here. Annual cash inflow 1 lakh and present value of perpetuity 10 lakh. So the rate of interest 10%. That's scenario 4. Now coming to the scenario 3. Single cash outflow with multiple cash inflows not in uniform over its life. Right, sir? So means like example, in year 0, you made an investment of 10 lakhs. And your cash inflows like year 1, 2 lakhs, year 2, 3 lakhs, year 3, 4 lakhs. So you can see here, there is no uniform cash inflows. Every year there is a change in the cash inflow. Like some year 4, 2,50,000, year 5, some 2,20,000. Uneven cash flows throughout the life of the project. Uneven cash flows. Now, in that scenario, for the calculation of IRR, you have 2 methods available. Number 1, trial and error method. Number 2, interpolation technique. Trial and error method, and number 2, interpolation technique. How to find out? When it comes to the trial and error method, step 1, calculate the NPV at a guess rate. First, for the given cash inflows, find out the NPV at a guess rate. Take any guess rate like 10%, 12%, 15%, any guess rate. Calculate the NPV. If NPV is positive, increase that guess rate. When your NPV is positive, increase the guess rate and find out NPV again. If your NPV is negative, decrease the guess rate and find out the NPV again. Suppose that at 12% guess rate, you have a positive NPV of 10,000. You have positive NPV. So you need to increase the guess rate. Means you need to find out the NPV either at 14% or 15%. Suppose that you find out the NPV at 16%. You got a negative NPV of 2,000. You got a negative NPV of 2,000. So means you need to decrease the guess rate. Let us find out that at 15%, you got NPV is equal to 0. So now your IRR is equal to 10%. So this is how one has to find out the IRR by using the trial and error approach. Right? This process continue until NPV is equal to 0. The discounting rate at NPV at which NPV becomes 0, that is your IRR. So under trial and error method, first we have to calculate the NPV at a given guess rate, a particular guess rate. A guess rate ఏంటనేది that depends upon your choice. మీరు 10% తో స్టార్ట్ చేస్తారా, 15% తో స్టార్ట్ చేస్తారా, your choice. Are you following, sir? Every one of you, right? Next. And sir, second guess rate, how to take the second guess rate? Suppose, sir, at 10% you started, you got a positive NPV of 10 lakhs. So when you have a positive NPV, you need to increase the guess rate. Now, immediately don't calculate the NPV at 11% because see, the guess rate at which NPV is equal to 0 is your IRR. So your NPV should become 0 and your NPV should be reduced by 10 lakhs. Right? If you increase the guess rate by just 1%, your NPV should not be reduced by 10 lakhs. In order to reduce the 10 lakhs, you have to go for a long jump. Means the second guess rate should be at 20%. 11%, 12%, 13%. No, there is a huge amount to be reduced. Inga 10 lakhs taggalamma. NPV 0 avali ante 10 lakhs taggali. 10 lakhs needs to be reduced in order to make your NPV 0. So you have to take a long jump for the second guess rate. Are you following or not? Every one of you. So wisely, you have to select the guess rate. And the process continues until your NPV becomes zero. The guess rate at which your NPV becomes zero, that is your IRR. Clear? So trial and error gives the most accurate answer, but lengthy process and lot of calculations involved. Okay. Now coming to the interpolation technique. The process is step number 1. Calculate the NPV at the two guess rates, higher guess rate and lower guess rate. Are you following, sir? Higher guess rate, say 10 percentage, sorry, 15 percentage. 15 percentage. Lower guess rate, 10 percentage. Right, sir. And while selecting this higher rate and lower rate, there are two principles to be satisfied. Number 1, at one guess rate, the NPV should be positive. At the other guess rate, NPV should be negative. NPV should be negative. Are you following, sir? Every one of you. At one guess rate, NPV should be positive. At the other guess rate, NPV should be negative. Next, the gap between these two rates should be as low as possible. So means it must be some 10% to 11%, either 10% to 12%. So you have to make sure that the gap between the two guess rates is as low as possible. If you are satisfying these two principles at the two guess rates, then you will get most accurate answer. So at one guess rate, your NPV should be positive. At the other guess rate, NPV should be negative. And the gap between these two guess rates should be as low as possible. Clear? Now, after finding out the NPV at the two guess rate, now apply this formula. Interpolation technique, we have a formula. L1 plus NPV at L1 divided by NPV at L1 minus NPV at L2 into L2 minus L1. L1 is a lower guess rate and L2 is a higher guess rate. Okay. Now interpolation technique, which gives you the most accurate, most approximate IRR. It is involving a simple process, less calculations. Clear? In the main examination, right, generally the students follow, and we also suggest interpolation technique only, because trial and error method takes a lot of time, which involves a lot of calculations. But whereas under interpolation technique, simply find out NPV at the two guess rates, and after that apply the formula, find out the IRR. That's it. Even the ICI is also suggesting interpolation technique for the finding out of the IRR. Clear? Next. After that, IRR decision making techniques, you can see here. In the case of single projects, I've already discussed. If IRR is greater than cost of capital, accept. Less than cost of capital, reject. Is equal to cost of capital, may accept or may reject. In the case of multiple projects, mutually exclusive, means only one project should be selected. Select the project with the highest IRR. In the case of mutual independent, we can select more than one project. So select all those projects whose IRR is greater than cost of capital. Clear, ma? Every one of you? Okay, now in the IRR also, you have some assumptions, just like you have the assumptions in NPV. The assumptions will be, right, the first assumption, all the cash flows given in the problem are assumed to be certain cash flows. Number 2, all the cash flows given in the problem are assumed to be occurred at the end of the every year. And number 3, all the cash flows given in the problem are assumed to be reinvested at IRR rate of return. So generally in NPV, if you remember, under NPV, we also learned 3 assumptions. The first 2 assumptions are same, that is certain cash inflows. And number 2, all the cash flows are assumed to be occurred at the end of the every year. And number 3, all the cash inflows are assumed to be reinvested at cost of capital rates. So this is the difference between IRR assumptions and NPV assumptions. Under IRR, all the cash inflows are assumed to be reinvested at IRR rate of return, whereas when it comes to the NPV, all the cash inflows are assumed to be reinvested at cost of capital rate. Clear? Very good, ma. So with that, IRR completed, sir. Just go through it once and ask the doubts if any, sir. Completed, sir. Now let's moving on to the next model, payback period reciprocal. Now, what is this concept of payback period reciprocal? Very simple concept, ma. Payback period reciprocal is nothing but the reciprocal of the payback period, the reversal of the payback period, reciprocal. So the formula you can see here, payback period reciprocal is equal to 1 divided by payback period into 100. 1 divided by payback period into 100. So reciprocal payback period is equal to 1 divided by payback period. We know the payback period formula. What is that, ma? Initial investment divided by annual cash inflows. But annual cash inflows take to the numerator. So the payback period reciprocal is equal to annual cash inflows divided by initial investment. Reversal, ma. Clear. So generally, why are we calculating this payback period reciprocal? Simple answer, sir. We are calculating the payback period reciprocal only with a view to estimating the IRR. It is a rough estimation of IRR, sir. Payback period reciprocal is a rough estimation of IRR. Right, sir. See, while calculating IRR for a given project, for a rough estimation, you can go ahead with the payback period reciprocal. Right. See, you can see if a particular company's payback period is 5 years, the payback period reciprocal is equal to 1 divided by 5 means 0.2 or 20%. You can say from this project, roughly we can get an IRR of 20%. Right, sir. But of course, we cannot use this IRR as a decision making technique here. Whatever the IRR you find out by using the payback period reciprocal is not an accurate IRR. It is just a rough estimation. But of course, while calculating the IRR by using payback period reciprocal method, first of all, there are two conditions to be satisfied. Number one, there must be equal cash inflows throughout the life of the project. Number two, the life of the project must be at least twice the payback period. Twice the payback period. Like in this case, we have said the payback period is 5 years. Now, in this case, the life of the project must be 10 years. Suppose that the life of the project is 6 years and you find out the payback period, which comes up to be 4 years. Now, in this case, payback period reciprocal is equal to 1 divided by payback period means 1 divided by 4, that is equal to 25%. So IRR for this project 25%, no. Because the second condition was not satisfied here. The life of the project must be at least twice the payback period. What is your payback period? 4 years. Twice the payback period means 8 years. So the life must be 8 years in this case. Then only you can say this 25% is a rough estimation of IRR. Are you following, sir? Every one of you. Next. That's the payback period reciprocal, sir. And after that, discounted payback period method. Next model, sir, discounting payback period method. Of course, in discounting techniques, as you all know that totally 5 techniques are there. First one, NPV, discussion completed. Then IRR, discussion completed. Then profitability index, discussion completed. Then terminal value method, discussion not yet completed. And finally, discounted payback period method. Now we are going to discuss. So then what about this terminal value method, sir? This terminal value method I'm going to discuss in the advanced concepts in investment decisions. I've already told you that this investment decision chapter divided into 3 parts. This is the first part we are learning, basics. Second part, advanced concepts in investment decisions. And third part, risk analysis in capital budgeting decisions. Okay, ma. So among the 5 discounting techniques, 4 discounting techniques I'm going to discuss here. The last discounting technique, terminal value method, I will discuss in the advanced concepts in investment decisions. Every one of you following now? Okay, ma. Now coming to the discounted payback period method. Now what is this concept all about? Very simple concept, sir. We already know the traditional payback period method, right, sir? We have seen that when there is uniform cash inflows throughout the life of the project, there is a formula we have learned, initial investment divided by annual cash inflows. When there are uneven cash flows, then you have to find out the accumulated cash inflows. Then after that, you need to apply a formula. Year up to which the accumulated cash inflows lower than the initial investment plus unrecorded investment divided by the cash inflows for the next year. Yes or no? But the major drawback under the traditional payback period method is It ignores time value of money principles. We simply accumulate the different years cash inflows directly. Yes or no? Like that, sir. Year one, your cash inflows. Sorry, sir. Your cash inflows, let us say, year one, 1 lakh, year two, 1.5 lakh, year three, 2 lakh, year four, 2.5 lakh. You have the cash inflows like this, right, sir? Now, cumulative cash inflows, what are you going to do? 1 lakh, 2.5 lakh, 4.5 lakh, 7 lakh. So you're simply adding, sir. You're simply adding. So different years cash flows, you're simply adding. But as per the golden principles of the time value of money, we know that very well, right? The worth of 1 rupee today is not equal to the worth of 1 rupee tomorrow. You cannot simply add the different years cash flows directly, right, sir? But whereas in payback period method, we simply added them. We ignore the time value of money principles. But under discounted payback period method, we will consider the time value of money principle. And that means first we will discount these cash inflows. Whatever the different years cash inflows are there, these different years cash inflows discounted first. Let us say the cost of capital given in the problem 10%. So we will take the present value factors at 10%. So 0.909, 0.826, 0.751, 0.683. Then we'll find out the present value of cash inflows. Now this present value of cash inflows will be cumulated. After the present value of cash inflows, next cumulative present value of cash inflows. Are you following, sir? Every one of you. So discounted cash flows will be cumulated. And after accumulating, apply this formula for the finding out the discounted payback period method. Year up to which the present value of cumulative cash inflows are lower than initial investment plus unrecorded investment divided by present value of cash flow after tax for the next year. So the major difference between the traditional payback period method and discounted payback period method is under traditional payback period method, we ignores time value of money principles. We will simply added the different years cash flows directly. But under discounted payback period method, we will consider the time value of money principles. Only the discounted cash flows will be cumulated. Clear? Next. After that, you have one more topic called capital rationing, the last topic of the chapter, capital rationing. Now, what is this concept of capital rationing? Look at here. Capital rationing concept we will apply only when there is a scarcity of the funds. Right, sir? Sir, when we have scarcity of the funds, we all know that the decision making should be based on profitability index method. Yes or no? Right? So when you have sufficient funds, go ahead with the NPV. Right? Select the projects which are suggested by the NPV. But when you are in scarcity of the funds, go ahead with the profitability index. The projects which are suggested by the profitability index should be selected. Okay, na sir? Right? Next. So when it comes to the multiple projects, especially, and mutually independent projects, mainly. See, mutually exclusive, only one project should be selected. So the project which is having the highest profitability index, directly we will select. No problem at all. But when it comes to the multiple projects which are mutually independent, where we can select more than one project, Now there arises a question, which project should be selected? Right? Which are the projects should be selected? More than one project. Suppose that there are 4 projects, project 1, project 2, project 3, and project 4. All the 4 projects having positive NPV. So means all the 4 projects can be selected. But for making investment into all the 4 projects, you want 50 lakhs funds, but you have only 40 lakhs funds. You're running out of the funds. You have only 40 lakhs. Means among these 4 projects, only 3 can be selected. Now you will get it out which 3 projects should be selected. Right, sir? Now in that scenario, you have to go for the capital rationing. The project selection should be based on the capital rationing. Okay, now what is the process of capital rationing? Step 1, calculate the profitability index for all the projects. First, find out the profitability index for all the given projects. And step 2, assign the ranks based on the profitability index. Assign the ranks to the projects. Assign the ranks to the projects basing upon the profitability index. How, sir? Sir, the project which is having the highest profitability index should be given first rank. The project having the next highest profitability index should be given the second rank. Like that, you can go ahead. Let me give you an example. Yeah, look at here, sir. There are totally 5 projects in proposal. 5 projects. 1 second, sir. So totally there are 5 projects in consideration. Now look at here, sir. The funds required for all these 5 projects, you can see 7, 9, 14, 16, 17, 22 lakhs at the funds required, sir. 22 lakhs. Now you can see I've given the funds required for investing on all the projects 22 lakhs and funds available for the investment just 20 lakhs. So from the above calculation, it is clearly evidencing that the Shrestha Limited is in scarcity of the funds. Therefore, the discussion as to which project should be selected based upon the capital rationing. So all the 5 projects, you can see that all the 5 projects have the positive NPVs. So all the 5 projects are acceptable, but we don't have enough funds to make investment into all the 5 projects. So means here we have to select only 4 projects or 3 projects. So which 4 projects, which 3 projects should be selected? That should be based on your capital rationing. So in the step number 1, we have to find out the profitability index. Yes, we did that profitability index. And in step number 2, we need to assign the ranks to the projects basing upon the profitability index. You can see here, project E having the highest profitability index, 1.82. So given the first rank. Then project B next highest, 1.64, second rank. Project D next highest, 1.5, third rank. Like that, you need to assign the ranks. And after assigning the ranks, then you have to make the decision making, which projects or projects should be selected. So the selection of the projects based upon the rankings. Look at here. In this concept, you have one more concept like the project's nature, types of the projects, divisible projects and indivisible projects. Divisible project means part investment also allowed. And if you are not having enough funds to invest in a particular project, suppose that after investing project A, C, and D, in A, C, D, you made a full investment. Only project B is left over where the funds are required, let us say 5 lakhs rupees. But you left with only a fund of rupees 2 lakhs. So you don't have sufficient funds to make investment in project B. You have only 2 lakhs. No problem. This 2 lakhs you can invest. Part investment is allowed. 2 lakhs you can invest and proportionate NPV will be allowed. See, if you made an investment of 5 lakhs, let us say your NPV is say 3 lakhs. So for 5 lakhs investment, you are going to get an NPV of 3 lakhs. But for 2 lakhs investment, what will be the proportionate NPV? Calculate Chandama, 2 lakhs into 3 lakhs divided by 5 lakhs. So you will get 1.2 lakhs. So proportionate NPV will be allowed to you. Are you following, sir, every one of you? Right? This is the nature of divisible projects. When it comes to the indivisible project, part investment is not allowed. If you have enough funds, come and invest, otherwise get lost. Okay, now. So in this case, only project A, C, D can be selected. B, no, not possible. Because you don't have the sufficient funds. Right, sir? So like this, divisible projects and indivisible projects. Here, look at first indivisible projects, the project's nature I've taken divisible projects. So when it comes to the divisible project, you have to go with the rankings. First rank goes to who? First rank goes to project E. So the investment first should be made in project E. Investment required 5,50,000. And after investing 5,50,000, the surplus investment available 14,50,000. NPV 4,50,000. You are getting an NPV from project E. How much, Amma? From project E, you are getting an NPV of 4,50,000 for the investment of 5,50,000. Clear. Next goes to the project B, second rank, then third rank project, then fourth rank project. Now, after making investment in these 4 projects, you have a surplus funds of 3 lakhs. You have a surplus funds of 3 lakhs. But when it comes to project C, what is the funds required? 5 lakhs. You have left with only 3 lakhs. You have left with only 3 lakhs. Only that 3 lakhs can be invested. And proportionate in NPV you will get. For the investment of 5 lakhs, 2 lakhs will be NPV. For the investment of 3 lakhs, how much? The proportionate NPV you will get. Are you following or not? This is the way of making decision making under the capital rationing when it comes to divisible project. When it comes to indivisible projects, you have to invest in the projects lump sum. All right, you need to select more than one project at a time in a lump sum manner. So you can see here, I've selected project A, B, C, E, where the investment required 20 lakhs, surplus investment 0. I'm getting NPV of 11,10,000. You can try the different permutations and combinations. And while you're trying the term permutations and combinations, you have to make sure that your entire investment is to be used. Right, sir? So here I've used entire investment 20 lakhs. There is no investment left with. That is why I'm getting the highest NPV 11,10,000. I have one more option, ACDE, but whereas my funds involving is only 19,50,000, I left with a surplus investment of 50,000. That's why my NPV is just 10,50,000 only. Clear now? Like this, you need to try for some different combinations. And while trying the different combinations, make sure that your entire investment is used. Then only you will get the highest NPV. Clear? So that's how you need to make the decisions with respect to indivisible projects. Clear? So that's about the capital rationing concept. So with that, we have completed all the theory topics of this chapter. Okay, Nasir? Right. So see you in the next class here. Just so in the next class, I'm going to start with the cost of capital chapter marathon. Okay, ma? So yet another important chapter, cost of capital, capital structure. These 2 chapters, from these 2 chapters, we can expect at least one question, sir. One problem compulsory for 8 marks. The next 2 chapters, cost of capital and capital structure. Okay, ma? So see you in the next class, sir. Till then, have a good day and good night. Stay home and stay safe. A very good morning, students. Welcome to the FM Marathon classes. In the last class, we have completed discussion regarding chapter number 2, investment decisions. Right, ma? Now, time for the chapter number 3, cost of capital. Cost of capital. Now, what is cost of capital and what are we going to learn from this chapter? So the weightage of the chapter, we can expect one question from this chapter for 8 marks. And these are the different models from this chapter. Cost of debentures, KD, cost of preference shares, KP, cost of equity shares, KE, cost of retained earnings, KR, and weighted average cost of capital, WACC, denoted with KO. Overall cost of capital. These are the different models we are going to learn from this particular chapter. Now, what is cost of capital? It's nothing but the cost associated with source of capital. See, what for the procurement of the funds, you will be having different options now. Like you will be having the options of procuring the funds by issuing the equity shares, procuring the funds by issuing the preference shares, procuring the funds by issuing the debentures or bonds, procuring the funds through loans from the banks, relatives, friends, right, sir? So like this, you have different options. For every option, you have a cost element. For every option you are selecting for the procurement of the funds, you have a cost element. Like for equity shares, cost of equity means dividends plus appreciation in the market price. I've already mentioned here, dividends plus appreciation in the market price. Preference shares, preference dividend is a cost. Debentures, debentures interest is a cost. Loans, interest on loans is a cost. So for every source you are selecting for the procurement of the funds, there is a cost element associated with it, and this is what we call cost of capital. This is what we call cost of capital, the cost associated with each source of capital. Every one of you following now. Now the same is called as investors expected rate of return. See, from one person point of view, it is a cost. From the other person point of view, it is a return. Yes or no? From one person, it is a cost. From the other person point of view, it is a return. From company point of view, it is a cost. From investor point of view, it is a return. Right, sir? So from investor point of view, it is the expected rate of return from his investment. So when a equity shareholder investing into the equity shares of a company, for company, the cost of equity is a cost element, and from the investor point of view, it is a return from his point of view. Right, sir? Look at here, sir. Example that you have a funds of rupees 10 lakhs with you. Now you would like to make a fixed deposit. You have chosen two options: fixed deposits into SBI and fixed deposits into HDFC. Right? One is a government bank, the other one is a private bank. Now coming to the SBI offering you 6% rate of interest on fixed deposits. And the FD into SBI is a risk-free investment because it is a government bank. Even in future, if that bank is unable to pay you the interest or unable to pay you the principal, government will come forward and government will take the responsibility to pay you. But whereas the investment into HDFC is a risky investment because HDFC is a private bank. Even though it is a #1 private bank for the time being, it stood in the #1 rank in the private banks list. But when it comes to the private banking sector, always the investment in private banks is always linked up with the risk element, because today HDFC is in the first position, tomorrow it won't be. Earlier ICICI Bank in the first place, now it is in some top 3 or top 4 or top 5. Right, sir? So top 1 position is not permanent to anyone when it comes to private industry. Clear? So always a risk element is involving. If in future, if HDFC made any default in the payment of interest or principal to you, whether the government will take responsibility? No, the government won't take responsibility because it is a private bank. Yes or no? Right, sir? Now, when SBI and HDFC offering you the same rate of interest, which option will you choose? Obviously, we'll choose SBI only. Because it is a risk-free investment. But how come the HDFC will attract the depositors, account holders? HDFC will attract the account holders by offering more rate of interest. Suppose that if HDFC is now providing 10% per annum interest on fixed deposits, now definitely some of the account holders will turn to HDFC. Sir, HDFC risky investment, yes, but the returns is higher. No, see, whenever you are ready to take the high element of risk, you can expect high amount of returns. When you are taking only low amount of risk, then you should expect low amount of returns only. So whenever you are making investments, so risk-free investments, the returns are lower. Whenever you are opting for risky investments, then only you can expect higher returns. You can expect higher returns, but there is no guarantee that you will get higher returns. See, by taking the higher element of risk, there is no guaranteed higher returns. But the only thing you can expect higher returns. If you get them, very happy. Are you following or not? See, investment into the real estate sector is a high risky investment because the returns are also higher. But we don't know that when the real estate will have the boom and when the real estate will have down. Investments into the stock markets, also a high risky element. Right? Thereby you can expect high amount of returns, but we don't know how the stock markets behaves. Yes or no? Right? How the stocks behaves. So whenever you are choosing for risky elements, you will get higher returns, but there is no guarantee. You can expect higher returns. Clear, sir? So when HDFC offering 10% rate of interest, at least 50% of the investors will turn towards HDFC. Out of this 10%, 6% we can say risk-free rate of investment, risk-free rate of return. Because anyhow 6% is offered by the SBI, risk-free rate of return, right? And the additional 4% offered by the HDFC is now what we call a risk premium, RM, risk premium. Risk premium is nothing but the additional return expected by the investor for accepting the additional risk. So whatever the additional risk is accepting, for additional risk, he will expect some additional returns. And that additional returns is what we call risk premium. Everyone following now? So from the above discussion, we can conclude that investors' expected rate of return is equal to risk-free rate of interest plus risk premium. Clear? So the same will become the cost of capital from company point of view. Whatever we are discussing, investors' expected rate of return from investor point of view, the same will become the cost from company point of view, cost of capital. Then a question arises. So why should we calculate cost of capital? What is the need of calculating cost of capital? Mainly two reasons. Number one, for the calculation of NPV. For the calculation of NPV, cost of capital is must. Without knowing the cost of capital, you cannot calculate NPV, sir. Yes or no? You can see in every NPV problem, you have cost of capital information. Let me take you there. So NPV started from here, net present value. And you can see in every problem, you can see the company's cost of capital is 10%. Now here, the cost of capital of ABC Limited is 12% in problem number 8. Problem number 9. The cost of raising the additional capital is 12%. Problem number 10. Assuming 12% required rate of return. From investor point of view, rate of return, the same becomes cost from company point of view. Problem number 11. Somewhere it must have been provided. Actually, here what happens? The present value of future cash inflows directly given in the problem. Hence, the cost of capital information is not given. Generally, with the help of the cost of capital only, we will calculate the present values of all future cash inflows. So already present value of future cash flows are provided directly in the problem itself. That is why cost of capital information is not given in the problem number 11. Now look at the problem number 12. Considers 12% to be an appropriate after-tax cost of capital. 12%. Problem number 13. Where it is cost of capital 12%. Clear, sir, every one of you. So for the finding out of the NPV, cost of capital information is must, right, sir? Right. For evaluation of the investment proposals, cost of capital is a must ingredient. Number 2, for making decisions by using IRR. IRR even in the case of ARR also. If you remember the decision making rule under ARR and IRR, ARR and IRR should be compared with the cost of capital, and after that we have to make a decision. So without knowing the cost of capital, you cannot make the decisions under IRR. So these are the two main reasons why we are calculating the cost of capital. Clear? And as we see the models already, the first model, cost of debentures. Cost of debentures. Sir, for the debentures word, there is a prefix already, always. There is a prefix. Like whenever you're observing the debentures word, you observe a prefix. 10% debentures, 12% debentures, 15% debentures, like this. Clear? Whatever the prefix providing here, this prefix is a coupon rate of interest. It is not the cost element. It is just coupon rate of interest. The rate of interest offered by the company on such debentures. Coupon rate of interest. Now, cost of debentures is equal to coupon rate of interest, for which we need to make certain adjustments, plus or minus some adjustments we have to make. Thereby, you will get the cost of debentures. What kind of adjustment? Look at the first one. Debentures are issued at par but redeemed at premium. You issued at 100 rupees, but at the time of repayment, you are paying 120 rupees. So there is a loss to you. So whereby your cost of debentures increases. Next, debentures are issued at discount, redeemed at par. Issued at 90 rupees, but you're redeeming at 100 rupees. So at the time of issue, you received only 90 rupees from the investor, But at the time of repayment, you are paying 100 rupees to the investor. You are paying 100 rupees to the investor. So here also the cost of debentures increases. It's a loss to you. The cost of debentures increases. Next, debentures are issued at premium, redeemed at par. Issued at 110 rupees. So you collected 110 rupees from the investor, but at the time of repayment, you are paying only 100. So whereby your cost of debentures decreases. Tax savings on interest. Debentures interest is a tax deductible expenditure. It is a charge against to profits. You can debit the interest to the profit and loss account, whereby your profits will get reduced, whereby your tax liability will get reduced. Tax benefits on interest. So by adjusting this tax benefit, your cost of debentures will get reduced. Flotation costs. Flotation costs are nothing but issue expenses, right? Whatever the expenses we have incurred in relation to the issue of debentures, they are called as a flotation cost, right, sir? So debentures, assume that you have issued 50 lakhs worth of debentures, you have incurred flotation cost of 2 lakhs. So net sale proceeds you can take only 48 lakhs. Though you have issued 50 lakhs worth of debentures, ultimately you received only 48 lakhs. So it's a loss to you, whereby your cost of debentures increases. So like this, we need to make some adjustments to the coupon rate of interest. Thereby you will get a cost of debentures. Clear? So here the debentures are mainly into two types: irredeemable debentures, redeemable debentures. And when it comes to redeemable debentures, again two subcategories: redeemable at once, redeemable in installments. Okay, first one, cost of irredeemable debentures. Means these debentures are not going to be redeemed during the lifetime of that company, during the lifetime of that particular debenture. These are irredeemable, non-repayable. Clear? So pre-tax cost of debentures before the tax element. If tax rate is not provided, then you have to find out the KI. The formula will be interest divided by net sale proceeds. Interest divided by net sale proceeds. This formula we have derived from the concept of present value of perpetuity. Present value of perpetuity. Do you remember the formula? Present value of perpetuity is equal to annual cash inflows divided by a rate of interest. Now, if you find out the rate of interest, the formula will be annual cash inflows divided by present value of perpetuity. Yes or no? This formula already we have learned in the first chapter. So here we are finding the rate of interest. So nothing but cost of debentures is equal to annual cash inflows. What is the cash inflow to investor? Interest divided by present value of perpetuity. How much is investing in lump sum? Net sale proceeds. Right, sir? So this formula is derived by using the concept of the present value of perpetuity. Perpetuity means what? Forever, unlimited. Yes or no? Here also this is irredeemable debentures. Once you made investment into this irredeemable debentures, you are going to get the interest forever. For infinite period, you are going to get interest. Clear now? Next, post-tax cost of debentures. If tax rate is provided, then from the interest element, deduct the tax element, then you will get the post-tax cost of debentures. KD, I into 1 minus tax rate divided by NSP, net sale proceeds. The other formula is cost of post-tax cost of debentures is equal to KI into 1 minus tax rate. In this formula also you can find out. Okay now. So T stands for tax rate. NSP is equal to net sale proceeds. Nothing but issue price minus flotation cost. Issue price minus flotation cost. Clear, sir? So that's about the cost of debentures. Right? You can see one example here. Debentures worth 10 lakhs issued, coupon rate of interest 10%. The interest per annum becomes how much, Amma? 1 lakh. And when you asked to find out the KI, means pre-tax cost of debentures, what is the formula? Interest divided by net sale proceeds. Interest per annum 1 lakh divided by net sale proceeds 10 lakhs. So KI is equal to 10%. KI is equal to 10%. Got it, everyone? Right, sir. Now coming to, if tax rate is provided 30%, tax rate information is provided 30%. KD, you need to find out the KD, post-tax cost of debentures. KD is equal to I into 1 minus tax rate divided by net sale proceeds. So interest 1 lakh we know, 1 minus tax rate 1 minus 0.3, tax rate given 30%, no, in decimals 0.3 divided by net sale proceeds 10 lakhs. So the formula will be 70,000 interest after tax, 70,000 divided by net sale proceeds 10 lakhs. So KD is equal to 7%. We also learn one more formula. KD is equal to KI into 1 minus tax rate. KI we already find out 10% into 1 minus tax rate, 1 minus 0.3. So KD is equal to 7%. In this formula also you can find out. But this formula you have to use only when there is no flotation cost. Only when there is no flotation cost. Every one of you following the next. Sir, in case a flotation cost information is provided, then KI is equal to interest divided by NSP, interest 1 lakh, net sale proceeds 9 lakhs. Because the issue price is 10 lakhs minus flotation cost 1 lakh. So the net sale proceeds 9 lakhs. So 1 lakh interest divided by net sale proceeds 9 lakhs. So cost of pre-tax cost of debentures is equal to 11.11%. Okay now. This is with respect to the cost of irredeemable debentures. Now coming to redeemable debentures. Yeah, here it is. Calculation of cost of redeemable debentures. As we all know that there are two submodels, redeemable at once, redeemable in installments. Redeemable at once means, sir, we have issued the debentures in Y0 and we have told to the investor in Y10, we will redeem your debentures. So at the end of the 10th year, the debentures will be redeemed. So we can say redemption period is equal to 10 years. N is equal to 10 years. So the debentures are redeemable and we are going to redeem at once. Clear? So in this case, for the calculation of the cost of debentures, we have two methods available. One is IRR method and the other one is shortcut method. IRR method and shortcut method. Okay, ma. Now coming to the IRR method, how to calculate? Very simple, sir. In investment decisions chapter, we have learned how to calculate IRR. How to calculate IRR. The same process you have to follow. First, you have to define the cash flows for the given situation. After defining your cash inflows and cash outflows, then either you can follow trial and error approach or you can follow the interpolation technique for the calculation of IRR. Find out the IRR, then the same will become cost from company point of view. From investor point of view, it is IRR. From company point of view, it is cost element. Next, the second method available is a shortcut method. We have a formula approach. Pre-tax cost of debentures is equal to interest plus RV minus NP divided by N whole divided by RV plus NP divided by 2. RV stands for redemption value. NP stands for net sale proceeds. N is equal to redemption period, number of years. Clear, sir? So what is the meaning of this formula? Very simple, sir. Let us assume that we have issued debentures worth 10 lakhs. We have issued debentures worth 10 lakhs. And we have incurred some flotation costs of rupee 1 lakh. So that means your net sale proceeds 9 lakhs. Your net sale proceeds 9 lakhs. Assuming that the redemption period is equal to 5 years. Rate of interest, the coupon rate of interest offered by the company. Let us say 10%. Now, what is interest per annum? Interest per annum is equal to 10 lakh into 10%, 1 lakh. Now, apply this formula, sir. Interest 1 lakh plus redemption value. If the question is silent about the redemption value, you have to take the assumption that the debentures are going to be assumed to be redeemed at par. The debentures are assumed to be redeemed at par. So redemption value 10 lakhs minus net sale proceeds 9 lakhs divided by redemption period 5 years. Now first look at the numerator. In the numerator, we always have to take the cost element. So interest is one part of our cost, 1 lakh we have taken, plus you also have one more cost element. Though you have issued 10 lakhs worth of debentures, but you have received only 9 lakhs. But at the time of repayment, you are going to repay 10 lakhs to the investors. And 1 lakh ni loss on netega, that 1 lakh is also a cost to you. And that 1 lakh you have not incurred at the year 1 or year 2 or year 3. That 1 lakh is a cost for the entire life of the project. So per annum, what is the cost element? See here we are finding out the cost of debentures per annum. So I want the interest per annum. I want the cost per annum. So that is why divided by number of years. So 1 lakh is your additional cost element here, divided by number of years. So means every year you're incurring an additional cost of 20,000. So 1 lakh is the interest element, 20,000 is additional cost you're incurring. Total cost you're incurring how much, Amma? 1,20,000. So the numerator 1,20,000 divided by denominator RV plus NP, 10 lakhs plus 9 lakhs, 19 lakhs divided by 2. How much, Amma? 9.5 lakhs. So this will be your cost of debentures. 1,20,000 divided by 9.5 lakhs. 12.63% is your cost of debentures. 12.63%. You can see here the coupon rate of interest is just 10%, but the effective cost of debentures is 12.63%. Are you following, sir? Every one of you. And this is because the flotation cost. 1 lakh you are incurring as flotation cost. Clear? Now, in case if you ask to find out the post-tax cost of debentures, the only difference is in I into 1 minus tax rate. Interest into 1 minus tax rate plus RV minus NP divided by N whole divided by RV plus NP divided by 2. This is how you need to find out the redeemable debentures which are redeemed at once. Now, when it comes to redeemable debentures, redeemable in installments, the only method available to you is IRR method. There is no option available to use here. IRR method only you have to use. See, shortcut method apply cheyali ante there are some conditions. There should be no changes in your interest throughout the life of debentures. The rate of interest should not be changed. The interest amount should not be changed. Right? When it comes to redeemable in installments, the interest element will be changes year to year. First year, it is 10 lakhs into 1%. So 1 lakh is the interest. Second year, in the first year, 2 lakhs worth of debentures were redeemed. And for second year, only the principal worth of 8% in position. So 8 lakhs into 10%, 80,000 is the second year interest. Third year, 6 lakhs into 10%, 60,000 is the amount of interest. You can see there is a change in the amount of interest. So you cannot apply the shortcut method here. Every one of you following now. Right, sir. Next. So with this, we have completed the debentures concept, cost of debentures concept completed, sir. Okay, now next, we have a new concept called theoretical market price. So next concept, theoretical market price. Now, what is this concept of theoretical market price? So first of all, let us try to understand the other names of this concept. Theoretical market price, also called as fair price of an asset and also called as equilibrium price of an asset. So theoretical market price, fair price, equilibrium price, all these are one and the same concepts. Okay. Now, TMP, theoretical market price. What is this concept? It is a maximum price at which the investor is ready to purchase the debentures, bonds, or shares. So whenever you are investing into a particular company shares or debentures or bonds, right? Suppose that a company offering you shares for 200 rupees per share. Right, sir? Now, before you are making investment into this company shares, first of all, you have to analyze. So investing 200 rupees per share into this company, is it viable to me or not? Is it profitable to me or not? Right? Or the shares of this company really worth 200 per share? You have to make a proper research analysis. After that only, you have to make investment. Suppose investors made some research and end of the research, he find out the maximum price he can make investments into this company shares is 180 rupees per share. Now, this is what we call theoretical market price. This is what we call theoretical market price. Theoretical market price is different. Actual market price is different. Whatever the market price at which the shares are trading in the stock markets is the actual market price, and that cannot be found out. right, sir? It cannot be found out by any person in the world, right? At what price these company shares are going to be traded in the tomorrow's session, no one can tell. Everyone can predict, but no one can tell exactly, yes, at this price these company shares are going to be traded in the tomorrow's markets. No one. There is no standard procedure, no logic, no theory behind that for the calculation of actual market price. Everyone does only predictions. Okay, in tomorrow's markets, this particular Adani Power Company shares are going to be traded at 20% increment, 30% increment. Today's market price some 220 rupees. Tomorrow it will be traded in between 235 to 245. So they will say a price range, and that is only a prediction, not exact amount, right, sir? So actual market price cannot be find out, sir. Whatever all we are doing is theoretical market price, the maximum price at which the investor is ready to purchase a debenture. Suppose that a company offering you, right, shares at 100 rupees per share, and you are going to get interest of 10 rupees per share at the end of every year, like that for 5 years, and end of the 5th year it is going to be redeemed at 110 rupees. Sir, every year 10 rupees interest vastundi, like that for 5 rupees, so 50 rupees, and redemption value of 110 rupees vastundi end of the 5th year, totally 160 rupees vastunayi. So I've just made an investment of 100 rupees, and where I'm getting a return of 160 rupees, so I'm getting a benefit of 60 rupees, so it is beneficial to invest. No, you should not do the calculation like this. If you do the calculation like this, the time value of money principles are not considered. You have just ignored time value of money principle. See, whatever the interest you are receiving in year 1 and whatever the interest you are receiving in year 10, both are having the same value? No. Then how can you add the same 10 rupees and 10 rupees? You cannot add, right? Different years time cash flows should not be added, subtracted. Yes or no? First, you have to bring them into the same time period. So whatever the future cash inflows you are getting, all that future cash inflows, you have to bring them into present values. You have to find out the present value of this future cash inflows. Are you following, sir? Right? Now, after finding the present value of all these future cash inflows, total, and whatever the value you are getting here, that is what we call theoretical market price. So theoretical market price is nothing but sum of the present value of future cash inflows discounted at the investor's expected rate of return. So whatever the future cash inflows you are going to get, first convert them into the present values, and at the time of conversion, you need to use your expected rate of return. You must be having some expected rate of return with respect to that investment. Clear? Now, after bring them into the present value, total it, and that is your theoretical market price. Clear, sir? Now let us assume that if theoretical market price is 95 rupees and the company offering you at 100 rupees, you decided that the maximum price I can invest in this company shares 95 only. So the situation is theoretical market price lesser than actual market price. It is a kind of overvaluation situation. That means these company shares are overvalued in the market, so not advisable to invest, not beneficial to invest. Clear? Suppose that if companies, we find out the theoretical market price as 110 rupees. So the situation is theoretical market price greater than actual market price. So you're ready to invest at 110 rupees, but the company offering you at 100 rupees only. Kallu muskani invest cheyochu. Blindly you can invest into this company shares. So here we can say that the company shares are undervalued in the open market. So it is ready to invest. It is advisable to invest. You can see the situations I have explained here. Okay, now, so that is the concept of the theoretical market price. Next, after that, so with that we have completed cost of debentures model, sir, and then moving on to cost of preference shares. Cost of preferential capital, KP. Just like in dividends, we have the two models. Here also we have two subcategories: irredeemable preference shares redeemable preference shares. When it comes to irredeemable preference shares, the formula is, I've already told you, in the numerator, you always have to take the cost element. When it comes to preference shares, what is the cost? Preference dividend divided by net sale proceeds. Preference dividend divided by net sale proceeds. Now coming to the redeemable preference shares, again two submodels, redeemable at once, redeemable in installments. Redeemable at once, you have two methods available, IRR method and approximate method, also known as shortcut method. IRR method, just like the same way you find out the IRR in the investment decisions, in the same manner you have to find out the IRR. End of the answer, right? End of the answer, you have to treat it as cost of preference share capital. From investor point of view, it is IRR. From company point of view, it is a cost of preference share capital. Clear, Amma? Next, coming to the approximate method, also known as shortcut method. The same formula, sir, right? Instead of the debentures interest, you have to write the preference dividend here. That's it. Preference dividend plus RV minus NP divided by N whole divided by RV plus NP divided by 2. Clear? Next, preference dividend is not a tax deductible expenditure. So that is why you don't have post-tax cost of preference shares. Okay, now, right? In case if preference dividend tax rate information is given, dividend tax rate, not income tax rate, dividend distribution tax, DDT, dividend distribution tax. If dividend tax information is given, then the formula for the calculation of preference shares, preference dividend plus dividend tax divided by net sale proceeds. In the numerator, generally we will take in preference dividend divided by net sale proceeds. If dividend tax information is provided, now add dividend tax. That's it. Because dividend distribution tax is paid by the company only, sir. So for company, it is an additional cost element. So in addition to the preference dividend, it is also incurring an additional cost called dividend tax. So that's why preference dividend plus dividend tax divided by net sale proceeds. Clear? That's it. So this is cost of preference shares. Just go through it once. Complete it. Next, moving on. Next concept, cost of equity shares. Yes, here it is. Cost of equity shares, KE. So there are different methods available for the calculation of cost of equity shares, like dividends price approach, earnings price approach, realized yield approach, and capital asset pricing model approach, CAPM approach. Okay, sir. Now first let us see the dividends yield approach. Calculation of the cost of equity, dividends price approach. So before going to learn about the dividends price approach, first let us try to understand the operating profit statement. It starts with the EBIT, earnings before interest and taxes, from which you have to deduct the interest on debentures. Then you will get EBT, earnings before tax. From that, deduct the tax element. Then you will get EAT, earnings after tax. From which you deduct the preference dividend element, less preference dividend, then you will get the earnings available to equity shareholders. Right, sir? So then after that, take the number of equity shares. So earnings per share is equal to earnings available to equity shareholders divided by number of equity shares. Let us assume that earnings available to equity shareholders is equal to 10 lakhs and number of equity shares issued 1 lakh. Now what will be the EPS, earnings per share? 10 lakhs total earnings distributed among the 1 lakh shareholders. So each shareholder will get 10 rupees per share. Each shareholder will get 10 rupees per share, earnings per share. Okay, now let us assume earnings per share is equal to 10 rupees. Option 1, the company have two options. Either it can declare the entire earnings as dividends or it can retain the earnings. Right? Or certain portion will be distributed as dividends, certain portion will be retained. Okay, now let us assume that the company is maintaining dividend payout ratio of 40%. And out of the total earnings of 10 rupees, 40% will be distributing as dividends. And 4 rupees is distributing as dividend. Dividend per share is equal to 4 rupees. Okay now. So now from this example, we can write some formulas like dividends per share is equal to earnings per share into dividends payout ratio. Earnings per share 10 rupees into dividends payout ratio 40%, 4 rupees. Okay now retention ratio is equal to 1 minus dividends payout ratio. Right, sir? So that means 1 minus 0.4, that is equal to 0.6, or we can say 60%. And out of the total earnings, 40% distributed as dividend, remaining 60% retained as earnings. Okay, now that's the meaning, sir. Clear now, everyone? Now, dividends price approach, we have two models. Number one, no growth in dividends. Number two, growth in dividends. No growth in dividends means the company is maintaining 100% dividend payout ratio. When company is not retaining any earnings, whatever the earnings are coming and earned by the company, the entire earnings will be distributed among the shareholders every year. In year one, it has got earning of 10 lakhs, entire 10 lakhs distributed as dividends. In year two, it has earned some 15 lakhs profits, entire 15 lakhs distributed as dividends. So whatever the earnings it is getting every year, distributing the same as dividends. Nothing will be retained for the future investment. Right, sir? When each and every penny earnings distributed as dividends now, when you don't have any retained earnings, it is not possible for you the future investments. In the future, if you get any profitable investment opportunities, you don't be having any funds to you, right? You won't have any funds to make investment into that future profitable opportunities. There will be no growth in your earnings, right, sir? No growth in your dividends. Look at this. Year one, dividends 10 rupees. Year two, dividends 10 rupees. Year three, dividend 10 rupees. You can see every year the same amount of dividend distributed to the shareholders. There is no growth in dividends. So whenever a company distributing 100% of the earnings as dividends, there won't be any growth in dividends. Clear? Next. So no growth in dividends, assuming you have to take the assumption that the company is maintaining 100% dividend payout ratio. The company is maintaining 100% dividend payout ratio. Retained earnings nil. So it is not possible for the company to go for expansion, diversification, or to accept the profitable investment opportunities. Hence, there will be no growth in profits. Hence, there will be no growth in dividends. In that scenario, cost of equity is equal to DPS1 divided by MP0. DPS1 means dividends at the end of the year, end of the first year, divided by current market price. MP0. Dividends at the end of the year one, or you can also call it as expected dividends. Expected dividends divided by MP0. Now, by using the same formula, if you ask me to find out the MP0, MP0 will go to this side and cost of equity will become denominator. DPS1 divided by cost of equity. DPS1 divided by cost of equity. Okay, ma'am. Next. So DPS1 is equal to dividend per share at the end of the year one, or we can also call it as expected dividend. MP0 means current market price or net sale proceeds. Clear? Next. So look at this example. MP0 100 rupees, DPS1 10 rupees, right, sir? And return on investment 10 rupees divided by 100 rupees. 10 rupees is your DPS1 divided by MP0 100 rupees. So return on investment 10%. From company point of view, it is a cost of equity. From company point of view, it is a cost of equity. Equity shares, now we are learning. Equity shares are irredeemable in nature. So from year one to year infinity, you will get a DPS, dividends per share of 10 rupees. Clear? You are getting this dividend for the investment of 100 rupees. So 10 rupees cash inflow for the investment of 100 rupees. So 10% is the rate of return. The same will become cost from company point of view. Okay, now. Next. Cost of equity, dividends price approach, growth in dividends. The second submodel, growth in dividends. Again, we have two concepts here. Constant growth in dividends, non-constant growth in dividends. Ma constant growth in dividends, and look at this example. Year 1, 10 rupees dividends. Year 2, 11 rupees. Year 3, 12 rupees. Year 4, 13 rupees. So every year you can see the increment in the dividend 1 rupee. Your dividend is increased by 1 rupee, equal amount of growth. But this cannot be the example for growth in dividends. Here, growth means to be not the amount of the growth, it is a percentage of the growth. The percentage of the growth should be equal. Then only you can apply this concept of constant growth in dividends. Look at this example. Year 1, 10 rupees. Year 2, 11 rupees. Year 3, 12 rupees, 10 pies. And year 4, 13 rupees, 31 pies. You can see the rate of growth in dividends from year 1 to year 2, the rate of growth is 10%. Year 1, 10 rupees, year 2, 11 rupees. So there is a growth of dividend of 1 rupee. So 1 rupee growth you have achieved for the base of 10. So 10% is a growth rate. Now year 2 to year 3, there is a growth of again 10%. There is a growth of again 10%. Year 2 to year 3, right, sir? Year 3, you got a dividend of 12 rupee 10 pies. Year 2, 11 rupees. So there is a growth of 1 rupee 10 pies. So 1 rupee 10 pies growth you have achieved from the base of 11 rupees. Again 10% growth. Are you following my everyone? So you can see every year there is a 10% growth. So this is the constant growth in dividends. Now the formula is cost of equity is equal to DPS1 divided by MP0 plus G. Normal case, what is the formula? DPS1 divided by MP0. And this is a growth in dividends now. So add back growth. This is a formula for cost of equity. DPS1 divided by MP0 plus G. Now by applying this logic, if you find out the MP0, the formula will be DPS1 divided by KE minus G. Okay, sir. This formula is nothing but the concept of present value of growing perpetuity. Do you remember the formula for present value of growing perpetuity? Cash flows at the end of the year 1. Cash flows at the end of the year 1 divided by R minus G. Right, sir? So DPS1, CF1 and nothing but DPS1 divided by R minus G. R from investor point of view, rate of return from investor point of view. We are finding out from company point of view. So KE minus G. The same logic. Clear? Next. Finding out of the growth rate. Sir, in case if the problem is silent about the growth rate, right? Then how to find out the growth rate? Very simple, sir. Look at this example, DPS1 10 rupees and DPS2 12 rupees. So you have earned a growth of 2 rupees from the base of 10 rupees. Unit percentage, so into 100. The growth rate is equal to 20%. Sir, if the gap is 1 year only, you can apply this logic. But if the gap is more than 1 year, look at here. DPS1 10 rupees, DPS6 15 rupees. So here the growth is almost 5 years. Now you cannot apply this logic. Now in that scenario, apply either present value concepts or future value concepts. DPS1 10 rupees, whatever is there, this you should be assumed as your present value. DPS6 15 rupees as your future value. And number of years is equal to 5 years. So you know the present value, you know the future value, you know the number of years. What is missing? Rate of interest. Easily find out. And whatever the rate of interest you're going to be find, that is your growth rate. So that is how you need to find out the growth rate. Okay, now next. After that, new formula for the calculation of the growth rate. You have a formula for the calculation of growth rate. Growth rate is equal to B into R. Retention ratio into rate of return. See, whatever the retained earnings you have, that retained earnings you are going to be reinvest. From this reinvestment, you will get some returns. Yes or no? You will get some returns. So your retention ratio into the rate of return on retained earnings, this will give you the growth amount. Clear? Next. Next. Second model, cost of equity, earnings price approach. Earnings price approach. Right, sir. Now, coming to this concept, earnings price approach. So again, two models. So two submodels. Number one, no growth in dividends. Number two, growth in dividends. No growth in earnings and growth in earnings. Just like dividends price approach. No growth in earnings. The formula should be cost of equity is equal to EPS divided by MP0. When it comes to dividends price approach, we have written the formula dividends price per share divided by MP0. Now this is earnings approach. No, instead of DPS, you have to write the EPS. Cost of equity is equal to EPS divided by MP0. That's it. Now coming to the growth in earnings, again two submodels, constant growth in earnings, non-constant growth in earnings. Constant growth in earnings, the same formula. When it comes to dividends price approach, we have written like DPS1 divided by MP0 plus G. This is earnings price approach. Now, instead of DPS1, you have to write what, sir? You have to write EPS. That's it. EPS divided by MP0 plus G. Clear, ma? Next. Realized yield approach. The third model under cost of equity, realized yield approach. Look at this example. In P0, that means in the Y0, as and today, I've invested into the company equity shares at 10 rupees. Right, sir? And I've held that shares for 1 year. I held that shares for 1 year. I hold that shares for 1 year. End of the 1 year, I am going to sell it for 12 rupees. 10 rupees konnan sir, 12 rupees ki sale chestunnanu. Since I hold the shares for 1 year, I also got a dividend of 2 rupees. Now the total return to the investor 4 rupees. You made an investment of 10 rupees. For this, you get a dividends 2 rupees and capital gains 2 rupees. 12 rupees per share you sold, 10 rupees at you purchase, 2 rupees your capital gains. Total 4 rupees is a returns to the investor. Yes or no? Now, among these 4 rupees, dividend yield is 2 rupees. Formula, dividend yield is equal to DPS1 divided by MP0 into 100. So, dividend yield 20%, then capital gains yield. 12 rupees you have sold, at 10 rupees you purchased, you got a capital gain of 2 rupees. P1 minus P0 divided by P0 into 100. So, capital gains yield 20%. Now, return on investment, dividend yield plus capital gains yield. Or you can also write the formula like this. DPS1 divided by P0 plus P1 minus P0 divided by P0. The P0 common is say DPS1 plus P1 minus P0 divided by P0 into 100. This is a return on investment. From company point of view, it is a cost of equity. So find out the returns from the shareholder point of view, right? And whatever the return information you got, answer you got, the same will become the cost from the company point of view. Clear, everyone? Next. The last one, CAPM approach, capital asset pricing model approach. Right, sir. Now, in this, mainly we are going to focus on risk return trade-off. Risk return trade-off. I've already told you that whenever you are making investments into the high risky ventures, so higher the expectations towards returns. Low risky ventures, lower should be your expectations towards returns. Are you following, sir? Sir, if you're taking high element of risk, you guaranteely get the high amount of returns. Absolutely wrong. ఎంత ఎక్కువ రిస్క్ తీసుకుంటే అంత ఎక్కువ రిటర్న్స్ వస్తాయనేది రాంగ్ అజంప్షన్ మా, రాంగ్ ఎక్స్ప్లెనేషన్. If you are taking high element of risk, then you can expect high amount of returns. When you're taking low element of risk, then you should expect low amount of returns. Low amount of returns. That is correct explanation. Okay, now the same which I've already explained to you at the beginning of this chapter. Funds available 10 lakhs, SBI fixed deposit, HDFC fixed deposit. The same I have already explained, sir. Right? Types of risks. Here the risks are defined into mainly two categories. Unsystematic risk, systematic risk. Unsystematic risk ante it is a diversifiable risk. Company specific risks maybe these are easily avoidable. by making investments into different portfolios. Different portfolios. The second one is systematic risk, non-diversifiable risk. These are industry specific or market specific risk which cannot be avoidable. Systematic risk, all the company can do is just it has to face that systematic risks. That's it. And this risk is measured by using the beta factor. And we know that the investor's expected rate of return is equal to risk-free rate of return plus risk premium. At the beginning of the chapter, we have learned this formula. So the same will become the cost from company point of view. Cost of equity is equal to RF, risk-free rate of return, nothing but RF, plus risk I've already told you is measured with beta. So risk into risk premium, beta into RM minus RF. This RM minus RF explains about the risk premium. Okay, now next. So this is how we need to find out the cost of equity under CAPM approach. All the 4 models completed under equity approach, cost of equity approach. Next, after that, you have cost of retained earnings. So far, whatever we have completed, debentures, preference shares, equity shares, these are external sources. So obviously we will be having cost element. For debentures, interest. For preference shares, dividend. For equity shares, equity, dividend, and appreciation in the market price. These are all the cost elements. These are all cost elements. But when it comes to retained earnings, it is internal source of financing. It is internal source of financing, like our reserves and surplus, retained earnings. For internal source of financing, what is the cost element? It's nothing but opportunity cost foregone by the equity shareholders. And how you get retained earnings, ma? Suppose, look at this example, sir. You have a profit after tax of 10 lakhs. Profit after tax of 10 lakhs. Clear. Now, out of 10 lakhs, you have declared dividends as 2 lakhs rupees. The remaining 8 lakhs you have retained as earnings. Clear. Every one of you. Now, sir, here the profit after tax 10 lakhs, whatever is there, this is earnings available to equity shareholders. These are the equity shareholders funds. But you have not distributed the entire funds to the equity shareholders. You have retained 80% of the funds with you only. Had you distributed the same to the debenture holder, equity shareholders, and the equity shareholders would have get dividends of 10 lakhs, assuming that there is 10,000 total number of equity shareholders. So each equity shareholder would have get 10 lakhs total funds available divided by 10,000 shareholders. Each equity shareholder would have get 100 rupees as dividend. Suppose that I have 500 shares with me. So 500 shares into 100 rupees, I would have received 50,000 rupees as dividend. Now 50,000, suppose that even if I made investment into a bank where the banker offering me 10% rate of interest, I would have get 5,000 interest. I would have get 5,000 interest. But now the company has declared only 2 lakhs as dividends, which is distributed among the 10,000 equity shareholders. Instead of 100 rupees, I get only 20 rupees per dividend per share. 500 shares into 20 rupees, I have received only how much, Amma? I have received only 10,000 rupees dividend. So 10,000 into 10%, I am receiving only 1,000 interest. Earlier, I used to get 5,000 as interest, but now I'm getting only 1,000 interest from that deposits. And this 4,000 interest loss is there, no? That is my opportunity cost. And this opportunity cost, being a shareholder, this is an opportunity cost to me. And I'm facing this opportunity cost because the company retained the earnings. Now, whatever the opportunity cost I'm facing here, I'll expect the same from the retained earnings. Why the company retained earnings? For further investment. From the further investment, I will expect the recovery of this opportunity cost. So that is why cost of retained earnings is nothing but opportunity cost foregone by the equity shareholders. Okay, ma. Next. Cost of retained earnings. There are different models available for the calculation of cost of retained earnings. Number 1, dividends price method. Number 2, earnings price method. And number 3, growth method. Coming to dividends price method, formula KR is equal to DPS1 divided by MP0. Earnings price method, EPS divided by MP0, and growth method, DPS1 divided by MP0 plus G. If you look at all these formulas are nothing but cost of equity formulas. Cost of equity under dividends yield approach, under earnings price approach, under constant growth. The same formulas you have learned, no? That is why cost of retained earnings is equal to cost of equity. But if you want to take this equation, there are some conditions to be satisfied. This equation holds good subject to the following conditions. There are no flotation costs and there are no shareholders' personal tax rate. If the problem having flotation cost information, or if the problem given shareholders' personal income tax rate, then this equation doesn't hold good. Okay, next. And the last model of this chapter, weighted average cost of capital, WACC, overall cost of capital. The overall cost of capital should be calculated only when the company is opting for more than one source of capital for the procurement of the funds. Look at this, funds required 100 lakhs. 100 lakhs, right here. See, for the raising of this 100 lakhs, if you choose an only one source of capital, like equity shares, so you have raised entire 100 lakhs by issuing equity shares. It is enough to find out the cost of equity, compare the cost of equity with IRR and made a decision. If you raise the entire 100 lakhs by issuing preference shares, calculate the cost of preference shares, compare with the IRR, make a decision. If you raised 100 lakhs by using debentures, find out the cost of debentures, compare with the IRR, make a decision. But these 100 lakhs, if raised with multiple sources, more than one sources, look at here, 50 lakhs I've raised by issuing equity share, 25 lakhs I've raised by issuing debentures, 25 lakhs I've raised by issuing preference shares. I have used multiple sources. Now in this case, I need to find out the weighted average cost of capital. Then I need to compare this weighted average cost of capital with IRR. Then I have to make a decision. Clear, sir? When a specific source is selected, find out the cost of that specific capital, then compare the cost of that specific capital with IRR, make a decision. But when your multiple sources are used, multiple options are you have selected for the procurement of the funds, then you need to find out the overall cost of capital, compare the overall cost of capital with IRR, then make a decision. Clear? Now, how to calculate weighted average cost of capital? You have different alternatives. First alternative, tabular format, source of capital, take equity preference debentures, weights, and nothing but the amount of the capital you are procuring by issuing that source. By issuing equity shares, we are raising 50 lakhs. By issuing preference shares and debentures, we are raising 25 lakhs each respectively. Then take the specific cost of capital and the cost of equity, cost of preference shares, cost of debentures. Then total weights, W into X, weights into specific cost of capital. Then find out the sigma WX, the total of the total weights. So the formula is weighted average cost of capital is equal to sigma WX divided by sigma W. Sigma WX divided by sigma W. That is a weighted average cost of capital. Okay, ma. This is how you need to find out. Alternative 1. Alternative 2, the same calculations without table. 50 lakhs into 20%, 25 lakhs into 18%, 25 lakhs into 15% divided by total weights 100 lakhs. Same answer you will get 18.25%. Third alternative is just like multiplying the specific cost of capital with the weightage of that source. So the specific cost of equity 20% into cost of equity weight. And equity capital, you have raised 50 lakhs by issuing equity capital. Out of 1 crore, 50 lakhs you have raised. And what is the weightage of that equity in the total capital employed? So specific cost of capital into weights. Specific cost of capital into weight. Clear now? So then you'll get the weighted average cost of capital. So there are 3 alternatives. In the examination point of view, you can follow any alternative. Absolutely no problem. Clear? Next, while calculating the weighted average cost of capital, you have 2 alternatives. One, by using the book values as weights. Number 2, by using the market values as weights. Okay, now Now, when it comes to the market value as weights, first you should find out the market value of equity, sir. Market value of preference and market value of debentures. How to find out? Very simple, sir. Number of equity shares into market price per share. Number of preference shares into market price per preference share. Number of debentures into market price per debenture. That will give you the market values. So generally here in the step number 1, you will find out the specific cost of capital, if not provided by the problem. Step number 2, you need to find out the market values of different sources. And step number 3, weighted average cost of capital. 3 steps procedure. Okay, now that's how you need to find out the weighted average cost of capital. So with that, we have completed the entire theory explanation with respect to cost of capital. So cost of capital chapter marathon completed. So for 3 chapters completed, time value of money, investment decisions, cost of capital. In the next marathon, I'm going to take the capital structure. Okay, sir, every one of you. Right. See you in the next class. Till then, have a good day and good night. Stay home and stay safe. Very good morning, students. Welcome to the FM marathon classes. So in the last class, we have completed discussion regarding chapter number 3, cost of capital. Now time for the chapter number 4, capital structure. Okay, sir. Now what is this capital structure is all about? Now first look at the weightage of this chapter. You can see weightage of this chapter, we can expect one problem for 8 marks. So chapter number 3, cost of capital, and chapter number 4, capital structure. From these 2 chapters, we can expect one problem. We can expect at least one problem for 8 marks. And in sometimes you can expect 2 problems from these 2 chapters. 2 very easy chapters, ma. And if you get 2 problems from these 2 chapters, I can say that that attempt FM paper was very, very, very easy. Right. So this chapter deals with the procurement of the funds. And as we learned in the first chapter, that is Introduction to Financial Management, the entire financial management is discussed about only 2 main things. Number 1, procurement of the funds, and number 2, investment of the funds. Each and every chapter of the financial management either deals with the procurement of the funds or deals with the investment of the funds. Yes or no? Right, sir. Chapters so far we completed like time value of money, which deals with the fundamentals of financial management. Chapter number 2, investment decisions, which deals with the investment of the funds into fixed assets. Chapter number 3 is completed, cost of capital, deals with the procurement of the funds. Chapter number 4, capital structure, deals with the procurement of the funds. Right, sir. So here, what do you mean by the capital structure? It's nothing but it is the structure of our capital. Capital structure explains about what, explains about structure of our capital. Suppose that you have employed 30 lakhs worth of capital into your business. 30 lakhs worth of capital into your business. And how did you procure that 30 lakhs? 20 lakhs by issuing the equity shares, 5 lakhs by issuing the preference shares, and 5 lakhs by issuing the debentures. Right, sir. So this is your capital structure. Now look at this example. Totally, you have employed 50 lakhs into your company, right? And how did you raise that 50 lakhs? By issuing the equity capital 25 lakhs, by issuing the debt capital 25 lakhs. So that is your capital structure. So in your capital structure, you have equity capital and as well as you have debentures capital, debt capital. Clear? Now, what is the importance of capital structure? Suppose that the funds required 50 lakhs rupees. Funds to be raised 50 lakhs rupees, and you have multiple options available, and I have given only 3 options here. Option 1, 25 lakhs through equity capital and 25 lakhs through preference capital. Option 2, 25 lakhs through equity capital, 25 lakhs through debentures capital. Option 3, 25 lakhs through preference capital, 25 lakhs through debentures capital. So 3 different options available. Now, among these 3 options, which option should be exercised for the raising of the funds? Which capital structure should I choose for the procurement of the funds? Now, the decision making should be the capital structure which maximizes the shareholders' wealth. See, the ultimate objective of the financial management is wealth maximization of the shareholders. Right, sir. Again, in the introduction to financial management chapter, we have learned objectives of financial management: profit maximization, wealth maximization. What is the primary objective? Wealth maximization. Wealth maximization of whom? Wealth maximization of the shareholders. So whatever the financial decision you are going to made into your company, the underlying objective should be the wealth maximization of the shareholders. You have to make sure that yes, this financial decision is going to positively impact my shareholders' wealth. Clear. So when it comes to capital structure decisions also, whenever you're selecting the capital structure, you have to make sure that by selecting this capital structure, this will result into wealth maximization of the shareholders. Clear. Now, what are the different models we are going to learn from this chapter? First one, EBIT, EPS analysis. Second one, indifference level of EBIT and financial break-even point. Third one, capital structure theories. And fourth one, concept of arbitrage. Concept of arbitrage. Four models totally. EBIT, EPS analysis, indifference level of EBIT and financial break-even point, capital structure theories, the most important topic of this chapter, and the last one, arbitrage. These are the four models. Now let us go ahead with the first model, EBIT, EPS analysis. Sir, EBIT ECS analysis, it explains about the decision making regarding the optimum capital structure. We will be provided with some 2 or 3 capital structures in the problem. Among the 2 or 3 capital structures, you asked to find out the best capital structure. You asked to select the optimum capital structure. Then how should be the decision making process? Step number 1, you have to find out the EPS for the given capital structures. Step number 2, select the capital structure with the highest EPS. Select the capital structure with the highest EPS. That is the optimum capital structure, because highest EPS means what? Highest earnings per share. Earnings per share is a return to the shareholders. Yes or no? Right? So when returns to the shareholders increases in that particular capital structure, so that itself is the best capital structure. Clear. So the capital structure which is having the highest EPS selected. That's it. Now, operating profit statement, this we all know already. EBIT, earnings before interest and taxes, from which deduct the interest and debentures, you will get EBT. Deduct the tax, EAT, earnings after tax. Deduct the preference dividend, you will get the earnings available to equity shareholders. Then number of shares, then find out the EPS, earnings available to equity shareholders divided by number of equity shares. That will give you the earnings per share. Okay, ma'am. Now look at here. Look at the problem number 1. You have 3 options given, sir. And for these 3 options, first find out the EPS, earnings per share. You can see here at the option number 2, you got the highest EPS, 4 rupees 60 paise. Now look at the decision making. Since EPS is higher under option 2, it is advisable to raise the additional funds by issuing 16% non-convertible debentures. Totally here you have given the 3 options. Option 1, entire equity. Option 2, debt. And option 3, I guess 25 lakhs through equity and 25 lakhs through debentures. Yes. Okay, Nama. So we have chosen the option 2 as it is having the highest EPS. Clear. So that's EBIT EPS analysis. Now, in this model itself, we have one more variety of topic, EBIT MPS analysis. So generally in the problem, if PE ratio information is provided to you, then the decision making should be based on market price per share instead of earnings per share. If PE ratio information not provided, the decision making based on EPS. Select the capital structure with the highest EPS. End of the answer. But if PE ratio information is provided, price earnings ratio. PE ratio what am I? Price earnings ratio. If PE ratio information is provided, then the decision making as to what is the optimum capital structure, it should be based on MPS, market price per share, not based on the EPS. Okay, now. So generally the routine procedure from the operating statement, first find out the EPS, then go for the MPS calculation. How to calculate MPS? Formula is given EPS into PE ratio. And how did you get that formula? Generally the PE ratio formula is price earnings ratio, MPS divided by EPS. This is price earnings ratio formula. Now you want MPS. So denominator will go this side. When denominator is going to outer part of the is equal to, it becomes a multiplication. So that will be given you MPS formula. Now MPS formula becomes MPS is equal to EPS into P ratio. Okay, ma. So EPS into P ratio, that is how the formula what arrived is here. Now the decision making, select the capital structure which is having the highest MPS. So the capital structure which is giving you the highest market price per share would be selected. Now look at this problem number 3, sir. In problem number 3, I think we have a printer solution for this. Problem number 3. Yes, printer solution available for problem number 3. Okay, let's see the printer solution also. The problem number 3 is. Yeah, here it is. You can see, ma. Generally, we will find out the EPS routine manner. EBIT minus interest, EBT minus tax, EAT minus preference dividend, earnings available to equity shareholders divided by N. You will get the EPS. In the problem, PE ratio is also given. So this is PE ratio. For option 1, 8 times, for option 2, 10. Then multiply the EPS with PE ratio, you will get the MPS, market price per share. 4.33 into 10, 40 rupees 33 pice. So for option 1, market price per share, 32 rupees 76 pice. Option 2, 40 rupees 33 pice. You can see the conclusion. The objective of the financial management is to maximize the benefits to equity shareholders. Since the market price is high in option 2, it is beneficial to raise the funds of rupees 25 lakhs by way of the equity shares. Okay, ma? Right? Next. So that's the model number 1, EBIT EPS analysis, EBIT MPS analysis. Now, coming to the model number 2, we have two different topics, indifference level of EBIT and the financial break-even point. First, let us go with the indifference level of EBIT. Now, what is this indifference level of EBIT? Look at the definition. It is the level of EBIT at which EPS will be same under the given two financing options. So you will be provided with the two financing options. Now the level of EBIT at which EPS will become same, will be same under these two financing options. That level of EBIT is what we call the indifference level of EBIT. Every one of you following now? This indifference level of EBIT also called as EPS equivalency point. So the EPS become equal. The EPS become equal at the given two financing options. And the level of EBIT at which EPS becomes equal, that level of EBIT is what we call indifference level of EBIT. Clear now? Now how to calculate this indifference level of EBIT? Process of calculating indifference level of EBIT. Step number 1. Frame the two financing equations, LHS, RHS. So you would be given with two financing options. Now frame the two financing options into two financing equations. Right, sir? LHS, RHS, left hand side, right hand side. Generally, we know the formula for the EPS, earnings available to equity shareholders divided by N, number of equity shares. Okay, now we are going to elaborate this formula like EPS is equal to EBIT minus interest. EBIT minus interest gives you what, EBT. EBT into 1 minus tax rate. EBT into 1 minus tax rate gives you what, EAT, earnings after tax. Earnings after tax minus preference dividend gives you what? Earnings available to equity shareholders divided by number of equity shares. The same formula, but we have elaborated. EBIT minus interest will give you EBT. From EBT, deduct the tax, that will give you EAT. From EAT, deduct the preference dividend, that will give you earnings available to equity shareholders divided by number of equity shares. Same formula, but in an elaborated manner. So LHS, RHS, the two financing options. Take one option at LHS side, take the other option at RHS side. Okay, now, right? Now, let X be the indifference level of EBIT. You don't know this, right? EBIT, you don't know. So this should be taken as X. So on LHS side, you will get 1X and RHS side, you will get the X. Two equations will be formed. Solve that equations and then you will get the indifference level of EBIT. Okay, now look at this problem number 5. Alternative A, equity capital 10 lakhs, 15% debentures capital 5 lakhs, equity capital 5 lakhs. So means total funds to be raised at 10 lakhs amount. Option 1, the entire 10 lakhs you are raising through equity capital. Option 2, 5 lakhs you are raising through debt capital, 5 lakhs you are raising through equity capital. Two financing options, LHS, RHS. Okay, now let X be the indifference level of EBIT. First one, EBIT, we don't know. So X minus interest. In the option number 1, you don't have any interest because entire 10 lakhs you are raising through equity capital. So interest becomes 0 into 1 minus tax rate. 1 minus tax rate given 50%, 0.5 minus preference dividend 0 because in none of the options you have the preference capital. Clear. Then divided by number of equity shares. Totally 10 lakhs you are raising divided by the equity share per share price తీసుకున్నామా, then you will get the number of equity shares. If you go through the problem, you will get to know. Let me take you to the problem number 5. Here's a problem number 5, sir. And we are doing this alternative A. 10 lakhs equity share capital, option 1. 5 lakhs debentures and 5 lakh equity share capital. Okay, now. And here they said that the issue price of the equity share taken at par 100 rupees per share. So that is why we have taken here, Amma. Totally 10 lakhs we are raising divided by 100 rupees per share. You will get a number of equity shares, 10,000 shares. Okay, now 10,000 shares. This is LHS equation. RHS equation, option 2, you need to take the option 2. EBIT we don't know, so X minus interest, yes. In option 2 we have interest because we are raising 5 lakhs through debentures. So 5 lakhs into, what is the coupon rate of interest, 15%. So 75,000 is the interest, 75,000 into 1 minus tax rate, 1 minus 0.5 minus preference dividend 0 divided by number of equity shares. In option 2, we are raising only 5 lakhs by issuing the equity capital. So 5 lakhs divided by 100 rupees per share, 5,000 shares. Okay, now the first solve the denominations, 5,001 job, 5,002 job, and then make cross qualification calculation. See, first numerator solve cheyandamma, x minus 0.5x, so 0.5x divided by 2. Clear. And here numerator solve cheyandamma, so 0.5x minus 37,500 because 0.5 into x, 0.5x, 0.5 into minus 75,000 minus 37,500. Now 0.5x is equal to, so cross calculation just say 2 into 0.5 x, 2 into minus 37,500 minus 25,000. Now x is equal to 75,000 divided by 0.5. X is equal to 1,50,000. So this is indifference level of EBIT. So at this level of EBIT, the EPS will become same under two given options. Look at here, cross checking also I have done. EBIT take both the options at 1,50,000 minus interest and debentures. In option 1, there is no interest as the entire 10 lakhs we are raising through equity capital. Option 2, yes, we have an interest of 75,000. Then EBT 1,50,000 and here 75,000. Less tax at the rate of 50%, 75,000 and here 37,500. Then earnings available to equity shareholders, 75,000, 37,500. Number of equity shares in option 1, 10,000 shares, option 2, 5,000 shares. We'll get my EPS 7 rupees 55, 7 rupees 55. You can see the EPS is equal under the two given options. So at this level of EBIT, the EPS become equal. So that is why indifference level of EBIT for this alternative A is 1,50,000 rupees. Clear everyone? Okay, now. So that is how you need to find out the indifference level of EBIT. Next model, financial break-even point. So now what is a financial break-even point? It is a level of EBIT. It is the level of EBIT at which EPS becomes 0. The level of EBIT at which EPS becomes equal, that is indifference level of EBIT. But this is the level of EBIT at which your EPS is equal to 0. Financial break-even point. You might have learned about the concept of break-even point in marginal costing in the cost accounting subject. Break-even point means what, Amma? Break-even means no profit, no loss situation. No profit, no loss situation. That means whatever the profits you have earned that are equal to your expenses. So you are in no profit and also no loss situation. That is break-even point. Okay, now. So whenever you are producing a new product, first you always thrive for the break-even point. Once you reach at the break-even point, then Okay, fine. You will be on the safe side. You will be on the safe side because there is no profit and no loss. And even after reaching the break-even point level, still you are able to sell the product. Still you are able to generate the profits. That is your real profits. Okay, now similarly in the financial management also we have a concept called financial break-even point. So it means whenever you're procuring the funds, you have to make sure that the returns from this particular funds, first, at least they are in a position to meet your financial commitments, right? Once your EBIT meets your financial commitments, you are on safe side. So what is financial commitment? Like debentures interest and preference dividend. These are your financial commitments. I can say fixed financial commitments. Okay, now, irrespective of the financial position of the company, debentures interest, you have to pay compulsorily. Yes or no? Preference dividend, yes, if you have the profits, you have to pay compulsorily preference dividend. Yes or no? Every one of you. Right now, so first of all, you have to make sure that your EBIT, your operating profits are able to meet your financial commitments. Clear? Then you will be on the safer side. Right now, look at this example. EBIT given 1 lakh, interest and debentures 30,000, EBT 70,000, tax and earnings available to equity shareholders, then EPS. So here you can see the EPS doesn't become zero. So this 1 lakh EBIT is not your financial break-even point. Clear? You have a positive amount of EPS, 3 rupees 50 pies. The level of EBIT at which EPS becomes zero, that is your financial break-even point. In this example, at what level of EBIT your EPS becomes zero? At 30,000 rupees, because in this operating profit statement, you can find that there is only one fixed financial commitment. There is only one fixed financial commitment. What is that, Amma? Debentures interest. So it is enough that your EBIT is able to meet your debentures interest. That's it. So that means the minimum level of EBIT you have to maintain 30,000 rupees, which meets your financial commitments. Then your EPM becomes zero. So in this case, if you have only debentures interest, financial break-even point is equal to interest on debentures. Okay, next, second example. Look at here. Here you have two financial commitments, debentures interest and preference dividend. So 20 plus 20, 40,000. So when my EBIT is 40,000, so that is my financial break-even point. No. Because, sir, interest is a before tax item and preference dividend is an after tax item. It is an after tax item. You should not add them directly. You should not add them directly. All of you following now. So you have to bring the preference dividend into the before tax element. So the formula should be interest on debentures. It is always before tax item plus preference dividend divided by 1 minus tax rate. So when you're doing this, that means you are bringing the preference dividend into before tax category. So your interest on debentures before tax item, preference dividend before tax item. Now you can add them. Now you can add them. So choose my example, you got the answer 48,571. So apply chess student EBIT 48,571 minus interest on debentures 20,000. So EBIT 28,571, tax 8,571, EAT 20,000, preference dividend 20,000, earnings available to equity shareholders 0. Your EPS becomes 0. So at this level of EBIT, your EPM equal to 0. Clear? So when only interest on debentures is there, then formula financial break-even point is equal to interest on debentures. If interest on debentures and the preference dividend is also there, formula financial break-even point is equal to interest on debentures plus preference dividend divided by 1 minus tax rate. Following, sir, everyone? Right. So with that, we have completed the two models. With that, we have completed two models. Number one, EBIT EPS analysis, EBIT MPS analysis. Number two, indifference level of EBIT and the financial break-even point. Clear. Now let's moving on to the third model, capital structure theories, the most important model of the chapter. Okay, now, right. So next, moving on to the model number 3, capital structure theories. Right. Now, what are we going to learn from this particular topic. Look at this example, sir. This is my existing capital structure where I have equity capital 80 lakhs, debt capital 20 lakhs, my total capital employed 100 lakhs. And at this juncture, my market value of the firm is 120 lakhs. Okay, now, so out of the total 100 lakhs, I've raised 80 lakhs through equity capital, 20 lakhs through debt capital. So what is a debt equity ratio here? Debt equity proportion 80:20. Now I have changed this proportion. The proposed capital structure, equity capital 60 lakhs, debt capital 40 lakhs, the total capital employed 100 lakhs. See here, the important point is that I am not going to procure any additional funds. My total capital employed is not going to be changed. I'm just changing my capital structure proportion. Earlier 80% equity capital, 20% debt capital. Now I have reduced the equity proportion to 60% and increased the debt proportion to 40%. Now in my capital structure, 60% is the equity capital, 40% is the debt capital. Now when I changed my capital structure here, what happens to my market value of the firm? Will it remains to be same or will it remains to be change? So whenever there is a changes in the capital structure, what happens to the market value of the firm? Market value of the firm, whether it is remains to be constant or the market value of the firm also changes. That's what we are going to learn from these capital structure theories. Whether market value of the firm changes with the changes in capital structure. Some people said yes, some people said no. Some people said yes, belonging to relevant theories. So look at here, option 1, market value of the firm changes with the changes in capital structure. Relevant theories. There are two theories supporting this theorem. One, traditional approach, and two, net income approach, NI approach. And there are other category of people also, just like you have the two sides to a coin, heads and tails. And there are two opinions to this topic. Some people said, yes, the market value of the firm changes. Some people said, no, the market value of the firm remains to be constant, irrespective of the changes in capital structure. These people believes that changes in capital structure is your internal matter, and that internal matter doesn't affect your market value of the firm. Did you raise any additional funds? No, sir. Did you go on for expansion? No, sir. Did you go on for diversification? No, sir. Did you have started any new project? No, sir. What you have done? I've just decreased my equity capital, increased debt capital. Now, how can this have impact on your market value of the firm? If you go for expansion or diversification or starting up a new project, this will result into changes in your market value of the firm. That will changes your market value of the firm. Just by reducing equity capital, increasing the debt capital, doesn't have any impact on your market value of the firm. These people believes this. Okay, now, so these are belonging to irrelevant theories. One, NOI approach, net operating income approach, and the other one is a Modi-Gilani and Miller approach. Okay, now M&M approach. Okay, first let us start with the net operating income approach, NOI approach. It belongs to what? Irrelevant theories. What is your opinion? Market value of the firm remains to be constant, irrespective of changes in capital structure. Sir, what is market value of the firm? We know the formula that market value of equity plus market value of the debt. Market value of the firm is equal to market value of equity plus market value of debt. Okay, now. Now, first let us find out the market value of equity, then market value of the debt. Okay, now, thereby we are going to find out the market value of the firm. Clear, everyone? Right. First, let us find out the market value of equity, cost of equity, and relationship between the market value of equity and cost of equity. Okay, ma? First, we know the formula that cost of equity is equal to DPS1 divided by MP0 plus G. This formula we have learned in cost of capital chapter in the topic cost of equity, constant growth in dividends concept. Yes or no, sir? DPS1 divided by MP0 plus G. Here from this step, we have eliminated G because here we have some general assumptions for capital structure theories. And one of the general assumption that the company maintains 100% dividend payout ratio. Let me take you to the general assumptions. Yeah, here it is. This is a topic, sir. Capital structure theories we are dealing. Now in this, the following assumptions are made to understand this relationship. Here you can see the payout ratio is 100%. Company maintains 100% payout ratio. Clear, sir? So that's why we have eliminated G. Whenever a company maintaining 100% dividend payout ratio, the growth would be zero. There won't be any growth. So G eliminated. Now in this step, we have written the formula like DPS1 divided by MP0. Now cost of equity is equal to, in the place of DPS1, I have written EPS, because where 100% dividend payout ratio existing, DPS equal to EPS. Look at here, when my earnings per share 10 rupees, dividend payout ratio 100%. So that means the entire earnings are distributing as dividends. So EPS equal to DPS. Now in the place of DPS, I have written EPS. Now next step, I'm taking the MP0 this side. Now the cost of equity becomes denominator. MP0 is equal to EPS divided by cost of equity. This will give us the market price per one share. Now when I would like to know about the total number of equity shares market price, because I want market value of equity, not market value of one share. Clear? So market value of equity is equal to EPS divided by KE into N. When I'm multiplying with the number of equity shares, I'll get the total number of equity shares market value. So market value of equity is equal to EPS divided by KE into N. Okay, now in the place of EPS into N, I'll simply write earnings available to equity shareholders, because we know the formula EPS is equal to earnings available to equity shareholders divided by N. Now, when I want to know about the earnings available to equity shareholders, what would be the formula? EPS into N. Okay, now in the place of EPS into N, I have written earnings available to equity shareholders. So that gives me market value of equity. So what is the formula, sir? Market value of equity is equal to earnings available to equity shareholders divided by cost of equity. Applying the same formula, now I would like to know the cost of equity. Now cost of equity will go that side, and market value of equity becomes denominator. Cost of equity is equal to earnings available to equity shareholders divided by market value of equity. Okay, now every one of you. Now look at here. Let us see the relationship between cost of equity and market value of equity. Look at this example, sir. EBIT less interest on debentures. And here, one of the general assumption is that you can see there are only two kinds of funds are available. That is debt and equity. Whenever the company wants to raise the funds, right? It will raise the funds by using only two sources, that is debt and equity. There are no other options available to the firm. That's the assumption, sir. See, for understanding the capital structure theories, all these general assumptions have to be satisfied. Right, sir? So, since you don't have any preference share capital and there are no taxes as well, you can see another assumption here. Taxes are not to be considered. You just ignore the taxes. You just ignore all other sources of financing, right? Only two sources available, debt and equity. Clear, sir? So whatever the answer you are getting, this itself is the EBT, earnings before tax. This itself is your EAT because there are no taxes. And this itself is the earnings available to equity shareholders. There are no preference share capital. 60,000. Let us assume cost of equity 15%. Now, what is your market value of equity, Amma? 4 lakhs. Earnings available to equity shareholders divided by cost of equity. 4 lakhs is your market value of equity. Okay, now if cost of equity is greater than, increases to 18%, what happens to market value of equity? Your market value of equity reduced. 3,33,333. When your cost of equity decreases to 12%, your market value of equity increases 5 lakhs, from 4 lakhs to 5 lakhs. So from the above calculations, we can conclude that there exists inverse relationship between the market value of equity and cost of equity. If cost of equity increases, market value of equity decreases, and vice versa. So far we have learned cost of equity, market value of equity, and its relationship. Now, similarly, market value of debt, cost of debt, and its a relationship. Now, what is the market value of debt formula? Simple, sir. In the numerator, you have to take the cost element, right? What is the cost, ma? Sorry, the returns to the debenture holders you have to take. What is the returns to the debenture holders? Interest. Because when you are finding out the market value of equity, in the numerator, we have taken earnings available to equity shareholders. Yes or no? So here also in the numerator, you have to take the earnings available to debenture holders. What is that? Interest divided by, here we have taken cost of equity. Here you have to take cost of debt. Clear, sir? Now applying the same logic, cost of debt is equal to interest divided by market value of debt. Now again, look at the relationship. The relationship is same, inverse relationship, right? There exists inverse relationship between the market value of debt and cost of debt. If cost of debt increases, market value of debt decreases, and vice versa. Similarly, find out the market value of the firm, overall cost of capital, and its relationship. Market value of the firm. Sir, for market value of equity, in the numerator, we have taken earnings available to equity shareholders. In the market value of debt, we have taken the numerator earnings available to debenture holders, that is interest. So now we want to know the market value of the firm. That means market value of equity plus market value of debt. So means earnings available to equity shareholders plus interest, and then nothing but your EBIT. Your EBIT. So market value of the firm, the numerator becomes EBIT, and denominator you have to take the overall cost of capital, KO, overall cost of capital. Because for market value of equity, we have taken cost of equity. For market value of debt, we have taken the cost of debt. And for market value of the firm, we have taken the overall cost of capital of the firm. Now, applying the same logic, when you would like to find out the overall cost of capital, KO is equal to EBIT divided by market value of the firm. And if you observe the relationship between these two, again, same inverse relationship. There exists inverse relationship between market value of the firm and overall cost of capital. Means when KO increases, market value of the firm decreases, and vice versa. Okay, now specific assumptions under NOI approach. There are two specific assumptions, Amma. See, whatever given here, these are all general assumptions. These are all general assumptions applicable to the four capital structures theories equally. These are all common assumptions for all the capital structure theories. Now, apart from that, each and every capital structure theory has its own specific assumptions. Just a second, sir. Right. So whatever the assumptions mentioned here, these are all general assumptions common to all the four capital structure theories. Now, apart from that, each and every theory has its own specific assumptions, right, ma? So like that, here for NOI approach, we have two specific assumptions. Number one, cost of debt remains to be constant irrespective of level of gearing in total capital employed. Means whatever the debt capital you are introducing into your capital structure, will it be 20%, 40%, 60%? Your cost of debt remains to be constant. Are you following, sir? Suppose that in existing capital structure, you already have 20 lakhs debentures. Now, additional debt you are introducing 20 lakhs. Even this additional debt also, you are going to get at the same rate of interest, 12%. In future, you are going to raise additional debt of 20 lakhs again. You are going to raise additional 20 lakhs again. Even that additional debt capital, you are going to procure at the same rate of interest, 12%. So the cost of debt remains to be constant, irrespective of level of gearing in total capital employed. Level of gearing means percentage of debt capital. Whatever might be the percentage of debt capital, the rate of interest, the cost of debt remains to be same. That's the first specific assumption. Look at the second one. As the debt proportion increases in the total capital employed, the risk perception levels of equity shareholders also increases. As a result, cost of equity increases. Whenever you're introducing additional debt into your capital structure, Equity shareholders feels more risky because, see, when it comes to the distribution of the profits, the first priority is given to the debenture holders. Yes or no? Right, because it is a fixed financial commitment. After distributing the profits to the debenture holders, whatever the profits left over, only that profits are given to the equity shareholders. So when your debt capital increases now, the returns to the shareholders will decreases. That's why they feel more risky. When they are feeling more risky, their expectations towards the returns increases. As a result, cost of equity increases. Are you following, sir? Every one of you. That's the second specific assumption. Now look at here, diagram. Let me draw again here. Right, on x-axis, you have to take the percentage of debt capital. And on y-axis, you have to take the cost of capital, like cost of equity, cost of debt, and overall cost of capital. As per the specific assumption number 1, the cost of debt remains to be constant. Cost of debt remains to be constant irrespective of your level of gearing. Means whether you are maintaining 20% debt, 40% debt, 60% debt, 80% debt, your cost of debt remains to be constant. But whenever you are moving towards debt, what happens? The equity shareholders risk perception levels increases. Yes or no? So means whenever you are moving towards debt, the cost of equity increases. Cost of equity increases. Sir, whenever you are moving towards debt, whether it is advantage or disadvantage, the answer, you have advantage and as well as you have disadvantage. What is advantage? When you're moving towards debt, means you're moving to the cheapest source of finance. Debt is the cheapest source of finance. Yes or no? Right? Because the rate of interest is very lesser and the interest is a tax deductible expenditure. You'll get the tax benefit out of it. Right? That's why the debt is the cheapest source of finance. Equity is the costliest source of finance. Equity is the costliest source of finance because there is no restrictions with respect to the expectations of equity shareholders. You can put restriction to the expectations of debenture holders. See, when I said coupon rate of interest 12%, the company is bound to pay 12%. Even if the debenture holder expecting more than 12%, not required. Only we have to pay 12%. There is a restriction. But whereas coming to the equity shareholders expectations, there are no restrictions. Okay, now, right. And equity dividend is not a tax deductible expenditure. It is not a charge against to profit. It is an appropriation of profit. You won't get the tax benefit as well. So that's why the cost of equity is the costliest source of finance. Are you following, sir? Every one of you. Right? Now, so when you're moving towards debt, you have an advantage, that is you're moving towards cheapest source of finance. This is your advantage, but you also have a disadvantage. The disadvantage is that when you're moving towards debt, your cost of equity increases. Your cost of equity increases. So there is an advantage and there is a disadvantage. Both these advantage and disadvantage will be set off, exactly set off. Then your overall cost of capital remains constant. Both advantage and disadvantage got set off and your KVO remains constant. Sir, when your KVO remains constant, what happens to market value of the firm? We have learned that there existing inverse relationship between KVO and market value of the firm. If KVO increases, market value of the firm decreases. When KVO decreases, market value of the firm increases. When KVO remains constant, your market value of the firm remains constant. So that is what NY approach. What NY approach said, Amma? NY approach said, you can see here, the opinion of the net income approach, net operating income approach, the market value of the firm remains constant irrespective of changes in capital structure. Proved when KVO constant, your market value of the firm constant. So as long as your KVO remains constant, your market value of the firm also remains constant. So you can see here, whenever you are making changes to your capital structure, like 20% debt, 80% equity, what is your KVO? Remains same. When you moving towards debt, 40% debt, 60% equity, KO remains same. 60% debt, 40% equity, KO remains same. Yes or no? KO constant ga undamma. Ye proportion దగ్గర కూడా KO change అవ్వలేదు. As long as your KO constant, your market value of the firm constant. That is net operating income approach. Okay now let's moving to the net income approach. Net income approach belonging to relevance theories. Net income approach belonging to relevance theories. And here these people said market value of the firm changes with the changes in capital structure. Whenever you are making changes to your capital structure, your market value of the firm also changes. That change may be positive, may be negative, but your market value of the firm will change. And the two specific assumptions under this chapter, under this concept, cost of debt remains to be constant irrespective of level of gearing in the total capital employed. This is just like the first specific assumptions under NOI approach. Now, second assumption, increase in debt proportion in total capital employed does not change the risk perception levels of equity shareholders. As a result, the cost of equity also remains constant. So first specific assumption, they are saying cost of debt remains constant. And in second specific assumption, they also saying cost of equity also remains constant. Right, sir. Now look at the diagram. Your cost of debt constant, cost of equity constant. As a result, what happens, ma? Your KO will get changes. Are you following, sir? Every one of you. See, as long as your cost of debt constant, and your cost of equity constant. So when you're moving towards debt, then what happens? Your overall cost of capital decreases. When you're moving towards debt, when you're moving towards equity, then your KO increases. Your KO increases. Are you following, sir? So here you have advantage. Whenever you are moving towards debt capital, you have an advantage. You are moving to the cheapest source of finance. We know that when KO increases, market value of the firm decreases. When KO decreases, market value of the firm increases. You can see whether your KO remains constant. No, it is changing, sir. When you're moving towards debt, it is decreases. When you're moving towards equity, it is increases. When you're moving towards equity, now it will increases. Clear? And KO constant ga ledamma, either increasing or decreasing, means your market value of the firm also either increases or decreases. That is what NI approach is. NI approach said what, ma? Your market value of the firm changes with the changes in capital structure. Clear? Next. Traditional approach. Traditional approach also belonging to relevance theories. Market value of the firm changes with the changes in capital structure. Same concept, amma. Same concept. Right? It is a mixture of NOI approach and NI approach. These people said up to certain level of debt equity proportion, okay, that's acceptable, right? Certain level varki debt ni introduce cheyadam anedi acceptable, right? You can see here phase one, when you're moving towards debt, right? And here these people said like up to that particular level, your cost of debt and cost of equity remains constant. When cost of debt and cost of equity remains constant, your KO will be reduced. It is in decreasing stage. Okay, now, right? This is phase one. Now, phase two, look at here. You are still moving towards debt. Inka meru capital structure loki more and more debt you are introducing. Now, from this level, what happens? Your cost of equity slightly increases. So your cost of equity is an increasing trend. Cost of debt remains constant. One advantage and one disadvantage. So your KO line remains constant. Okay, now this is phase two. Now in the phase three, what they said is in the phase three, still you are moving towards debt. Now from here onwards, the cost of debt increases and cost of equity already is in increasing stage. When both cost of equity and cost of debt increases, your KO also increases. Your KO also increases. At this level, both are constant, Amma. So that's why your KO is in decreasing trend. But at the phase 2, your cost of equity remains constant, but cost of equity is in increasing trend. As a result, what happens, Amma? Your overall cost of capital constant. But in the phase 3, you can see your cost of equity increasing, your cost of debt increasing. As a result, your KO also increasing. But you can see more, you can see here in all the 3 stages, at one stage, overall cost of capital decreases. At the other stage, overall cost of capital increases. Ante, now you tell me, sir, whenever you are moving towards debt or moving towards equity, whether your overall cost of capital remains constant. No, it is changing. When your KO changing, your market value of the firm also changes. Okay, now, so that's what traditional approach. Okay, now finally, M&M approach, Modigliani and Miller approach. Here it is, fourth model, M&M approach, Modigliani and Miller approach. Now in this approach, sir, right, this approach is belonging to irrelevance theories. Belonging to irrelevance theories. Opinion, market value of the firm remains to be constant irrespective of changes in capital structure. Clear, sir? So M&M approach is an extension of net operating income approach. Sir, Modigliani and Miller approach is nothing but an updated version of net operating income approach. Updated version of net operating income approach. Clear, sir? The only difference is M&M approach, we have the taxes element as well. Right? M&M approach without any taxes, M&M approach with the taxes. Tax element also introduced here. See, as per the general assumptions, taxes not to be considered. But in the real world, the taxes impact will be there, sir. You have to consider the tax impact. So M&M approach developed a theory by taking into account the taxes impact as well. The concept is same as NOI approach, but under NOI approach, there are no taxes. No taxes. But under M&M approach, the tax impact also considered. That's the only difference approach between the NOI approach and the M&M approach. Clear, sir? Next. So that's it, sir. Coming to the capital structure chapter, right? Yeah. Here you have one more topic like M&M approach with corporate taxes. I have already told you. The formula would be market value of the levered firm. Levered firm ante the firm which is having debt capital as well. Firm which is having equity capital and as well as debt capital. Unlevered firm ante the firm having only equity capital. Only equity capital. No debt capital in the unlevered firms. 100% equity financed companies are called as unlevered companies. But in your company's capital structure, if you also have the debt capital, then your company is called as a levered company. So when you ask to find out the market value of a levered company, the formula should be market value of unlevered firm plus tax shield on debt. See, the only difference between unlevered and levered is the debt. Now, because of the debt capital, levered firm enjoys the tax benefits on the debt capital. Just simply add the tax benefits to the market value of unlevered firm. You will get a market value of the levered firm. Clear, sir? Every one of you? Right. So we also have one more concept called arbitrage. Arbitrage. Clear. And this concept of arbitrage, a very simple concept, but lengthy in writing. Means if you get a problem from arbitrage now, for doing this problem, at least it will take you 20 to 25 minutes a month. Very easy, but the procedure is very lengthy. Clear. So first, let me introduce this concept of arbitrage. Right now, look at this example, sir. X Limited is there, market value 20,000, sorry, 20 lakhs actually it should be. And Y Limited is there, market value 15 lakhs. Now look at this concept. When two companies which are belonging to the same risk class, their market values should also be same. Sir, X limited and Y limited both are belonging to the same risk class. The risk return characteristics of these two companies are same. When the risk return characteristics are same, their market values should also be same. But in this case, you can see X limited having market value 20 lakhs, Y limited only 15 lakhs. If in any case their market values are not in equilibrium stage, then we can reach equilibrium position with the help of arbitrage. Okay, now by using the concept of arbitrage, we can bring these two companies' market values at equilibrium position. How? Look at here. Arbitrage process. X limited, Y limited, both are having same risk return characteristics. Equity capital 20 lakhs and debt capital nil. So market value 20 lakhs. Now, so the market value of the X limited 20 lakhs. Coming to Y limited, equity capital 10 lakhs, debt capital 5 lakhs, totally market value 15 lakhs. Okay, now here you can see that there are these two companies' market values are not in equilibrium position. Now what happens here is the shareholders from the high market value company, in this example X limited, they will switch their investment to Y limited to the low market value company. Why, sir? Because of this, the shareholder will have an advantage. Whenever he is switching his investments from high market value company to low market value company, he will be having some advantages. What are they? Number one, he can get more returns with the same amount of investments. Right, sir? Now look at here. He is invested 1 lakh rupee where he is earning 15,000 rupees returns. 15,000 rupees returns. Now here, sir, when he invested the same amount of 1 lakh in Y limited, he will get more than 15,000 returns. Clear? With the same amount of investment, he will get more returns. Clear? The first advantage. Second advantage, he can earn the same amount of returns with less amount of investment. Clear? See, he would like to continue the same amount of return, 15,000 rupees. There is no need to invest the entire 1 lakh. Two advantages, but at a time, he can enjoy only one advantage. Either he can invest same amount, get more returns, or he can get the same return with less amount of investment. Are you following, sir? These are the advantages. That is why the shareholders from high market value company switched their investment to low market value company. And at one stage, what happens? Whenever the shareholders are switching to Y limited, what happens to the market value of X limited? It decreases, falls. 20 lakhs, 19 lakhs, 18 lakhs, 17 lakhs, 16 lakhs. And what happens to Y limited company shares market values? It will increases. Whenever more and more investments into a particular company, more shareholders purchasing the shares of a particular company, that particular company shares market value increases. So 15 lakhs, 16 lakhs, 17 lakhs. At one stage, these two companies' market values reaches to equilibrium position. Right. So this is how one can achieve the equilibrium position of the two companies' market values with the help of arbitrage. Once the company's market values equal, that will be the end of the arbitrage process. Clear? So at this juncture, the shareholder is indifferent between the investment into X limited and Y limited. At this juncture, whether he's investing in X limited, whether he's investing in Y limited, that will give you the same advantage. That will give you the same benefit to the shareholder. Clear? So that's the concept of arbitrage. Okay, sir. So with this, we have completed the capital structure chapter marathon. 4 chapters marathon completed, sir. Okay, now. So in the next class, I'll start with the leverages. A small chapter, leverages marathon. Okay, a small chapter, but very important chapter. Till then, have a good day and good night. Stay home and stay safe, sir. So a very good evening, students. So welcome to the FM marathon classes. In the last class, we have completed chapter number 4, capital structure. Right, ma? So far, we have completed 4 chapters. Now time for the 5th chapter, leverages. A very small chapter, but very important chapter, leverages. Now, what is this concept of leverages and what are we going to learn from this chapter? Okay, sir. First of all, look at the weightage. We can expect one problem from this chapter for 5 to 8 marks. Sometimes you will get a direct problem from this chapter, or sometimes this concept combined with the concept of ratios analysis or combined with the concept of capital structure. Then a question will be asked, a consolidated question. Leverages come capital structure or leverages come ratios analysis. Clear, sir? Right? Now, so first of all, what do you mean by the leverages? Leverages explains about getting the more returns with less efforts. Leverage. What is the leverage effect? Leverage and right? So getting more returns with less efforts. How? See here, leverage explains about the relationship between two interrelated variables. One must be independent variable, the other one must be dependent variable. So between these two relative variables, what is the relationship existing? And that relationship is explained by the leverages. Like example, general example, acceleration and speed. Acceleration is an independent variable. Speed is a dependent variable. Whenever you're accelerating the bike, your speed increases. When you're decreasing the acceleration, your speed decreases. Yes or no? So your speed of the vehicle depending upon the accelerator. Clear? No? Right? So next, results and efforts. Efforts and the results. Effort is an independent variable. Results is a dependent variable. Your results is purely depends upon your efforts. Your results purely depend upon your efforts. If you put more efforts, you will get good results. If you put less efforts, you will get less results. Yes or no? So result is a dependent variable. Effort is an independent variable. This is a general sense. Now coming to the financial management sense. In financial analysis, leverage represents the influence of one financial variable over the other financial variable. Here financial variables could be sales, variable cost, fixed cost, EBIT, EBT, EPS. These are all the financial variables. These are all the financial variables. So here leverage explains about the influence of one financial variable over the other financial variable. If that financial variable changes, how it is going to impact the other financial variables. Clear, sir? Right? Like risk and returns. Risk is an independent variable. Return is a dependent variable. Your returns are purely depends upon the element of risk you are taking. If you're taking the higher risk, then you can expect higher returns. You can expect higher returns. When you're taking the lower risk, then you have to expect lower returns. Higher the risk, higher will be expectations towards returns. Lower the risk, lower will be the expectations towards returns. Okay, now types of risks. We have three different types of risks here, operating risk, financial risk, and combined risk. Operating risk measured by operating leverage, financial risk leveraged by financial leverage, right? And combined risk measured by the combined leverage. Only three formulas here. Operating leverage, EBIT divided by EBT, sorry, contribution divided by EBIT, financial leverage, EBIT divided by EBT, combined leverage, contribution divided by EBT. End of the chapter. That's it. Only three formulas. Okay. Operating leverage, right? We have already learned leverage means it explains about the relationship between two variables. Here, two financial variables. Now, operating leverage explains the relationship between sales and EBIT. Financial leverage explains the relationship between EBIT and EPS. Combined leverage explains the relationship between sales and EPS. Sales and EPS, two financial variables. There is increase in the sales. How your EBIT going to be affected? If there is a decrease in the sales, if there is a decrease in the sale, how it is going to affect your EBIT? So increase or decrease in the sales, how it is going to be impact your EBIT? That is what explained in the operating leverage. Then changes in EBIT, how it will have impact in EPS. explained in the financial leverage. Then changes in the sales, how it is going to be affected your EPS, explained in the combined leverage. Okay, now let us try to understand each and every leverage in a detailed manner. First one, operating leverage. It is a measure of operating risk. Operating risk exists with the existence of fixed cost. Operating risk allows with the existence of fixed cost. If fixed cost is higher, your operating risk is said to be higher. If fixed cost is lower, your operating risk is said to be lower. If there is no fixed cost, no operating leverage. Are you following, sir? Clear? Now, look at this example, sir. First, look at the existing situation only. In existing situation, you have 10,000 units. You are producing 10,000 units and the entire 10,000 units you are selling out. And the selling price per unit 10 rupees. 10 rupees into 10,000 unit, your sales revenue 1 lakh minus variable cost per unit 5 rupees into 10,000 units, total variable cost 50,000. So contribution 50,000 minus fixed cost 20,000 rupees, EBIT 30,000. This is your existing scenario. Let us suppose that your sales increases by 20%. You put more efforts, right? And 20% sales were increased. Okay, now. So now the sales becomes 12,000 units into sales revenue, 10 rupees per unit, 1,20,000 is your sales revenue. Variable cost, variable cost per unit remains to be same. Your variable cost amount changes, but variable cost per unit will remains to be constant. Yes or no? Amount paranga variable cost marutunde tappa per unit cost variable cost maradu. So 12,000 units into 5 rupees per unit, variable cost becomes 60,000, contribution 60,000 minus fixed cost. See, at 10,000 units level, your fixed cost is 20,000. Now your sales in units increases to 12,000. Will it have any impact on your fixed cost? No. Fixed cost remains to be fixed irrespective of your level of activity. Yes or no? Whether your level of activity increases or decreases, the fixed cost amount remains to be same, 20,000 rupees. Now your EBIT 40,000. Look at here, changes in the EBIT from 30,000 to 40,000. EBIT increased 10,000 rupees. 10,000 increment is there from the base 30,000. As a percentage, you will get your EBIT increases by 33.33%. When your sales increases by 20%, your EBIT would also increase by 20%. But how come your EBIT increases 33.33%? Because of the existence of fixed cost. Are you following, sir? Right? So if sales increases by 20%, your EBIT increases by 33.33%. Less efforts, more returns. Like 20% efforts per day, 33.33% returns vachayamma meeku. That is the beauty of leverage. And here you are getting the leverage advantage because of the fixed cost. Now, look at the other side of the coin. Look at the other side of the coin. Suppose that, sir, because of the COVID, right? COVID pandemic situation, your sales decreases by 20%. Now you are able to sell only 8,000 units. Sales decreases by 20%. So sales revenue 80,000 minus variable cost 40,000, contribution 40,000. Sir, మీ సేల్స్ తగ్గాయి కదా అని చెప్పి మీ ఫిక్స్డ్ కాస్ట్ ఏమన్నా తగ్గుతుందమ్మా? No. Just because your sales reduces, whether your fixed cost reduces? No. Whether your sales increases or decreases, fixed cost remains to be same 20,000. Now your EBIT 20,000. Now from the base level of 30,000, your EBIT reduce it to 20,000. Reduction in EBIT 10,000 from the base level 30,000 as a percentage student 33.33%. When your sales decreases by 20%, your EBIT decreases by 33.33%. Are you following, sir? So you can see degree of operating leverage explains the relationship between sales and EBIT. Sales is an independent variable. EBIT is a dependent variable. Your EBIT is purely depends upon your sales. Now, the formula for the degree of operating leverage, when two levels of activity is given in the problem, like You asked to find out the operating leverage at 10,000 units level, 12,000 units level. So two levels of activity is given. Then the formula should be percentage change in EBIT divided by percentage change in sales. Apply the same logic into a formula, into our example. Percentage change in EBIT 33.33% and operating leverage, percentage change in sales 20%. So your degree of operating leverage 1.67 times, which means if sales changes by 1%, EBIT changes by 1.667%. The change could be either increase or decrease. Okay, now the other formula, sir, if only one level of activity is given, you asked to find out the operating leverage only at 10,000 units level, then formula should be contribution divided by EBIT. Contribution 50,000, EBIT 30,000, so 1.67 times. Okay, now if fixed cost increases, operating cost increases, operating risk increases. As a result, operating leverage increases. When fixed cost decreases, operating risk decreases, and as a result, operating leverage will also decreases. Okay, now, right, sir. Now look at here, the same concept I've explained through example here. In existing scenario, your fixed cost is 20,000, where your operating leverage 1.67 times. Now, when your fixed cost increases to 30,000, instead of 20,000, you have to reduce the fixed cost 30,000 from the contribution. Your EBIT become 20,000 only. Now, operating leverage student, you will get 2.5 times. When your fixed cost increases, your operating leverage increases. Increase ainda leda? Fixed cost increase ainappudu operating leverage increases. Okay, now next. If there is no fixed cost, your degree of operating leverage is equal to 1. Had there been no fixed cost, like sales revenue 1 lakh minus variable cost 50,000. So contribution 50,000 minus fixed cost nil, and then you will get EBIT 50,000. Now, what is the formula for operating leverage? Contribution divided by EBIT. What is the contribution amount? 50,000 divided by what is the EBIT amount? 50,000. What is your operating leverage amount? 1. So had there been no fixed cost, your operating leverage would have been equal to 1. If there is a fixed cost, then there will be operating leverage. Clear now? That's about the degree of operating leverage. Okay, now second one, degree of financial leverage. Degree of financial leverage. Degree of financial leverage is a measure of the financing risk. Measure of the financing risk. And financing risk exists with the involvement of fixed financial commitments. Sir, in your cost statement, in your operating profit statement, if you have debentures interest, if you have preference dividend, that means you have a fixed financial commitment. Whenever you are raising the funds through debentures, whenever you are raising the funds through preference share capital, means you are accepting a fixed financial commitment. You are accepting a fixed financial commitment. Clear, sir? Because payment of the debentures interest is a fixed financial commitment. Irrespective of your financial position of the company, you have to pay the debentures interest mandatorily. It is your financial commitment which is fixed. Preference dividend. Whenever your company is running in profits, payment of preference dividend mandatory na kada? It's mandatory. Clear now, right? So whenever there is an existence of fixed financial commitments in your operating profit statement, it gives rise to the financing risk. And the measure of the financing risk is your financial leverage. Degree of financial leverage explains the relationship between EBIT and EPS. EBIT is an independent variable. EPS is a dependent variable. Your EPS is purely depending upon your operating profits. Yes or no? Look at this example. EBIT 1 lakh. Interest and debentures, EBT, tax, earnings available to equity shareholders. Then you find out the EPS. Your EPS become 4 rupee 20 paise. Assume that your EBIT increases by 20%. 1,20,000. Interest and debentures. Because interest and debentures is a fixed commitment. Whether you are in running in profits, whether you are running in losses, it's a fixed commitment. It doesn't change. So you will get calculation here. UPS you get here 5 rupees 60 paise. What is the increase in the EPS? 33.33%. See, when your EBIT increases by 20%, your EPS increases by 33.33%. Less efforts, more returns. But look at the other side of the coin also, right? Because of the coronavirus, COVID pandemic situations, our profits got reduced by 20%. But profits reduce అయ్యాయి కదా అని చెప్పి debenture interest ఏమైనా తగ్గుతుందా? No. Just because there is a reduction in profits, the debenture holders won't reduce their interest amount. They will ask for same 40,000. Now you can see here, your EPS comes down to 2 rupees 80 pice from the base 4 rupee 20 pice. Your EPS decreased by 33.33%. Okay. Now the formula, sir, percentage change in EPS divided by percentage change in EBIT. In our example, your EPS changes by 33.33% for the 20% change in EBIT. So degree of financial leverage is equal to 1.67 times. 1.67 times. Right. This explains about if EBIT changes by 1%, your EPS changes by 1.67%. This change could be either increase or decrease. Either increase or decrease. Okay, now the other formula for financial leverage, degree of financial leverage is equal to EBIT divided by EBT. Okay. Now, if fixed financial commitment increases, your financing risk increases. As a result, your financial leverage also increases. Right. When your financial commitments are lower, the financing risk is lower. As a result, your financial leverage is also lower. So lower the financial commitments, lower will be financial leverage. Higher the financial commitments, higher will be the degree of financial leverage. Okay. That's about the financial leverage. Coming to degree of combined leverage. It is a measure of combined risk, means the total of operating risk and financing risk. Operating risk and financing risk. It measures both the joint impact of the operating leverage and combined financial leverage. Combined risk is a total of operating risk and financial risk. Combined risk exists with the existence of fixed cost and fixed financial commitments. Now it explains about the relationship between sales and EPS. Sales is an independent variable. EPS is a dependent variable. Okay, ma. How the financial variable sales is going to influence the other financial variable EPS, explained under the degree of combined leverage. Okay, now the formula part, degree of combined leverage is equal to first formula, operating leverage into financial leverage. Operating leverage into financial leverage. Second formula, sir, operating leverage key, we have learned one big formula. When two levels of activity is given, what is the formula, sir? Percentage change in EBIT divided by percentage change in sales. So as for financial leverage, percentage change in EPS divided by percentage change in EBIT. Now percentage change in EBIT, percentage change in EBIT crosses. Then the formula for degree of combined leverage is equal to when two levels of activity is given, percentage change in EPS divided by the percentage change in sales. Okay, ma. Third formula. So we have learned another formula for operating leverage when single level of activity is given, contribution divided by EBIT. So as for financial leverage, EBIT divided by EBT. EBIT cross chain, the ultimate formula for the combined leverage, contribution divided by EBT. Okay, now you can use any of these three formulae and you will get the same answer, sir. So this is about the operating leverage, financial leverage, and combined leverage. Just go through it once. Now let's moving on. Impact of few combinations of operating leverage and financial leverage. Right. Sir, when operating leverage and financial leverage both are in higher position, your operating leverage is high, financial leverage is high. The impact will be, it is a very risky situation, ma. See, your operating leverage high and financial leverage high means what? Your fixed costs are higher and your fixed financial commitments are higher. Operating is risk is high, financing risk is high. Very risky situation. Try to avoid these kind of situations. See, when your cost elements are higher, when your commitments are higher, now what is the profits you are going to enjoy? What are the returns you are going to enjoy? The returns to the shareholders will be reduced. Try to avoid this situation. Look at here, ma. Look at here. Higher operating leverage means, it means what, sir? High fixed cost structure, high financial leverage, high level of debt financing. This combination is very risky. Having both high leverages, it shows that the firm is employing excessive assets for which it has to pay fixed costs simultaneously. It is also using large amount of debt capital. This combination should normally be avoided. Not a beneficial situation to the equity shareholders. Ma, whatever the financing decision we are taking, you always have to think from the equity shareholders point of view, because the ultimate objective of the financial management is to increase the wealth of the shareholders, maximization of the wealth of the shareholders. Yes or no? Right? Now, second position, higher operating leverage, lower operating leverage, lower financial leverage. So rendu high unte vaddanaru, avoid cheyamannaru kada. So let me try to maintain both the leverages at lower level. That means your fixed costs are lower, your fixed financial commitments are lower. So that means the company is following a cautious approach. This situation should also be normally avoided. See, too cautious approach is too dangerous. Yes or no? Right? When you're not interested in taking up the risk elements, your returns will be lower. Then how can you maximize your shareholders' wealth? Clear now? Look at here. Low fixed cost structure and low debt capital. This represents a situation management is making a cautious approach. It is not possible for a company to maximize the returns to the shareholder in this type of situation. So this situation should also be avoided. Third situation, higher operating leverage, lower financial leverage means you are having high fixed costs and lower fixed financial commitments. Even this is also not advantageous to equity shareholders. Normally avoided, because see, lower fixed financial commitment means what? You are using high equity capital, low debt capital. Debt is the cheapest source of finance. You are using lesser amount of cheapest source of finance and more amount of costliest source of finance. Not an advantageous situation to the shareholders. Normally avoided. Look at here. Third scenario, high fixed cost, low debt capital. This situation is not advantageous to shareholder. This situation does not take the true advantage of debt financing, because through the debt financing, you can enjoy the tax. Are you following, sir? Every one of you. Clear? No. So that is why the third situation is also normally avoidable. Clear? Next. Fourth scenario. Look at the fourth scenario. Lower the operating leverage, higher the financial leverage. Now, this is an ideal situation because you're using more debt capital in your capital structure, which is the cheapest source of finance. Your cost of capital will be reduces, return on equity increases. Advantages to equity shareholders. So this is the ideal situation, maintaining operating leverage at lower level, financial leverage is higher level is the ideal situation, sir. Look at here. Low fixed cost, high level of debt financing. This is considered to be the ideal situation for the maximization of the profit with minimum risk. Maximization of profit with minimum risk. Since operating leverage is low, full advantage of debt financing can be taken to increase the return on equity. Okay, now. So that's about the different impact of the different leverages. Next. Next. That's it, sir. So, and I'd like to tell you one more thing here regarding the degree of financial leverage ratio. So we have already learned that the degree of financial leverage is equal to the formula. We have learned that degree of financial leverage is equal to EBIT divided by EBD. This is a general formula, sir. EBIT divided by EBD. But whenever the preference dividend is given in the problem, the formula slightly changes, sir. In this scenario, degree of financial leverage is equal to EBIT divided by EBIT minus interest. Up to this, the same formula. Numerator EBIT remains same divided by EBT. My EBIT minus interest is nothing but EBT only, no? Minus, you have given with the preference dividend minus preference dividend divided by 1 minus tax rate. Now, this divided by 1 minus tax rate, you have to put only for preference dividend. Only for preference dividend. So this should be the degree of financial leverage formula when preference dividend is given in the problem. Okay now, right? So normal cases, this is a formula EBIT divided by EBT. When preference dividend is given in the problem, this is a formula EBIT divided by EBIT minus interest minus preference dividend divided by 1 minus tax rate. Clear? So with this leverages chapter marathon also completed. Totally 5 chapters marathons completed. In the next chapter, I'm going to deal with the working capital management. Chapter number 6, working capital management. Yet another very important chapter. Clear? So till then, have a good day, sir, and good night. Stay home and stay safe. A very good morning, students. Welcome to the FM marathon classes. In the last class, we completed a discussion regarding chapter number 5, leverages. Now, time for the chapter number 6, management of working capital. Also known as working capital management, right? Famously known as working capital management. Right, sir? So one of the very important chapters of the financial management, right? So look at here, working capital management. Basically from the subject financial management, there are 2 chapters from which you will get a definite problem. That is investment decisions and as well as working capital management. In investment decisions, you will get 1 question compulsory for 8 marks, and from working capital management, 1 question compulsory for 8 marks. Right, sir? You can take any attempt financial management paper. You will definitely find questions from these 2 chapters. And not only the problems, you can also find sometimes theory questions also from these 2 chapters. So from the theory question point of view also, these 2 are very important chapters. Clear, ma? Out of this investment decision, we have already completed. Now time for the working capital management. Now, first, let us start with the introduction to this. Question number 1, what do you mean by the working capital management? It's nothing but, sir, working capital management is nothing but management of working capital. See, we know that financial management. What do you mean by the financial management? Nothing but management of finances. Management of finance is called financial management. Then after that, we have learned what do you mean by the finance, and then we later understood what is the concept of financial management. Similarly, working capital management means to be management of your working capital. Then now it's time to understand what do you mean by working capital. So that's our question number 2. What do you mean by the working capital? So look at here. Working capital means it is a capital It is a capital required for, just a second, sir. It is a capital required for smooth functioning of the day-to-day business functions. Right, sir? So whatever the day-to-day routine operational activities are there, for the smooth functioning of that routine functional activities, whatever the funds are required, whatever the capital required, that capital is what we call working capital. Working capital, the name itself indicating it is a capital required for working. It is the capital required for working. That is why it is called as a working capital. Clear? So working capital refers to funds in the business for a short period, usually up to 1 year. So this capital is a kind of a short-term capital. That is why it is also known as a short-term capital, also known as a circulating capital. So working capital and short-term capital and circulating capital and all are one and the same. Right? So whatever the capital we are raising, these capitals we are raising only for 1 year, max 1 year. And after that, the same capital will be reintroduced into the business. Right? And the same capital is circulating in the business. That is why it is called as a circulating capital. Right, sir? Like example, suppose that you're running a petrol bunk. You're running a petrol bunk. You have 2 petrol bunks in your petrol pump. 2 pumps are there. Right, sir? One for petrol and one for diesel. And today you got the stock of some 50,000 liters of petrol and 50,000 liters of diesel. And you have spent an amount of rupees 10 lakhs for this. Right, sir? With an investment of 10 lakhs rupees, you have taken 50,000 liters of petrol and 50,000 liters of diesel. And after you got this stock, what are you going to do with it? You are going to sell it. You're going to sell it. So buying and selling of the petrol and diesel is your business activity. Right, sir? Whatever the amount you are spending for buying of the petrol and diesel, that is your working capital. See, just having a platform, just having an establishment, 2 pumps, workers, everything, you cannot run the business. You must have the stock first. You must have the petrol and diesel first. Yes or no? And whatever the petrol and diesel you purchased, assume that within 1 month it was completed. The entire petrol and diesel were sold out. What next? See, by selling the petrol and diesel, you might have received your 10 lakhs back along with profit element. Now with the same 10 lakhs for the next month, again, you will purchase 50,000 liters of diesel, 50,000 liters of petrol, and the same lakh is getting circulating in the business. So that is why it is called as a circulating capital. So working capital or short-term capital or circulating capital, all these are one and the same. Okay, ma'am. Next, investment of the funds. In this chapter, we are going to discuss about both investment of the funds and as well as procurement of the funds, but mainly about the investment of the funds. So investment of the funds into fixed assets. This is an investment decision which we have already completed, chapter number 2. Now coming to the investment in current assets, now we are going to discuss in working capital management. So working capital management, we are going to learn about the investment of the funds and in which asset you are investing, you are investing in the current assets. Investment in current assets are going to be dealt by the working capital management. Now, in accounting terms, in accounting terminology, in accounting language, working capital means to be, it is the difference between the current assets and current liabilities. You might have studied this formula in your accounting. Working capital is equal to current assets minus current liabilities. Yes or no? Right? So, working capital management means management of working capital. Now, what do you mean by working capital? Current assets minus current liabilities. So that means, that implies management of working capital is nothing but management of your current assets and current liabilities. Are you following, sir? Management of your working capital is nothing but management of your current assets and current liabilities. Clear? Now, coming to the current assets, we have a lot of current assets in our balance sheet. Yes or no? Like closing stock, debtors, cash, bank, short-term investments, prepaid expenses, input tax credit of GST. All these are comes under current assets category. But what are the major current assets? Out of all these current assets, what are the major current assets? The major current assets for any business undertaking is a closing stock, debtors, and cash and bank balances. Are you following, sir? So working capital management is nothing but management of working capital. Working capital means current assets minus current liabilities. So management of working capital means management of current assets and management of current liabilities. And in the current assets, we are going to manage what? We are going to manage the closing stocks, debtors, and cash and bank balances. Okay. So management of closing stock, inventory. So we have a topic called inventory management. This inventory management is similar to the concept of EOQ. This you might have learned in the chapter materials in the cost accounting subject. Yes or no? In your cost accounting, you might be having the chapters like materials, labor, overheads. Yes or no? First chapter should be the cost sheet, then materials, then labor, then overheads, then you will be having standard costing, marginal costing. Yes or no? So in the materials chapter, you have a concept called economic ordering quantity. Square root of 2AO by C something, you have a formula, right? Economic ordering quantity. It is a level of quantity at which your transaction cost is equal to, means your carrying cost is equal to your interest cost and the total cost is minimum. Right, sir? You might have learned this concept of EOQ. At what level of quantities we need to maintain the inventories in our business unit? At the higher level. So at what level of quantities we need to maintain at the higher level or lower level? Right, sir? So whenever you're doing the business, whenever you are maintaining the inventory, so there is a question arises at what level we need to maintain the inventories. So then experts said like you need to maintain the inventories at EOQ level, economic ordering quantities. Because if you maintain the stocks at a higher level, then carrying cost will be incurred. Carrying cost will be means, you know, it will be increased, right? When you're maintaining the inventories at the lower level, then ordering cost will be increased. So that is why experts said EOQ level, maintain the stocks at the EOQ level, economic ordering quantity level, right? It is a level of quantity at which your transaction cost, means your carrying costs are equal to your ordering costs and the total cost is minimum. Yes or no? So the same concept, Amma, right here in working capital management also. So that is why in working capital management chapter, we are not going to discuss about the inventory management because it is same as EOQ concept in your concept cost accounting. Next, after that, debtors management. This is very important topic from examination point of view. I've already mentioned here. Very important topic from examination point of view. Sir, working capital management, I've already told you that it's a guaranteed question chapter. And from this chapter, there is higher chances that you will get a question from the topic of debtors management, managing the debtors. Next, after that, cash management, preparing the cash budgets, then optimum cash balances models, Baumol's model, Miller-Orr model. These are we are going to learn in the cash management. Next, after that, management of current liabilities. Here we are going to discuss about the sundry creditors. Creditors management are also known as the management of payables. So these are all the topics which we are going to learn from the working capital management. And this is about the introduction to working capital management. Clear, sir? Every one of you. Now, moving on to the very first model of this chapter, estimation of working capital. So this is all the theory I mentioned in the textbook, right, sir? So the very first model, estimation of the working capital. Clear. So inventory management, same as EOQ concept. Payables management, nothing but creditors management, right? And then cash management, receivables management, nothing but debtors management. This is cash management, right, sir? So model number one, you can see here, sir, estimation of the working capital requirement, right? Now, sir, whenever you're going to start a business, first of all, you need to estimate what is the working capital requirement. Or whenever you are going to start your new financial year, yours is an existing business unit. You are in this business since last 10 years. But for every year, you need to estimate the working capital requirement. So what is the working capital required for this year, for this project, for this new business undertaking, right? Just like you estimate the funds required for starting the business. Right. Whenever you are going to start a business, suppose that I would like to start a new educational institution, right? Now, what is the capital required for it? So I need to purchase, or I need to have the buildings, land, furniture, plant and machinery, equipments. Then I must have some working capital with me also. Yes or no? For smooth functioning of the day-to-day classes without any financial disturbances, I need to maintain some working capital, right? So what is the working capital required? What is the working capital required? First of all, we need to estimate the working capital requirement for this year, for this new unit, for this new project. Yes or no? Now, how to estimate that working capital? We have three options available, man. Number one, based on the turnover, right? Estimation of the working capital as a percentage of turnover. Look at this example. Last year, 2019-20, where your turnover is 50 lakhs and you have maintained a working capital of 10 lakhs. Now, working capital you are maintained as a percentage of turnover. 20% of turnover you are maintained as working capital. Now, current year 2021, your estimated turnover is 60 lakhs. So this year you're going to estimate the turnover 60 lakhs. Now, what is the working capital to be required? Simple, ma. Last year, how much you have maintained? 20% of turnover I maintained as working capital. So maintain the same in this level also. In this year also. What is your estimated turnover for this year? 60 lakhs into 20%. So this year, maintain a working capital of 1,20,000. Are you following or not? Every one of you. Then you will get a doubt. Sir, if it is an existing business unit, we definitely have the last year's turnover details and last year working capital details, based on which we can find out the percentage, and the same percentage will maintain this year also. But what if it is a new business? What if it is a new project for the first time you're starting out? We don't have any previous year data with us. No problem, sir. Even it is a new business unit, even if it is a new project, you must have some turnover on your mind. You must have some estimated turnover on your mind. Or for you, it is a new business, but there are some already existing people. See, I'm going to start a new software unit. For me, it is a software is a first time I'm entering into the software industry. But there are so many people like TCS, Wipro, Satyam, Mahindra Satyam. Now, yes or no? Already the software giants are existing in the business unit. Yes or no? Right? Now, take the similar level. Right? See, for me, TCS, Wipro, Tech Mahindra, these are all large players. I'm a medium player. So take your level of software company, right? Look at them, how much working capital they are maintaining. So you try to maintain the same level of working capital. Try to maintain the same level of working capital. Are you following or not? Right, sir. Next. That's the first option available. Second option, based on the total assets, means as a percentage of total assets. So last year, how much total assets you maintained? And for the total assets, how much working capital you maintained? Take the percentage and apply the same percentage on the current year's total assets. Third one, most important one, estimation of the working capital based on operating cycle. So 90% of the cases, financial managers uses third method for the estimation of working capital. That is based on operating cycle. See, based on as a percentage of turnover, as a percentage of total assets, very few people uses these methods for the estimation of working capital. But when it comes to 90% of the financial managers, they will use a third model only, estimation of the working capital based on operating cycle. Now let us try to understand what do you mean by operating cycle. Simple, sir. It is a time required for converting the cash into cash. It is a time required for converting the cash into cash. That is what we call operating cycle. What do you mean by it? Very simple, sir. See, whenever you're starting a business, you'll start with the cash. Okay, I'm ready with 10 lakhs funds with me. Now with this 10 lakhs, I'll purchase what, Amma? Out of this 10 lakhs, 5 lakhs I spent on raw materials. So first I'll purchase what? Raw materials. Then the raw materials I'll issue into the production process. They will be into work in progress. Then from the work in progress, after completing its production, then it will be turned into finished goods. And the finished goods will sell on credit basis, then debtors comes into picture. Yes or no? And from the debtors will collect the money, then the cash will be realized. So I started with the cash. With the cash, I purchased the raw materials. Raw materials are issued into the production process, work in progress. After completing the production, they will be turned into finished goods. And the finished goods I've sold on credit basis, debtors will be arised. And from the debtors, I'll collect the money. So then I'll get back my cash. So whatever the time required for this converting the cash into cash, that is what we call operating cycle. That is what we call them a operating cycle. Every one of you following now? From the day one, let us assume that from the day one, I made investments. I purchased raw materials. I purchased work in progress. I made some investment into finished goods, then debtors, and finally, I collected the money from debtors, then I'll get the cash back. Clear? And this operating cycle is also known as working capital cycle and cash cycle. In the main exam, you may be asked to find out the operating cycle or working capital cycle or cash cycle. Clear? Next, moving on. Components of operating cycle. What are the components? First one, you can see raw materials holding period. Raw materials holding period. What do you mean by it? Very simple, sir. Whenever you're starting business, the first activity you're going to do is procuring the raw materials. Suppose that I'm engaging in the business of car manufacturing. Cars manufacturing is my business activity. So first of all, what I have to do for manufacturing of the cars, first I have to procure all the materials, all the raw materials required for the cars manufacturing. Yes or no? Right? So every day I am procuring 1000 units. Every day I'm procuring 1000 units for the cars manufacturing. Like that, from day 1 to day 30, I've just spent my time on procuring the raw materials. The first 30 days, I've spent my time on procuring the raw materials. Right, sir? You'll get a doubt here. So why on day 1, you already procured 1000 units of raw materials, which are used in the manufacturing of cars. Immediately, you can issue the same 1000 units into production process. Why are you waiting up to day 30 days? Why? Because suppose that if I am issuing the raw materials on a continuous basis for manufacturing purposes on daily basis, you know what will happen? Suppose that if due to pandemic COVID situation, we were under lockdown for almost 2 months, a complete lockdown for 2 months. In that 2 months time period, right, sir, my production will get stopped because I am unable to procure the raw materials. See, if on a particular day, if I am unable to procure the raw materials, on that particular day, my production will stop. Yes or no? Suppose that there is no lockdown, nothing, sir. But the raw materials were in scarcity, shortage. I am unable to purchase the raw materials from my regular suppliers, right? So that on that particular day, the production will be stopped. Suppose that my raw material supplier ready to supply the raw materials, but there is no transportation. All the trucks went into strike. All the truck drivers unions went into strike. So I'm unable to get the goods to my factory. Sir, even the trucks are available, but there is some natural calamity, floods, earthquake, unable to procure the raw materials. So there are no calamities, but there are some riots, civil disturbances, unable to procure the raw materials. So there are so many unexpected things you might face on procuring of the raw materials. So that's why you always have to keep certain quantity of raw materials your go down every day. Like say at least for 20 days at 30 days, raw materials you should be maintained in your godowns. So even if you are unable to procure the raw materials for a continuous 20 days, it won't stop your production because you already have in your godown raw materials for 20 days. 20 days ki saripada raw materials మీరు already godown లో మెయింటైన్ చేస్తున్నారమ్మా. But ఆ 20 days raw materials ని మీరు production లోకి issue చేసుకోవచ్చు. So even if you're unable to procure the raw materials for a continuous period of 20 days, your production will not stop because you already had a stock of 20 days. So that is why 24/7, 365 days, you must maintain certain quantity of raw materials in your godown. So that's why on the first 30 days, I've just procured the goods, raw materials, and stored in my godown. See, even day 31 onwards, also I'm procuring the raw materials. Amma. 365 days I'll procure the raw materials. I never stop procuring the raw materials. But from day 31 onwards, I will issue the raw materials into production process also. Right, sir? See, up to 30 days, I have procured 30,000 units of raw materials. From 31st day onwards, what happens, Amma? I'll procure the raw materials, 1,000 units, and I will issue the raw materials of 1,000 units into production process. So means at the end of the 31st day also, I have 30,000 units of raw materials into my godown. Now day 32, again I'll procure 1,000 units of raw materials. Again, I will issue 1,000 units of raw materials into production process. So end of the day 32 also, in my godown, I'll be having 30,000 units of raw materials. Like that, you can go to the godown any day. You will find 30,000 units of raw materials into your godown. And of course, I'm going to follow the FIFO method on issuing the raw materials into production process, first in, first out. FIFO method. Are you following or not? So like that, 24/7, 365 days, you can go to any day into your raw material, you go down, you will find 30,000 units of raw materials. Right, sir? Suppose that raw material cost per unit 10 rupees. 1,000 units into 10 rupees, 10,000 rupees. Investment in raw materials. I said 30,000 units of raw materials you are maintaining into your godown all the time. 24/7, 365 days. And how much investment is blocking in raw materials? 30 days, every day 1,000 units you're procuring into 10 rupees per unit. 3 lakhs rupees is a investment in raw materials. So you can go to your raw material godown any day, ma. You will find 3 lakhs worth of raw materials into your godown. Are you following, sir? Raw materials holding period. This is what investment in raw materials. Clear? Now moving on to the work in progress holding period. What is this? So from day 31 onwards, I've started issuing the goods into production process. I assume that my production process takes place of 15 days. See, if on day 31 morning, I will issue the raw materials for production. By day 31 evening, I'll get a car. No. Car manufacturing takes time, sir. పొద్దున మీ రా మెటీరియల్స్ ఇష్యూ చేసి ఈవినింగ్ కల్లా కార్ రెడీ అయిపోయి వచ్చేదమ్మా. టైం పడుతుంది. It will take time for manufacturing of the car. So 15 days, I assume that the work in progress period. Right, sir? That means whatever the raw materials I've issued on day 31, it will complete its production process by day 45. So on day 45 evening, I'll have 1,000 cars, 1,000 finished goods. Like that, on day 32, again, I might have issued 1,000 units into production process. And that will complete its production process on day 46. Again, 1,000 cars will be manufactured. So that means from day 45 onwards, every day I'm going to get 1,000 cars finished goods every day from day 45 onwards. So whatever the 15 days production time is there, no? Mari production cheyalante, you might have some investment. You might incur some investment like inventory expenses, labor expenses, overhead expenses. So for all these 15 days, whatever the investment you are incurring, investment in work in progress. And this 15 days is what we call work in progress holding period. Okay, ma. Next, after that, finished goods holding period. Amma, from day 45 onwards, you are getting 1,000 cars. Every day you will get 1,000 cars. Whatever the finished goods you are getting, are you going to issue the same into your depots, your branches for the selling purposes? No. Today, if you receive 1,000 finished goods, you don't issue the same into your depots or branches for sale. Because see, if you issue only 1,000 cars, assume that you got an order for 5,000 cars. You are unable to meet that order because you don't have the sufficient finished goods with you. You have only 1,000 quantity of finished goods with you right now. So that's why generally the large manufacturing units, what they will do, sir, they will maintain certain buffer stock, maintain certain quantity of finished goods into their godowns. Suppose that even though you are getting 1,000 cars on day 45, you won't issue them for sale. You won't issue them for your depots, your branches, your outlets for the selling purposes till day 75. You will maintain 30 days finished goods with you. Means around 30,000 units, 30,000 cards you will maintain in your finished goods go down. Why? Because see, if you issue 1,000 units on a daily basis, and if you get some bulk orders, you're unable to meet. If you're unable to meet, you might lose that bulk order. So that's why in order to make you ready for bulk orders, you have to maintain certain quantity of finished goods with you. That is what we call finished goods holding period. So that means whenever you are maintaining finished goods into your godown, you have to incur some carrying costs that go down, rent, electricity charges, right? The guards will be there, salaries, everything, investment in finished goods. And then after that, from day 76 onwards, we started issuing the units into outlets for the selling purposes. Day 76 onwards, you are going to sell them goods. And nowadays, majority of the goods we are selling on credit basis. Yes or no? Why? Because cutthroat competition. We are living in a cutthroat competition. See, when your competitors are selling the goods on credit basis, you also have to sell the goods on credit basis. Yes or no? So whenever you're selling the goods on credit basis, debtors comes into picture. And debtors, yes, you have to give them some time for the payment. Yes or no? If you sell the good on morning and if you ask him to pay in the evening, what is the credit period you're giving to him? One day there won't be no person to purchase. They will ask for some 2 months time or 3 months time for the repayment. That is what we call debtors collection period. Clear, sir? So assume that you have given 30 days time for the payment. So even though you sell certain quantity of goods on day 76, you are going to get the amount when? Day 105. Are you following, sir? Now here you have to find out the investment in debtors. How much investment is blocking in debtors? Clear. Then after this, you will get a gross operating cycle period. Gross operating cycle period is nothing but the total of raw materials holding period, work in progress holding period, finished goods holding period, debtors collection period. That is what we call a gross operating cycle period. And whatever the investment blocked in this period is what we call gross working capital. So the first four we have taken current assets. Now from that, you have to deduct current liabilities, because we know that working capital is equal to current assets minus current liabilities. Right? Just like you given the credit period to your debtors, you will also get certain credit period from your suppliers. See, I'm purchasing the raw materials from my supplier X. So that supplier X will also give me certain credit period for the payment. So that's an advantage for me. Suppose that I purchase the raw materials from him and he has given me 15 days credit period. So am I going to pay that credit period amount immediately? No. Even though today I procured the raw materials, I'm going to pay him after 15 days. So that's an advantage to me, right? Thereby, it will reduce my working capital requirements, sir. So that 15 days you have to deduct from the gross operating cycle period. Finally, you will get a net operating cycle period 90 days. NOCP, net operating cycle period. Then cash cycle anachu, working capital cycle ani kuda anachumma. And whatever the credit amount is giving to you, let us assume some 5 lakhs rupees. That will be reduced from your gross working capital. Finally, you will get about a net working capital, right? 25 lakhs. So here your operating cycle period is 90 days. For converting your cash into cash, how much time requiring 90 days. So day 1 రోజు మీరు ఇన్వెస్ట్మెంట్ స్టార్ట్ చేస్తే ఆ డే 1 రోజు నుంచి మీరు ఏదైతే ఇన్వెస్ట్మెంట్ స్టార్ట్ చేశారో ఆ ఇన్వెస్ట్మెంట్ మీకు తిరిగి రావడానికి పట్టిన టైం పీరియడ్ ఎంతమ్మా 90 days. దీన్ని ఆపరేటింగ్ సైకిల్ పీరియడ్ అంటాము. వాట్ ఎవర్ ది ఇన్వెస్ట్మెంట్స్ యూ స్టార్టెడ్ ఫ్రమ్ డే 1, all that investments, for getting back all that investments, you are taking 90 days time period, and that 90 days time period is what we call operating cycle period. And for this 90 days time period, what is the working capital required? 25 lakhs. This is how you need to estimate the working capital based on operating cycle. Okay, next, the important points here. Calculation of investment in debtors. Now for calculating the investment in debtors, we have 3 models available: sales value method, total cost method, variable cost method. 3 methods available. Now among these 3 methods, which method should I adopt while calculating investment in debtors? The answer is, if problem is specifically mentioned like calculate the investment in debtors based on sales value method, adopt the sales value method only. If problem specifically mentioned, like calculate the investment in debtors on total cost method, follow the total cost method only. But if problem is silent about how to calculate investment in debtors, on what basis we have to calculate investment in debtors, the problem is silent, then in that scenario, go for the variable cost method. Evaluate the investment in debtors based on variable cost method, because it is the most logical and reasonable method, sir. Why? Because look at this example, sir. For the production, for manufacturing of a particular unit, assume that you have incurred a variable cost of 60 rupees per unit, fixed cost of 40 rupees per unit. So the total cost comes out to be 100 rupees per unit, where you have added your profit element of 20 rupees. So selling price per unit is 120 rupees. Okay, ma. So selling price per unit is 120 rupees per unit. Now, so first of all, look at here, while evaluating the investment in debtors, if you're adopting the sales price per unit, sales value method, then you have to take 120 rupees per unit. Okay, now, if you adopt total cost method, you have to take 100 rupees per unit. If you adopt variable cost method, then you have to adopt 60 rupees per unit. Clear? Now, why I said variable cost method is logical. Simple, sir. Sir, if you adopt 120 rupees, selling price per unit, 120 rupees. So now my question is whether your profit is your cost. See, this 120 you got after adding the profit element of 20 rupees. But my question is whether profit element is your cost. No. Did you incur anything out of your own pocket of 20 rupees? No. Your profit element is not a cost to you. Then how come you treat 120 rupees investment is blocked in debtors? You sold it for 120 rupees, sir, to the debtors, right? But how come you treat that 20 rupees as your investment? It is not a cost to you. You have not expenditured any 20 rupees cost here. Okay, now investment means whatever you made out of your pocket is your investment. But 20 rupees is a profit element which cannot be your investment. So that's why sales value method is not correct. Okay, fine. In that case, total cost method is correct. No, sir. Even in total cost also, sir. How did you get the total cost? Variable cost 60 rupees. After adding fixed cost of 40 rupees, you got a total cost of 100 rupees. Now, my question is, sir, whether this fixed cost of 40 rupees you have incurred, whether did you incur this 40 rupees exclusively for this product, exclusively for this unit? No. Fixed cost remains to be fixed irrespective of your level of activity. Whether you produced this unit or not, you have to meet that expenditure. So did you exclusively incur an expenditure of 40 rupees for this unit? Answer is no. So then how come this 40 rupees become your investment? Okay, now. So you have exclusively incurred only 60 rupees for this unit. So out of your pocket, you have spent 60 rupees for producing this unit. So that is why only 60 rupees is blocked in investments in debtors, not 120 rupees. So logically speaking, variable cost method is correct, ma. But of course, if the problem specifies certain method, you have to follow that method only. Like, look at here, ma. So look at here, sir. In the problem number 1, it was specifically mentioned value investments in debtors at sales value. So while calculating investment in debtors, it is clearly mentioned based on sales value. In problem number 2, look at ma, investment on debtors has to be valued at total cost. So then while you're calculating investment in debtors, you have to calculate at total cost basis. Clear, ma? If the problem is silent, go for the variable cost. Next. Sir, while estimating the working capital, we have two methods available, sir. One, cash cost basis. And two, total cost basis. While estimating the working capital, we have two methods available: cash cost basis and total cost basis. Means, sir, cash cost basis means we have to consider only cash expenses, only Then cash receipts, incomes. That means you have to just ignore depreciation while calculating working capital based on cash cost basis. Sir, if you include depreciation while estimating your working capital, it means you have estimated the working capital based on total cost basis. Are you following, sir, every one of you? The problem will specifically mention whether to consider the depreciation or whether to ignore the depreciation. If nothing is mentioned now, you just estimate the working capital on total cost basis. If specifically mentioned now, then estimate the working capital on cash cost basis. Okay, ma? So all this was already mentioned in theory, sir. You can see here depreciation, right? An important point in estimating the working capital requirement is a depreciation, right? Depreciation on fixed assets is not considered as working capital estimation because it is a non-cash expenditure. There is no funds locked in depreciation. Therefore, it should be ignored. Depreciation neither included in the valuation of work in progress nor in finished goods. The working capital calculated by ignoring depreciation is known as cash cost basis working capital. In case if the depreciation is included in working capital calculations, such estimation is known as a total cost basis working capital. Clear, ma? Next. Sir, for estimating this investments in raw materials work in progress, we have formulas here, right? So raw materials inventory, look at the formula. Budgeted production in units, budgeted production, because we are estimating, sir. We are estimating for the next year, upcoming year. So you have to take the budgeted production only, not the existing production, budgeted production, estimated production in units into raw material cost per unit. Up to this formula, what are you going to get? Up to this formula, you're getting total raw material cost, total raw material cost for the budgeted production. Divided by 12 months, divided by 12 months means you will get what, Amma? Total raw material cost per month. Total raw material cost per month into average inventory holding period. Let us suppose that your inventory holding period is 1 month. So then you will get Amma investment in raw materials. How much investment is blocking in raw materials for that 1 month? Let us assume that. Suppose that your budgeted production in units. Your budgeted production in units, let us assume that some 50,000 units. Raw material cost per unit, let us say 100 rupees per unit. So now when you're multiplying budget production in units, 50,000 units into 100 rupees, you will get 50 lakhs rupees. 50 lakhs rupees is your what, sir? Total raw material cost divided by 12 months. So 50 lakhs rupees divided by 12 months. You're getting 4,16,667 rupees. This is raw material cost per month. Assume that you are maintaining 2 months worth of raw materials into your godown into 2. You are getting 8,33,333. So that means what is the investment blocking in raw materials? The investment blocking in raw materials is 8,33,333 rupees. So you can walk down to your raw material godown any day. You will find 8,33,333 rupees worth of raw material. Are you following, sir? That's the meaning of this formula. If the problem specifies the number of days, then divided by 365 days. Number of weeks divided by 52 weeks. Clear? Next. Coming to the work in progress inventory. Here, while calculating work in progress, you have to take the raw materials for 100%, whereas labor and overheads, unless otherwise specifically provided in the problem, you have to take them at 50%. You have to take them at 50% because work in progress involves all the three: materials, labor, overhead. Right? Materials at 100% you have to take. The cost element 100% you have to take. Labor and overheads you have to take at only 50%. Clear, sir? Right? And now what is the formula? Same, budget production units into cost per unit of work in progress. This will give you the total cost of work in progress divided by 12 months. So you will get per month cost of work in progress into holding period. So for that holding period, what is the investment blocking? You will get to know. Next, finished goods inventory. Budget of production units into manufacturing cost per unit. That will give you the total manufacturing cost divided by 12 months. Per month manufacturing cost you will get into finished goods holding period. You will get what is the investment blocking finished goods for that holding period. Okay. Then investment in debtors. Budgeted credit sales. Look at here. Credit sales. While evaluating the investment in debtors, you have to take the sales. For the first three, you might have observed that budgeted production, and here also budgeted production. But whereas in the debtors, you have to take the sales information, budgeted sales into cost of sales per unit. Here, either you have to take the sales value or total cost or variable cost. Depends upon the information given in the problem. Then divided by 12 months, per month cost you will get into debtors collection period. Clear? And apart from that, cash and bank balances, this information will be given in the problem. Company wants to maintain 25,000 rupees cash. Company wants to maintain 35,000 rupees into cash. This will be directly given into the problem, sir. You will simply add it to the current assets. That's it. Then estimation of current liabilities, trade creditors, budget of production in units into raw material cost per unit. This will give you the total raw material purchases, total raw materials purchases value divided by 12 months. That will give you per month purchases value into credit allowed by creditors. Clear? Next, direct wages, budgeted yearly production into direct labor cost per unit. That will give you the total labor cost per annum divided by 12 months. You will get per month into average time lag in payment of wages. Generally, the time lag in payment of wages, yes, you have to take 1 month. Right, sir? Basically, the month of March will be payable in the month of April. Month of April, wages of the April will be payable in the month of May. So mostly it will be for 1 month, sir. Then overheads, budgeted yearly production in units into overhead cost per unit. That will give you the total overhead cost divided by 12 months per month overheads cost into average time lag in payment of overheads. Like rent. So March month rent payable in the April month. April month rent payable in the May month. So basically, even the time lag in payment of overheads also maximum 1 month. Next. And then statement of working capital. So you have a standard format. In this format, you have to estimate the working capital. First, it goes through current assets. Right, Ma? What is the current assets? Raw materials. Whatever the formula you have used here, raw materials inventory. Right? By using this formula, whatever the answer you got, 8,33,333. Here you have to mention 8,33,333. So like that, work in progress, then finished goods, then debtors, cash, prepaid expenses, if any. Prepaid expenses, it is our current asset, ma? Yes or no? So then that will give you the gross working capital, the total of current assets known as gross working capital, from which you have to deduct current liabilities, creditors for raw materials, creditors for wages and overheads, total current liabilities. Now net working capital, A minus B, total of current assets minus total of current liabilities. That will give you the net working capital, for which add provision for contingencies, if any. Safety margin. What we call a safety margin. Here you have. Because whatever we are doing here is just estimation, sir. Sir, we have estimated the working capital requirement 10 lakhs. It's just an estimation, sir. You are not God. నువ్వేం దేవుడివి కాదు సార్. ఎగ్జాక్ట్గా నీ వర్కింగ్ క్యాపిటల్ రిక్వైర్మెంట్ 10 lakhs ఉంటుంది అని చెప్పడానికి. It may be more than 10 lakhs or it may be less than 10 lakhs. Possibility is there because it is just an estimated amount. So that's why for compensating that contingencies, right, sir, what we'll do is we'll maintain a safety margin like 10% or 20%. Like if the problem said like the company is maintaining 10% safety margin, 10% of what? 10% of your working capital. So 1 lakh. In totally, we will raise 11 lakhs working capital. So though you estimated 10 lakhs only, 1 lakh you are maintaining as a spare safety margin. Even in future, if some increment in the expenses, raw material cost increased, the overheads increased, you are unable to estimate that. So for all that contingencies, we will maintain a safety margin. Clear? So though you estimated 10 lakhs, you have to maintain 11 lakhs working capital. Clear, Amma? Next. That's what safety margin. And these are some additional assumptions. Sir, whatever the estimations we are doing, all that estimations are based on some assumptions. Right, sir? Like you can see here, after the completion of one problem, I've given that assumptions. Yeah, look at here. First assumption you have to take, in the case of work in progress, raw material is assumed to be completed to the extent of 100%, whereas wages and overheads are assumed to be incurred to the extent of 50%. That I've already told you. Raw materials you have to take for 100%, wages and overheads you have to take it for 50%. Next, all the purchases are assumed to be based on credit basis. Unless otherwise specifically mentioned, you have to assume all the purchases are on credit basis. 1 year is equal to 52 weeks. And level of activity will remains unchanged. Level of activity, your production, means you have estimated that this year production will be 1 lakh units. So this 1 lakh units remains same as it is. There is no higher production, lower production. Only we will produce 1 lakh units. Next, various components of operating cycles will remain unchanged. Means raw materials holding period, work in progress holding period, finished goods holding period, like this. These components are not going to be changed. Next, debtors are being valued on sales value basis. You may value on sales value or total cost or variable cost. If you valued on sales value basis, now you have to write an assumption. Debtors are being valued on sales value basis. Alternatively, it can also be calculated on total cost basis and variable cost basis. Last assumption, cost structure will remain unchanged. Cost structure. What is the cost structure? Cost structure means, you can see here in the problem they have mentioned, like here, raw material cost 80 rupees per unit, direct labor cost 30 rupees per unit, overhead cost 60 rupees per unit. So total cost 170 rupees per unit. Profit 30 rupees. So selling price per unit 200 rupees. This is what we call cost structure. Idi mana cost structure amma. Ardhamautunda? So whatever the cost structure we have estimated, that remains unchanged. I've estimated raw material cost 80 rupees per unit. So the raw material cost 80 rupees per unit, throughout the year it will be same. It remains same. Clear? So that is what the estimation of the working capital in the case of the existing business units. Okay now? So just go through it once and ask the doubts if any. Completed. Now let's moving on. So for existing firms, estimation of the working capital is very easy, sir. It's very easy. But when it comes to the new firms, it is somewhat difficult. I'll tell you, ma. So estimation of in the working capital, when it comes to the new firms, right? New business units. Look at here, sir. Right. This is a model. Estimation of working capital in the case of the new firms. So in the case of the existing companies, you can see here, the following equations holds good. Raw materials purchases is equal to raw materials consumption. Sales is equal to production. Collections from debtors is equal to total credit sales. So the above equations holds good on satisfaction of the following conditions. See, if all these 4 conditions are satisfied, these equations are holds good. Right? What is it? There is no change in the level of activity. Means whatever the level of activity we estimated, some 1 lakh units to be produced in this year, that 1 lakh units we are going to produce. No change. Right? And there is no change in the cost structure. Like Raw material cost per unit, we have estimated some 50 rupees per unit. Wages, 30 rupees per unit. Overheads, 20 rupees per unit. Like this, we have estimated the cost elements. And these cost elements are going to be same. There is no changes. No increments in the raw materials cost per unit, no increases in the wages, and no increases in the overheads. Neither the decreases, right? Whatever the estimations we have made, there is no change at all. Next, no change in the inventory norms. Like we have estimated that raw material holding period, say 1 month, means we decided that 1 month's raw materials we will maintain in the godowns all the time. Work in progress holding period, we have estimated that raw materials took 15 days for completing its production process. Right, ma'am. So work in progress holding period, we have estimated 15 days. So the raw materials conversion takes 15 days time period. And in future also, like the work in progress holding period remains to be same 15 days. Means in this year, the estimated year, right, sir? And there is no change in the inventory norms. There is no change in the credit norms. Means we have given the debtors collection period, credit period, 2 months. So within 2 months, we are going to collect the money from the debtors. And no changes in future. Like see in the 2020-21, right? We have given the debtors collection period 2 months. 2 months. In 21-22 also, you are going to maintain the same 2 months collection period. You're not going to give you additional time period. You're not going to give additional time period to your debtors for paying the amount, sir. Are you following, every one of you? Right? So if all these 4 conditions are satisfied, then these conditions holds good, these equations. When these equations are holds good, then the estimation of the working capital in the case of the existing becomes easy. Right? Because while you're calculating the investment in raw materials, you will take raw material consumption. While you're calculating the creditors for raw materials, you will take raw material purchases. Are you following, sir, every one of you? Next. The above equations doesn't holds good in the case of the newly formed companies, as the opening stock in the newly formed companies is 0. Example, Chonamma, raw material consumption is equal to raw material purchases. We have taken this equation, and this equation holds good in the case of the existing firms. Why? Because my raw material consumption formula in the opening stock of raw materials plus raw material purchases minus closing stock of raw materials. That's the formula. Right. Now, opening stock of raw materials, 2000 units. I assume that closing stock of raw material, 2000 units. Why? Because there is no change in the inventory norms. Clear, sir? Last year, whatever the raw material holding period we are maintaining, say, let us suppose that 1 month holding period we are maintaining, means last year's closing stock will be 1 month's raw material, becomes this year opening stock, 1 month's raw material. And this year also, we are maintaining the same raw materials holding period, 1 month. No change in the inventory norms, kada. This year also, we are maintaining same raw materials holding period, 1 month. And this year closing stock also is going to be only 1 month stock of raw materials. Are you following, sir? So opening stock, 1 month stock of raw materials, closing stock, 1 month stock of raw materials. So plus minus, it will be, striked off as the same quantity is there. So whatever you left, raw material consumption is equal to raw material purchases. Clear. This is holds good in the case of the existing firms. Whereas in the case of the new firms, there will be no opening stock. The opening stock is 0. Right, sir? So opening stock 0 plus raw material purchases. Later, suppose that you purchase 10,000 units of raw materials minus closing stock of raw materials 2,000 units. So your raw material consumption become only 8,000 units, whereas your raw material purchases 10,000 units. So that is why raw material consumption not equal to raw material purchases. So in the case of the new firms, as there is no opening stock, these equations doesn't hold good. Raw material consumption not equal to raw material purchases. So while estimating the investment in raw materials, we want raw materials consumption. So we have taken into account 8,000 units. While estimating the creditors for raw materials, we want raw material purchases where we are going to take 10,000 units for calculation. There is a difference now, right? So that is why estimation of the working capital in the case of the new firms is a little bit difficult, sir. Earlier, raw material purchase and raw material consumption same. So in raw materials inventory, investment in raw materials, creditors for raw materials, both you got the same value, same answer. Like I'll show you one example here. You can see estimation of current assets, investment in raw materials, 30,000 rupees, current liabilities, creditors for raw materials, 30,000 rupees, because this is existing unit, right, sir? I'll show you one more example. Look at this. Investment in raw materials, 6,93,333. Creditors for raw materials, 6,93,333. Because in both the cases, we have taken the same 1,04,000 units into 80 rupees per unit. 1,04,000 units into 80 rupees per unit. Are you following, sir, everyone? But this is not holds good in the case of the new firms. In the case of new firms, raw material consumption is different from raw material purchases. So these values will not be same. It will differ. It will differ. Are you following, sir? Every one of you. Right? Next. Impact of double shift working on working capital requirements. Look at this example. Single shift. When you're working in a single shift where you're producing 10,000 units, working capital required 5 lakhs rupees. Right, sir. Now, when you're shifting to double shift, you're going to work for 16 hours a day, double shift. So your production will get doubled, obviously. When you're working for 8 hours a day, your production is 10,000 units. Whereas when you're working for 16 hours a day, your production will get doubled, 20,000 units. Okay, ma. Now in that scenario, working capital requirement, how much? So for single shift, it is 5 lakhs. You're going to work for double shift, 2 shifts a day. So 5 lakhs into 2, 10 lakhs is your working capital requirement. Absolutely wrong answer. When you're working in double shift, ma, you will get some advantages. And because of that advantages, your working capital requirement for double shift will get reduced. For single shift, it is 5 lakhs. For double shift, it should be less than 10 lakhs for both the shifts put together. For double shift working now, hardly it will be some 3 lakhs. So 5 plus 3, 8 lakhs. Working capital requirement for both the shifts, 8 lakhs. Why, sir? The production is getting doubled. So as my working capital requirement also should be gets doubled? No. Because, sir, look at this. When you're working in a single shift, when you're producing only 10,000 units, your raw material cost per unit is 10 rupees per unit. Your raw material cost is 10 rupees per unit. Whereas when you're working for double shift, when your production is getting doubled, your raw material requirement will get increased. Earlier, you used to purchase only 10,000 units of raw materials. Now you're going to purchase 20,000 units of raw materials. When the quantity increasing, you can ask for quantity discounts. You can bargain more. You can get quantity discounts where you can bargain for raw material cost per unit just 9 rupees per unit. Just 9 rupees per unit. Alane, you'll also have some benefits like fixed overhead recovery rates will get reduced. Suppose that the rent of the building is some 50,000 per month. Earlier, you are using to work only for one shift, 8 hours a day, where your production is just 10,000 units. So when rent per unit, we are apportioning the rent amount for every unit, it will be like 50,000 per month divided by 10,000 units. So 5 rupees per unit. So while you are calculating the total cost of production to that unit, rent amount you will apportion 5 rupees per unit. But when you're working in a double shift, rent amount, is it going to be increased? No. Whether you are using the building for 8 hours a day, whether you are using the building for 16 hours a day, it doesn't change your rent amount, sir. Rent we are paying per month, not per hour. Not per hour, per month. So the rent amount remains to be same. When you're apportioning the rent per unit, now it will be 50,000 rupees divided by 20,000 units. So it will be now 2 rupees 50 rupees per 2 rupees 50 paise per unit. You can see your overhead recovery rate reduced or not. Because of this, what happens? Your total working capital requirement will get reduced. That's the advantage of working for double shift. When you're working for third shift also, you will get more advantages. That's why now many of the MNCs you can see, they'll work on shift basis. They'll work on shift basis. 3 shifts a day, they will work. Enjoys the overhead recovery rates benefits, enjoys the quantity discounts, everything. Clear, sir. That's the concept of estimation of working capital and double shift working. Okay, now. So there is only one problem available for this concept. right? So with this, we have completed model number 1 and model number 2. Model number 1, estimation of the working capital, right? In the case of the existing firms, and then in the case of the new firms also completed. And then model number 2, impact of double shift working on working capital requirements. This is also completed, sir. Clear? Next. So in the next session, I'm going to start with the model number 3, different approaches of financing the working capital. Aggressive approach, conservative approach, right? We have different approaches. What about that? What are the approaches? What are their characteristics? All this we are going to discuss in the next session. Clear, sir? So chill that. Have a good day. And meet you in the next session, sir. Stay home and stay safe. A very good morning, students. So welcome to the Shrestha FM marathon classes. So in the last class, we have started discussion regarding chapter number 6, working capital management, and in which we have completed model number 1, estimation of the working capital, and number 2, estimation of the working capital when it comes to the double shift workings. Okay, mom. Right. And we have also learned about the estimation of the working capital with respect to the existing business units and as well as of the new business units. Right, sir. Now time for the model number 3, different approaches in financing the working capital. Okay, sir. Right. Now, sir, there are 3 mainly different approaches in financing the working capital needs: aggressive approach, moderate approach, and conservative approach. Right, sir. So look at the running notes for this. Right. Sir, let us assume that we have a working capital requirement of 10 lakhs. So in step number 1, what we have done, sir, we have estimated the working capital requirement. Now we have estimated that we have a working capital requirement of 10 lakhs. Now, for the financing of this working capital needs, we will be having different options like short-term sources, long-term sources. Short-term sources like bank overdraft, cash credits, commercial papers. Like commercial papers are nothing but money market instruments like a pro note. Short-term loans, loans from the friends and relatives. These are all the short-term sources for financing the working capital. And the long-term sources like equity shares, preference shares, debentures, bonds, long-term loans, etc. So we will be having different sources for the financing of our working capital. Then there is a question arises. For financing my working capital requirement, which source should I select? Should I go with the short-term sources or should I go with the long-term sources? Or should I mix up the short-term sources and long-term sources? Right, sir? Now look at here. While selecting these sources, short-term sources or long-term sources, you have to keep in mind certain important considerations. Right? What are they? Look at here. So short-term sources and long-term sources, their characteristics, risk, cost, returns, and liquidity problems. These are the 4 main important considerations. Now, when it comes to the risk factor, short-term sources, the risk is higher because they are repayable on demand. They are repayable on demand. There is no fixed tenure for the short-term sources. Like if you take the example of bank overdraft, there is no fixed tenure for the bank overdraft. As and when the banker asks you to repay the bank overdraft, you have to repay. Right. So the risk of repayment is always higher. Risk of repayment is always higher. Whereas when it comes to the long-term sources, the risk of repayment is very low because there is a fixed tenure. Like if you take the example of debentures, you have issued a debentures for 10 years. So that means from year 1 to year 10, there is no risk of repayment. The risk of repayment comes only at the end of the year 10. Right, sir? Even if the debenture holder asks you to repay mid of the term of the debentures, like on year 6th, like a debenture holder came and asked for money, there is no need to pay because there is a fixed term of 10 years. Only at the end of 10th year, you are bound to be redeeming the debentures. So the risk of repayment is lower. Coming to the cost element, when it comes to the short-term sources, the cost element is lower. Why? Because you are going to pay the cost only for a short period, like 1 year, max 1 year, right, sir? Even though the rate of interest is higher, but you're going to pay only for 1 year, right? But when it comes to the long-term sources, you are going to pay the cost for a longer period. Even though the debentures rate of interest is lower, but you're going to pay for 10 years or 15 years or 20 years, the cost is higher. Equity shares, the costliest source of finance. Are you following, sir? Next, returns. When it comes to the short-term sources, the returns are higher because whenever you're taking the high element of risk, you can expect high amount of returns. But when it comes to the long-term sources, the returns are lower because the risk is low now. When the risk is lower, the expectations towards the returns should also be lower. Liquidity problems. When it comes to the short-term sources, the liquidity problems are higher. Liquidity problems means what, Amma? Like, see, you actually depend on a loan from a friend. You have estimated working capital requirement of 10 lakhs. You ask your friend and your friend promised to pay within 1 week. Don't worry, your working capital needs I'll take care of. Don't worry, I'll give you 10 lakhs rupees within 1 week. Believing that friend's words, you have not gone for the another option. After 1 week, assume that your friend not able to provide you the 10 lakhs funds. He said like, sorry, there was some unexpected payment was made. So I was unable to provide you the 10 lakhs working capital needs. Means working capital means what, Amma? It is a capital required for working of your business. When you're unable to provide the working capital funds, your business working will get affected. Even for meeting some petty expenses, you're not in a position to have the funds with you. So that means you're facing liquidity problems. You don't have the liquid funds with you for working of your business. That is what liquidity problems. So when it comes to the short-term sources, the liquidity problems are higher because short-term sources, the procurement of the funds are not guaranteed. The banker said you like, okay, we will provide you bank OD. But after 1 week, what happens? Assume that your credit rating drops from A plus to B double plus or B plus. Your credit rating was dropped by the credit rating agencies. Now, after looking at credit rating, the banker withdrawn his bank overdraft. Again, you have to face the liquidity problems. But when it comes to the long-term sources, the liquidity problems are lower because you are going to raise the funds at a time for a longer period of 10 years or 15 years. Right? You will be having more funds than what you required. So that's why long-term sources, the liquidity problems are lower. Now here you can see advantages and disadvantages. Short-term sources, you have two advantages. What is that advantage, Ma? The cost is lower, returns are higher. Cost lower, returns are higher. This is the advantage. But what is the disadvantage associated with it? The disadvantages are risk is higher and liquidity problems are higher. Two advantages, two disadvantages. Whereas when it comes to the long-term sources, again, you're going to have two advantages, two disadvantages. Advantages in terms risk lower and liquidity problems are lower. Advantages. Disadvantages in terms cost higher and returns are lower. So two advantages, two disadvantages again in the long-term sources. Two advantages and two disadvantages in the short-term sources. Now, which one will you adopt? Which source you are going to tap for procuring the working capital funds? The answer is it purely depends upon the individual's risk-taking perspective, risk-taking behavior. Right, sir? See, not all the financial managers thinking will be same. Not all the financial managers will not think in the same manner. Some financial managers are more aggressive. They're ready to take any amount of risk because they believe that only when you're taking the risk, you'll get returns. Some financial managers are more conservative in nature. They don't want any more risk. They don't want risk. They are satisfied with the low returns, but they don't want to face any liquidity problems, any risk. Right, sir? So those who are more aggressive in nature, more risk-taking personalities are there, they'll go with the short-term sources. There are some people who are not ready to take the risk element, not yet ready to face the liquidity problems. They'll go for the long-term sources. And there are third category of persons, they will mix up short-term sources and long-term sources. So that's why we have three approaches. Right, Ma? What are they? Aggressive approach, conservative approach, and moderate approach. Aggressive approach low, the more depending is on short-term sources, less depending on long-term sources. Whatever the working capital need is there, only to that extent they will raise the funds. No idle funds, no loss of interest. Cost will be lower, returns will be higher, but at the same time, liquidity problems also higher. This aggressive approach is also known as matching approach or hedging approach. Okay, ma. Conservative approach. Here, the maximum working capital required is funded through the long-term sources. Right, sir? Whatever the working capital requirement is there, that is funded through the long-term sources. More idle funds, hence there is huge loss of interest. Risk is lower, but at the same time, returns also lower. Liquidity problems lower. Cost will be higher because you are maintaining more idle funds. There is a huge loss of interest. And this approach is also known as a traditional approach. Next, moderate approach, as I said, no, they will mix up both conservative approach and aggressive approach. The average working capital requirement, whatever is there, that is your minimum working capital plus maximum working capital divided by 2. That average working capital is there, no, that will be raised through the long-term sources. If any additional working capital required, that will be funded through short-term sources. So they are going to tap both long-term sources and short-term sources. Okay, ma'am. Moderate idle funds, there is loss of interest as well, but the loss of interest is moderate. The risk element, cost element, liquidity problems are moderate, and this approach is known as a trading approach. Okay, ma'am. Next. So that's your model number 3, different approaches in financing the working capital. And then model number 4, operating cycle. Model number 4, what am I? Operating cycle. Yeah, here it is. Operating cycle. Sir, what do you mean by operating cycle? We have already learned in the first model itself. It is the time required for converting the cash into cash. That is what we call operating cycle. Yes or no? We have seen that from day one, we will start with, right? Day one will start with the investments in raw materials, then investment in work in progress, investment in finished goods, investment in debtors, and finally that from debtors will collect the money, the cash will be received. Right? Totally how much days, Amma? 30 plus 15, 45 plus 30, 75 plus 30, 105 days. Right, sir? This is your gross operating cycle period from which you have to deduct the creditor's payment period. Then you will get the net operating cycle period. Okay, now there are some important terminologies you have to learn, like inventory conversion period, ICP, inventory conversion period. This includes raw materials holding period, work in progress holding period, and finished goods holding period. This is what? Inventory conversion period. Nothing but this is a time required. This is a time required for converting raw materials into finished goods. It is a time required for converting raw materials into finished goods. That is what we call inventory conversion period. In our example, it is 75 days. Right? So from day one onwards, if you started procuring the raw materials, it will complete its conversion and it will be converted into a finished goods within 75 days. So for converting a single unit into finished goods, the time required is how much, Amma? 75 days. Inventory conversion period. Okay, now for which add the debtors collection period, DCP, or receivables conversion period, RCP, no problem. Debtors collection period and receivables conversion period and one and the same. This will give you what, Amma? Gross operating cycle period. Gross operating cycle period. Okay, sir. From which deduct the creditors payment period, CPP, creditors payment period, you will get a net operating cycle period. You will get what? Net operating cycle period. Or simply operating cycle or working capital cycle or cash cycle. Clear? You can see here, you got a net operating cycle period of 90 days. Assuming that 1 year is equal to 360 days, number of operating cycles in a year. So how many operating cycles we are going to have in a year? So the formula could be 360 days divided by net operating cycle period. 360 days divided by 90. So 4 cycles. Net operating cycle, number of operating cycles in a year, 4 cycles. For every 90 days, 1 cycle will get completed. From day 1 to day 90. first operating cycle period. First operating cycle will be from day 91 to day 180. Second operating cycle. Second operating cycle, like that. Okay, ma'am. Next, assuming that the total operating cost is equal to 12 lakhs. Total operating cost means the total working capital requirement per the year for annum 12 lakhs rupees. Now, working capital requirement per operating cycle. So this is for 360 days. This is for 360 days for full year. What will be the working capital requirement per one operating cycle? So the formula could be total operating cost divided by number of operating cycle. Total operating cost 12 lakhs divided by number of operating cycles 4. So the working capital requirement per operating cycle will be 3 lakhs. So that means on day 1, if you want to start your business, it is enough to have a working capital of 3 lakhs. There is no need to maintain 12 lakhs rupees. You have estimated working capital 12 lakhs, but that is per annum. You have a working capital cycle of 90 days. So what that means whatever the investment you made on day 1, that investment is getting back to you on day 190, on day 90. So the meaning ఏంటంటమ్మా, day 1 రోజు మనం 3 lakhs working capital తో start అవుతాం sir. Right? We are going to start with the 3 lakhs working capital on day 1, and this 3 lakh working capital will be get back to us on day 90. On day 90. Now on day 91st, the second operating cycle will be starts. So bring back the same 3 lakhs into your working capital, and this will be reverted on day 180. The same 3 lakhs will be received by you. End of the operating cycle, no. So the same cash will be come back to you, 3 lakhs. Now with the same 3 lakhs, start the third operating cycle. Are you following or not? Every one of you. Right? So even though you have an annual requirement of 12 lakhs, but for starting of the business, it is enough to maintain 3 lakhs rupees. The same 3 lakhs will be circulating in the business. That's it. That is why it is also called as a circulating capital. Yes or no? Next. So you have the problems as well. So whatever the theory I'm explaining, sir, with the help of that theory, try to do the problems. And if you come across any doubts now, you can ping me, sir, either to Telegram, to WhatsApp, or my email, or you can also call me back directly. No problem at all. Okay, sir. So look at here, operating cycle, right? So operating cycle, the same diagram we have taken. Cash, with the cash we purchase the raw materials, then they will be sent into work in progress for the production. Then after the completion of work in progress, finished goods will be arrived. Then the goods will be sold to the debtors. Receivables comes into picture. From the receivables, we'll collect the money. Though we'll get back the cash. Net operating cycle period. You can see the formula here. Total operating cycle period minus deferral period. DP stands for deferral period. Nothing but credit as payment period. Right? Or the other formula ICP plus RCP. This will give you the total operating cycle period minus DP. And for finding out of the raw material conversion period, finished goods conversion period, you have the formula as well. Look at here, ma. Average raw material stock. How are you going to get this? Opening stock of raw materials plus closing stock of raw material divided by 2. That will give you the average raw material stock divided by the total raw material consumption. Total raw material consumption. How are you going to find out, ma? You have the formula, right? Opening stock plus raw material purchases minus closing stock. That will give you the raw material consumption. Right? So average raw material stock divided by raw material consumption into 365. That will give you the raw material conversion period. See, here we have the answer in number of days. That is why we are multiplying with the 365. If the problem specifically mentioned 1 year is equal to 360 days, here you have to take 360. Instead of 365, you have to take 360. If the question is silent about the number of days in a year, you can directly go ahead with the 365. Are you following or not? If problem specifically mentioned that 1 year is equal to 360 days, then in every formula, you have to take 360 days only. Otherwise, go ahead with the 365. Next, work in progress conversion period. Average stock of work in progress means opening stock of work in progress plus closing stock of work in progress divided by 2 divided by total cost of production. How did you get this, ma? Total cost of production, right? You have a formula, right? In your cost sheet, you might have learned already about the cost of production. right? Apply the same logic here into 365 days. That will give you the work in progress conversion period. Then finished goods conversion period, average stock of finished goods, opening stock of finished goods plus closing stock of finished goods divided by 2. That will give you the average finished goods divided by total cost of goods sold into 365. Then receivables conversion period, average receivables, opening debtors plus closing debtors divided by 2. That will give you the average debtors divided by total credit sales. So since you are finding out the receivables conversion period, you have to take credit sales into 365. Then deferral period, also known as creditors payment period, average creditors, opening creditors plus closing creditors divided by 2. That will give you average creditors divided by total credit purchases into 365. Clear now? Okay. See, for raw materials conversion period, in the denominator, you have to take what, Amma? Raw material consumption. Okay. For work in progress conversion period, cost of production. Finished goods conversion period, cost of goods sold. Receivables conversion period, credit sales. Deferral period, credit purchases. Okay, sir. So whatever you're finding, దానికి related గా ఉన్నది మనం తీసుకోవాలమ్మా. You're finding receivables conversion period, debtors. For debtors, what is related factor? Credit sales. Credit sales. And you're finding deferral period. For deferral period, what is related? Credit purchases. Are you following or not? Next. Here in this problem, you can see I assume 1 year is equal to 360 days. So in every formula, you have to take 360 days. Clear now? Right. So that's the end of the model number 4, that operating cycle. Now coming to the most important model of this particular chapter, most important model of this particular chapter, that is management of receivables. Model number 5, management of receivables. Nothing but debtors management, Amma. Nothing but debtors management. Okay, sir. Now look at here. Here it is. Management of debtors. Now, first of all, a question arises. Sir, management of debtors management. What is the need of managing the debtors? What is the need of managing the debtors? Why there is a need arises for managing the debtors? Can anyone? See, the answer is very simple, sir. The answer is very simple. Sir, whatever the investments we have made from day one, right, sir? We are starting with the cash now. With this, we are procuring the raw materials into the work in progress, and the work in progress converted into finished goods. And then these will be sold to the debtors, customers on credit basis. Debtors will be arised. So from day one, whatever the investments you are making, suppose that you procured the raw materials worth 50 lakhs. You procured the raw materials worth 50 lakhs. And you made investment of work in progress 20 lakhs. Investment of finished goods worth 10 lakhs. Totally 80 lakhs investment is blocked in debtors. So whatever the investment you are made from day one, the entire investment will be blocked in debtors. See, if you are selling a particular product on credit basis, let us say the selling price per unit is 100 rupees. 100 rupees per unit. And how did you arrive at this 100 rupees? You will take the raw materials, right? Labor, wages, overheads, everything into consideration. Cost of production, cost of goods, so you will find, you will add back your profit element, then you will arrive at the selling price per unit. Cost sheet, you might have learned already. And when you're selling this unit to the debtors, the entire amount of 100 rupees will be blocked, the entire investment of 100 rupees will be blocked in debtors. Suppose that if you're not properly managing the debtors, suppose that if debtor turned into a bad debt, this entire 100 rupees is a loss to you. Yes or no? If you're not properly managing your debtors, what happens? You have to face the bad debts. Right? The debtor is not going to repay to you. He taken the goods from you and he's enjoying the goods and is not repaying you. The entire investment is blocked in data and you're unable to properly manage your data. No, your investment completely lost and you're in a position to shut down your business. Data are the most important factor of every business organization. There are so many business organizations which are failed just because of the poor data management systems they have employed. Because the entire investment is blocked there itself only, no? Clear, sir. Now, what do you mean by managing the data? See, managing the data means you have to evaluate the proper credit policies. You have to offer some cash discounts for the early payments from debtors. You have to continuously follow up them for the payments. You have to continuously remind them for the payments. Just like whenever you purchase a particular product on EMI basis. Suppose that example, I've recently purchased an air conditioner, right, sir? And I purchased through EMI basis. My first EMI is going to be due on May 2nd. May 2nd. But since last 1 week, I started getting messages from that particular financing company that your first installment is going to be due on May 2nd and make sure that you are going to have enough funds in your bank account. A continuous reminding for every 2 days or 3 days. Yes or no? Sometimes even the people will come over the call, sir, your EMI is becoming due, hoping that you have enough funds in your bank account. Yes or no? Right. Continuous follow-up. Preparing the efficient credit policies. Offering the cash discount sometime for the early payments from the debtors. These are all comes under the management of debtors. Are you following, sir? When you're adopting all these policies, then only you are able to get the entire funds from the debtors. Right, sir? See, even after deploying all these policies, there is a normal bad debts, routine bad debts of 10% minimum, sir. In every organization now, 10% bad debts common. Despite of following all the credit policies, offering the cash discounts, yes or no? And assume that if you're not adopting any of these, you just estimate your bad debts. It will be some 50%, 60%. And they assume that if you made it sales of 10 crores, you're able to collect only 4 crores or 5 crores. The remaining amount loss. Are you following, sir? Every one of you. Now here, we are going to discuss about the management of debtors, mainly two things. Number one, framing the efficient credit policies. Number two, offering the cash discounts. Now first, look at the first one, evaluation of the credit policies, right? So there are two approaches available in the evaluation of the credit policies. Number one, total approach, and number two, incremental approach. Majority of the problems we are going to solve under the incremental approach because as it is very easy and as well as involves less calculations. Now, there is a standard format for evaluation. So look at here. First, we'll take the incremental sales revenue. By adopting that particular credit policy, what happens, Amma? Our sales revenue will get increased. So go ahead with the incremental sales revenue, from which deduct the incremental variable cost. That will give you the incremental contribution, from which you have to deduct incremental bad debts and incremental collection charges, if any, and incremental admin charges, if any, administration charges. So from the contribution, deduct bad debts, collection charges, administration charges. That will give you the incremental PBT, incremental profit before tax, from which deduct the tax element. Then you will get the incremental profit after tax. Next, you have to find out the incremental investment in debtors. These calculations are very important. Calculation of incremental investment in debtors. I'll tell you with the help of one problem, sir, how to calculate. I'll tell you with the help of one problem. Don't worry. Okay, now incremental investment in debtors, right? And then you have to find out the incremental opportunity cost of loss of interest. And finally, from the incremental profit after tax, deduct the incremental opportunity cost of loss of interest. Deduct the incremental opportunity cost of loss of interest. And then you will be arrive at what am incremental net benefit. This will decide whether that credit policy should be adopted or not. Okay, now look at here. If this incremental net benefit is positive, suppose that you got incremental net benefit of 1 lakh positive 1 lakh, then it is advisable for the company to accept the proposed credit policy. Suppose that if that incremental net benefit is a negative, you got a negative 1 lakh. It is not advisable to accept the proposed credit policy. Not advisable. మీరు ఆ క్రెడిట్ పాలసీ అడాప్ట్ చేయడం వల్ల మీకు బెనిఫిట్ ఏం రావట్లా, డిస్పైట్ యు ఆర్ గెటింగ్ ఎ లాస్. ఇన్ స్పైట్ ఆఫ్ దట్ యు ఆర్ గెటింగ్ ఎ లాస్. సో ఇట్స్ నాట్ అడ్వైజబుల్ ఫర్ ద కంపెనీ టు అడాప్ట్ ద క్రెడిట్ పాలసీ. Clear, sir? Next, for the calculation of investment in debtors, as we all know that we have three methods available: sales value basis, total cost basis, and variable cost basis. If the question is silent, we have to go with what, amma? If the question is silent, we have to go with the variable cost basis. But if question specifically mentioned something, yes, we need to follow the same. Clear? Now, look at here, sir. Evaluation of the credit policy. Look at the problem number 11. X Limited wishes to increase its credit period from net 35 to net 50 days. Net 35 to net 50. And that means earlier we used to give the credit period of 35 days only. And that means if we made the credit sales on day 35, day 1, the debtors have to repay us within 35 days. You have given 35 days time period for the debtors for the repayment. Now this credit period we are going to increase from 35 to 50 days. మనకి ఏం చేస్తున్నామా, క్రెడిట్ పీరియడ్ ని ఇంక్రీజ్ చేస్తున్నాము. సో మోర్ అండ్ మోర్ కస్టమర్స్ కమ్ ఫార్వర్డ్ అండ్ మోర్ సేల్స్ we can enjoy. You can see here it expects the sales increases from 120 lakhs to 180 lakhs. So that means we can take the incremental sales 60 lakhs. Existing sales already 120 lakhs unnayamma. After increasing this credit period, you are going to achieve 180 lakh sales. So what is incremental sales? Increase in sales 60 lakhs. And the average collection period to increase from 35 days to 50 days. The bad debts loss ratio and collection cost ratio will remain at 5% and 6% respectively. The company's variable cost ratio is 85%. Company's variable cost ratio 85%, and the tax rate is 50%. And the after tax required rate of return is 20%. This we have to be considered while calculating the opportunity cost of loss of interest. Advise the X Limited based on the variable cost valuation, sales valuation. Right, look at the answer. Incremental sales revenue, I've already told you 60 lakhs. How did you get this? Proposed sales 180 lakhs minus existing sales 120 lakhs. Okay, then incremental variable cost. In the problem, it was mentioned variable cost ratio 85%. Right, sir? So incremental sales revenue into variable cost ratio. See, whenever the variable cost is given in a ratio, we always have to apply it on sales revenue. So then you will get the variable cost 51 lakhs. So sales minus variable cost will give you contribution 9 lakhs, from which you have to deduct the bad debts at the rate of 5%. And collection cost at the rate of 6%. Apply on the incremental sales, you will get bad debts and collection cost. So from the incremental contribution, deduct the bad debts and collection cost, you will get incremental PBDT, profit before tax. From which you deduct the tax element, you will get incremental profit after tax. Now here comes the most important part: investment in debtors. How to calculate investment in debtors? Look at the working notes. Calculation of incremental investment in debtors. Right, see here in the problem we asked to find out on variable cost valuation and as well as sales valuation. First, look at the variable cost valuation. Investment in debtors is equal to variable cost into debtors collection period divided by 360. What is your variable cost? Right, sir? See, when it comes to the existing situation, the increment, the total sales under existing situation 120 lakhs into variable cost ratio 85%. This will give you variable cost into debtors collection period under existing scenario 35 days divided by 360 days. So you will get the answer of 9,91,667. Sir, if we made the sales on day 1, we are going to get the amount on day 35. Ante our investment is blocked for 35 days, sir. For this 35 days, how much investment is getting blocked? The answer is 9,91,667 rupees. 9,91,667 investment is blocked in our debtors. That is what we call investment in debtors. You made the sales on credit basis on day 1, but you are not getting amount immediately. You are getting amount on day 35. అంటే 35 days కి నీకు ఇన్వెస్ట్మెంట్ బ్లాక్ అయినట్టేగా. Next, coming to the proposed situation where your sales are 180 lakhs into 85%, this will give you the variable cost into 50 divided by 360. Under proposed situation, the credit period is 50 days divided by 360. The answer you will get 21,25,000. That means if we made the sales on day 1, we are going to get the amount on day 50. And in this 50 days, the investment is blocked where, Amma? The investment is blocked in debtors. How much investment is blocking, Amma? 21,25,000. Clear. Now we are finding out the incremental basis. No. So take the incremental investment in debtors. So under existing situation, it is 9.91 lakhs. The investment is blocking. Under a proposed situation, 21.25 lakhs. So what is the incremental investment in debtors? 11,33,333. Okay. Or the alternative way to calculate, very simple, sir. Right. For existing sales, that is 120 lakhs into 85%. This will give you your variable cost into, sir, existing situation, anyhow 35 days investment is blocking. Additionally, how much investment is blocking? For additional 15 days, the investment is going to be blocked because under proposed situation, the credit period is 50 days. Already existing 35 days ellago block avutundamma. But additional ga existing sales lo inka enni rojulaki nee investment block avutundi. For how many days your investment is going to be blocked with respect to the existing sales? How many additional days? Additional days 15 days amma. This will give you 4,25,000. Okay, and add proposed sales 180 lakhs. Sorry, the incremental sales you have to take here, that is 60 lakhs into 85% into 50 days divided by 360. So all Chandama, you will get 7,08,333. Total Chandama, you will get 11,33,333. For the incremental sales, anyhow it is going to be blocked for 50 days. Anyhow, it is going to be blocked for 50 days for the incremental sales. For the existing sales, additionally, it will be blocked for 15 days. For incremental sales, it will be blocked for 50 days. Total put together, you will get a incremental investment in debtors. Okay. So 11,33,333. Now find out the opportunity cost of loss of interest. This much amount is investing in your debtors, blocking in debtors, in which you're going to get a loss of interest at the rate of 20%. The problem specifically mentioned after tax opportunity cost of interest is 20%. So the loss of interest from this investment and 50 days ki inta investment block avadam valla neeku enta loss of interest vastundamma 2,26,667 rupees is a loss of interest. Okay, now this loss of interest have to be deducted from your incremental profits after tax. Then you will get the incremental net benefit. How much you are getting, sir? A negative of 1,06,667. Since your incremental net benefit is negative, it is not advisable for the company to extend the credit period. Right? It's not advisable to go ahead with the 50 days proposed credit period. Let's continue with existing credit period of 35 days only. Are you following, sir? Every one of you. Right? This is how you need to find out. Investment in debtors and opportunity cost of loss of interest. Clear? This is one model under debtors management. The other model is that evaluation of the cash discounts. Yeah. Evaluation of the cash discount policy. Now, what is this evaluation of cash discount policy? Look at these examples. Sir, we have made a credit sale of 100 lakhs and the credit period given is 30 days. And at day 1, we have made a credit sales of 100 lakhs and this 100 lakhs we are going to receive back on day 30. Yes or no? Right? Now, new credit terms. After we made the credit sales, we have come up with a new credit terms like 2/10 net 30. 2/10 net 30. What do you mean by it? Now, this 30 representing the credit period allowed. You've already allowed 30 days credit period. This 10 representing payment period and 2 representing the rate of cash discount. Rate of cash discount. And what does it mean? It means if you repay if you repay within 10 days, then you will get 2% cash discount. Then you will get 2% cash discount. See, without waiting for 30 days, actually I've given you a credit period of 30 days. Actually, I've given you a credit period of 30 days. But if you pay within 10 days, then you will get 2% cash discount. Without waiting up to day 30, suppose that you made a payment on day 10. Day 10 day me pay chesaru, so you are eligible for 2% cash discount. అర్థమవుతుందా సార్? అంటే instead of 100 lakhs, it is enough to pay 98 lakhs. It is enough to pay 98 lakhs. Are you following or not, every one of you? Right, sir? So like this, sir, why are we offering cash discounts? The answer is that we are offering cash discounts for the early payments. For the early payments from the customers. Earlier, you have to wait up to 30 days to get back your investments. But now, within 10 days, you are going to get your money, sir. Within 10 days, you are going to get your money because you are offering cash discount. At least certain portion of customers will come forward and will make the payment in order to enjoy the cash benefits, cash discount benefits. At least even 50% of the customers come forward and make the payment within 10 days. And the 50 lakhs you are going to get within 10 days itself. Early recovery of the funds. That's the main objective. And because of this early recovery, you can make more and more investments. You can accept more and more projects and you can enjoy more and more returns. And the probability of bad debts also will get reduced. These are all the advantages of the cash discount policy. Again, same thing, sir. We need to calculate the incremental net benefit. If the incremental net benefit is positive, go ahead with the cash discount. If it is negative, it's not advisable for the company to offer the cash discount. As simple as that. Cleared, right, sir? Look at this problem. You have an incremental net benefit of 55,700. Since there is an incremental net benefit of 55,700, it is advisable for the company to adopt the liberalization scheme. Okay, now, like, look at the problem number 17. Here it is. A company presently having a credit sales of 12 lakhs. Existing credit sales. The existing credit terms are 1/10 net 45 days. So that means actual credit period is given 45 days. But if anyone paid within 10 days, he is enjoying 1% cash discount. He is eligible for 1% cash discount. Average collection period is 30 days. Okay. The current bad debts loss is 1.5%. In order to accelerate the collection process further, and also to increase the credit sales, the company is contemplating liberalization of its existing credit terms to 2/10 net 45 days. So earlier, if anyone paid within 10 days, he is eligible for only 1% cash discount. But now he is eligible for 2% cash discount. So more cash discount is offering. It expects that the sales are likely to increase. Right, 1/3 of existing sales in the ma 12 lakhs, 1/3 of existing sales and in the ma 4 lakhs, and the total sales in the ma 16 lakhs. Bad debts increases to 2%. Earlier it is 1.5%. Now it is increasing to 2%. Average collection period declined to 20 days. Earlier it is 30 days. Now it is declined to 20 days. Contribution to sales ratio is given 22%. Contribution ratio is given 22%. But variable cost ratio? Variable cost ratio is nothing but 1 minus contribution ratio. You might have learned in your cost accounting. Means 1 minus 0.22, that is 0.78 or 78%. So you have to take the variable cost ratio 78%. Opportunity cost of investment in receivables is 15% pre-tax. Okay, 50% and 80% customers are availing the cash discount benefits under existing and liberalization scheme. Tax rate given 30%. Should the company change its credit terms? Assume 360 days in a year. There is a question, sir. And the answer you can see here. And here we have evaluated this cash discount policy under the total approach, not under incremental approach, but total approach lo chesamu. Okay. Like first we have taken the sales revenue, then variable cost, that will give you contribution, bad debts, right? And apart from bad debts, you also have another cost here, that is cash discount. Cash discount. So from the contribution, deduct the bad debts and cash discount, you will get PBT. Next, find out the investment in debtors, for which you need to see the working notes number 2, investment in debtors. Existing sales amount 12 lakhs is a total sales, and we have given the credit period of 45 days, but average collection period is 30 days. No. So on an average, we are collecting our funds within 30 days. Okay, now, so 30 divided by 360 into, since we need to adopt variable cost method, because for the evaluation of investment in debtors, if the problem is silent, we have to go for the variable cost basis. So 78% variable cost ratio. So under the existing scheme, the investment in debtors is 78,000. Under the liberalization scheme, 16 lakhs is your total sales, and the investment is going to block for 20 days. So what is a 20 days investment? And we need to find out on variable cost basis into variable cost ratio. You get 69,333. Take the investment in debtors and then apply the rate of interest given 15%. Right, sir? And the important point here, they mentioned like the rate of opportunity cost of interest is given pre-tax. So that's why while evaluating the answer also, you have to take the pre-tax. That is why we find out the PBT directly. We have gone for investment in debtors and opportunity cost of loss of investment, loss of interest. We have not deducted tax element here, even though we have the tax rate information in the problem. Since the loss of interest concept is given pre-tax, you have to deduct it from profits before tax only, not from profits after tax. Okay, find out the loss of interest, deduct it from profits before tax, then you will get the net benefit. Find out the incremental net benefit. So incremental net benefit is positive. It's advisable for the company to adopt the liberalization scheme. So this is how you need to evaluate the cash discount policy. Clear, sir? Now, after that, we have a concept called factoring. In the debtors management model, you have one more concept called factoring. Right, sir? Now, what is this concept of factoring and how to evaluate the factors proposal and everything? And with this, we'll complete the debtors management. Next, we'll be having cash management. Then we'll be having creditors management. So another half an hour to complete this marathon of working capital management. Clear? So that I will complete in the next session, sir. So children, have a good day and good night, sir. Stay home and stay safe. Clear? A very good morning, students. Welcome to the Shrestha FM Marathon classes. So in the last class, we have started discussion regarding our chapter number 6, working capital management. And we have completed the first 4 models. That is model number 1, estimation of the working capital. Model number 2, estimation of the working capital in the case of the double shift working. Model number 3, we have learned about the different approaches or different sources available for financing the working capital. And model number 4, we have learned about the operating cycle. And model number 5, we are discussing about the receivables management, also known as debtors management, in which we have completed 2 sub models, that is evaluation of the credit policies and evaluation of the cash discount policies. Now, time for the 5.3 third sub model in the model number 5, that is concept of factoring. Today's first topic, concept of factoring. So now what is this concept of factoring? Look at here, sir. Concept of factoring. Yeah. So outsourcing of debtors management is what we call factoring. Outsourcing. So generally, debtors management is a responsibility of the company. Yes, sir. Right? So that organization, that company have to take care of the debtors management. But company, that organization is busy in doing the business. Right? The financial manager is busy with taking the financial decisions. Procurement of the funds, investment of the funds, a lot of decisions he has to take. He is always busy. Then who will take care of this debtors management? So many of the organizations, what they are doing is, they are doing the outsourcing of the same to the private companies or other companies, other institutions. Right, sir? See, nowadays, just like whenever there is some recruitment is happening, whenever there is a new placement is happening, background verification will be done by not by the same company, will be done by the other companies. So that background verification of that candidate, that candidature, qualifications, experience, all this background verification will be done by the other company, not by the company which is recruited to you, which is recruited you. Are you following or not? Right, sir? So in the similar manner, even the debtors management also, majority of the organizations outsourced. There are some expert companies which are experts in this particular concept of debtors management. Right, sir? So for them, this work will be assigned. Right. So for that companies, the list of debtors will be given, the aging schedule, everything will be given. Right. So accordingly, that other company will take care of our debtors. Right, sir? So this is a concept of factoring. Outsourcing of the debtors management is called as factoring. The person or the company who providing the debtors management services called as factor. Whoever providing that services to us, the debtors management services to us, they are called as factors. The agreement between you and that factor is called a factoring agreements. Factoring agreements. So generally, what are the different services offered by the factor? The services offered by the factor, number one, credit analysis services. Means whenever you want to make credit sales to a group of customers, first give that list of group of customers to the factor. Now he will verify that particular customer's repayment capacity. Right, sir? His financial strengths, his financial weakness, the entire background verification, who persons are the promoted this company, what are the financial positions of this company, what are the projects these companies are handling, and what are the projects these companies were handled already, what are the projects they are going to be handled in the future, financial strengths, weaknesses, what are the loans they have taken, repayment history, everything will be analyzed by the factor, and then they will come up with a report called credit analysis report. Sir, you want to sell to the 100 customers now. Out of these 100 customers, 80 customers promptly will repay you. They are financially very strong. 20 customers, their financial position is not as good as you expecting. So it's better to avoid these 20 customers. So thereby what happens, see, without taking this credit analysis services from the factor, if you blindly sell the goods to these 100 customers, in future, you are going to face 20% bad debts. But now by taking the credit analysis services prior to the selling of the goods to the customers, you can successfully avoid that probable bad debts. Yes or no? Second one, collection agent services. You have sold to the 80 customers now, as per the credit analysis report given by the factor. Now from that 80 customers, right, you can give the task to the factor to collect the money from them. So on a timely basis, the factor will approach the debtors and collect the money from them and will be remitted to you. Collection agent services. Number three, advances against debtors. Suppose that today you made sales, what rupees? Some 10 crores. And you have given a credit period of 60 days. That means you are going to get back this 10 crores only after 60 days. Right, sir? But assume that on 10th day, you have a contingent liability. Contingent liability, which was uncertain. You don't know. On 10th day, you happen to pay certain money. Assume that you happen to pay certain money of 5 crores rupees immediately. But your funds are blocked in debtors. That funds are going to be released after 60 days only. Now what you can do is, you can give these debtors to the factor on a security basis. From them, you can get the advances. Okay, factor, you know that I have sold goods to this group of customers worth 10 crores. Take my debtors as a security and give me some advance money. And you can get back this advance money after 60 days. Anyhow, after 60 days, you are going to collect the money from them now. You are going to collect 10 crores now. Out of 10 crores, 5 crores you can retain along with the interest amount. So that is the third service they are going to provide us. Advances. They will provide us the advances against our debtors. And number four, buying the debtors at a lump sum consideration. Means here you are not giving the debtors as a security. You are selling the debtors as a lump sum consideration for a lump sum consideration. Suppose that on 10th day you come up with a proposal. Okay, factor, I would like to sell off all my debtors for 9 crores. If you are interested, you can purchase 9 crores. 10 crores worth of debtors we are selling for 9 crores. right, sir? So the factor, if he is interested, he can purchase our entire debtors for that lump sum consideration. Now, after 60 days, he can collect 10 crores from the debtors. So 1 crore profit to factor. Are you following now? But what if the case if he is able to collect only 9 crores, no profit, no loss? What if the case if he is able to collect only 8 crores, there is a loss of 1 crore to factor. But of course, we have a concept called recourse factoring, non-recourse factoring. That's a different case where you are going to learn in the final level, Amma. Okay, now next, come back. Now, so by taking the services from the factor, what are the advantages? What are the benefits available to us? What are the benefits we are going to enjoy? Number one, savings in bad debts. You can successfully avoid the bad debts. Savings in administration costs, because you are not administering your debtors. Who is administering? Your factor is administering. Savings in collection charges. Yes, your factor is going to collect the money from them. Savings in opportunity cost of loss of interest. If you successfully avoid the bad debts, see 20% of the customers probable bad debts, and this you are knowing this fact before you are making the sales. So you can successfully avoid this 20% customers. See, without knowing this fact, if you sell the goods to these customers, unnecessary loss of interest on the investment will be blocked in that particular 20% customers. To that extent, there is a loss of interest. So these are all the advantages by availing the factoring services. But whenever you're getting advantages, you're also having some cost now. Factor will provide you all these services not at free of cost. He will charge how much? He will charge factors commission 2%, 3% of the collections. Then factor service charges and interest on loans and advances. If any loan or any advance is given to you against the debtors on that particular loan, on that particular advance, he will charge interest. He will charge interest. So these are all the costs of availing the factor services. End of the day, what you have to see? If your benefits are greater than costs, advisable to avail the factor services. By availing the factoring services, you are getting a benefit of some 10 lakhs and you are incurring a cost of some 8 lakhs. So 2 lakhs net benefit, positive. So avail the factor services. If benefits are lower than costs, sir, you are getting a benefit of only 8 lakhs, but you are incurring a cost of 12 lakhs. So there is a negative net benefit. For availing 8 lakhs benefits, 12 lakhs incurring cost. We are incurring a cost of 12 lakhs, not advisable to avail the factor services. This is how you need to make the decision when it comes to the factoring services. Okay, ma. Look at this problem number 18. Evaluation of the factors proposal. First, take out the savings. Savings in administration costs, savings in bad debts. Total savings 8,60,000. Total savings 8,60,000. Now coming to the cost. Factors commission, he's charging a cost of 3,60,000 commission and interest and advances 4,500,000. The total costs are 7,60,500. Now you can see the net benefit. You are getting a benefit of 8,60,000 against which you are incurring a cost of 7,60,500. So there is a positive net benefit 99,500. There is a positive net benefit of 99,500. Since there is a net benefit of rupees 99,500, it is advisable to accept the factors proposal. This is how you need to make the decision. Clear, ma? Every one of you. So with that, we have completed the debtors management concept. Okay, ma? Model number 5 completed. Now time for the model number 6, cash management. Management of the cash, management of the bank. In this model, we are going to learn about the cash budgets and optimum cash balances models. Cash budgets. It is similar to like in your accountancy, you might have learned about the cash flow statements. Cash flow statements. Actually, cash flow statements and funds flow statements earlier forming part of the financial management subject only. But recently, these subjects, these chapters were removed from the syllabus and some new chapters were added like risk analysis in capital budgeting decisions, dividend decisions analysis. Yes or no? Lease financing. Of course, now lease financing is covered at the final level, but now at inter level, risk analysis in capital budgeting decisions, dividend decisions analysis, these two were covered. Yes or no? Right, sir. So cash flow statements, where you used to prepare the cash flow statements. No. At the same time, in the cost accounting also, especially in the chapter called budgetary control, where you are going to prepare some budgets like production budget, sales budget, purchases budget, expenses budget, cash budgets. Yes, sir. Same model. Here we are going to prepare the cash budgets. Clear, sir. Now, what are we going to do in the cash budgets? Nothing but, sir, scheduling of our payments and receipts. Scheduling of the payments and the receipts. So when we are going to have the probable payments and when we are going to have the probable receipts. By scheduling the payments and receipts, we are going to find out what are the time periods where we are going to have the excess cash balances with us, and what are the time periods where we are going to running out of the cash, shortage of the cash balances. Yes or no? By preparing the cash budgets, you are going to get no. Yes, sir, in the month of June, we are going to have some excess cash balances and there are no upcoming payments in the month of June, July, August. So that means 3 months you're going to have the excess cash balances with you. Now, accordingly, what you can do is you can invest into the marketable securities. So whenever you find that there are some excess cash balances with us and there is no nearby payments, within 2-3 months, there are no payments. What you can do is you can invest that excess cash balances into marketable securities. Only into marketable securities, not into the equity shares, debentures, because they are not convertible easily into the cash. Marketable securities, yes, which can be easily convertible into the cash. Okay, now for that short period of 2-3 months, you can enjoy the interest benefits. At the same time, by preparing the cash budgets, you're going to know the time periods at which you're going to running out of the cash or shortage of the cash balances. Okay, in the month of October, November, there are no receipts for us, only payments. So we are going to running out of the cash. So we have to make sure that in the month of October and November, we are going to have the enough cash balances with us. See, you are preparing budget when, at the beginning of the year. Budget is always for the future, not for the present. Yes or no? See, for the year 2022-23, the budgets will be prepared in the 21-22 itself. Yes or no? Right, sir? Or at least at the beginning of the 22-23 itself, the budgets will be prepared. So thereby, at the beginning of the financial year itself, you are going to know in which month you are going to running out of the cash, in which month you are going to having the shortage of cash balances. So in the month of April itself, you get to know that in the month of October, you are going to have a shortage of cash balance. So that means from the month of April itself, you have to make the necessary arrangements that in the month of October, I am going to have the enough cash balances to meet my payments. Are you following or not? Every one of you, right? So we have to make the necessary arrangements for the procurement of the funds for short-term purposes. So in the month of April itself, or in the month of June, July itself, you need to go for the short-term sources for the procurement of the funds. You need to intimate your banker, dear banker, in the month of October, I am going to have a shortage of cash balance. Please provide me bank overdraft in the month of October. So when you're priorly intimating to the banker will also get ready in the month of October. He will provide you the bank overdraft. Are you following or not? So these are all the advantages by preparing the cash budgets, Amma. And how to prepare the cash budgets, you know very well. Clear? Next model, sir. Optimum cash balances models, right? In which we are going to have the Baumol's model and as well as Miller-Orr model, right? So optimum cash balances model, in this concept, we are going to learn about what is the cash balance to be maintained to meet our all expenses. What should be the cash balance should I maintain? Suppose that we have estimated the working capital 10 lakhs. Now, out of this 10 lakhs, what should be the cash balance to be maintained? How much cash balance should I maintain? What is my optimum cash balance? Out of 10 lakhs, working capital also includes cash balance amount, because working capital nothing but current assets minus current liabilities. Current assets low, what are covering amma? Stock, debtors, cash and bank balances. Yes or no? So certain portion of your working capital is cash balances. So how much cash balance should I maintain to meet my expenses? At what level? At higher level should I maintain, or at lower level should I maintain? Right. So that is what we are going to learn in this model, optimum cash balances. Clear, sir? So first model in that William J. Baumol's suggested, right? And it is similar to the concept of EOQ, economic ordering quantity. Optimum cash balances, whatever the Baumol suggested, That model is similar to EOQ concept of your materials chapter cost accounting, economic ordering quantity. Right, so there you might have learned a formula called square root of 2AO by C. Same amma ikkada kuda optimum cash balance is C. Formula is equal to square root of 2FT by R. 2FT by R. F stands for your annual cash requirement amma. T stands for transaction cost and R stands for rate of interest. Optimum cash balance means to be the level of cash balance to be maintained where the interest cost is equal to your transaction cost and the total cost is minimum. Your interest cost must be equal to your transaction cost and the total cost must be lower. So the level of cash balance is where these 2 points are getting satisfied. That level of cash balance is what we call optimum cash balance. Are you following, sir? Right? Just like for EOQ concept, economic ordering quantity is a level of quantity at which your ordering cost is equal to your carrying cost and the total cost is minimum. Yes or no? Every one of you, right? Here, interest costs are representing the carrying cost amount. See, by maintaining certain cash balance with you, you are going to have some loss of interest. See, let us assume you are maintaining a cash balance of 1 lakh with you. Right, sir? Had this 1 lakh would have been in the bank account, you would have received some interest now. ఇదే 1 lakh మీ బ్యాంక్ అకౌంట్ లో ఉంటే మీకు కొంత ఇంట్రెస్ట్ వస్తుందిగా. బట్ ఆ 1 lakh ని మీరు బ్యాంక్ లో పెట్టకుండా క్యాష్ లో మీ దగ్గర పెట్టుకోవడం వల్ల ఏమవుతుందమ్మా, మీకు 1 lakh మీద వచ్చే ఇంట్రెస్ట్ నీకు లాస్ అన్నట్టేగా. దట్ ఈస్ వాస్ ఇంట్రెస్ట్ కాస్ట్. Had you deposit the same 1 lakh into your bank account, you would have received some interest now. But by not putting the same 1 lakh into the bank account, you are maintaining that 1 lakh in cash with you. You're losing that interest now. That interest is called interest cost. And transaction cost is actually means to be ordering cost. Transaction cost means it is a cost you are incurring for converting your marketable securities into cash. Every time whenever you are in need of money, every time whenever you are in need of money, what you will do, you will convert your marketable securities into cost. That conversion cost is what we call your transaction cost. Are you following, sir? Right? The total of interest cost and transaction cost is your total cost. Clear, sir? Right? So look at here. Yeah. Cash management, Baumol's model. Formula you can see here, square root of 2FT by R, right? And F stands for total cash requirement during the year, annual cash requirement you have to take. T stands for transaction cost, the cost of each transaction between cash and marketable securities. R stands for rate of interest on marketable securities. By using this formula, you have to calculate the optimum cash balances model. Optimum cash balances. You can see here, sir, right? In the problem number 22, you have given some lot sizes, right? In that lot size, you might be asked to find out the economic lot size, right? How to find it, Amma? Right? You need to select the lot size where your transaction cost is equal to your holding cost, means your interest cost, and the total cost is minimum. Look at here, at the lot size of 2 lakhs, your transaction cost 5,000 rupees and holding cost 5,000 rupees. Equal, both are equal now, and your total cost is minimum. Among all these 5 lots, the total cost is 10,000 is minimum at the economic lot size of 2 lakhs rupees. Okay, Nama. So finally, look at the conclusion. As the transaction cost is equal to your holding cost and the total cost is lower at 2 lakhs lot size, economic lot size is equal to rupees 2 lakhs. The same answer you can get by using the formula as well. Formula approach should Nama. Your annual cash requirement as given in the problem 10 lakhs. Transaction cost as given in the problem 1,000 rupees. Rate of interest 5% per annum. Apply the formula. Square root of 2FT by R. 2 into annual cash requirement 10 lakhs into transaction cost 1,000 rupees divided by rate of interest by converting into decimals 5% convert cheyandi decimals loki 5 divided by 100 you will get 0.05 and calculate you will get 2 lakhs economic lot size. Okay, now, and the most important point here is while calculating the holding cost, right, you have to take the average cash balance into rate of interest. What is average cash balance, Opening cash balance plus closing cash balance divided by 2. Clear? Just like where you are used to calculating the carrying cost in the EOQ concept. Opening inventory plus closing inventory divided by 2. Average inventory you will take into account. Similarly, here also you have to take an average cash balance. Clear? Every one of you. Next. After that, you will be having the next model in the optimum cash balances model. That is Miller-Orr model. Sir, Baumol model is already provided a concept, a formula, right? Optimum cash balance is equal to square root of 2FT by R. By using this formula, you will get some answer. Just like in the last problem, you got an answer of 2 lakhs. That means what Baumol suggested? You have to maintain 2 lakhs rupees cash balance in order to meet our all expenses. But I have a doubt. Is Mr. Baumol is a god? No. He's also just making an estimation. He had applied some logics, and based on that logics, he's saying certain amount. Yes, this amount you have to be maintained, and this is your optimum cash balance. But what if the case at the end of the day, if our cash balance required is more than 2 lakhs? This 2 lakhs is just an estimated amount, not an exact amount, sir. ఏదో కొన్ని లాజిక్స్ రూల్స్ అప్లై చేసి ఎండ్ ఆఫ్ ద డే బాబు మీకు 2 lakhs మెయింటైన్ చేయండి అమ్మా, ఇది మీ ఆప్టిమం క్యాష్ బ్యాలెన్స్ అని చెప్పాడు. కానీ అది కూడా ఒక ఎస్టిమేషనే కదా. దట్ ఈస్ ఆల్సో అన్ ఎస్టిమేషన్. And estimation may goes wrong. End of the day, suppose that you ended up paying an expenditure of 2,50,000, but look at your cash balance. You have only 2 lakhs with you. So 50,000 shortage of the cash. Yes or no? Right? So that's why what Miller-Orr suggested, instead of maintaining a single amount, an exact amount for optimum cash balances, it is advisable to maintain a range. Okay, you maintain your optimum cash balance. Your optimum cash balance is 2 lakhs to 3 lakhs. So maintain your cash balance in these two limits, 2 lakhs to 3 lakhs. Maintain your cash balance in between these two limits. It should not be reduced by 2 lakhs. It should not be increased by 3 lakhs. So your optimum cash balance falls in between these two limits. Now what happens? Right, sir? If your end of the day, if you are having an expenditure amount of some 2,50,000, anyhow you are maintaining your optimum cash balances in these two levels. Yes or no? So means you are able to meet your 2,50,000 cash expenditure. Yes or no? See, if you maintain exactly 2 lakhs, you ended up with facing the liquidity problems. But you are maintaining the cash balance in between a limit. See, whenever you are estimating now, you will estimate in between a limits are not exact. See, in May 2022, you are going to writing your exams. After the completion of your exams, I asked you how many marks you are expecting in the FM paper. In the paper number 8, FM and Economics for Finance. What you are going to tell me, sir? Sir, I'm expecting in between 70 to 75, sir. And some people said like, sir, I'm expecting in between 80 to 90, sir. And they are going to tell a range only, no, not an exact amount of the marks. Sir, I'm going to get exactly 77 marks. How come he's sure? When you are estimating, you cannot estimate an exact amount, right? You estimating 77 exact marks, but in future you may get more than 77, or in future you may get less than 77. But if you're estimating in between, sir, I'm expecting in between 70 to 80 marks. End of the day, after declaration of results, you got 78 marks. So well within your range only, now. Yes or no? Right? So that is why Miller-Orr said, whenever you are estimating, your estimation should not be an exact amount. It should be in between a range. He has given ranges, upper limit and lower limit. So you have to maintain your cash balance in between this upper limit and lower limit. So in this example, the lower limit is 2 lakhs and the upper limit is 3 lakhs. Are you following now? Look at this diagram. Upper limit and lower limit. This is your lower limit. This is your upper limit. Okay now. And in between you have a limit called a reorder level. Reorder level. So whenever you are having continuous cash receipts with you, continuous cash receipts, that means your cash balance is going to be increased. Increased, and finally your cash balance touched the upper limit. Right? Still you have cash receipts with you. Then what the Miller or suggested is immediately purchase the marketable securities. Thereby your cash balance will get reduced. Right, sir? So purchase the marketable securities till your cash balances touches the reorder level. Once the cash balance touches the reorder level, stop purchasing the marketable securities. Stop investing in the marketable securities. Okay. Right, sir. Next. Sir, sometimes you might be having a continuous payments whereby your cash balances are going to be reduced. Reduced, and it will touches your lower limit. Still, you're having continuous cash payments. And if you make the continuous cash payments, you're going to see your cash balances falls below than lower limit. Then immediately what Miller or suggested is sell off your securities. Sell your marketable security. Whatever marketable security you purchase, you know, sell them until your cash balance reaches to the reorder level. See, when you're selling securities, no, you're getting money, you're getting liquid cash, whereby your cash balances increases. Right? Until which point you have to sell, ma? Until your cash balances reaches to reorder level, return point. Okay, now. Once your cash balances reaches to return point, stop selling the securities. Clear? Right. So this is what Miller or suggested. Your cash balances shall not exceed the higher limit, shall not fall below the lower limit. Maintain the cash balances in between these two limits. That is your optimum cash balance. Now, how to find out all these? Very simple, Amma. You have formula. Upper limit H is equal to 3Z plus L. Return point R is equal to L plus Z. Now, what do you mean by the Z here? Z is equal to cubed root of 3TV divided by 4I. Cubed root of 3TV divided by 4I. T stands for transaction cost. V is equal to variance of daily cash flows. I is equal to rate of interest. Okay, now. Now, spread. Spread means the difference between the upper limit and lower limit. The difference between upper limit and lower limit. That is what we call spread. H minus L. And average cash balances 4R minus L divided by 3. Okay, now. So by using these formulas, you need to find out the necessary amounts. Now, process for finding out nth root of a number. Because here you have cubed root. In your calculator, you have only square root. You only have the square root button, not cubed root button in your calculator. And scientific calculators are not allowed into our examination hall. Then how, sir? How to find out the cubed root? I have a process mentioned here, ma. By following this process, you can easily find out the cubed root, or for that matter, any root by using your calculator. Okay, ma. Look at here. I'll explain you some examples here. Process for finding out of the nth root of a number. Step number 1, type the number for which the nth root is required. Right, sir. Suppose that you want to know the cubed root of 2, right? And the answer you got the 8, ma. Answer you got the 8, right? So you need to start with the number 8. Clear? So that means cubed root of 8. This is you want to find out, sir. Cubed root of 8. So then you need to start with the 8. Type the number for which nth root is required. Type 8 on your calculator. Then press the square root button for 12 times. Right? On your calculator, you will be having square root button now. Press it for 12 times. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Then subtract 1 from whatever the answer you got on your calculator. Now, from that value, deduct 1, subtract 1. So minus 1. Then whatever the answer you got, divide it by 3. So divided by 3. Now, whatever the answer you got, for which add 1, plus 1, plus 1, and final step. Listen carefully. Press into multiplication button, into and is equal to buttons in combination for 12 times. In combination means simultaneously, like into is equal to, into is equal to, into is equal to, simultaneously. So into is equal to 1 time, into is equal to 2 times, like that for 12 times. Press it for 12 times. 3, 4, 5, 6. So when you pressing it the is equal to button for 12th time, into is equal to for 12th time now, right, you will be having the answer 2 on your calculator. Are you following, sir? Every one of you, right? So that is how you need to make the cube root of any given number. Any given number. Clear, sir? So here you have the cube root of this particular number. How much, Amma? 375, 37,500 crores. 37,500 crores. For which value you have to get the cube root. Cube root of 37,500 crores. Follow the same procedure. Follow the same procedure. 375 and then 9 zeros now. Right? Your calculator will be full. 375, 9 zeros, 37,500 crores, for which you want to know the cube root. Same process. Press the square root button for 12 times. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Then minus 1. Then divided by 3. Then plus 1. And finally into is equal to button for 12 times. 1, 2, 3, 4, 5, 6, 7, 8. Right? So end of that 12th button, whenever you're pressing the 12th button now, into and is equal to, then you will be having the answer 7351.6 something like that. You will get, you can round it up to 7352, 7,352. The square root of cube root of 37,500 crores is 7,352. 7,352. You can write on your calculator, approximately you will get now 7,352 approximately you will get. Clear, sir? Next. And once you get the Z value, the remaining calculations are very simple. And after that, in the cash budget, in the model itself, you have the submodels called concentration banking and logbox approach. Concentration banking and logbox approach. Now, what are these concepts? First, look at the concentration banking and logbox approach models. First, let us try to understand. First of all, the main important point here is at present days, these concepts are not having any relevance. These concepts have the relevance in the years 1970s, 1980s, and even the prior period, 1960s, 1950s, where there are no concept called internet banking. No concept called internet banking. No concept called IMPS, RTGS, NEFT, UPI payments, right, ma? When the days where all these facilities are not available, right? Only in that particular days, these concepts have some relevance. Concentration banking and logbox approach. At present days, ma, these are not having any relevance at all. Because first, let us try to understand the concept. Suppose that you are having your outlet, your place of business in Hyderabad, and you are having the customers across the India. You have the customers in Delhi, you have the customers in Bangalore, you have the customers in Chennai, you have the customers in Kolkata. Right, in all the metropolitan cities, you have the customers. Now look at the example. Hyderabad, from where you sell the goods to Delhi, from one of the customers, worth rupees 5 lakhs. The credit period given is 60 days. Look at this example. On 5th of May 1987, we have sold the goods. Credit period given 60 days. That means if you sell the goods today, after 60 days only, you're going to get your money. And anyhow, for the 60 days, there is an opportunity cost of loss of interest. Right? 60 days నీకు investment block అవుతుంది. ఆ investment మీద నీకు loss of interest. Yes or no? Next. Sir, on 4th of July 1987. So if you calculate the 60 days time limit, the 60 days time limit is going to be end with 4th of July. On 4th of July, he draw a check. Right? He draw a check on our name, 5 lakhs rupees. Right? And he sent through post. Right? మన పేరు మీద చెక్ డ్రా చేసి through post ద్వారా మనకి పంపించాడు. He sent through post. And when are we going to get that post? Immediately. మార్నింగ్ పోస్ట్ చేసి ఈవినింగ్ కల్లా హైదరాబాద్కి వచ్చేస్తుందా? ఏమి హైదరాబాద్లో ఉన్న దిల్సుఖ్ నగర్ నుంచి అమీర్పేట నుంచి Sanat Nagar ko వెళ్ళడం కాదు. Right, sir? The post should come from Delhi all the way to Hyderabad. Right? So it will take time, sir. Olden days, we are in the olden days, 1980s, 1970s, where we don't have even the proper transportation facilities as well. The postal van which started in Delhi, it will reach Hyderabad only after 1 week. Because Delhi to Hyderabad, there are so many states, there are so many post offices. That postal van will go to the head post offices of every state and city, collect the posts which are having the destination to Hyderabad or nearby places. Right, Mad? Then it will reach us to Hyderabad after 1 week only, 7 days. Right? The 7 days time period is what we call mailing float. Next, finally, on 11th of July 1987, check reaches to Hyderabad and received by our company. Immediately after receiving the check, you don't send the check for collection, because you are going to send a bunch of checks for collection, not a single check for collection. Yes or no? Generally in the organizations, what happens now, whenever they are going to send the checks for collection, they won't send a single check. They will send bunch of checks. They'll wait until a bunch received, a bunch of 20 checks or 30 checks. See, from different customers, you are going to receive the checks every day on an average. Right? Once a bunch of 20 checks received, then you will send the checks to banker for collection. Meanwhile, the check will be lying with you only. You will make the proper accounting entries and everything. Books of accounts lo entries pass cheskone any cheskone sarki 4-5 days pattudamma. By the time of 4-5 days, you will receive a bunch of checks. Then you will send the checks for collection. The 5 days, even after the check received to you, the check will be with you for 5 days. This is what we call a processing float. And finally, a bunch of checks received and you deposited in the bank for collection. Immediately, the banker will get the money and will realize to your account, will credit to your account? No. Sir, if it is an intra-branch check, means you and your customer have the account in the same bank and in the same branch. It will take at least 1 day for realization and crediting the money to your account. If it is an inter-branch check, means you both are having the account in the same bank, but in a different branches. You have SBI Dilshuk Nagar account, right? And your customer having SBI Jantar Mantar branch account. In Delhi, there is a place called Jantar Mantar, very famous place, right? So both of you having the same account in the same bank, SBI, but the branches are different. You having in a Hyderabad branch and your customer having in a Delhi branch. Inter-branch checks. It will take at least 3 days for clearance. 3 days for clearance and crediting the amount to your account. If it is an inter-bank checks, assume that you have an account in SBI, your customer having an account in ICICI. It will take at least 1 week for the check clearance and crediting the money to your account. Suppose that in our case, 3 days time limit was taken, right? Within 3 days, the bank money was realized and credited to our account. And this 3 days is what we call banking float. Totally chudamma, you have a mailing float of 7 days, processing float of 5 days, and 3 days banking float. Totally 15 days. And even after the check was drawn on your name, you are going to get the money only after 15 days. Anyhow, I already have a 60 days opportunity cost of loss of interest. In addition to that, now in additionally 15 days also, I have to face the opportunity cost of loss of interest. Check మన పేరు మీద రాసి పంపించినప్పటికీ కూడా ఆ చెక్ రియలైజ్ అయ్యే అమౌంట్ మన అకౌంట్ కి క్రియేట్ అవడానికి 15 రోజులు టైం పడుతుందమ్మా. Despite of the fact that the check was drawn on your name, but the amount was realized and credited to your account only after 15 days. So this 15 days also you have opportunity cost of loss of interest. This is what we call total float period, delay period. In order to reduce this float period, the following concepts have been introduced. Number 1, concentration banking. Number 2, lockbox approach. Now, what is this concentration banking? Very simple, amma. Very simple, right? First of all, you have to identify where your customers are locating. Major customers. So my major customers are locating in Delhi. Okay, fine. In Delhi, where they are locating? They are locating in the Jantar Mantar. Okay, ma'am. Jantar Mantar is a place for protest. It's a famous for protest. You have seen Anna Hazare protested for Lokpal bill. Where, amma? Jantar Mantar. Yes or no? The farmers have fight against the new farmers reformation bills. Where am I? Jantar Mantar. Yes or no? Right? So for every area, every city, they have some places, we have some places for protesting against to some bills and rules and laws. In Hyderabad, we have a place called Gun Park, Indira Park, Necklace Road, Tank Bund, Secretariat. These are all the famous places for protest. Okay, now. So your majority of the customers are locating in Jantar Mantar area, sir. Now, what you have to do is you have to open a bank account in that particular area, and you have to give instructions to all the customers who are there in the Jantar Mantar or nearby to deposit the checks into that particular bank. Are you following, sir? And I have another customer, major customers in Chennai, where in Nungambakkam. There is a place called Nungambakkam in Chennai, right? Then you have to go there and open a bank account in the Nungambakkam, and you have to give the instructions to your customers to deposit directly the money into that particular bank account. In Kolkata, your major customers are locating in Rajarhat. Rajarhat. There is a place called Rajarhat, Newtown, Rajarhat in Kolkata. Majority of the customers are locating there. Then you have to go there and open a bank account, and you have to give instructions to the customers to directly deposit into that particular bank. So first of all, what you have to do is you have to identify where your major customers are locating. Go there, open a bank account, and give instructions to your customers to deposit the money directly into that particular bank account. Are you following, sir? Every one of you. So thereby, what are the advantages to you? Mailing float will be reduced. The customer from Delhi, there is no need to send the check from Delhi to Hyderabad. Mailing float completely eliminated. Processing float. See, when you receive the check to your company, then only you will be having processing float. You need to wait for the bunch of checks. You need to wait for the accounting treatment, everything. But when check was directly deposited into the bank, there is no processing float. And you might be having mostly banking float, amma, adi kuda hardly 2 or 3 days. Your total float is just 2 days. Earlier, amma, total float 15 days. Now it has been reduced to 2 days. And 13 days, 13 days float period reduced. To that extent, there is a savings in opportunity cost of loss of interest. Yes or no? Right? So here, whether adopting the concentration banking system advantages or not, how to identify? Very simple, amma. You have to find out the cost of concentration banking system. And then you have to identify what are the benefits from concentration banking system. If benefits are more than cost, go for the concentration banking system. If benefits are lower than cost, not advisable to adopt. Next, lockbox approach. What is this lockbox approach? Very simple, amma. Here also same, you have to identify where your major customers are locating. And in that places, what you have to do is, instead of opening a bank account, right, sir, what you have to do is, you have to take a postal box on rental basis. A postal box on rental basis. Okay, now. Post boxes. In post offices, you might find the post boxes. Right, sir? So take a post box on rental basis, and you have to give instructions to your customers to drop the checks in that particular post box. Or you can go to the bank, and in that bank, you can take a drop down box on hire basis. Drop down box. Okay, now. Because if you ask your customer to go to the bank and deposit the check into the bank, he may hesitate to go to the bank and deposit the same into your bank account, because old and see nowadays itself, if you go to the bank on a Monday morning, you will find a lot of queues. Yes or no? Right? But look at the situation of 1970s, 1980s. Imagine how the banks are crowded. They don't go, sir. They don't want to waste their time in banking queues. That's why you just take a drop-down box on rental basis in the banks. You just give instructions to your customers to drop the checks into that particular drop-down box. Matter of 5 minutes. Yes or no? Right. So, and then you have to give the instructions to the banker to see the drop down boxes, to see the post boxes on a regular time intervals. Morning once, afternoon once, evening once. If any checks were dropped into that particular box, take out the checks and deposit into my account. This is what log box approach. Okay, now. So again, you need to see the benefits and costs, right? If you have the benefits more than cost, advantageous to adopt log box approach. If your benefits are lower than cost, not advantageous. Okay, ma? Right. Next. Next, we have a concept called MPBF, maximum permissible banking finance. MPBF. This is actually whenever you are going to the bank for the working capital loans. Suppose that you went to the bank for a working capital loan of 20 lakhs. Working capital loan of 20 lakhs. The banker will not give you the entire amount as working capital loan. Because while the banker giving the working capital loans, he has to follow the Tandon Committee recommendations. Tandon Committee has made some recommendations to the bankers to be followed at the time of issuing the working capital loan. They have to comply with the Tandon Committee recommendations. What the Tandon Committee suggested, recommended. Look at here, ma. X Limited have a current assets of 100 lakhs, which includes core current assets 10 lakhs. And they have a current liabilities of 60 lakhs. So means the working capital requirement is 40 lakhs. Current assets minus current liabilities is a working capital, yes or no? So they are having a working capital requirements of 40 lakhs. Now, look at the method one. What suggested by the Tandon Committee? The Tandon Committee suggested when a person coming to you for the first time for the working capital loan, you have to give only 75% of the working capital as loan. Only 75%. You come for working capital loan of 40 lakhs amma. Andalo 75% enta 30 lakhs. So give him only 30 lakhs working capital loan because see, there must be certain portion from the contributor itself, right? Proprietor itself. See, I'm a proprietor of a business. I went to a bank for the working capital loan of 40 lakhs. Then immediately banker asked me, sir, out of this 40 lakhs, what is your personal investment? అబ్బాయి నా పర్సనల్ ఇన్వెస్ట్మెంట్ ఏం లేదు సార్, మీరు డబ్బులు ఇస్తే వెళ్ళి బిజినెస్ చేసుకుంటా. రేపొద్దున లాస్ వస్తే ఎవడమ్మ పోయేది? బ్యాంకర్ పోతాడు. బ్యాంకర్ కదా లాస్ ఫేస్ చేసేది. నువ్వు నీ ఓన్ డబ్బులు నువ్వేం ఇన్వెస్ట్ చేయలేదు కదా. ఎస్ ఆర్ నో? The banker will definitely ask you, what is your personal investment in this particular 40 lakh? If you say like, no, sir, I don't have any personal investment. Just you give me money, enter 40 lakhs, I'll do the business. If I get the profits, I will enjoy the profits. If I get the loss, you have to face the losses. Whether the banker accepts. If you get the losses from the business, who is going to suffer? Not you, because you have not invested any your personal investment now. Who invested? The banker now. You simply do one thing, that is what we call a insolvency petition. Insolvency petition. Or you fly away to foreign countries just like Vijay Mallya, Neerav Modi. Yes or no? Right? So that's why what the Tandon Committee recommended, make sure that 25% of working capital is funded by the proprietor himself. Only 75% you have to give. That's the method number one. 0.75 into current assets minus current liabilities. And current assets minus current liabilities and your working capital. So only 75% of working capital requirement should be given as loan. Next, method two. When he is coming second time for working capital loan, then what you have to do is only 75% of current assets you have to consider for working capital minus current liabilities. What is your current assets? 100 lakhs. 100 lakhs into 75%. 75 lakhs minus current liabilities 60 lakhs. So only 15 lakhs loan you have to give. Only 15 lakhs loan you have to give. And when he is coming third time for the working capital loan, what Tandon Committee suggested, out of the total current assets, core current assets must be funded by the proprietor himself. Core current assets and very important current assets, 10 lakhs, these must be funded by the proprietor himself. With respect to core current assets, we don't give even 1 rupee as a loan. The full core current assets should be funded by proprietor himself. On the remaining current assets, now consider only 75%. Means, so 0.75 into current assets minus core current assets minus current liabilities. And the third time you're going to get a loan of only 7.5 lakhs. Look at Amma. First time when you go on for the loan, you get 30 lakhs. Second time 15 lakhs. And third time just 7.5 lakhs only. And the working capital requirement loan, the working capital loan sanctioned by the banker is getting reduced time by time. My initial days, the banker is giving you 75% because you are in need of money. But over the time, after 4 or 5 years, you will be having the enough profits with you. You will be having the enough retained earnings with you. That's why the banker will provide you very less amount as working capital loan. Are you following or not? This is what the Tandon company suggested. Clear? This is the concept of maximum permissible banking finance, MPBF. Clear? Next. After that, the last model, that is management of payables. Management of payables, nothing but creditors management. Also known as what among creditors management. Now, you will get a doubt here. Sir, we learned the concept called debtors management. You said the debtors management is very, very important because our entire investment is blocked in debtors. If you're not properly managing the debtors, we are going to face the losses. Sometimes we need to shut down the business. But why there is a need to manage the creditors? Are they equal important to debtors? Creditors are equal as importance to debtors? As important as debtors? Answer is yes. Debtors management yenta important o creditors management kuda ante important amma. Whatever the priority you are giving to the debtors management, the same priority you should give to the creditors management, because there is an old saying in English. There is an old saying in English. What is that? The old saying, if you want to sell well, first you have to buy well. So you always have a target of selling 1 lakh units in a month. 1 lakh units in a month. That's your target. But if you want to reach your target, first you might have purchased 1 lakh units. No. So when you have a purchase of 1 lakh units, then only you can sell 1 lakh units. If you purchase 10,000 units, you are going to sell only 10,000 units. Na? Right? The quantity you purchase, the same quantity you are going to sell. So if you have a high target of sales, you must purchase high target. Yes or no? So if you want to sell well, first you have to buy well. అర్థమవుతుందా? 1 lakh units target reach అవ్వాలంటే ఫస్ట్ నువ్వు 1 lakh units కొంటేనే కదా target reach అయ్యేది. So that's why creditors management as equal as important as debtors management. Clear now? Creditors management, what are we going to do in this model? Sir, just like when we offering the cash discount to our customers for early recovery of the money, so as our creditors, for our creditors, we are debtors. మన క్రెడిటర్ కూడా మనకి cash discounts offer చేస్తారమ్మా. Our creditors will offer the cash discounts to us. Now the question arises, should I avail this cash discount or not? Should I avail this cash discount or not? If I avail this cash discount, what are the advantages and disadvantages to me? If I am not availing this cash discount, what are the advantages and disadvantages to me? This you have to analyze here. Look at this example, sir. Availment of cash discount. Suppose that your creditor offered you credit terms like this: 2/10 net 30. 2/10 net 30. And that means actually the credit period given to you is 30 days amount. But if you pay within 10 days, then you can enjoy 2% cash discount. You can enjoy about 2% cash discount. Right, sir? So you have to make the payment of 98 rupees only, but within 10 days. Suppose you purchase for 100 rupees amma. Cash discount 2% and no net and the pay chali 98 kada. You have to pay 98 rupees within 10 days. No, sir, I would like to pay within 30 days. Then you have to pay 100 rupees. When you're not availing cash discount, you have to make the payment of 100 rupees within 30 days. right, sir? So either you have to pay on day 10, you have the options. On day 10, if you wish to pay, you have to pay 98 rupees. Later, sir, I would like to pay on day 30. On day 30, then you have to pay on day 30, 100 rupees. You have the advantage. If you pay on day 10, 98 rupees, you are going to pay, sir. Right, sir. These are the two options you have. If you opt to pay on day 10, you have to pay 98 rupees. If you opt to pay on day 30, you have to pay 100 rupees. Now, sir, when you're availing the cash discounts, what is the benefit you are getting, Amma? 2 rupees benefit you are getting. 2 rupees benefit you are getting, sir. Cash discount రూపంలో 2 rupees benefit వస్తుంది మీకు. Now you have to compare this 2 rupees benefit with opportunity cost of investing this 98 rupees for 20 days. Sir, suppose that if you invest this 98 rupees for 20 days, assume that you are going to get a benefit of 3 rupees. Right, sir? Ante, for availing 2 rupees benefit, you are losing 3 rupees benefit. 3 rupees opportunity cost you are losing. So it is not advisable to avail the cash discount. Right? See, you have the money with you, but if you invest that money, right, for the 20 days more, on day 10, instead of paying 98 rupees to the creditor, if I invest that 98 rupees for another 20 days, right, I will get interest now for that 20 days. That interest is, let us say, 3 rupees. But if I avail the cash benefit, cash discount, I'm getting only 2 rupees benefit. I'm losing interest of 3 rupees. What is the point in it? So it's not beneficial to avail the cash discount. Suppose that if I invest this amount for 20 days, suppose that I'm going to get only 1 rupee interest. Now it's benefit to avail the cash discount. Avail the cash discount, pay the amount in 10 days, pay 98 rupees, enjoy 2 rupees cash discount. Clear? This is how you need to make the analysis of availing the cash discount or not. And for finding out, we have a formula, sir. Opportunity cost of foregoing the cash discount, D divided by 100 minus D into 365 days divided by N minus P. D stands for cash discount. N stands for credit period. That 30 days is a answer in our question. And P stands for payment period, 10 days. Apply the answer, Amma. The credit terms given how much, Amma? 2 by 10 net 30 kada. So D cash discount and the 2% divided by 100 minus D, 100 minus 2 into 365 divided by N minus P. N and N credit period, total credit period given 30 days minus P and N payment period. What is the payment period? 10 days. 30 minus 10. So 2 divided by 98 into 360 divided by 20. Calculate, you'll get opportunity cost of foregoing the cash discount 37.24%. Right, sir? 37.24%. Suppose that the rate of return on investment of 98 rupees for 20 days. Right? So 20 days, investment chesunte 98 rupees ni, you are going to get an opportunity cost of 40% per annum. 40% per annum. So if opportunity cost of foregoing the cash discount is greater than return on investment, advisable to avail the cash discount. If opportunity cost of foregoing the cash discount is less than return on investment, suppose that your opportunity cost of foregoing the cash discount is 37.24%, where the rate of return on investment is just a second, sir. Yes, if opportunity cost of foregoing the cash discount is less than return on investment, your opportunity cost of foregoing cash discount 37.24% and your return on investment 40%. Instead of going for cash discount, it's better to reinvest. Right, sir? Better to invest that 98 rupees for 20 days, enjoy 40% rate of return. Okay, now hardly you are foregoing just 37.24% benefit, but you are getting 40% benefit here. It is advisable not to avail the cash discount. Are you following, sir, every one of you? Clear? Next. And there is one more formula for the calculation of opportunity cost of foregoing the cash discount. The formula is 100 divided by 100 minus D square root of whole root of 365 divided by T minus 1. Where D is the cash discount and T is a net period. And nothing but credit period minus discount period. In our example, Credit period given 30 days minus discount period 10 days. అంటే మీకు ఆన్సర్ ఎంత వస్తుందమ్మా 20 days వస్తుంది. Okay, now this formula you have to apply when there is a reinvestment information provided. In the question, there is information regarding the reinvestment. If we reinvest this much amount for this much days, you will get this much rate of return. If reinvestment rate information is provided in the problem, you have to apply this formula, sir. Like, look at the problem number 26. I'll show you examples here. Yeah, this is a problem number 26. Look at here. ABC Limited has been offered credit terms of its major supplier of 2/10 net 45. Hence, the company has a choice of paying 98 rupees per 100, right? And that means if the company able to pay within 10 days, enough to pay 98 rupees instead of 100, or to invest 98 rupees for an additional 35 days and eventually pay the supplier 100 per 100. Right, sir? When you opted to pay within 45 days, not within 10 days, then you have to pay 100 rupees, no? So 98 rupees for additional 35 days, you can reinvest. Clear? So there is information regarding reinvestment. The decision as to whether the discount should be accepted depends upon the opportunity cost of investing 98 rupees for 35 days. What the company should do if the opportunity cost is 25%. So reinvestment rate information provided, sir. That is why we have used the second formula. If this information is not provided, then you can use the first formula. D divided by 100 minus D into 365 divided by N minus P. That formula you can use. Clear? So with this, we have completed the management of payables, that is creditors management. So we have completed both management of current assets and management of current liabilities. That means we have completed the management of working capital. And working capital management chapter completed. Clear, Amma? So with this, totally 6 chapters completed, sir. Out of the total 10 chapters, 6 chapters completed. And I can say that these 6 chapter weightage is almost 75%. Because the remaining 4 chapters, advanced concepts in investment decisions, risk analysis in capital budgeting decisions, dividend decisions analysis, ratios analysis. These 4 chapters. Okay, now. And in that, only the ratios analysis will have the lengthiness. Remaining 3 chapters now, very less time we can complete. Clear, sir? Every one of you. Okay, now. So in the next class, I'm going to start with the advanced concepts in investment decisions. Okay, right? So till then, see you in the next class, sir. Have a good day and good night. Stay home and stay safe. A very good afternoon, students. So welcome to the Strata FM Marathon classes. In the last class, we have completed discussion regarding chapter number 6, working capital management. Now time for the chapter number 7, advanced concepts in investment decisions. Right, sir? See, we have already learned chapter number 2, investment decisions. Yes or no, ma? Chapter number 2, we have learned investment decisions. In this chapter, we have learned all the fundamentals, basics of this investment decisions chapter. Like we have learned about the various project evaluation techniques, like traditional techniques, average rate of return, payback period method, and discounting techniques like NPV, IRR, profitability index. Yes or no? They are all the fundamentals, basics of investment decisions, part 1. And this is part 2, advanced concepts in investment decisions. Now we are going to see the advanced concepts. If you remember, sir, in the discounting techniques, totally we have 5 techniques. In chapter number 2, we have discussed about only 4 techniques, 4 discounting techniques. We discussed about what, Amma? We discussed about NPV, then IRR, then profitability index method, and we also discussed about the discounted payback period method. One method we have ignored in chapter number 2, that is terminal value method. And this terminal value method we are going to cover in this chapter. Terminal value method, which is also known as the modified NPV method. Clear, sir? Right. Now in this chapter, what are we going to learn? In this chapter, we are going to learn about the different topics like important adjustments in the investment decisions analysis, while you're making the investment decisions analysis, there are certain expenses you have to be ignored and there are certain expenses you have to be considered. And then block of assets method, replacement analysis method, modified NPV or terminal value method, then modified IRR method, and finally NPV IRR conflicts. Okay, ma. Let us see one by one. So first, model number one, important adjustments in investment decisions analysis. Just now I said no, while making the investment decisions, there are certain expenses to be ignored and there are certain expenses to be considered. So what are the expenses to be ignored and what are the expenses to be considered? Let us see one by one. First, expenses to be considered. So while making the investment decisions, you have to consider certain expenses like opportunity cost of investing that particular money in the project. Suppose that there is a project X where I am investing 10 crores rupees, right, sir? Now, if I invest this 10 crore rupees in project Y, the same 10 crore rupees, assume that I am going to earn some 2 crores rupees returns. This is my investment. $10 crores is my investment and my returns are 2 crores. But instead of investing in the project Y, I'm investing in project X. Now, the returns from the project Y, that is 2 crores, will become opportunity cost for project X, 2 crores. Now, from the project, if I'm able to collect the returns more than 2 crores, then only the project is viable to me. Yes or no? If from the project, I'm able to generate only some 1.5 crores return or 1 crore return, then selecting the project is not a wise decision. Because already project Y is there, which is giving you 2 crores returns now. Instead of investing in project Y, you are investing in the project X, and where you are getting returns of only 1 crore or 1.5 crores. So not a wise decision. Project X is viable only when the returns from the project X is more than 2 crores. So if the project X is able to recover my opportunity cost of 2 crores, then only my project X is viable to me, advisable to me. Yes or no? So that's why opportunity cost should be considered. And the second one, the fixed cost exclusively incurred for the project. Whatever the fixed cost you're incurring exclusively for this project, that fixed cost you have to be considered. Normal fixed cost you have to be ignored, amma, but the fixed cost which are exclusively incurred for the project, that fixed cost you have to be considered compulsorily. Okay, ma. These two are the main expenses to be considered. Next. There are certain expenses to be ignored. What are the expenses to be ignored? Like first one, depreciation, because it is a non-cash expenditure. Depreciation is a non-cash expenditure. Hence, we have to be ignored while making the investment decision. Yes or no? Right? But of course, we are considering the depreciation only for the purpose of taking the tax benefits out of it. Do you remember, sir, while calculating the CFAT, PBDT minus depreciation PBT minus tax PAT, add back depreciation CFAT. So once we are deducting and later we are adding back, so the ultimate impact will be 0. Sir, next, second one, sunk costs. Sunk costs means the costs which are already incurred in the past expenses. So past expenses you have to just ignore, ma. Suppose that you already purchased a land in the year some 2000. You purchased a land. Just a second, sir. You purchased a land for 10 crores. Right, sir. And this land you have purchased during the previous year, 2020-21. Now assume that during the previous year, 2023-24, you are going to construct a building on it. Right, sir, on that particular land. Now, whether the construction of the building is viable or not, construction of a factory building on that particular land is viable or not. Now, while you're making this decision, the cost of the land you have to be simply ignore. Because you have not purchased the land for the construction of this building, right? It's already incurred. It's a past expenditure. You have not purchased this land exclusively for the construction of this building. Clear. So all the sunk costs you have to be ignored while making investment decisions. Overheads allocated, right, sir? So if you have some 5 departments and assume that you have incurred an overheads of, let it be some 100 lakhs. You have incurred overheads of some 100 lakhs, right, sir? Now, when you're allocating the overheads to this particular departments, 4 departments, assume you that 4 departments. Overheads incurred in the overheads incurred 100 lakhs. So 100 lakhs divided by what? 100 lakhs divided by 4 departments you have. So overheads allocated in the 25 lakhs or something. Overheads allocated 25 lakhs per department. Suppose that you have increased one more department. So 100 lakhs, the same 100 lakhs you are going to allocate between the 5 departments. Earlier you used to have only 4 departments. Now you have 5 departments. Now you have the 5 departments. Okay, sir. So now it will come, how much, sir? It will come to be 20 lakhs. Every one of you following now. So overheads allocated. You are not incurring that indirect expenditure exclusively for this project. Whether you had this department or not, the overheads allocated, the amount of overheads will remain to be same 100 lakhs. Right? If you take the example of a departmental store like D-Mart, Big Bazaar, Spencer's, suppose that they have only 4 departments in that departmental store like stationery, groceries, right, Sma? And then you will be having some footwear and some clothes. Now we have added 5th department as well. Right, so 5th department also you have added. So earlier 4 departments are there where the overheads are 100 lakhs. Now the 5th department were added in the same building. So whether you are going to pay any additional salary to the security guard of that building, dear security guard, we have added one more department here. So we are increasing your salary. No, you're not going to increase. Whether you are going to increase any rent amount to your landlord, we have added in the same building, in the same space, you have added one more department. Are you going to pay an additional rent to the landlord? No, you're not going to pay any additional rent to the landlord. So the overheads will remain to be same. Earlier, the same allocated between 4 departments. Now the same allocated between 5 departments. Right, sir? So you are not incurring any additional overheads exclusively for the 5th department. Now, whatever the 5th department getting allocation of 20 lakhs overheads, that should be ignored while making investment decisions. Next, common costs. Common cost means whether this department is existing or not. These expenses are common, like some advertisement expenses. You are going to advertise your shop as a whole, your branch as a whole, not for department wise, right? Common costs. So all that common costs you have to be ignored. So these are the important consideration while you have kept in mind while you are making the investment decisions. Okay, now next. Replacement or modernization decisions. Replacement decisions. But generally in the chapter number 2, whatever you have done is a single decision. Should I purchase a plant and machinery or not? Only one decision. But now in chapter number 7, you are going to make 2 decisions. Number 1, should I dispose of my existing machinery? Should I dispose of existing machinery or not? Number 2, should I purchase a new machinery or not? Two decisions. Should I continue with the existing plant and machinery, or should I replace the existing plant and machinery with the new machinery? 2 decisions you have to make. Replacement decision. Should I replace my existing machinery with the new plant and machinery or not? Right, sir. Now here for making the replacement decisions, you have two options available. Number one, by using the total approach. Under total approach, have to make a decision, sir. First, you have to find out the NPV under total approach, and means NPV under existing situation and NPV under proposed situation. Compare both of these NPVs. If NPV under proposed situation is greater than NPV under existing situation, then it is advisable to go for the replacement decisions. It is advisable to replace the old machinery with the new machinery, right? So here you have to find out the NPV two times, under existing situation, under the proposed situation. Under total approach, it is normally be avoided because it will take a lot of time, a lot of calculations will be involved, right? Now, the second method available is incremental approach. Under incremental approach, we will consider only the incremental information. That means by installing the new plant and machinery in the place of the old plant and machinery, what are the incremental sales I'm getting? What are the incremental cash inflows? What are the incremental cash outflows? Only the incremental information you have to take into account, and thereby you need to find out the incremental NPV. If incremental NPV is positive, accept the project. If incremental NPV is negative, reject the project. Are you following, sir? Every one of you. That is how you need to make the decisions under incremental approach, replacement decisions. Clear? Every one of you. And while you're doing these problems under replacement decisions, now there are some additional steps you are going to have. Generally, NPV consisting of 4 steps. What are the 4 steps, Amma? Step number 1, calculation of present value of cash outflows. Step number 2, calculation of present value of operating cash inflows. Step number 3, calculation of present value of terminal cash inflows. And step number 4, calculation of NPV. Right, sir? These are the 4 steps while we are calculating the NPV. But here, while you're making the replacement decisions, now when additional working notes comes into picture, this is the additional working notes. Calculation of net sale proceeds of the existing machinery as on today, because you are going to calculating the NPV by assuming that I am replacing the old machinery with the new machinery. So when you're taking that assumption that you are replacing the old machinery with new machinery, means what, Amma? You are going to sell your old machinery. You are going to sell your old machinery. Now, when I'm selling the old machinery as on today, what is my net sale proceeds? The additional working note you have to do. Look at here, sir. If you go through the problem, the information will be provided there. Here it is. Problem number 3. Yeah, here is more. An existing company has a machine which has been in operation for 2 years. Already we had in existing machinery, which has already been in operation since 2 years. Its remaining useful life is 10 years. Inka 10 years life on the both put together means the total life of the machinery is 12 years. With no salvage value at the end. At the end of the 12th year, end of the life of the machinery, there is no salvage value. Its current market value is 1 lakh. As on today, its current market value is 1 lakh. So that is why here we have taken a gross sale proceeds 1 lakh. Return on value of the machinery. The cost of the machinery, how much, sir? Purchase price of the existing machinery, 2,40,000. Right? Life 12 years, salvage value 0. We know the depreciation formula. Cost of the machinery 2,40,000 minus salvage value 0 divided by life 12 years. Depreciation per annum 20,000. So, and you have used the machine for 2 years. It's already been in existence for 2 years. So 2 years depreciation in the amount 40,000. So what is the present return on value? 2,40,000 original cost minus 40,000 depreciation for 2 years. So the return on value as on today 2 lakhs. But 2 lakhs worth machinery you are selling for 1 lakh. So there is a capital loss of 1 lakh. Since you have a loss, you will get tax shield, tax benefit at the rate of 50%, 50,000 tax benefit. So by selling the machinery, you are getting 1 lakh plus tax benefit, you are getting 50,000. So that means the net sale proceeds 1,50,000. Net sale proceeds in the 1,50,000. Right, sir? So by selling the plant and machinery as on today, you are going to get a benefit of 1,50,000 rupees. This additional working note you have to be considered. And now this impact will have in your step number 1. Cost of the new machinery 4 lakhs, from which you have to deduct the net sale proceeds of old machinery. Your cost of new machinery 4 lakhs amma. There is no need to pay 4 lakhs out of your pocket. By selling old machinery, you are getting 1,50,000. So 4 lakh low, 1,50,000, you are getting sale proceeds of old machinery. So additionally, what is your cash outflow? 2,50,000. Right. So you are going to additionally incur for the new machinery only 2,50,000. Clear. So that's the impact. Clear now? And at the same time, in step number 3 also, sir, while calculating the terminal value of cash inflows, right? So first you should take the NSP of the new machinery, from which you have to deduct the NSP of the old machinery, net sale proceeds of the old machinery. Clear, sir? Right? Thereby you will get the terminal cash inflows, right? So that's how you need to make the decisions with respect to replacement decisions analysis. And then after that, you have NPV IRR conflicts. NPV and IRR conflicts. Then you will get a doubt here. Sir, what is the reason behind NPV and IRR conflicts? Asli renditi madhya conflicts enduku vastayi, sir? Right? So reasons for conflicts. Number 1, nature of the projects. Sir, if the given project's nature mutually exclusive, that means we have to select only one project. Mutually exclusive means we have to select only one project. Now, look at this example, sir. NPV project 1, you have positive 5 lakhs, project 2, positive 4 lakhs. In both the projects, you have a positive NPV, right, sir? So that means both the projects are acceptable. We know that if NPV is positive, accept the project. Yes, sir. Next, look at the IRR. In the project 1, it is 15%, project 2, 18%. And cost of capital 12% for both the projects. In both the projects, IRR is greater than cost of capital. And when you are making decision by using IRR, you can select both the projects. Sir, if the given project's nature is mutually independent, there is no problem at all. We can select both the projects. As both the projects NPV positive, as both the projects IRR is greater than cost of capital. The real problem comes into picture only when the given project's nature is mutually exclusive. Clear, sir? Means we are going to select only one project. Now, which project should be selected? NPV suggesting project 1, IRR suggesting project 2. Project 1, NPV is higher, so NPV suggesting project 1. Project 2, IRR is higher, so IRR suggesting project 2. So there is arising a conflict between NPV and IRR. Next, that's the first reason. Second reason, investment disparity, also known as size disparity. Generally, the projects which are having the higher investment obviously will have high NPV. But whereas when you're talking the profits as a percentage, the percentage is lower. Like I'll tell you example. Mukesh Ambani investing in the Reliance Jio. He will make the investments in thousands of crores. He invested some 20,000 crores. Right, sir? And he's enjoying an NPV of, let us say, some 2,000 crores. But as a percentage, when you're talking, he's getting only 10% rate of return. Okay, now. Whereas there is a small departmental stores owner who invested hardly some 20 lakhs rupees, but he is enjoying almost 5 lakhs rupees of returns. Now, as a percentage, you can see the rate of return to him 25%. See, when your investment is higher, your NPV will be higher. But as a percentage, if you talk, the percentage is lower. But when your investment is lower, your NPV would be lower. But as a percentage, you talk 25% rate of return. Are you following, sir? So the projects generally which are having the high investment will have the low IRR. The projects which are having the low investment will have the high IRR. So again, there is a conflict. NPV suggests the bigger investment projects. IRR suggests the lower investment projects. Right? So this is another reason for conflict between NPV and IRR. Next, life disparity. Yes, obviously apply the same logic. A project having the higher life will have the higher NPV, but as a rate of return, it will be lower. A project which is having a lower life will have the lower NPV, but as a percentage, when you're talking about, the rate of return is higher. So again, NPV suggests the projects having higher life. IRR suggesting the projects having the lower life. Again, there is a conflict between NPV and IRR. Fourth case, cash flows disparity. Cash flows disparity. Sir, if you are earning the major cash flows in the initial years, no, definitely your project will have a highest NPV. But if you're having your major cash flows in the latter years, no, then your NPV will be lower. Look at the project one. Its major cash flows occurring in the initial years, first 3 years. So its NPV will be high, sir. Whereas project two, its major cash flows occurring in the latter part of the project, last 3 years of the project. So its NPV will be lower. And generally, NPV suggests the projects where the cash flows are heavier in the initial years. But IRR doesn't differentiate the timing of occurring of cash flows. Clear. So the cash flows disparity is also another reason for IRR and NPV conflicts. Now you will get a doubt here. So whenever there is an IRR and NPV conflict, now which project should I select? Right. Should I go with the NPV project? Should I go with the IRR project? Simple answer, sir. Generally, the financial management basic objective, primary objective ఏంటమ్మా? Wealth maximization of the shareholders. Now, among the NPV and IRR project evaluation techniques, NPV is the most widely used technique, and NPV is a technique which satisfies the primary objective of the financial management. NPV discussed about the amount of returns. IRR discussed about percentage of returns. Are you following, sir? NPV prevails over IRR. Whenever there is a conflict between NPV and IRR, NPV always prevails over IRR. You have to go with the projects which are suggested by NPV. NPV suggest చేసిన projects నే select చేయాలమ్మా. ఎందుకంటే first one, NPV discussed about the amount of returns. The investor, as an investor, you always looking after your returns rather than the percentage of returns. Amount of returns, as a shareholder, you understood only the amount of returns. What is the amount I've invested? What is the amount I got? That's it. నేను ఎంత ఇన్వెస్ట్ చేశాను, నాకు ఎంత వచ్చింది? 1,00,000 ఇన్వెస్ట్ చేశాను, 2,00,000 వచ్చింది. ఓకే, 1 lakh ప్రాఫిట్. ఆర్ యూ ఫాలోయింగ్, సార్? I invested 1 lakh, I got 2 lakhs in return. So 1 lakh is my profit. That's it. End of the day. But he need not worry about his percentage of returns, amma. He's least bother about percentage of returns. He's always concerned about amount of returns, and that amount of returns explained under where, amma? NPV. Yes or no? Second reason, two projects NPV can be additive. You can add the two projects NPV directly. Suppose that project 1 NPV, like here we have example. Project 1 NPV 5 lakhs, project 2 NPV 4 lakhs. The total NPV from these two projects, I can say 9 lakhs. Total NPV. Now, what is the total IRR from these two projects? Sir, 15 plus 18, the total IRR from this project, 33%. No, wrong answer. Two projects NPV cannot be added directly. You cannot add directly, sir. Two projects NPV, two projects IRR. NPV you can add, but two projects IRR you cannot add. The second reason. Third reason, NPV calculations are very easy and somewhat accurate. But when it comes to IRR, there are so many problems involving in IRR. The problems are like, if you give a particular data to 10 people for the calculation of IRR, 10 people will come up with the 10 different answers. Right, sir? Because IRR calculation is purely based on your guess rates. And not all the 10 people will take the same guess rates. You will be having a concept of multiple IRRs. Now, among the multiple IRRs, which IRR is correct is a $1 million question. But NPV, now, if you give data for the calculation of NPV for 10 people, almost all the 10 people will come up with the same NPV. Yes or no? So these are all the major advantages under NPV. So that's why NPV is always prevails over the IRR. Clear, right? So generally you have to go with the projects which are suggested by the NPV. Clear? Next. When you have life disparity in asset, for life disparity, you have different methods, like you need to find out the equivalent annualized criterion, right? Like means annualized NPV, you need to find out, right? NPV per annum. Look at this example. NPV of the machine 1 lakh, NPV of the machine 2 1,80,000. Just a second, sir. Yeah, sorry. NPV of the machine 1 is 1 lakh and NPV of the machine 2 1,80,000. Sir, here you cannot directly go with, okay, I'll select machine 2 as it is having highest NPV. You should not go like that because there is a life disparity. Are you following, sir? Machine 1 having the life of 3 years only, whereas machine 2 having the life of 6 years. So machine 2 obviously having the highest life will have the highest NPV. See, these two machines are not having equal lives. So that is why their NPVs are not equal. So first of all, here what you have to do is you have to find out the annualized NPV. Find out a annualized NPV. How to find out? Total NPV divided by present value of annuity factors divided by R percentage and number of years. Are you following, sir? Total NPV divided by present value annuity factors. So for project machine 1 lakh divided by 10% 3 years annuity factor 2.487, you will get a NPV per annum 40,209. For machine 2, it is 1,80,000 divided by 10% 6 years. The life is 6 years, no? 4.355. You will get a 41,322 per annum. Clear? So the conclusion, since the annualized NPV of the machine 2 is higher, it is advisable to select the machine 2. It is advisable to select the machine 2. Clear? But sometimes, if there is no sufficient information for the calculation of annualized NPV under life disparity method, you have to follow this method, sir. Equated annual cost. Equated annual cost. In that particular problem, now you will be having only cost element. There is no sufficient information for the calculation of NPV. You have only cost element. Then go with the cost only. Total maintenance cost divided by present value annuity factor. First, find out the total maintenance cost divided by present value annuity factors for the given percentage and life number of years. You will get equated annual cost per annum. So for both the projects, you will get per annum cost. Compare the cost and select the project which is having the lowest cost. See, if it is an NPV, select the project with highest NPV. If it is a cost, select the project with the lowest cost. Are you following, sir? So that is how you need to resolve the conflict between NPV and IRR if it is arising because of the life disparity. Next. And after that, model number 4, modified NPV, also known as terminal value method. Modified NPV, also known as terminal value method. Now, what is this concept all about? So generally, while calculating the NPV, we will take some assumptions like all the cash flows given in the problem are assumed to be certain. First assumption. Second assumption, all the cash flows arising in the problem are assumed to be occurred at the end of the every year. And number 3, all the cash inflows generating out of this project are assumed to be reinvested at cost of capital rate. So the third assumption, whatever the cash inflows we are getting, we are not going to putting them idle. We are reinvesting them at what rate, Amma? At cost of capital rate. That's the third assumption. So as long as your reinvestment rate is equal to your cost of capital, normal NPV, modified NPV, both are one and the same. Both are one and the same. But in case if your reinvestment rate is not equal to cost of capital rate, then there is a need arises for the calculation of modified NPV. In that scenario, normal NPV is different, modified NPV is different. So look at here, when reinvestment rate is different from the cost of capital rate, then there is a need arises for the calculation of modified NPV. Clear, sir? Every one of you. Okay, now, if the problem specifically mentioned about the reinvestment rate, Like look at the problem number 7. This is a problem number 7. So it mentioned cost of the machinery 10,000, life 3 years, cash inflow 6,000 every year for 3 years, cost of capital rate given 15% cost of capital, and the reinvestment rates given separately, sir. The expected interest rate at which the cash flows are reinvested. First year cash inflows, you're reinvesting at 12%. Second year cash inflows, you're reinvesting at 10%. Third year cash inflows, you're reinvesting at 9%. Okay, now state whether the project should be accepted under terminal value method. Here the cost of capital rate different from reinvestment rates. So that's why there is a need arises for the calculation of terminal value method, modified NPV. Okay, now, so look at here. How to calculate? First of all, step number 1, find out the terminal value, sir. So take years 1 to 3, cash inflows every year you are getting 6,000. Number of years can be reinvest. Now, first year cash inflows, right? This is your Y0, Y1, Y2, Y3. Every year you are getting a cash inflow of 6,000. Okay, now, and as per our assumption, we are getting this cash inflow at the end of the every year. Clear? Now, at the end of the first year, you got 6,000 cash inflows. And for how many years you are going to reinvest it, Amma? You are going to reinvest only for 2 years now. End of the first year you are getting. So year 2, year 3, only 2 years left for reinvest. So maximum this first year 6,000 cash inflow can be reinvested for 2 years. End of the second year, again, you got a 6,000 rupees. And this is maximum you are going to reinvest for 1 year. And end of the year 3, you also got another 6,000. And this how many years you are going to reinvest? 0. That is the end of the project life now. The project life is only 3 years. End of the third year, you got 6,000. Right, sir? So the third year cash inflow will not fetch you any interest. So the reinvestment rate as mentioned in the problem, 12%, 10% and 9%. Take the future value factors. Future value factors, not present value. We are finding out terminal value, Amma. We are bringing all these cash inflows into future value. Right? So you'll get the terminal cash inflow. At the end of third year, you're going to get 20,124 rupees. But we want NPV as on today. So convert these terminal cash inflows into present value. At what rate, Amma? At cost of capital rate. So after 3 years, you are going to get 20,124 cash inflow, Amma. But what is its present value? So while converting your terminal cash inflows into present values, now this you have to use a cost of capital rate. So the present value of terminal cash inflows 13,242, from which deduct the present value of cash outflows. How much you are investing, Amma? 10,000. So your modified NPV 3,242. Since modified NPV is positive, it is advisable to accept the project. Clear, sir? That is how you need to find out the modified NPV, the terminal value. Next. After that, modified IRR. So now what is the need of finding out modified IRR? Actually, under traditional IRR method, there are some drawbacks, Amma. The drawbacks are, number 1, there is a concept called multiple IRRs. Multiple IRRs. And that means, I've already told you that if I give the data to 10 people, the same data for the 10 people for the calculation of IRR, 10 people will come up with a 10 different IRRs. Right? So that traditional IRR method, there is a problem. Multiple IRRs will be there, and it is not easy to select what is the correct IRR. That's the first main problem under traditional IRR method. And the second problem is, reinvestment rate issues. The second problem is reinvestment rate issues. While we are calculating the traditional IRR, we have taken some assumptions. Number 1, all the cash inflows given in the problem are assumed to be certain. Number 2, all the cash inflows are assumed to be occurred at the end of the every year. And number 3, all the cash inflows are assumed to be reinvested at IRR rate of return. The third assumption is not logical, not practical. See, whatever the cash inflows you are getting, you're not putting them idle, you are going to reinvest them. What is your assumptions here? You are going to reinvestment them at the same rate as your project giving. Your project giving 25% rate of return, sir. Now, what are the cash flows generating from that project? If I reinvest this cash flows into the open market, now on this reinvestment also, I'm get same 25% rate of return. That's the assumption. The third assumption meaning the cash inflows are assumed to be reinvested at IRR rate of return. సార్ ఈ ప్రాజెక్ట్ లో నీకు ఎంత రిటర్న్ అయితే వస్తుందో ఈ ప్రాజెక్ట్ ద్వారా వచ్చిన క్యాష్ ఫ్లోస్ కూడా తీసుకెళ్ళి నేను బయట ఇన్వెస్ట్ చేస్తే నాకు అంతే రిటర్న్ వస్తుంది అనేది ఎంతవరకు ప్రాక్టికల్? ఇట్స్ నాట్ దట్ ప్రాక్టికల్. You may get more than the 25% rate of return. You may get less than 25% rate of return. Yes or no? So reinvestment rate issues. These are the major two drawbacks under traditional IRR method. By overcoming these two major drawbacks, we have come up with a concept called modified IRR. In modified IRR method, these two drawbacks have been overcome. Now, how to calculate modified IRR? It is similar to the calculation of modified NPV. First, you have to find out the terminal value. Same manner, years, the cash inflows, how many years we are going to reinvest them, and all these cash inflows bring into the future value. Find out the terminal value, Amma. So in Y0, you have a cash outflow, and in Y5, the life of the project is here 5 years. End of the 5 year, you have a cash inflow of 2,13,587. So you know the present value, you know the future value, you know the number of years. Find out the IRR. Either you can adopt here future value of single amount model, or you can adopt here is present value of single amount model, and then find out the IRR. You know present value, you know future value, you know number of years. What is missing, Amma? Rate of interest is missing. That is your IRR. Clear, sir? So here modified IRR, we find out 9%. Clear? That is how you need to find out modified IRR. Okay, ma. So with this, we have completed all the models in this chapter, sir. Right? And that block of assets concept is similar to section number 32 of Income Tax Act. Same concept, amma. Right? Like this particular concept plays a role where if the asset is existing in the block, after selling this asset, if there are some other assets are existing in the block, you have to calculate the depreciation for the entire life of the asset. Like I'll tell you, sir. Here I'll show you block of assets and depreciation. In the problem number 9, you can see there is an asset. Yeah, look at this provision. There is no other asset in the same block of assets. After selling this asset, the model number 1 or model number 2, right? After selling this asset, there are no other assets left in the block. And as we know that we need to calculate the depreciation on satisfaction of two conditions. Number 1, there must be at least one asset in the block. Number 2, there must be some value for the block. Here, you're going to have value in the block, but there are no assets. So you have to calculate the depreciation from year 1 to year 4 only. The life is given 5 years. Only from year 1 to year 4, you have to calculate the depreciation. For year 5, the depreciation should not be calculated. Calculate cheyyodamma. Endukante asset ledhuga block lo. There are no assets in the block. So you're not eligible for depreciation in the year 5. Right, sir? Now look at the problem number 10. There are several assets in the same block of assets. Ante, after selling the plant and machinery in the question, you have many more assets in the same block. So the life is given 6 years, amma. So from year 1 to year 6, you can eligible for depreciation. You can claim depreciation. So that's the only impact in this problem, amma. Clear? Right. So with this, we have completed the marathon for chapter number 7, advanced concepts in investment decisions. In the next session, I'm going to start with the chapter number 8, risk analysis in capital budgeting decisions. Okay, ma? Right. Till then, have a good day and good night. Stay home and stay safe. A very good evening, students. Welcome to the Shrestha FM marathon classes. In the last class, we have completed our discussion about the chapter number 7, that is advanced concepts in investment decisions. Right, ma? Now, time for the chapter number 8, risk analysis in capital budgeting decisions. So this is nothing but the part 3 of investment decisions chapter. In the part 1, that is chapter number 2, we have discussed the basic concepts, fundamentals. Part 2, that is chapter number 7, advanced concepts in investment decisions. And part 3, risk analysis in capital budgeting decisions. All these are belonging to same chapter, investment decisions. First part, we have learned fundamentals. Second part, we have learned advanced concepts. And third part, we are going to learn risk analysis in capital budgeting decisions. Right, sir? Now, what is this risk analysis in capital budgeting decision? Let us have some introduction. Sir, basically, whatever the project evaluation techniques we have learned in the first part, investment decisions, like we have learned the project evaluation techniques like ARR, payback period method. These are comes under the traditional techniques, right, Ma? And when it comes to discounting techniques, we have learned like NPV, IRR, profitability index method, terminal value method, and discounted payback period method. All these project evaluation techniques are based on some assumptions. See, out of all these project evaluation techniques, the major technique which we are used is NPV. Net present value method is the most widely used project evaluation technique. And if you remember, NPV calculation is purely based on 3 assumptions. Number 1, all the cash flows given in the problem are assumed to be certain. Number 2, all the cash flows given in the problem are assumed to be occurred at the end of each year. And number 3, all the cash flows given in the problem are assumed to be reinvested at cost of capital rate. These are the 3 assumptions. Yes or no? By taking these 3 assumptions only, we are calculated NPV, and based on that NPV, we have made some decision. Without taking these assumptions, you cannot calculate NPV, sir. These 3 assumptions are compulsorily you have to take for the calculation of NPV. Yes or no? Right? So these assumptions we have taken only for the purpose of our convenience. Only for the purpose of convenience. For easy understanding of the project evaluation techniques. For easy understanding. Easy understanding of the project evaluation techniques, we have taken this assumption. Based on these assumptions, we have calculated NPV. Based on the NPV, we have made a decision. In order to understanding the concept of project evaluation techniques, we have taken some assumptions. Based on that assumptions, we have calculated NPV, IRR, payback period like that. Yes or no? But when you're thinking from a real-time point of view, right, in a real-time world, whether these assumptions holds good? Answer is no. What is the first assumption, ma? All the cash flows given in the problem are assumed to be certain. So whatever the cash flows I am taking for the calculation of NPV, all they are estimated cash flows. Estimated. For year 1, I've estimated that my cash flow will be 1 lakh. For year 2, 1,50,000. For year 3, 2 lakhs. These are all estimated cash flows, amma. Are you following, sir? And estimations may go wrong. There is always a scope for wrong estimation. For year 1, you have estimated 1 lakh, but end of the year 1 in a real-time scenario, after the completion of the 1 year, you might ended up getting cash inflow of 1,50,000, 1,80,000, 2,50,000, but you have estimated only 1 lakh, or sometimes you may get less than 1 lakh. Yes or no? Right? Second assumption, all the cash flows are assumed to be occurred at the end of the year. In a real-time world, whether this assumption holds good, amma? Absolutely no, sir. Because whenever you're doing business, every day there is some cash inflow, there is some cash outflow. How come you expect all your cash inflows and cash outflows are at the end of the year? Suppose that in the year 1, you got some 3,65,000 amount. And when are you getting that 3,65,000? NPV said from day 1 to day 365, from day 1 to day 365, sorry, day 364, my cash flows are 0. Whatever the cash inflows I'm getting only on the last day of the year. Is that possible in the real day world? Every day there are some cash inflows. Yes or no? So the second assumption not holds good. Reinvestment at the cost of capital rate. You may reinvest at cost of capital rate or you may not. So all these assumptions doesn't hold good in a real time scenario. And that means whatever the NPV you calculated by taking this assumption, by that NPV you may ended up by taking a right decision, or there is a possibility that you may ended up by taking a wrong decision. Suppose that by taking these assumptions, you've calculated NPV, you got a positive NPV of some 1 lakh. Since the NPV is positive, you may ended up by taking the decision that, okay, since the NPV is positive, accept the project. But this NPV 1 lakh is purely based on these assumptions. Are you following, sir? So at the end of the 1 year or at the end of the life of the project, in a real time scenario, you might be having a positive NPV of 1 lakh or you might not. Are you following, sir? So there is a certain element of risk involving in the investment decisions, and that risk we are going to be measured in this chapter. And why the risk comes into picture, Amma? Because whatever the decision making you are taking by using the NPV or IRR, all that decision makings are purely depends upon some assumptions, projections, estimations, right? These are all for your future. Future by definition, it is uncertain. Uncertainty gives rise to risk, and that risk we are going to measure here. Are you following or not? Look at the introduction part, Amma. Look at the introduction part here. Right. In capital budgeting techniques, we assumed that the investment proposals do not involve any risk, and cash flows of the project are known with certainty. This assumption was taken to simplify the understanding of the capital budgeting techniques. The assumptions we have taken only to understand, easily understanding the capital budgeting techniques. However, in practice, this assumption is not correct. In fact, investment projects are exposed to various degrees and types of risks. Right, there are various risks, some internal risk, external risk, market specific risk, product specific risk, industry specific risks. There are, whenever you're going to make an investment decision, see, by taking this assumption, calculation of NPV is hardly a matter of 15 minutes, 20 minutes. And within 20 minutes, you can take a decision. But in a real time scenario now, for an investment decision, financial manager will take a minimum of 1 month time. 1 month time, 30 days, 30 working days I'm talking about. Right, here you are doing NPV decision within 30 minutes. Calculating NPV by taking assumption, within 30 minutes you are getting an NPV answer. Basing on that answer, you are making a decision. This is completely different. Theory is completely different from practice. Right, sir? Your theoretical knowledge will help you only up to a certain extent in the practical world. Practical knowledge is completely different, Amma. See, I am teaching financial management since 11 years. But right now I'm working in a government undertaking, right, where I'm observing, I'm looking at the financial management is in a complete different scenario here. So whatever I'm teaching financial management is completely different from whatever I'm experiencing in my company. Are you following? This theoretical FM knowledge is helpful, but only to certain extent in the practical world. Every one of you following now? Right, sir? Now, so risk and uncertainty. A decision to take up or leave out a project depends upon taking up or leave up a project depends upon the expectations of the future cash flows from the project. And such expectations are purely based on the information that is currently available with us. The future by definition is uncertain. The cash flows when they occur are likely to be differed from what we were expected. We were expected year one cash flow 1 lakh, but end of the year one in a real time scenario, you might getting some 80,000 or 70,000. Are you following, sir? Or you might get more than 1 lakh as well. See, if you get more than 1 lakh, very happy. Anyhow, you estimated 1 lakh, you got more than 1 lakh, happy, sir. But you expected 1 lakh, but you got only 70,000. Then there is a problem. Clear. So the uncertainty about the future cash flows gives rise to risk. Clear, sir. But however, the risk and uncertainty is not the same, because risk can be measured. There are some techniques, there are some theorems for analyzing the risk, for measuring the risk, but there is no theorems, no logics, no concepts for measuring the uncertainty. So risk can be measured, but uncertainty cannot be measured. Clear, sir. And how we are going to make that analysis of the risk, right? And how we are going to be overcome that risk element, all this we are going to be learned in this chapter. Okay, now, so risk analysis in the capital budgeting techniques, where it is. Yeah. So we have different methods for analyzing the risk, right? They are like, number one, conventional techniques we have, where we are going to have the first one, RADR, risk adjusted discounting rate. RADR stands for risk adjusted discounting rate. And number two, CEF, certainty equivalent factors. Certainty equivalent factors. And coming to the statistical techniques, right? Here we are going to find out the expected NPV. And statistical techniques, we are going to have probability distribution, variance and standard deviation, and coefficient of variation. These are all just like the concepts which you have learned in your subject called statistics at your CPT level, at your CA foundation level. In your CA foundation, you have a subject called statistics. In that subject, you might have learned already all this: probability, variance, standard deviation, coefficient of variance, same concepts, nothing more than that. Clear. And other techniques, actually, frankly speaking, these techniques are purely for CA final level. CA final level topics, right? In CA final level, you are going to learn SFM, strategic and financial management. Strategic and financial management, SFM, 100 mark subject, where you are going to have all these topics once again, but in a depth manner. Here, sensitivity analysis, scenario analysis, simulation, decision trees, very introductory level. Now, among all these, now, sensitive analysis is important. Remaining all the three, you can blindly ignore. Scenario analysis, simulation, decision trees, you can blindly ignore for examination purposes. Concentrate only on sensitivity analysis. That's it. Frankly speaking, sir, from this chapter, you will get one question for 5 marks only, 5 marks. And mostly the questions are from either from RADR or CEF factor or the statistical techniques. Are you following, sir? Right. See, the majority of the problems I have mentioned here are only from these two topics. In total, in this chapter, we are going to have the problems. How many problems we are going to have, ma? 14 problems. We have 14 problems from this chapter. Out of 14 problems, you can see the first model here. We are going to see the statistical techniques. Probability and expected cash flow, statistical techniques, and then expected NPV, also forming part of statistical techniques. Standard deviation, variance, coefficient of variance, statistical techniques only, right? You can see 8 problems from the statistical techniques, 8 problems. Clear. And risk adjusted discounting rate method, model number 4, traditional techniques, maybe. Certainty equivalent factor, again, traditional techniques, model number 5. You can see here 12 problems only from the first 2 topics. Only from the first 2 topics. Traditional techniques, 4 problems, and statistical techniques, 8 problems, 12 problems out of 14 problems. So the remaining 2 problems, I've given under sensitivity analysis. Sensitivity analysis, problem number 13, scenario analysis, problem number 14. That's it, end of the chapter. I have not even given the problems for simulation and a decision trees because they are not important from examination point of view. Are you following, sir? So whenever you're preparing this chapter, just focus only on the first 2 models. Conventional techniques, where we have 4 problems, and statistical techniques, we have 8 problems. Out of 14 problems, 12 problems only from these 2 topics. Clear now, every one of you, right? Now, moving on. So first, let us see one by one the models. The first model is about the probability and expected cash flow. Very simple, sir. You know very well about the probability, right? Probability is the chance of occurrence or non-occurrence of an outcome. If you toss a coin, there is 50% probability that you're going to get heads and 50% probability that you're going to get tail. Only two possible outcomes. So 1 by 2, 1 by 2. Clear? If you throw a dice, there is 1 by 6 chances are there to get the answer either 1, 2, 3, 4, 5, 6. If you throw a dice, 1 by 6 chance outcome, 6 outcomes are there. No. So 1 by 6. That is what the probability is. Clear? So the aggregate of all the probables, when you aggregate all the probables, no, it must be equal to 1. Clear? For example, if there is a 70% chance that there is a rain today, that means the remaining 30% what, there is no rain today. So when you said 70% chances are there, yes, there is a rain today. That means the remaining 30% what, no rain. Clear? Okay, now. So probability distribution, very simple, sir. You get the problem number 1. You are given the best assumption, best guess, high guess, and low guess, and cash flows associated with that particular guesses and their probabilities. And you asked to find out the expected cash flows. Very simple, sir. Cash flow into probability. That's it. 3 lakhs into 0.3. It will get how much you are getting, sir? 90,000. 2 lakhs into 0.6. 1,20,000. 1,20,000 into 0.1. 12,000. The total comes out to be 2,10,000, 2,22,000. That's the end of the answer. 2,20,000 expected net cash flows. And look at here, problem number 2. Find out the expected investment. You are given the investments and probabilities. 30 lakhs into, 30 lakhs into 0.25. It will give you how much? 7.5 lakhs. Yes, 7.5 lakhs. And 40 lakhs into 0.5 means 20 lakhs. 50 lakhs into 0.25, 12.5 lakhs. 27.5 plus 12.5. So 40 lakhs. The expected investment 40 lakhs. End of the answer. So like this, you need to calculate, sir. Like this, you need to calculate. Now, this is the first model, right? Now, coming to the second model, expected NPV. Expected NPV. Now, here, how to calculate expected NPV? I've given the procedure for every model, sir, right? Look at here. Step number 1, find out the expected cash flows. Find out the expected cash flows. That means cash flow into respective probability, just like we have did in the problem number 1. అదే కదమ్మా మన ప్రాబ్లం 1 లో చేసింది. Cash flows into probability, whatever the answer you are getting here, this is expected cash flow, na? Right? That's your step number 1. Step number 2, find out the present values of expected cash flows. Once you get the expected cash flows, na, multiplied with the present value factor, you will get the present value of expected cash flows. Step 3, find out the expected NPV. From the present value of expected cash flows, deduct the investment. Right? So what is NPV formula, sir? NPV is equal to present value of cash inflows minus present value of cash outflows. Ante kadamma. This will give you NPV. That's it. Clear? See, normal NPV, expected NPV, the only difference is under expected NPV, first we are converting the cash flows, right? We are finding out the expected cash flows by using the probability factors. Expected cash flows. Like, look at this problem number 4. Let me show you the answer further. Problem number 4. Problem number 4. Yes, look at here. This is a problem number 4. Right. So problem number 4, you can see project A, project B, 2 projects information is given and the possible events, respect to cash flows and probabilities. Clear? And the discounting rate given 10%. Present value of investment, initial investment 10,000 rupees. Now, first, you need to find out the present value of cash inflow. Ela cheyalama? Simple. Expected cash flows into probability. That's it. So 8,000 into 0.1. It will give you 800, 10,000 into 0.2, 2,000, 12,000 into 0.4, 4,800, 14,000 into 0.2, 2,800, and 16,000 into 0.1, 1,600. You'll get expected cash flows. How much you're getting? ₹12,000 expected cash inflows. 12,000 rupees. And this you're going to get at the end of the first year. You can see here, first I find out the expected cash flows. Step number 1. I find out the expected cash flows. How much I got about 12,000. Just now I said no 12,000. And then I'm converting that present value, converting this 12,000 because this 12,000 I'm getting epudama at the end of the first year. But I want present value of cash inflows. So multiply it with the first year present value factor at 10% 1 year. So 12,000 into 0.909, 10,909. This is my present value of expected cash inflows. This is my what am I? Present value of expected cash inflows. 10,908 minus present value of cash outflows. What is the initial investment given? 10,000. So my expected NPV 908 rupees. And same as for the project B. First, find out the expected cash inflows, then find out the present value of expected cash inflows, and finally the expected NPV. Expected NPV. Clear, everyone? That's how you need to find out the expected NPV. Now, next, after that, standard deviation, variance, and coefficient of variance. Standard deviation, variance, and coefficient of variance. Standard deviation, right, sir? Let me explain you with the help of the notes. Right. Look at the concept of standard deviation. You might have already learned in your CA foundation level, CA CPT level. Suppose that I've expected the cash flows like this. Years, cash flows, year 1, 2, 3. So year 1, I've expected 1 lakh, year 2, 1,50,000, and year 3, 2 lakhs. These are the cash flows I've expected, sir. Right. Now, first, you need to find out the mean for these cash flows, 4,50,000. So means comes out to be 4,50,000 divided by 3. It comes out to be 1,50,000. Right, sir. Now you have to find out the deviation from the mean. What is the mean we find out, sir? We find out 1.5 lakhs. Right, sir. You need to find out the deviation for this. Right. So year 1, you expected 1 lakh cash inflow. And the mean cash inflows comes out to be 1,50,000. The deviation is negative 50,000. Year 2, 0, and year 3, positive 50,000. And then after that, you need to find out the deviation square. Then this deviation square should be multiplied with the probabilities. You will get the PD square. Right, sir. And after that, you will be having a formula for the calculation of standard deviation. See, first of all, theoretical understand the concept. What is deviation? You have estimated 1 lakh, but you got only 80,000 rupees cash flows. In year 1, you estimated a cash flow of 1 lakh, but you actually got 80,000 only. So there is a deviation of 20,000 rupees. Right, sir. Standard deviation. Deviation. What you actually expected, what you actually got. That deviation between these two cash flows. Yes or no? Obviously, all these are estimations, Amma. Whatever you estimate, taken the cash flows here, they are estimated. So there is always a deviation from the expected cash flows, and that deviation we are finding out here. Look at here. Project cash flows are forecasts, and forecasts cannot be accurate because we are not God, right? We are just human beings. Clear. And there can be a margin of error. The risk associated with the project can be expressed as the extent to which the actual value of outcome will differ or deviate from the expected value, right? The extent, up to which extent the actual value is deviated from the expected value. Clear. And the risk is measured here is what we call standard deviation. This risk is measured with the help of a statistical tool known as standard deviation. Standard deviation is nothing but the standardized unit of deviation From what? From mean. That is why first I've calculated mean here. From mean, what is the deviation that I've calculated? Are you following or not? Every one of you. Completed, right? Next. So the standard deviation is a standard unit of deviation from mean, and this measure is denoted by the symbol sigma. Symbol sigma. And the square of standard deviation is known as variance. Square root of standard deviation. That will be your variance. Higher the standard deviation means higher will be the risk involved in the project. So whenever the deviation is higher, yes, you estimated 1 lakh in the year 1, but you actually got only 20,000. The deviation is very huge and the risk is very higher. Suppose that you estimated 1 lakh, but end of the year 1, you actually got 90,000. And from your estimation, there is a deviation of hardly 10% only. Okay, acceptable. 10% deviation is quite acceptable, sir. But here the deviation is almost 80%, which cannot be acceptable. That means the risk is very huge. So that is why higher the standard deviation, higher will be the risk. Lower the standard deviation, lower will be the risk. Okay, now next, how to compute the standard deviation? Look at the procedure, sir. Step number 1, compute the expected value. That means you just take out the cash flows given in the problem, multiply it with the probabilities, you will get the expected cash flows, and compute the deviation from the expected value. Find out the deviation, then aggregate the result of step number 2, total chain number, and this resultant is known as your variance. And find out the sigma. How to find out square root of variance is your standard deviation. Square root of variance. Like let me show you a problem here. This is a problem number 6. Possible events and cash flows. First, multiply the cash flows. Multiply the cash flows with your probabilities. You just multiply. You will get the expected cash flows. Right, sir? Expected cash flows, and you just aggregate it, total it. That will be your mean, and find out the deviation. Right, sir? So 8,000 minus 12,000 minus 4,000 is the deviation. 10,000 minus 12,000 minus 2,000 is the deviation. Like that, find out the deviation. Then find out the square of the deviation. Square of the deviation, and then multiply the square of deviation with the probabilities. PD square. This is your standard deviation. Sorry, this is your variance. Variance for 48 lakhs, and we know that standard deviation is equal to square root of variance. Right, square root of variance. Standard deviation square is variance, amma. Don't confuse. Variance is equal to standard deviation square. PD square, standard deviation square. Clear? And now, if you want to find out the standard deviation, the square root will come this side. Square root it vachese emotundamma. Right. So that is why standard deviation is equal to square root of variance. Clear? Okay, now, right. So find out the standard deviation, then finally coefficient of variance. Coefficient of variance, standard deviation divided by expected cash flows. Standard deviation divided by expected cash flows. In the problem, if you have the information of expected NPV, standard deviation divided by expected NPV. Clear, everyone? Every one of you. Next. So like that, find out the coefficient of variance. Clear? You can see here. Coefficient of variance. The formula you can see here. Standard deviation divided by expected return or expected cash flows. Higher the coefficient of variance, higher will be the risk involved in the project. Because see, when your deviation is higher, means when your standard deviation is higher, your coefficient of variance will also be higher, sir. Because the standard deviation is the numerator. No, when your numerator is higher, obviously the answer will be, the coefficient of variance will also be higher. Means the risk is very high. Clear? Right? See, the coefficient of variance calculate the risk borne by every % of the expected return. Standard deviation explains about the risk of the whole project. The entire project risk is measured by standard deviation, project as a whole. But coefficient of variance calculates the risk associated with every % of your return. Clear, ma? Next. And after that, you have model number 4. So with that, we have completed the statistical techniques. Statistical techniques completed, Amma. Now time for the conventional techniques, risk adjusted rate of return, risk adjusted discounting rate. Clear. Now, what is this concept of risk adjusted discounting rate? Very simple, sir. See, whatever the assumption number 3 we have taken, no, all the cash inflows given in the problem are assumed to be reinvested at cost of capital. Yes or no? See, this is purely based on here in this particular concept, we are going to measure the risk involving in the reinvestment rate. The risk involving in the reinvestment rate. Are you following, sir? Just a second. So in this model, we are going to analyze the risk involving in the reinvestment rate. Clear, sir? So what is the reinvestment rate we are taking here? Cost of capital. Cost of capital. Clear. So assume that your cost of capital is 10%. So that means whatever the cash inflows you are going to get, all that cash inflows are going to be reinvested at 10% rate of interest. But in the real time world, you may get more than 10% or you may get less than 10% returns. Exactly a 10% of say and a guarantee. There is no guarantee that your project cash inflows, if reinvested, will fetch you 10% rate of return. There is no guarantee. You may get more than 10% or you may get less than 10%. So there is certain risk involving in this particular reinvestment rate, and that risk we are measuring here with the help of the concept called risk adjusted discounting rate. We are going to adjust the risk element to this discounting rate. Clear, sir? Every one of you, right? Now, how to adjust that risk? Look at here. The discount rates in capital budgeting represents the expected rate of return from the project. Projects with higher risk are generally expected to provide a higher return, and projects with relatively lower risk expected to provide a lower rate of return. So consequently, all the projects should not be discounted at the same rates. High risky projects should be discounted at the high rate. Low risky projects should be discounted at the low rates. Clear, sir? So Kabaddi, not all the projects having the same risk return characteristics. Not all the projects cash flows should be discounted at the same rate. Clear? So normally the company's cost of capital. So hence the cutoff discount rate should be adjusted towards upwards or downwards to take care of the additional or lower risk element. And this is referred to as a risk adjusted discounting rate. So first, step number 1, identify the cash flows. Step number 2, compute the RADR, risk adjusted discounting rate. How to find out, Amma? For your cost of capital, add or less premium for risk. Risk premium will be given in the problem, Amma. Risk premium problem like you simply add that cost of capital, add to the cost of capital or less to the cost of capital. That will give you the risk adjusted discounting rate, and discount that cash flows at RADR and find out the NPV. If NPV is positive, accept the project. Otherwise, reject the project. Are you following, sir? Every one of you. Look at here. The formula is a risk adjusted discounting rate is equal to cost of capital plus or minus risk premium. Look at the problem number 9. INVST Corporation Limited adjusts the risk through discounting rates by adding various risk premiums. To the risk-free rate. You will be given risk-free rate, Amma, for which you need to add the risk premiums. Thereby, you will get a risk-adjusted discounting rate. For low risky projects, it will be 12%. For medium risky project, it will be 15%. And for high risky projects, it will be 18%. Clear. Now you are going to discount the cash flows at this rate, Amma. And then you will find out the NPV. Now, whatever the NPV you are finding out, that is what we call risk-adjusted NPV. And based on that risk-adjusted NPV, you have to make a decision. Clear, sir? Look at here. In the step number 1, I find out the RADR 12%, 15%, 18%. Then I find out the risk-adjusted NPV. For low risky projects, I've discounted the cash flows at 12%. For medium risk at 15% and for high risk at 18%. I find out the NPV, sir. And here you have a positive NPV only at the low risky projects. Clear? Every one of you. And next. So like that, you need to make a, you need to find out the risk adjusted NPV, risk adjusted discounting rate. And next, model number 5, the second model of conventional techniques. Second model of conventional techniques, that is certainty equivalent factors method, CEF. Certainty equivalent factors method. Now look at here. Yeah, model number 5, CEF method. In this method, we are going to analyze the risk involving in the cash flows. The risk involved in the cash flows. See, what are the cash flows we have taken for calculating NPV or IRR? They are purely estimated cash flows, expected cash flows. Clear, sir? So here I've given one example. Year 1, the cash flows I have estimated 1,50,000. Year 2, 2 lakhs, and year 3, 1,80,000. They are uncertain. First of all, you have to convert the uncertain cash flows into certain cash flows by multiplying that uncertain cash flows with certainty equivalent factors. So how certain that cash flows are? Okay, for year 1, you estimated 1,50,000 as your cash flow. But how certain you are? Are you 100% confident? 100% not sure, sir, but 90%. Okay, that means 1,50,000 you have estimated for year 1, but you are not 100% sure. You have sure 90% only. Okay, so that means for year 1, I can say 1,35,000 are certain cash flows for year 1. Okay, year 2, what is your estimated cash flow? 2 lakhs, sir. I'm expecting 2 lakhs cash inflow for year 2. How sure you are? 100%? No, sir. Okay, 90%? No, sir. 80%? Oh, okay. 80% I'm guaranteed, sir. That means for second year, the certain cash flows are 1,60,000. 2 lakhs uncertain cash flows, risky cash flows. 1,60,000 risk-free cash flows. Are you following? Risk-free cash flows. So like that, every year you have to find out the certain cash flows, risk-free cash flows, and how you are getting by multiplying uncertain cash flows with certainty equivalent factors. You are getting risk-free cash flows or certain cash flows. Now, based on that certain cash flows, you have to find out the NPV. Since these cash inflows are risk-free cash inflows, you have to discount these cash inflows at risk-free rate of return. RF, risk-free rate of return. Finding out now, then you will get what? Risk-free present value of cash inflows, from which you have to deduct the present value of cash outflows. Then you will get risk-adjusted NPV. If that NPV is positive, accept the project. NPV is negative, reject the project. Look at here. Certainty equivalent method. Certainty equivalent factor is the ratio of assured cash flows to uncertain cash flows. Under this approach, the cash flows are expected in a project are converted into riskless equivalent amounts. So we are finding what are risk-free cash flows. The adjustment factor we are using here is called as a certainty equivalent coefficient factor. Clear, right? So this varies between 0 to 1. Always your CEF factors always varies between 0 to 1. Clear. A coefficient of 1 indicates that the cash flows are certain, 100% guaranteed. Clear. The greater the risk in a cash flow, the smaller will be the CEF factor. Clear. Risk ఎక్కువ ఉంటే నీకు CEF factor lower గా ఉంటదమ్మా. Risk తక్కువ ఉంటే నీకు CEF factor higher గా ఉంటది. Every one of you following now? Right, sir. Next. Since the risk involved in the cash flows are already incorporated, the appropriate discounting rate for the project evaluation will be the risk-free rate. Clear? So how to find out the NPV here? Number 1, convert your uncertain cash flows to certain cash flows. Ella, by multiplying with certainty equivalent factor. Step 2, discount the certain cash flows at risk-free rate of interest to arrive at the NPV. Step 3, decision. If the resultant NPV is positive, accept the project. Otherwise, reject the project. Otherwise, reject the project. As simple as that. Look at one problem here. Problem number 11. First, what I've done, sir? First, I've taken the uncertain cash flows. I'm multiplying this uncertain cash flows with certainty equivalent factor. Then I will get what? certain cash flows. And after that, the certain cash flows multiplying with what, sir? Multiplying with the risk-free rate of interest. At risk-free rate of interest, I'm taking present value factors. Now, with the help of present value factors, I'm converting certain cash flows into present value of certain cash flows. Then I'll get present value of cash inflows minus present value of cash outflows. Then I'll get a risk-adjusted NPV. Are you following or not? That is the procedure. Clear? Next, after that, you have sensitivity analysis, right, sir? So this is a CA final level topic. But don't worry, I'll explain here, sir. I'll explain here what is sensitivity analysis. Clear? Though it is a final level topic, in the main exams at CA interlevel, the probability of getting a question from this topic, I can say hardly 10% from the sensitivity analysis, because it is a very lengthy concept and the answer will also be very lengthy. Answer kuda chala lengthy untadamma. Now first, let me try to understand you the concept of sensitivity analysis. Yeah, sensitivity analysis. Now, so far, whatever the techniques we have learned, like risk-adjusted discounting rate method we have learned. Risk-adjusted discounting rate method is going to measure the risk involving only in the discounting rate. Right? Only the risk involving in the discounting rate. That's it. And certainty equivalent factor method is going to analyze the risk involving in the cash flows only. That's it. And standard deviation, coefficient of variance, all these are mainly concentrating only one factor, one component. Right, sir? But NPV is not purely depending upon one component. NPV is not depending upon only on cost of capital. NPV is not depending upon only on cash flows. NPV is depending upon so many components, like sales in units, selling price per unit, variable cost, fixed cost, cost of capital, life of the project, cash flows. All these influences your NPV. Not only cost of capital, not only cash flows. All these components influences your NPV. Clear, sir? Right. In risk-adjusted discounting rate method, you have analyzed only the risk involving in cost of capital. But what about the other components? You just simply ignore the risk involved in the other components. Right. Similarly, certainty equivalent cash flows method, you have concentrated only on the risk involving in the cash flows. What about the other components? Right. So that's why now, for analyzing the consolidated risk involving in all the components which influences NPV, we come up with a concept called the sensitivity analysis. Under sensitivity analysis, we can analyze the risk involving in the each and every component which influences NPV. NPV ni influence చేసే ప్రతి కాంపోనెంట్ లో ఉన్న రిస్క్ ని మనం కంబైన్డ్ గా కన్సాలిడేటెడ్ గా అనాలిసిస్ చేయొచ్చు. ఎక్కడ? సెన్సిటివిటీ అనాలిసిస్ మోడల్లో. That's the beauty of sensitivity analysis. We can combinedly analyze the risk involving in the each and every component which influences NPV. Are you following, sir? How we are going to be like, look at here, sir. Your estimated sales in units, 1 lakh units. At that estimated sales in units, your NPV is 5 lakhs. Your estimated NPV is 5 lakhs. But end of the year, you got only 80,000 units sales. You able to sold only 80,000 units. Or else take like this, at 80,000 units, your NPV becomes 0. Right, sir? At 80,000 units. At 1 lakh units, you have a positive NPV of 5 lakhs. Just a second, sir. So at 80,000 units of sales, your NPV is going to be 0. And that means how sensitive your sales in units component to the NPV. So from 1 lakh units to 80,000 units. At 1 lakh units, your NPV is 5 lakhs. At 80,000 units, your NPV is 0. And if your sales are decreased by 20,000 units, your NPV decreased by 5 lakhs. Right. So sensitivity analysis, చూడండి. if 20,000 decrease in sales from the base of 1 lakh, ante 20%. If sales decreases by 20%, you will be in danger. You will be in danger. Right, sir? If sales decreases by 10%, no problem. You will be having still a positive NPV. You will be having still a positive NPV. If sales decreases by 15%, no problem. You're still in a positive NPV. But if sales decreases by 25%, yes, you are going to face a negative NPV. And by calculating this sensitivity 20%, what you are going to get? See, whenever you are making estimations now, you have to maintain a reasonable buffer. Suppose that you are estimating your sales in units for the year one, some 1,20,000 units you are estimating. But for calculation of NPV, now take only 1 lakh. Consider only 1 lakh units you are going to sell in the year one. Don't 1,20,000. Don't take 1,20,000. Maintain a reasonable buffer, because you estimated 1,20,000. You calculated NPV at 1,20,000. You got a positive NPV. You accepted the project. You started working on your project. But end of the year one, suppose that you are able to sell only 90,000 units, only 1 lakh units, and your estimation goes wrong. Your positive project NPV becomes a negative project NPV. Now you cannot reject the project at the end of the year one. You have already taken. This is investment decision, which will be having an impact over the longer period. You cannot deny the project at the end of the first year or second year. Once a project is taken, now it will be for 10 years or 20 years like that. Are you following or not? Right, sir? So your estimation goes wrong. You're going to face the negative NPV. You are going to face the losses, and you cannot avoid this project. If you avoid this project, you have to face huge amount of losses, which may end up your business. Are you following, sir? So that's why, even though you estimated 1,20,000, but take only 1 lakh for the NPV calculation. Maintain a reasonable buffer. Are you following, sir? Now, look at here, selling price per unit. You have estimated your product is going to be sell in the open market at 100 rupees. You're believing that, yes, the customer is ready to purchase my product at 100 rupees. But suppose that in the real market, if the customer is not interested in purchasing 100 rupees, he would like to purchase only at 90 rupees. Then, so that's why, even though your estimation is 100 rupees per unit, for the calculation of NPV, take only 90 rupees per unit. Maintain a reasonable buffer. Clear? Sir, how much buffer should be taken? That's why you need to find out the sensitivity percentage first. So first you have to find out at what rate of selling price per unit my NPV is going to be 0. So you find out that at 90 rupees per unit, your NPV becomes 0. Ante, okay, I need to maintain a buffer of 10%. And even if my selling price per unit reduces by 10%, still my NPV is 0. And I'm at break-even point level, no profit, no loss situation. Are you following now? Clear, sir? Right? So you need to maintain a reasonable buffer of 10%. Clear, everyone? Right? And from comparison point of view, I can take from the sales in units, you have a sensitivity of 20%, and selling price per unit, you have a sensitivity of 10%. And in the sales in units, you have a buffer of 20%. Even if your estimated sales in units reduces by 10%, 15%, 20%, you are still in a safe position. And you have a large buffer. But whereas selling price per unit, you have a buffer of only 10%. And if your selling price per unit reduces by 10%, you are in safe position. But if you are still, your selling price per unit decreases by 15%, 20%, then you have to be face the losses. That's why higher the sensitivity, lower will be the risk. Higher the sensitivity meaning higher will be the buffer. Lower the sensitivity, higher will be the risk, because the lower will be the buffer. And then buffer chal takundamma. You estimated key, the actual key, if the gap is more than 10% here, you are facing losses. But here, your estimation and actual, if the gap is more than 20%, then only you are going to face the loss. Estimate chesin daniki actual key డిఫరెన్స్ అనేది మోర్ దాన్ 20% ఉంటేనే ఇక్కడ నువ్వు లాస్ ఫేస్ చేస్తావు. బట్ ఇక్కడ మోర్ దాన్ 10% ఉంటే నువ్వు లాస్ ఫేస్ చేయడానికి రెడీగా ఉండాలి. అంటే ఇక్కడ బఫర్ తక్కువ ఉంది. సో లోవర్ ద సెన్సిటివిటీ, లోవర్ విల్ బి ద బఫర్, higher will be the risk. So like that, for every component you have to find out the sensitivity, and based on that sensitivity analysis you have to identify what is the risky factor, risky component, and you have to take care of that risky component. Clear, sir? Let me show you some answer for this. Problem number 13, you have the sensitivity analysis problem, and they are saying that find out the sensitivity analysis like at 2.5% advanced variance in each variable. And what if the sensitivity percentage, if your each and every component decreases by 2.5% from what you expected, Clear, sir? Adverse variance annadu, right? But selling price per chudandamma, you actually estimated 100 rupees undi. Adverse variance ante enti minus 2.5%. Ante you have to find out at 97 rupees 50 pice. At 97 rupees 50 pice, what is your NPV? Your actual NPV is 134.6 amma. But when your selling price per unit reduces to 97 rupees 50 pice, your NPV falls down to 101.19. What is the percentage change in NPV? 24.82%. Ante if your selling price per unit reduces by 2.5%, your NPV reduces by 24.82%. So the maximum impact on selling price per unit amma. So the most sensitive component here is your selling price per unit. You can see here the above table shows that by varying one variable at a time by 2.5% while keeping the others constant, the impact in percentage terms on the NPV of the project. Thus, it can see that the change in selling price has the maximum effect on the NPV by 24.82%. The most sensitive component I can say here, selling price per unit, and the least sensitive component now, this is, what is this, sir? Fixed cost per unit. You have estimated 50 rupees amma, adverse variance annadiga ante 2.5% add cheyandi. So that means your fixed cost comes out to be 51 rupees 25 pice. Your fixed cost increases by 1 rupee 25 pice. And what is its impact on NPV? See here, the normal NPV is 134.6. And when your fixed cost increases by 1 rupee 50 pice, your NPV becomes 131.26. Ante it is having the lowest impact on your NPV, just 2.5%. That's it. So the least sensitive variable is a fixed cost. You need not worry about the increase in fixed cost here, but you have to worry about the decrease in selling price per unit. Neeku ekko buffer ledamma. You 100 rupees estimate chesavu, right? Even if it is reduces by 2.5%, even if your selling price per unit reduces to 97 rupees 50 pice, your NPV reduced by 25% amma. Ardhamautunda every one of you. So this is how the sensitivity analysis works out. Clear, sir? So with this, I am ending up the marathon of chapter number 8, risk analysis in capital budgeting decisions. Okay. The next chapter, I'm going to discuss about the dividend decisions analysis. That will be the last chapter of the FM marathon. I know that I'm skipping ratios analysis, but this is a marathon, sir. Don't expect 100%. Almost out of 10 chapters, I'm covering 9 chapters. And 90% of the syllabus I'm covering. No. Right? If I even cover the ratios analysis, what is the difference between a regular batch and marathon batch? This is not even a crash batch. So don't expect 100%. Okay, Namma. And why I'm skipping ratios analysis, there is a reason behind that, because it's purely based on formulae. Almost 40-50 formulae are there in ratios analysis. Okay, now 40-50 formula explanation itself needed some 5 to 6 hours discussion. In my regular class, no, only for formula explanation I've taken around 8 hours amma. I've started problem number 1 of ratios analysis only in the 9th hour of my regular batch. So that's why I'm not covering in marathon. Okay. So next chapter, dividend decisions analysis, chapter number 9, the last chapter of the FM marathon. Okay. See you in the next session. Till then, have a good day and good night. Stay home and stay safe. A very good morning, students. So welcome to the Shrestha FM Marathon classes. In the last class, we have completed discussion regarding chapter number 8, risk analysis and capital budgeting decisions. Okay, ma. Now time for the chapter number 9, dividend decisions. Dividend decisions analysis. In this chapter, we are going to learn about the various models, right? Like Walters model, Gordon's model, Graham and Dodd, Lintner's approach, Modi-Gilani and Miller approach, M&M approach. So these are the different models which we are going to learn from this chapter, dividend decisions. So look at the running notes. Dividend decisions. The weightage of this chapter is, we can expect one question from this chapter for 5 marks, one problem for 5 marks. And the important concept, Walters model, Gordon's model, and Modigliani and Miller's model. We have plenty of models from this chapter, like I can show you here. Number 1, James Walters model. And number 2, Gordon's model. Number 3, Graham and Dodd approach. Number 4, John Lintner's model. And number 5, Modigliani and Miller's approach. But among these, all the 5 models, the most important models are, I've already listed out, Walters model, Gordon's model, and M&M approach. These 3 models are most important. See, when you are getting a question from dividend decisions analysis now, you will definitely get only from these 3 models, either from Walters model, Gordon's model, or M&M approach. That's it. There is a very less probability to get a question from Graham and Dodd model and Lintner's model. Clear, sir? Everyone. Okay. Now moving on. Introduction. So what is this dividend decisions analysis and what are we going to learn from this chapter? Look at here. Sir, when a particular person doing business and after paying out all his statutory commitments and fixed financial commitments, he left with the profit after tax. Right, sir? So generally, you might have seen the operating profit statement like profits before depreciation and tax. From this, we will deduct the depreciation. We'll get PBT, profits before tax, from which we'll deduct the tax. Then we'll get what, Amma? Profits after tax, PAT, profits after tax. Or else we can also call it as EAT, earnings after tax, like EBIT, earnings before interest and taxes. We can also call it as EBIT first. It starts with earnings before interest and taxes, from which we'll deduct the interest. We'll get EBT, earnings before tax, from which we'll deduct what am tax element. Then we'll get what am EAT, earnings after tax. Profit after tax or earnings after tax, no problem, sir. Every one of you, right? Earnings after tax or profit after tax, these are nothing but the earnings available to shareholders. Earnings available to shareholders for distribution. Earnings available to shareholders for distribution. Clear. Now, when the profits after tax arrived, then the company will be having 2 options, either to declare the profits as dividends or to retain the profits, retained earnings, 2 options. So then the company has to make a decision between, should I declare the profits as dividends or should I retain the profits for my future investment purposes, retained earnings. Now, whatever the decision the company is going to take here, will that decision has any impact on market value of the firm? Now, the important question is whether the dividend decisions do have any impact on market value of the firm. One second. Okay, ma. Now the question comes into the picture is that whether the dividend decisions do have any impact on market value of the firm, right? So what is the decision we are going to make here? Should I declare the dividends or should I retain the profits? Right. Now this decision do have any impact on our market value of the firm? Some people said yes, dividend decisions will have an impact on market value of the firm, right? And they are belonging to relevance theories. And who are said yes, ma'am? Walter, Gordon, Graham and Dodd, and Lindner. These four people said that dividend decisions will have impact on market value of the firm. And some people said no, dividend decisions will not have any impact on market value of the firm. They are belonging to whom? Irrelevance theories. Irrelevance. They said like dividend decisions are irrelevant in determining the market value of the firm. And who suggested this? M&M approach, Modigliani and Miller approach. Even if you remember, sir, in the capital structure theories, he proved that financing decisions are irrelevant in determining the market value of the firm. In dividend decisions, he is going to prove that even the dividend decisions also are not having any impact on market value of the firm. Clear, sir? Right? So you can see here, introduction part. Dividend is that part of profit after tax which is distributed to the shareholders of the company. In other words, the profit earned by a company after paying taxes can be used for distribution of the dividends, or it can be retained as surplus for future growth. When it is distributed, it will be called as a dividend. When it is retained, it will be called as a retained earnings. The various models and dividend deals with, this is the theory of the chapter. This is a theorem of the chapter, whether the declaration of the dividend affects the market price or not. A single sentence, the entire chapter concept in a single sentence, whether the declaration of the dividend affects the market price or not. The dividend relevance theories argues that declaration of dividends affects the market price of a share. Here the dividends are said to be relevant in determining the market price, and the dividend irrelevance theories argues that declaration of dividend does not affect the market price. Here the dividends are said to be irrelevant in determining the market price. So there are two theories, relevant theories and irrelevant theories. Relevant theories saying that the dividend decisions will affect the share price and market value of the firm. They will have a direct impact on market price per share and market value of the firm. And irrelevant theories arguing that the dividend decisions will not affect share price and as well as market value of the firm. Clear, sir? Now let us see the one by one. First one, Walter's model. Look at the Walter's model. Relevance theories we are discussing in that. The first one, Walter's model. Walter's model belonging to relevance theories. And what is opinion of James Walter? Dividends are relevant in determining the market price per share. So whether you're declaring the dividends or not, this decision will have a direct bearing on your market price per share. Clear, sir? So profit after tax, you have two options. Option one, declaring the dividends, and option two, retaining the profits. Right, sir? See, when you retain the profits, see why the company is going to retain the profits, Amma? The simple answer is for reinvestment. When a company is retaining the profits, right, the objective behind that decision is to make reinvestment. It will not put the funds idle. It will retain the profits only for the purpose of reinvestment into the future projects. By reinvesting that retained earnings into the future products, the company is going to get what, Amma? The company is going to get required rate of return. So whenever you are investing into a particular project, what are you going to expect from the project? Some returns you are going to expect, no? Clear? R. And the option one, declaring the dividends. When company declare the dividends, right, sir, the shareholders will get the money in the form of dividends. As a shareholder, assume that I got a dividend of 1 lakh. Now what I'm going to do with this 1 lakh? I will reinvest. Yes or no? Now by reinvesting this 1 lakh dividends in the open market, I will get rate of return. From shareholders' point of view, it is rate of return. From company's point of view, it is cost of equity. Yes or no? Investors' expected rate of return is nothing but cost of equity from company point of view. Yes or no? So that's why you need to think, see, all these decisions, all these theories, we need to understand from company point of view. So from shareholder point of view, it is rate of return. From company point of view, it is cost of equity. Every one of you following us, right? No. So cost of equity from company point of view. Now the situation, if R is greater than KE, that means the company's required rate of return. Let us assume that the profit after tax 20 lakhs a month. The company opted for option 2, and it means the entire 20 lakhs was retained, and the company reinvested this 20 lakhs into some project X, where it is earning rate of return of some 18%, right? Assume that instead of retaining the profits, the company declared the entire 20 lakhs as dividends. Assume that. Now the shareholders got the money in the form of dividends, and shareholders made the reinvestment, and shareholders earning a rate of return of just 15%. Just 15%. And that means here the company's reinvestment is better than shareholders' reinvestment. Now the company will say, okay, shareholders, you have a very less rate of return now compared to my rate of return. I have some profitable projects in my hand, so I'm going to retain the profits. So when company's rate of return R is greater than shareholders' rate of return, it's better to maintain optimum payout ratio as 0. It's better for the company to retain entire profits. Don't declare any amount as dividends. అర్థమవుతుంది, ఎందుకంటే కంపెనీ దగ్గర మంచి ప్రాఫిటబుల్ ఆపర్చునిటీస్ ఉన్నాయమ్మా, rather than shareholders. Company have better investment opportunities compared to the shareholders investment opportunities. So the company, it's better for the company to retain the entire profits. Are you following or not, everyone? Right. Now if the situation is reverse, R is less than KE, see company earning only some 12% rate of return from its investments and shareholder having 15% rate of return. Now the company has to accept the truth, and the company has to declare the entire amounts as dividends. Right, sir? Okay, shareholder, you have the better investment opportunities than me, so I am here giving you the entire profits as dividends. I'm going to declare the entire profits as dividends. So when R is less than KE, when company is not having profitable opportunities in hand in future, it's better to declare the entire amounts as dividends. When R is less than KE, optimum payout ratio is 100%. When R equal to KE, indifference point. Whether the company retaining the profits or declaring the dividends, it doesn't have any bearing on market value of the company. Because when company is getting same 15% rate of return, shareholder earning same 15% rate of return, indifference amma. Declaring the profits as dividends or retaining the profits, it doesn't have any impact on market value of the firm. Clear? Next, formula. The formula suggested by the Walter here is D plus R divided by KE into E minus D whole divided by KE. Now first let us understand the terminology here. D stands for dividends per share. R stands for rate of return on investment, the company's rate of return on investments. KE, you know very well, cost of equity. And E stands for earnings per share, or you can take total earnings, no problem. And D stands for dividends per share, or the total dividends declared. Okay, now let us try to understand this formula. P0 is equal to, we know the formula, D plus R divided by KE into E minus D whole divided by KE. Now I'm going to divide this formula into two parts. First part, D divided by KE. Second part, R divided by KE into E minus D whole divided by KE. Any change in the formula, amma? No change. When you take in the KE common, then again you will get the same problem. D plus R divided by KE into E minus D whole divided by KE. Same formula you will get. Now why I have divided this formula like this? But this formula is what? P0, market price per share. Market price per share. Right? And when you're multiplying with the number of shares, you will get market value of the firm. Market price per share. Ekkada vinnattundi kada, theoretical market price, TMP. Theoretical market price. Whatever the market price we are finding out, it's nothing but theoretical market price. Now, what do you mean by the theoretical market price? Theoretical market price is nothing but sum of the present values of all the future earnings, future cash inflows, which are discounted at the investor's expected rate of return. That's the formula of TMP. Yes or no? Now, by investing into the equity shares of a company, by making investments into the equity shares of a company, what are the earnings that a shareholder is going to get? Answer: number one, dividends, and number two, appreciation in the market price. Clear? So the shareholder is going to get what? From year 1 to year infinity is going to get the dividends, and there is appreciation in the market price. These are the expectations of the shareholder from his investment. Clear? Now, the first part of the formula representing the sum of present values of year 1 to year infinity dividends. Year 1 to year infinity dividends. Do you remember the present value of perpetuity formula? What is the formula, sir? Annual cash inflows divided by rate of interest. The same formula. Annual cash inflows, every year I'm going to get dividends divided by rate of interest. From the company point of view, cost of equity. So this will give me the present value of year 1 to year infinity dividends. So the first part, present value, I've taken. Now the second part, appreciation in the market price. So now I would like to know the sum of present value of capital appreciation. Now how I am going to get this? Look at it. Look at this example, sir. My total earnings 10 lakhs, right? And out of the 10 lakhs, I have declared 4 lakhs as dividends. Now what are my retained earnings, Amma? 6 lakhs. Clear? So E minus D, 6 lakhs, 10 lakhs is my earnings, out of which 4 lakhs I have declared as dividends. 6 lakhs is my what? Retained earnings. And E minus D represent what, Amma? Retained earnings. E minus D representing retained earnings. Okay. Now, this retained earnings, what I'm going to do? I'm going to reinvest. At what rate of interest? At R rate of interest. Are you following, sir? E minus D representing my retained earnings. This retained earnings, I'm going to reinvest at R rate of return. Okay, now assume that the project is having a life of 10 years. Clear? Now, I would like to know the present value of all these future earnings. So that is why divided by KE. Divided by KE. Now, this representing what? The project's present value of future cash inflows. Clear? So when a company retain the earnings and that earnings are reinvested, now what is going to happen to the market value of that company? Market price of the particular company. When a company reinvested its all retained earnings successfully in a most highly profitable investment opportunity, the market price per share will get increased. Yes or no? So this is representing the present value of my capital appreciation. And like this, every year I will get dividends. Every year I will invest into the different projects. Now, when I would like to know the sum of the present value of all that project's cash inflows, I have to divide it by whole divided by. I have to again divide it with cost of equity again. Numerator giving me only one project's present value of cash inflows. Now, when I invested into the 10 different projects, now I would like to know the 10 different projects present value of future cash inflows. That is why I'm dividing again with cost of equity. So that's the meaning of the second part of the formula. My first part of the formula meaning entandi. The first part of the formula meaning is this: sum of present values of year 1 to year infinity dividends, for which I've used the present value of perpetuity formula. From year 1 to year infinity, I'm going to get the dividends, right? And in order to know the present value of all such future dividends, I would like to discount them at investors' expected rate of return. So divided by cost of equity. Investors' expected rate of return, nothing but from company point of view, cost of equity. That's the first part of the formula. Now the second part of the formula is what, sir? Sum of the present value of capital appreciation. Because when I'm finding out the theoretical market price is nothing but what, Amma? The sum of the present value of future cash inflows discounted at the expected rate of return. So I'm getting two cash inflows here, one dividends and number two appreciation in the capital market price. Clear, everyone? So that's the meaning of the formula. MP0 is equal to P0 is equal to D divided by KE, or else you can go for the single formula D plus R divided by KE into E minus D whole divided by KE. Clear, sir? Now by applying that formula, you need to find out the market price per share and as well as market value of the firm. That's Walter's model. Now moving on to the Gordon's model. Reliance theory law, the next model is Gordon's model. Model number 2, Gordon's model. Okay, ma. Now, Gordon's model also belonging to relevance theories. And opinion, dividends are relevant in determining the market value of the company. So whatever the dividend decisions you are going to get, it will have a direct bearing on market price per share of the company and so as on market value of the company. Clear? Now how he is going to explain his logic theory. Now again start with the profit after tax. So when a company having the profit after tax after paying all its fixed financial commitments and as well as all its statutory commitments, then it will be left with the profit after tax. Then it will be having two options. Either that profits after tax can be declared as dividends or can be retained as retained earnings. Now first look at the second option. Second option, Chornamma, when the company is retained the earnings, what is the advantage to the company? The company's growth will be increased because these retained earnings will be reinvested into the projects, and from that reinvestment the company will get more returns. And when company is earning more returns, the market price per share of the company increases. The growth will be increases. Growth will be increases. Yes or no? Now, but what is the disadvantage? When company retained the profits, then the risk perception levels of equity shareholders increases. Risk perception levels of equity shareholders increases. Risk perception levels of equity shareholders increases. Means what? Sir, when company retain the profits, the shareholder thinks like, okay, company retaining the profits means the company having profitable investment opportunities in hand. So that means, yes, the company is going to get more returns. And his expectations towards the dividends increases. His expectations towards the returns increases. Are you following or not? Right? So when his expectations towards the returns increases, means from company point of view, cost of equity increases. Cost of equity increases. Yes or no? That's the disadvantage. When it comes to the first option, declaring the dividends, what are the advantage and disadvantage? Simple, Amma. You just simply reverse the advantage and disadvantage of retained earnings. See, the advantage of retained earnings becomes a disadvantage here. Ante, when a company declaring the entire profits as dividends, that means here the retained earnings are zero. The retained earnings are zero. The company is not having any surplus profits with it for future reinvestments. See, when it is not having any surplus funds, how can the company will make investments into the future projects? You may ask me, sir, why not the company go for a bank loan? Why not the company issue fresh issue of equity shares? Why not the company go for issuance of the debentures? See, first of all, whenever you want to make the future investment, now everyone first look for what is a proprietary investment. What is a share of the proprietor in that new investment? At least the proprietor should make investment of 25% to 30% into that project. Then everyone will come forward and will make investment into that particular project. Even if you go to the banker first will ask you a question. Babu, what is your personal investment into this project? If you said, sir, I don't have any surplus funds with me, right? So give me the entire amount as loan. I will go and do the investment. The banker will not give you loan. You must have some personal investment. Then only you will be having some personal care and interest in that project. Yes or no? Right, sir? So that is why. So when you're not having any surplus funds, then you don't make any investments into future. The growth of the company will get decreases. Clear? Next, the disadvantage of the retained earnings becomes advantage here. When the company declaring the dividends, then the risk perception levels of the equity shareholders decreases because they are getting profits now. They are getting profits now. Yes or no? See, future returns are uncertain. Present dividends are certain. Uncertainty gives rise to risk. But when company declaring the entire profits as dividends now, the shareholder is going to see some money in his pocket. So his risk perception levels decreases. Are you following now? Now, sir, what is the optimum dividend payout ratio here? Same amount, just like Walter's model, when R is greater than KE, when company having the better investment opportunities than shareholders, the optimum payout ratio should be 0. That means the company has to retain entire profits. The company has to maintain what amount? 100% retention ratio. The company has to maintain 100% retention ratio. Every one of you. Okay, ma'am. Now, when R is less than KE, when company is not having better investment opportunities than the shareholders, let the shareholders do their own business. Let us declare the entire amount of the dividend profits as dividends. Let the shareholder make his own reinvestments. So maintain 100% dividend payout ratio. Okay, now. And when R is equal to KE, indifference point. Okay, sir. Now look at the formula given by the Gordon. Formula is current market price P0 is equal to E into 1 minus B whole divided by KE minus BR. Now let us try to understand the terminology used, where E is equal to EPS, earnings per share, or you can take total earnings. When you're finding out the market price per share, E stands for EPS. When you're finding out the market value of the firm as a whole, E stands for total earnings. Depends upon, you have to take them up. Now B stands for retention ratio. B stands for retention ratio. KE, cost of equity, you know very well. R is the rate of return on reinvestments by the company. And we know that B into R is equal to growth rate. This formula we have learned in cost of equity. Gurtundama? B into R. G is equal to B into R. You have learned the formula in cost of capital. Clear? So KE minus BR, instead of that, you can also write KE minus G. Okay. Now look at the and let us try to understand the formula meaning. P naught is equal to E into 1 minus B divided by KE minus BR. And the B and range of kundam, sir, retention ratio. B stands for what? Retention ratio. Yes or no? Now, let us assume that the retention ratio is some 70%. 1 minus B and entama 1 minus 0.7. That is equal to 0.3 you are getting. See, when 70% is the retention ratio, what is the other 30%? Payout ratio. As simple as that. Nikachna 100 rupees low. Out of 100 rupees you got profits after tax. You are retaining 70 rupees as a retained earnings. Now, what are you going to do with the remaining 30 rupees? Remaining 30 rupees you are declaring. Declaring as what? Dividends. So 70 rupees retained earnings, 30 rupees dividends, 70% retention ratio. That means the remaining 30% what amma? Dividends payout ratio. Ante this 1 minus B representing what, sir? 1 minus B representing dividends payout ratio. Dividends payout ratio. Every one of you following now? What is the dividends payout ratio amma here? 30%. When your total earnings is equal to 100 rupees, total earnings is equal to 100 rupees. Now E into 30%. 1 minus B under dividend payout ratio amma. 1 minus B under dividends payout ratio. Right. Your total earnings 100 rupees into dividend payout ratio 30%, and you will get what amount? 30 rupees. What is this 30 rupees? Nothing but dividends per share. And the numerator representing what? E into dividends payout ratio. E into dividend payout ratio, nothing but DPS. Dividends per share. And the numerator, this entire numerator representing what amount? Dividends per share. Divided by KE, cost of equity, minus G. Gurtunda? DPS 1 divided by KE minus G. One formula we have learned. P0 is equal to, this formula we have learned in constant growth in dividends. Cost of equity, cost of capital chapter low, we have learned the cost of equity. In the cost of equity, we have seen some models like, dividends price approach, earnings price approach, CAPM approach, capital gains yield approach, earnings yield approach. There in dividends price approach, we have learned non-constant growth in dividends, constant growth in dividends, no growth in dividends. Constant growth in dividends, what is the formula you have learned? DPS 1 divided by MP0 plus G. And when you want to know about the MP0, DPS 1 divided by KE minus G, the same formula, sir, we are using. The same formula we are using. Constant growth in dividends, the original formula, cost of equity is equal to DPS 1 divided by MP0 plus G. And when you want to know about the MP0, MP0 will come here. Now plus G, it comes minus G. So MP0 is equal to DPS 1 divided by KE minus G. So whatever the formula suggested by the Gordon here, is nothing but constant growth in dividends formula. Is nothing but constant growth in dividends formula. P naught is equal to DPS1 divided by KE minus G. Clear, sir? Every one of you. So that's about Gordon's model. Now moving on to next model, Graham and Dodd approach. Model number 3, Graham and Dodd approach. Walter's model we have done. Gordon's model also we have done. Graham and Dodd approach. Now what is this approach about? Even Graham and Dodd also belonging to same theorem, relevance theories. Relevance theories. Even Graham and Dodd also opines the dividends are relevant in determining the market value of the company. But he explained his logics, his theorem in a different way. So as per the Graham and Dodd approach, he said the shareholders prefers the present dividends over the future capital gains. Right, ma? Shareholder always prefers the present dividends rather than future capital gains. Future capital gains means when company retain the profits. For what purposes the company is retaining the profits? For reinvestments. For reinvestment. From the reinvestment, what the company is going to get? The company is going to get the more returns. The returns of the company is going to be increased and it will have a positive impact on market price per share. Suppose that you buy these company shares 100 rupees per share. After 2 years, the company share price increases to 150 per share. Now we have sold the shares. At 100 rupees you purchased, at 150 you have sold. And how much capital gains you are getting? 50 rupees capital gain you are getting. But when you are getting immediately? No, after 2 years you are getting. After 2 years you are getting. Yes or no? So this is a future capital gains. 50 rupees is your future capital gain. But the shareholder prefers the present dividends. Present day the company in cheppindante, if you want, I will declare the entire profits as dividends and you will get dividends immediately. Suppose that you are getting a 20 rupees per share as a dividend. So the shareholder prefers the present 20 rupees dividends rather than future 50 rupees capital gains. Adentaya, you can wait for 2 years, you will get 50 rupees returns. If you want, as of now, you will get only 20 rupees returns. But the shareholder prefers the present dividends only because future by definition is uncertain. He feels the future by definition uncertain. Okay, you are saying like wait for 2 years. After 2 years, you will get a capital gain of 50 rupees. But what is the guarantee? Whatever the projects it has reinvested, the project may go failure. The company may face losses. The company's market price per share may fall down. Even I am not able to get my actual investment of 100 rupees. Who knows? Anything can happen in the future. See, before COVID-19, after COVID-19, the present day scenario, we are discussing like before COVID-19, after COVID-19. Who expected in the year 2019? Who expected the COVID? No one. What about those people who made investments in 2009 for a long-term perspective? They are all now facing losses. Yes or no? So that's why future by definition is uncertain. So that's why the present dividends are more certain than future capital gains. The shareholders will give the more weightage to the present dividends rather than future capital gains. Every one of you. So that's why Gordon suggested only one thing. The optimum payout ratio is always 100%. You forget about R greater than KE, R less than KE, you just ignore it. Gordon suggested only one thing. Whatever the profits you got, declare them as dividends immediately. Don't retain, not even a single rupee you retain as profit. Optimum payout ratio as per the Graham and Dodd is 100% payout ratio. So higher the dividend payout ratio, higher will be the market price per share. Lower the dividends payout ratio, lower will be the market price per share. Okay, now he also suggested a formula, sir. Current market price P0 is equal to M into D plus E divided by 3. M stands for a multiplier, D is equal to dividends per share, E is equal to earnings per share. Right. But actually, Graham and Dodd approach have faced many controversies, right? Because Graham and Dodd explain his theory, but there is no logic. Like he while he's finding out the market price, he is multiplying this factor with a multiplier. And how did he arrive at this multiplier? There is no logic, no theorem. Are you following, sir? A multiplier the mana multiply chestunnamo d plus e divided by 3, but there is no logic behind how to arrive at this multiplier. Are you following, sir? Every one of you. And when it comes to the shareholders point of view, not all the shareholders are risk averse. Some people are risk takers. Some shareholders are risk takers. Okay, they will prefer the future capital gains rather than present dividends. It's your opinion, sir. It's Graham Dodd's opinion that shareholders prefers present dividends. But being I'm a shareholder, I might think about my future capital gains rather than present dividends. So there is no logic. Are you following, sir? So look at here. What the Graham and Dodd said, his propositions. Investors assign more weights to the present dividends than retained earnings. Clear. Investors use a high discount rate for distant dividends, that is capital gains, than near dividends, because nearby dividends are more certain than distant dividends. Clear. And criticisms. The weightage 4 times and 1 time are derived subjectively without any empirical analysis. A weights ela assign chesadu, a multiplier ela calculation chesadu. There is no logic. Are you following, sir? That's about the Graham and Dodd model, sir. And Lindner's model, I'm skipping because that's a final level concept. You didn't get a question from Lindner's model. You need not worry. I've already mentioned the most important models from this chapter: Walter's model, Gordon's model, and Modigliani and Miller approach. That's it. You don't even get a question from that Graham and Dodd approach. Are you following now? Because you can see the answer, Graham and Dodd approach, very small answer. This answer won't give you for 5 marks. Don't expect for 5 marks for this kind of problems. Okay, now coming to the last model, Modigliani and Miller approach. And he is belonging to what? Irrelevant theories. Modigliani and Miller is always belonging to irrelevant theories. If you remember, in cost of capital also, sorry, capital structure also, we have learned capital structure theories. There also we have seen relevant theories and irrelevant theories. Relevant theories suggested by net income approach, traditional approach. Irrelevant theories suggested by NOI, net operating income approach, and M&M approach. Do you remember? Capital structure theories. M&M approach belonging to irrelevant theories. And here also in dividend decisions, M&M also again suggested irrelevant theories. Market value of the firm remains constant irrespective of your dividend decisions. See, whether you are declaring the dividends or not, whether you're retaining the profits or not, these decisions will not have any impact on your market value of the firm. He proved in capital structure theories, financing decisions are irrelevant. He proved that market value of the firm remains to be constant irrespective of changes in capital structure. See, increasing the equity share capital by decreasing debt capital, or decreasing equity share capital by increasing debt capital, financing decisions, these are irrelevant in market value of the determining the market value of the firm. In determining the market value of the firm. Are you following, sir? Because financing decisions are your internal matters. Ma equity in తగ్గించి debt పెంచడం వలనో, equity in పెంచేసి debt తగ్గించడం వలనో, market value of the firm అనేది మారదు. Market value of the firm doesn't change with your debt equity proportions. In order to increase your market value of the firm, you have to accept the future profitable opportunities, profitable projects. Only the investment decisions affects your market value of the firm, neither the dividend decisions. Neither the dividend decisions. By declaring the dividends, you cannot increase your market value of the firm. By not declaring the dividends, you cannot decrease your market value of the firm. Ma dividend declare chese market value peruguddano, declare cheyakapothe market value tagguddano, all this foolishness. Whether you declare the dividends or not, this decision doesn't affect your market value of the firm. Are you following, sir? Logically, this is correct. Your market value will be changes only with your investment decisions. As long as you are making investments into good return projects, your market value of the firm is going to positively affected, positively changes, increased. As long as you're not making investment into profitable projects, your market value decreased. Only the investment decisions will have a direct bearing on your market value of the firm. Neither the financing decisions nor the dividend decisions. Clear? And that's what going to be proved by the Modigliani and Miller approach in this model. Now look at here, ma. The current market price per share. Just a second, sir. So he has given the formula like this: current market price P0 is equal to D1 plus P1 divided by 1 plus KE. Right? D1, what is D1? Dividends price per share at the end of the first year. P1 market price per share at the end of the first year divided by 1 plus KE. Now let us try to understand this formula. Step number 1, multiply the formula with n both the sides. Right? So that means multiply the formula with both the sides. Like, so that means NP0 is equal to ND1 plus NP1 divided by 1 plus KE divided by 1 plus KE. Okay, sir. Now NP0 is equal to ND1 plus NP1 as it is I'm written. Now I have added this plus MP1 minus MP1. I've added plus MP1 minus MP1. What is the ultimate impact? Plus minus cancel అయిపోతుంది. It will be 0. The impact will be 0. The ultimate formula remains to be same. ND1 plus NP1 divided by 1 plus KE. Okay, now NP0 is equal to P1. P1 common the take the P1 as common. Now what will be the formula? P1 into N plus M. N plus M, like you'll get like this. P1 common, you say N plus N. I've taken the P1 as common. N plus M plus ND1 plus ND1. What is missing here, ma? What is missing here? I'm missing here is MP1. Now I would like to write the formula of MP1 here. Now, MP1, we have a separate formula. MP1 is equal to I minus E minus ND1. I minus E minus ND1. Now what do you mean by it? Now I is equal to, first of all, M is equal to number of new equity shares to be issued. Number of new equity shares to be issued. P1 is equal to market price per share at the end of the year 1. Now I is equal to investment required, total investment required. E is equal to total earnings available. N is equal to number of equity shares, and D1 is equal to dividends payable at the end of the year 1. Now let us try to understand with the help of example. Total earnings available 10 lakhs amma. Total earnings available 10 lakhs minus dividends paid 4 lakhs. So now earnings available for investment in the 6 lakhs. Earnings available for investment 6 lakhs. Okay, now, right? Now, investment required for project X 15 lakhs. The investment required 15 lakhs. So investment required 15 lakhs, right? 15 lakhs. Out of which, what is the earnings available with you? The earnings available with you is 6 lakhs amount. Right? So here investment required 15 lakhs minus total earnings available 10 lakhs, out of which you have declared a dividend of 4 lakhs. 4 lakhs. Okay, now see ND1 representing what, sir? ND1 representing dividends paid. Dividends paid. So from the total earnings 10 lakhs available, 4 lakhs you have paid dividends. Ante E minus ND1 ultimately representing what, sir? This is ultimately representing your retained earnings. Total funds available 10 lakhs minus 4 lakhs your dividends paid. So 6 lakhs is your retained earnings. So investment required 15 lakhs, out of which 6 lakhs you are going to fund it through retained earnings. 15 lakhs make funds kavalama. 15 lakhs low, 6 lakhs you are funding through retained earnings. Ante the funds to be raised by issuing the new equity shares in the 9 lakhs. So this entire formula is representing what? Funds to be raised by issuing new equity shares. So we are issuing M number of equity shares at P1 price to get these funds. We are issuing M number of equity shares. M stands for new equity shares. New equity shares. Are you following, sir? Everyone. So I'm issuing M number of equity shares for at P1 price. At P1 price, I'm going to issue for funds to be procured. for the reinvestment. So the total investment required, I'm repeating once again, 15 lakhs I need investments. Okay. And I have the funds available with me, 10 lakhs. Out of which 4 lakhs I have declared as dividends. Ante retained earnings available in the 6 lakhs. So 15 lakhs funds are required, out of which I already have 6 lakhs. Ante means what, amma? 9 lakhs is the total funds raised. And how I'm going to raise? I'm going to issue M number of equity shares at P1 price. So that's the formula meaning. MP1 is nothing but the number of new equity shares we are issuing at P1 price for the funds to be raised for the investment. Now this formula I am going to replace here. In the place of MP1, I am going to replace this formula. Ikkada replace chestunnanamma M place lo. MP1 formula em nechukunnam manam? I minus E minus ND1. That's the formula we have learned. Now MP1 place lo I am representing this formula. Plus I will become minus I here. Plus I becomes minus I here, right? Because in this place of MP1 I am representing minus MP1 kada, minus symbol undi kada. So minus into plus I minus into minus E, minus into minus E plus E, right? Ikkada bracket symbol undi kadamma, idi manaki directly minus symbol ki velipotundamma, minus ND1, minus ND1. Clear everyone? Because ఇప్పుడు ఈ ఫార్ములాని మీరు మల్టిప్లై చేస్తే I మైనస్ E మైనస్ ఇంటూ మైనస్ ఏమవుతుందమ్మా? ప్లస్ ND1 అవుతుంది. ఎస్ ఆర్ నో ఎవ్రీవన్? ప్లస్ ND1 అవుతుంది. క్లియర్? ఇప్పుడు ఇక్కడ నేను ఇది మైనస్ MP1 కదా, మైనస్ MP1 కదా, అంటే ఇప్పుడు మైనస్ ఇంటూ ప్లస్ I మైనస్ ఇంటూ మైనస్ E ప్లస్ E మైనస్ ఇంటూ ప్లస్ ND1 మైనస్ ND1 హోల్ డివైడెడ్ బై 1 ప్లస్ KE. ఓకేనా? నా ఇప్పుడు చెక్ చేయండి. The formula like P1 into N plus M plus ND1 minus I plus E, minus ND1 minus ND1 whole divided by 1 plus KE. ఇది కదా ఫార్ములా. ఇప్పుడు ప్లస్ ND1 మైనస్ ND1 క్యాన్సిల్ అయిపోతుందమ్మా. Now what is ultimate formula? NP0 is equal to 5 minutes. P1 into N plus M minus I plus E whole divided by 1 plus KE. Okay now, every one of you. Clear? Right, sir. So by applying this formula, you need to find out the market price per share of the company, sir. Right? And we have one more formula. MP1 ippude formula nechukunnanga, sir. I minus E minus ND1. Now, when I would like to know the M, the total number of new equity shares to be raised, into P1 will come this side now, divided by P1. So M, the total number of new equity shares to be issued is equal to I minus E minus ND1 whole divided by P1. Clear, everyone? So that's it, sir. With that, Modigliani and Miller approach also completed. Just a second, sir. With that, Modigliani and Miller approach also completed, sir. You can just go through the problems, and if you come across any doubts by solving the problems, at the time of solving the problems, you can directly text me in my WhatsApp number or Telegram, or you can make a mail to me, right? casamashwa@gmail.com is my Gmail ID. You have all the details at the first page of the textbook, right? Let me see whether it is available or not. Index page, did I give it or not? I don't think so. Okay, you can take it down. My mobile number, you know very well. 9948972752 is my mobile number, right? You can either WhatsApp or Telegram, and my mail ID casamashwa@gmail.com. This is my mail ID, sir. Okay now. So either you can mail your doubts, absolutely no problem. Clear, every one of you? So With this, we have completed the total 9 chapters from the financial management. Only one chapter I left with, that is the ratios analysis. And even I have explained the reason behind lefting that chapter in the last class itself. Clear, sir? So I wish you a very all the best for your May 2022 examinations, and as well as those who are going to write the November 2022 exams. For you also, very all the best, ma. Would like to see you and would love to see you again in CF final level. Okay, mom. Right? So all the best, sir. So children, have a good day and stay home and stay safe. Thank you, sir.